Hello, my dear CMA students. I hope you are all doing good. I hope your preparations are going well. Exams are nearing, and you have a very short period. Around 2 weeks' time is there for you for your preparation, and after that, your examination will start. I hope all your studies are going on good. So here we are with the marathon for direct taxes. We will be going live. So you are watching me live on YouTube. So any questions if you have, you can ask me. I'll definitely take those questions and reply to those questions. Okay, so that being said, let me not waste your time because you have a very less time and the time which you have is very precious right now. So let us directly start with the discussion on CMA Inter. Direct taxes will start today. So as you all know, CMA Inter has two groups, group 1, group 2. In group 1, you have a paper called as paper number 7. In paper number 7, which is of 100 marks, this paper number 7 is for 100 marks. This 100 marks is divided into two categories. One is called as direct taxes, another one is called as indirect taxes, wherein direct taxes covers your majorly direct taxes covers your income tax, and indirect taxes covers your goods and service tax.
Guys, let's not panic. I have a solution.
Okay. Indirect taxes covers what, sir? Indirect taxes covers your GST as well as customs. So what is the weightage of the marks in the examination, sir? Direct taxes will be for 50 marks. Indirect taxes, of course, will be for 50 marks, another 50 marks, wherein your GST will be for 40 marks and customs will be for 10 marks. So this is how your marks is divided into this category. So 50 marks, 40 and 10 marks. Now, sir, what is our question paper pattern? One of the easiest paper is your paper number 7 taxation, wherein you can score more than 80 easily. See, how is your question paper pattern? If you see your question paper is divided into two categories. One is your MCQ based questions and another is your descriptive questions. Now, MCQ based questions, you will have totally 15 questions of 2 marks each. How many questions, sir? 15 questions you will have of how many marks? 2 marks each. So total MCQ questions which are there is of 30 marks. Normally this MCQ questions which are there, normally what happens in MCQ is you will get 7 marks in the sense 7 questions I'll write. 7 questions from direct taxes. Then 8 questions from indirect taxes. Normally it will be like that. 7 questions from direct taxes, 8 questions from indirect taxes. So total to 50. Now this 8 can have 6 questions from GST, 2 questions from customs, or it can have 7 plus 1. It can be in any format. Okay, normally we have seen it is 6 plus 2. 6 questions will be from GST and 2 questions will be from your customs law. And your descriptive paper which is there is for your balance 70 marks. And very simple and very easy. You will be having lot of options over here. See, wherein you have to answer. So each question will be for 14 marks on an average, 14 marks. Okay, and each question which is there will have 2 sub questions in it. Meaning, I'll just show you the maybe we'll check one of the mock test paper and I'll just show it over there also. So descriptive paper or practical paper which is there, it will have the questions will be divided. There will be totally 7 questions which they will be giving you. Out of that 7 questions, you are supposed to answer only 5 questions. And each question which is there, question 1, question 2, question 3, each question will have 2 subparts and each question will be for 14 marks and each sub question will be for 7 marks. Okay, wherein if you see, your direct tax part of the question paper will normally be, meaning 90% of the time the direct tax or 90% of the question or 90% of the marks which you get from direct taxes, that will be practical questions, meaning they will ask you to find something, compute income. They'll ask you to compute the income under a particular head, compute the total income, etc. And your indirect taxes which is there, your indirect taxes is actually divided into 3 categories. 30% of your indirect taxes will be theory, pure theory, nothing else, pure theory. It can be 40% also. Then 30% of your indirect taxes will be case study based question. Case study based question means what, sir? They'll give a story to you, they'll give a case to you. Based on that case, you should apply the provisions of the law, and tell the answers. And balance 40% which is there, no, that last 40% will be practical questions. They'll ask you to compute the total ITC available, GST liability, compute the custom duty which you have to pay, or assessable value under customs law, etc. So that type of question will be asked to you. So basically, this is your question paper pattern. This is how your question paper will look. Of course, this basic information is something which you already know, but I thought let me just cover this also. Let me just take your CMA Inter model question paper for June 2026 examination. We'll take one of the question paper just to check how it actually is. But I hope your preparations are going on good, because at this moment you just have to concentrate more on revision than studying anything new. And I hope the lecture which you are watching right now will help you revise that. And of course, if you have not seen your website has been completely changed. They have improved your website a lot. When I saw the website, I also liked it. So direct and indirect tax question paper. So if you see, this is how your question paper looks like. So full marks will be around for 100 marks. Then there will be 15 question of 2 marks is 30 marks. There will be MCQ. Each MCQ will be for 2 marks. Sir, what if I give the wrong answer for MCQ? Will they cut the marks, sir? Answer is absolutely no. They are not going to cut any marks for you if you give a wrong answer. So there is no negative marking. Then you have MCQs. After that, you have section B. Section B is your practical questions, wherein you are supposed to answer any 5 questions, and each question will be for 14 marks. There will be totally 7 questions. See, answer any 5 questions out of 7 questions which are given to you. So one of the easiest to score. So first 4 questions will be from your income tax, and then 3 questions will be from your indirect taxes. Now each question, as I told you, will have 2 subparts. Say question number 2, it has 2A, which is your 2A residential status question, and 2B is your salary related question. Similarly, if you see house property and business income question, then similarly if you see it is capital gain and other sources question. So one of the easiest to score. Then you have your set off and carry forward, then you have your total income question, etc. So each question will have 2 subparts. Then you have your indirect taxes, which is starting from here. So I hope you have fairly understood how your question paper pattern will be there. What is that thing which is going to come in the examination, etc. We'll discuss all those things over a period of time as and when we are discussing. But just to give a fair idea to you at the beginning only, okay. CMA Inter study material. Just to give a fair idea, each and every chapter which you have will come for 7 marks. I'll just give the fair idea to you at the beginning only. So because some student may skip the beginning part, or sometimes they may do is the in between part they may skip, and the beginning part they may not skip. They can watch the beginning part, but in between they may skip some parts. And in between, if I'm telling something and if you miss out that part, that will not be helpful to you. So we'll see your what are the different topics or what are the different chapters which you have. From each and every chapter, question will come or not come. I'll just tell you right now, based on the fair idea which I have from the previous examinations questions which has been asked in the examination. So in your direct taxes, so you have basic concepts, then you have your residential status and scope of total income. One question will come from your residential status and scope of total income. Then you have heads of income. Each head of income will come for 7 marks. Each head of income, 5 heads of income are there. Each head of income will come for how many marks, sir? 7 marks. Each head of income will come. Then you have your set off carry forward, clubbing of income. In that set off and carry forward, one question will be coming. Then you have deductions. Then you have your total income, computation of total income. In that you'll get a question from computation of total income. Deduction, there may not be a separate straight away question from deductions chapter, but from deductions, what they can ask you in the examination is the questions which you are doing. Let us say you are doing a question on total income. The total income question may have one or two adjustment with respect to deductions. Correct? Clubbing of income also, there may not be a separate question directly on clubbing of income, but they may merge the clubbing of income with your, let us say, income from other sources question or your total income question. Then you have some procedural aspects under direct taxes, from which you will get theory question for 7 marks. If you get, okay, one question will come from there, a theory question for 7 marks. Then comes your indirect taxes. Okay, this is taking time. Okay, anyways, then comes your indirect taxes. Indirect taxes is divided into 3 parts. First is your basic concept, one compulsory question for 7 marks. Then is your main GST part. From main GST part also, okay, this is not opening. Customs will come, one question will always come from your valuation of customs, that will come for 7 marks. And in between we have GST. Okay, in between we have GST. So in GST, what do you have? In GST, you have value of supply, you have place of supply, one question will come, and input tax credit and computation of tax liability questions will come. Okay, anyways, let me start with your direct taxes marathon first. Okay, so this will be quick. Please note, I believe those who are watching this marathon, I believe that you have already gone through the entire syllabus, and now we are just going through or recapping all the provisions which you have studied. What is tax? Tax is one of the important. See, what happens is everyone needs money, correct? You need money for your studies, to stay, to eat, etc. Just like that, government also needs money to take care of various different activities. Government is constructing roads, bridge, highway projects are undertaken by them. They are spending money for defense. They are spending money for building new infrastructure, etc. So government needs money. That money which government needs, government is collecting that money from us. And government is collecting that money from us in the form of tax. So what is tax, sir? Tax is one of the important source of revenue to the government. It is one of the important source of revenue to the government. Now this tax can be divided into 2 types. One is called as direct taxes. Another one is called as indirect taxes. So direct taxes means what, sir? Direct tax means that type of tax where the incidence as well as impact of the tax is on same person. Meaning, the person who is earning the income and the person who is paying the taxes are same. That is direct taxes. Incidence and impact is on same person. Whereas indirect tax is a type of tax wherein the incidence and impact is on 2 different persons. What do you mean by this, sir? The person who is doing a particular activity and the person who pays the tax is 2 different persons. For example, direct taxes example is income tax. So I am a person who is earning an income of 10 lakh rupees. On that, let us say the tax rate is 10%. Now 10 lakh rupees is an income which is earned by me. On that, tax rate is 10%. Therefore, I should pay 10% of 10 lakh, 1 lakh rupees as tax. This 1 lakh rupees of tax which is required to be paid by me, I will have to pay to the government. So who earned this 10 lakh rupees? I earned this 10 lakh rupees. Who is going to pay the tax on this 10 lakh rupees? I am going to pay the tax on this 10 lakh rupees. Correct? So this is what, sir? This is the direct taxes. Incidence and impact is on same person. I earned the income, I am paying the taxes. Indirect taxes. Indirect tax is a type of tax wherein the incidence and impact is on 2 different persons. I am running a business in the name of Priya Sarees. I have a saree business, Priya Sarees. I sold the saree to you. You came to Priya Sarees. I sold the saree to you. You purchased the saree from me. So when you purchase the saree, lawmaker says GST is applicable on this particular transaction. So I will collect the GST from you and I'll pay that GST to government. Now what happened over here? When I sold the saree, the tax incidence was created. When I sold the saree, government told me, Dilip, you have to pay the taxes. But am I paying the taxes from my own pocket? Answer is no. I am collecting the tax from you and paying it to the government. So what is happening over here? Incidence and impact is on 2 separate person or 2 different person. So that is indirect taxes. So in simple words, in case of direct taxes, I cannot shift my burden of paying the tax to someone. Whereas in case of indirect taxes, I am shifting my burden of paying taxes to someone. So direct taxes, tax is directly paid to the government. It is a tax on income, whereas indirect taxes is not on income, it is on your goods and services. Direct taxes are progressive in nature. What do you mean by this, sir? As and when your income is increasing, the amount of tax which you pay also increases. Whereas indirect taxes are regressive in nature. So it does not matter whether a person is a high earner or a less earner. So the amount of tax which he has to pay will be same, because indirect taxes is regressive. For example, so if I'm earning more, I'll have to pay more income tax. If I'm earning less, I'll have to pay less income tax. But if I go and purchase a Parle-G biscuit, if a beggar goes and purchases Parle-G biscuit, if Mukesh Ambani goes and purchases Parle-G biscuit, irrespective of what it is, the amount of tax which you have to pay will remain same. Now, some constitutional provision with respect to taxation. So what is our Constitution of India talking about with respect to tax? So we have Article 265, which says no tax can be levied or collected unless there is an authority of law. So if you want to levy any tax in India, if you want to collect any tax in India, you should have the permission, you should have the authority. And who will give the permission to you? The permission will be given by the Constitution. So if the Constitution has a provision with respect to collection of a tax, then only the tax can be levied and collected. Then we have an article called as Article 245. Article 245 says no, a central government has the power to make the law for whole or any part of India, and the state government has the power to make law for whole or any part of that particular state. So if you want to make a law for entire India, who has the power to make the law for entire India? Central government or the parliament. And if you want to make law for any part of India, then also the power is with central government. Similarly, state government has the power to make law for that particular state. We have an article called as Article 246. Article 246 has a schedule called as Schedule number 7. In that Schedule number 7, they have given 3 lists to us: Union list, state list, and concurrent list. Union list is also called as List 1. State list is also called as List 2, and concurrent list is also called as List 3. Now, basically, this union list, state list, and concurrent list, which is there, they all are talking about different things which can be undertaken by central government, state government, and jointly by central government and state government. So, union list is a list which contains the matters with respect to which only central government has the exclusive power to make the law. So what is union list containing, sir? Union list contains different things with respect to which who can make the law? Only the central government has the exclusive power to make the law. In union list, there is an entry called as entry number 82. Entry number 82 of union list talks about taxes on income excluding agriculture income. What is entry number 82 telling? That the central government has the power to collect taxes on income. Central government has the power to collect taxes on income, except which income, sir? Agricultural income. State list contains different matters with respect to which only the state government can make the law. And sir, on agriculture income tax cannot be collected only. No, on agriculture income tax can be collected, but central government does not have the power to collect taxes. Central government has the power to collect taxes on all types of income except agriculture income. So on agriculture income, the power has been given to state government. So there is an entry called as entry 46 in the state list, which talks about the taxes which can be collected by whom, sir? The taxes which can be the central government can collect the state government can collect taxes on agriculture income. And concurrent list does not talk about any tax law. It talks only about some general laws which are required for India. And whatever is there in this concurrent list with respect to that, if a law is required to be made in India, both central government and state government should jointly come and make that law. Now, since we are starting with income tax or direct taxes, so we'll see first point, the sources of income tax law. So what is that thing which I have to study under income tax law? Should I study only the Income Tax Act or should I study the income tax rules, etc.? Now, please note, those students who are writing the examination in June 26 and December 26, for you, the old income tax law is applicable. For you, the old Income Tax Act, that is Income Tax Act 1961 is applicable. Okay, please be very careful with respect to this. Many students keep on sending message telling, sir, that Income Tax Act 2025, new income tax has come. Is it applicable to me for my examination? Those who are writing in June and December 26 for you, the old income tax law will apply. Those who are going to write the examination from June 27 and onwards, who are going to write examination when, sir? June 27 and onwards, for you, the new income tax law will be applicable. Okay. So sources of income tax law. So first is your Income Tax Act. So what do I have to study, sir? First thing which you have to study is your Income Tax Act, and major provisions which you are going to discuss is with respect to what, sir? Income Tax Act itself. So Income Tax Act gives you the main provisions of the law. What you are supposed to do. You are supposed to, if you are earning income, you are supposed to pay the taxes. Who is telling? Income Tax Act is telling. How should I compute the taxes? How many heads of income are there? How many different types of income a person can earn, etc. All those are given in Income Tax Act. So it talks about the main provisions of the law. It will include sections, subsections, etc. Then Income Tax Rules 1962. This is supporting the main law. So main law is going to tell you something. To support that, we have what, sir? The Income Tax Rule. Income Tax Rules 1962 is supporting to the main law. Then I have Finance Act. Finance Act, every year, the Finance Minister of India, on 1st of February, they will conduct the budget. So in that budget, no, they introduce, or the Finance Minister is introducing a bill called as Finance Bill. Now this Finance Bill, once it receives the signature from the President of India, it becomes the Finance Act. Correct? So in the budget is presented in the Parliament, that is Lok Sabha and Rajya Sabha, and once President signs it, it becomes the Finance Act. So every year, because the budget is coming, every year you have to study the new Finance Act which will be coming. So for your examination, the Finance Act which is applicable is what, sir? Finance Act 2025. And notifications and circulars also you are supposed to study, and legal decisions are case law. Here and there at intermediate level, normally they don't test you based on the case laws, etc. But still you will find some case laws in your institute material. Only one case law is something which you have to know. All other case laws you can just ignore. We'll study. We'll see which is that case law which you are supposed to learn, etc. Then what do you mean by income? See, income in simple words, income means what's a receipt. You are receiving something, that means it is an income. But does that mean that all the receipts are income? No, all the receipts are not treated as income. Now these receipts which are there are divided into two categories. One is called as capital receipts, another is called as revenue receipts. Capital receipts are normally not considered as your income. Capital receipts are normally not considered as your income unless it is specifically included. Whereas revenue receipts are normally considered as your income unless they are specifically excluded. So something which you are receiving on recurring basis, that is your income. Something which you are receiving on recurring basis, that is normally treated as income under income tax law. But something which you receive in lump sum occasionally, that is normally not treated as income unless they specifically include it. So we'll see that. And we have two things. One is called as source of income, one is called as head of income. Source of income means what, sir? The place from where the income is coming. The origin of income, the generation of income. So I can earn income from different ways, or I can do different things and earn the income. Let us say I am teaching, earning income. I have my own practice, earning income. I also have my own business, I am earning income. So what are these different things, sir? They are all my different sources of income. Correct? They are all my different sources of income. Then we also have something called as heads of income. We have also something called as what, sir? Heads of income. What do you mean by heads of income? Whatever income you are earning from different places, these incomes are required to be segregated or distributed to different heads, and the computation should be done individually under those different heads. So income tax law has totally 5 heads of income. So whatever income is earned by a person, that income will be distributed or apportioned in this 5 heads, and computation will be done under each head of income, and then your gross total income and total income will be computed. So we have totally 5 heads of income, which is your income from salary, income from house property, income from business or profession, income from capital, and income from other sources. Now what do we do under income tax law? Majorly two things you will do under income tax law. First, you have to compute the total income of a person. So once you compute the total income of a person, on the total income you have to compute the tax liability of that person. So there is a specific format which we'll see later also again. Name of the assessee, previous year assessment year. So first you write the person whose income you are computing, then which year it is, previous year assessment year, what it is, we'll see very soon. Computation of total income and particulars. So income from salary, income from house property, business, profession, capital gain, income from other sources. All these are different heads of income. Compute the income under each and every head separately. The total of that will give you your gross total income. From that, subtract your deductions under chapter 6A. You will get your taxable income or your total income. Now, the charging section under income tax law is what, sir? The charging section under income tax law is your section number 4 of Income Tax Act 1961, which says income tax is charged for every assessment year. You have to pay income tax for what, sir? You have to pay income tax for every assessment year. Income tax is charged for every assessment year on every person. On whom is it going to be charged, sir? On every person, on the total income earned by such person. So everyone has to pay tax on what, sir? On the total income earned by them. When are they going to earn this total income? In the previous year. On which income, sir? On the total income which is earned by you in the previous year. The tax you have to pay in the assessment year. At what rate? At the rate prescribed in Finance Act. And for your examination, what is the Finance Act applicable to you? Finance Act 2025. So please note, income tax, who has to pay? All types of assessee has to pay income tax. On what, sir? On the total income which is earned by them in the previous year at the rate prescribed in Finance Act. Now please see. Normally, financial year is a year which starts from 1st of April and ends on 31st of March. Now this financial year is divided into two categories under income tax law. One is called as your previous year. Another one is called as your assessment year. Previous year means what, sir? Previous year means that year in which income has been earned. Assessment year means what, sir? Assessment year is that year in which the tax is required to be paid by you. So previous year is the year of earning income. Assessment year is the year of paying taxes. So for your examination, you have to do the computation of the tax on the income earned by a person during the period 1st April 25 to 31st March 26. Therefore, for your examination, the previous year is 25-26. For your examination, what is the previous year, sir? Previous year is 25-26. So from 1st April 25 till 31st of March 26, whatever income is earned by you, on that income you are supposed to do the computation. So this is the previous year for you. Which is the previous year? 25-26, and assessment year is 26-27. Previous year 25-26, assessment year 26-27. See, normally previous year will be a period of 12 months. It will start from 1st of April and on 31st of March. But sometimes what may happen is, let us say you guys wrote your examination in the month of June and you cleared your examination and you started working somewhere. So now your income will be generated from middle of the year, correct? You will get a new source of income coming in the middle of the year. So for you, for that particular income, the previous year will start from that particular date from when you started earning that income. So normally previous year is a period of 12 months. However, in following two cases, previous year can be period less than 12 months also. Which two cases, sir? Where a new business or profession is set up in the middle of the year. Where you are starting a new business or a new profession you are starting in the middle of the year, or a new source of income has been generated in the middle of the year, or a new source of income, a new income is coming in the middle of the year. In such cases, for that income and for that business or profession, the previous year will start from that particular date. Now, section 231. Section 231 talks about what, sir? Person. Person means tax has to be paid by every person. Who is a person, sir? Who is a person? A person includes, it is an inclusive definition. Inclusive definition means whatever you generally understand by the word person is a person. Apart from that, person will include this thing. Person includes individual, HUF, AOP, BOI, firm, company, local authority, AJP. Individual means people like us, natural person. HUF is Hindu undivided family. So Hindu after his marriage can form a separate entity called as HUF. Firm is partnership firm. LLP is limited liability partnership. Company means a body corporate, private company, public company, section 8 company, any type of companies registered under Companies Act. AOP or BOI, association of persons or body of individuals. So a group of persons will be called as AOP. Group of individuals will be called as body of individuals. Local authority means your municipality, your corporation, etc. And AJP is artificial judicial person. Then assessee. So who has to actually pay the tax, sir? Assessee has to pay the taxes. Assessee means what, sir? Any person who is liable to pay tax or any other sum under this act. So if you are liable to pay tax under the income tax law, or if you are liable to pay any other amount under income tax law, it can be interest, penalty, late fee, etc., then you will be called as assessee, and it will include these three people: representative assessee, deemed assessee, and assessee in default. Representative assessee means what, sir? Let us say my daughter is earning some income, she cannot file her income tax return. I am going to represent her for filing her income tax return. I am representative assessee. Deemed assessee. Deemed assessee means you are not actually the assessee, but you are assumed to be the assessee. For example, a notice has been sent to you. You are not a person who is liable to file return, etc., but still a notice has been sent to you. You have to reply to that notice. Now, because you are liable to reply to that notice, you will be deemed as assessee. Assessee in default, if you are supposed to do something and if you have not done that particular thing, that means you are an assessee in default. You have done some mistake. So assessee in default. You have not followed the law. Now start the actual provision. Tax rates for previous year 25-26, assessment year 26-27. For your examination, what is the tax rate applicable to you? See, tax rates basically are of two categories: general tax rates and special tax rates. General tax rates means what, sir? The rates which are applicable for all types of income normally. Special tax rates are those rates which are applicable only for some special category of income. Normally, general tax rates are applicable only for some special category of income. What is applicable, sir? Special tax rates are applicable. Special tax rates are given in your Income Tax Act itself, whereas general tax rates are given in your Finance Act. So some income on which special tax rates are applicable is your long-term capital gain 112A, short-term capital gain 111A, casual income, online money gains, undisclosed income, etc. We will see this separately later. General tax rates or slab rates. General tax rates or slab rates, which is applicable to you for your examination, which is previous year 25-26, assessment year 26-27, is if you are an individual, resident individual age less than 60 years, or a non-resident person irrespective of your age. So if you are an individual means what, sir? A resident individual whose age is less than 60 years, or a non-resident person irrespective of his age, or if you are an HUF, AOP, BOI and AJP. If you fall under this category, if you are an individual, HUF, AOP, BOI, AJP, if your total income is up to 2.5 lakhs, you don't have to pay any taxes. If your total income is how much, sir? Up to 2,50,000, no tax is required to be paid by you. If your income is more than 2,50,000 up to 5 lakhs, you have to pay a tax of 5%. 2,50,000 to 5 lakhs. In between this, if your income is there, then you have to pay tax only of 5% for income more than 2.5 lakhs. So first 2.5 lakhs 0, then for 2.5 lakhs to 5 lakhs 5%, 5 lakhs to 10 lakhs 20%. So if your income is between 5 lakhs to 10 lakhs 20%. So how will this 20% be calculated? So let us say my income is 10 lakh rupees. My income is 10 lakh rupees. So this 10 lakhs will be divided first 2.5 lakhs, then 2.5 lakhs to 5 lakhs, and then 5 lakhs to 10 lakhs. So for the first 2.5 lakhs, no tax. Then for the next 2.5 lakhs, pay only 5%. And for this 5 lakh rupees, pay 20%. So this is how it will be divided. Okay. So up to 2.5 lakhs, 2.5 to 5, 5 to 10, and more than 10. So more than 10, it will be 30%. Next, if you are a senior citizen, who is a senior citizen? Senior citizen means a resident individual whose age is 60 years or more. Who is a senior citizen, sir? A resident individual aged 60 years or more. So a senior citizen need not pay tax up to 3 lakhs. So for him, the basic exemption limit means what, sir? That limit up to which you don't have to pay any taxes. For him, it is 3 lakh. So from 3 lakhs to 5 lakhs, it is 5%. 5 lakhs to 10 lakhs, 20%. And more than 10 lakhs, he has to pay a tax of 30%. And if you're a super senior citizen, who is a super senior citizen? A resident individual who's aged 80 years or more. Up to 5 lakhs, no tax. 5 lakhs to 10 lakhs, 20%. More than 10 lakhs, 30%. Surcharge you have to pay. So this is the basic tax which you have to pay on your normal income or general incomes. On special income, special tax it will be applicable. Now, on the tax which is computed by you, how to pay extra tax, that is called as surcharge. Surcharge is what, sir? Surcharge is an extra tax which is required to be paid by an individual. So surcharge is what, sir? It is a tax applicable on the total income if the total income is more than 50 lakh rupees. It is a tax which you have to pay if your total income is more than 50 lakh rupees. So if your income is more than 50 lakh rupees, you have to pay something called as surcharge. If the total income is more than 50 lakhs and if it is up to 1 crore, it is 10% on tax. How much is the surcharge which you have to pay? If the income is more than 50 lakhs up to 1 crore, 10% of tax. If the total income is more than 1 crore up to 2 crores, 15% of tax. If the total income is more than 2 crores up to 5 crores, it is 25% of tax. And if the total income is more than 5 crores, it is 37% of tax. Now, please, sir, what if my income is, let us say, 2 crores, sir? How much will I pay, sir? You will pay 15% of tax. Sir, what if my income is, let us say, 7 crores? You will pay 37% of tax amount. Please note, this surcharge, see, this basic tax which you have to pay, that is on your income, whereas surcharge is on the tax amount. So whatever tax is computed on the tax amount, you have to pay surcharge. Then you have to pay something called as health and education cess, equal to 4% of tax amount. So this is compulsory. If there is a tax applicable, compulsorily health and education should come. So they will not ask you to levy health and education cess separately. They will not ask you to levy surcharge separately. They will only tell you to compute tax. And based on the question, you should see whether surcharge is applicable or not. Basic tax, once it is applicable, health and education cess will definitely apply. So let us understand how to compute the tax with one example. Mr. Dilip, aged 19 years, has a total income of 16 lakh rupees. Compute his tax liability. So let us now what is my income, sir? 16 lakh rupees. Now what happens when my income is 16 lakh rupees? Can I say it is more than 10 lakhs? Now because it is more than 10 lakhs, shall I directly apply 30% on 16 lakhs? No. We have slab rate system. Slab rate means what, sir? Up to certain income, there is some rate, after that some rate, after that some rate, etc. So up to 2.5 lakhs, up to 2,50,000, it is what, sir? No tax you have to pay, zero tax. If your income is from 2,50,000 to 5 lakhs, if your income is from 2,50,000 to 5 lakhs, you have to pay a tax of 5%. So 2.5 lakhs to 5 lakhs, what is the difference, sir? 2,50,000. On that you will pay 5%, which is 12,500. Income is more than 5 lakhs, up to 10 lakhs, you have to pay, on 5 lakh rupees, you have to pay 20%. So 5 lakhs into 20% is your 1 lakh. And if it is more than 10 lakhs, that is, in the present case, it is 16 lakhs. So more than 10 lakhs is 6 lakh rupees. You have to pay 30%. How much, sir? 1,80,000 rupees. So this is how you compute the tax. So first 2.5 lakhs, nothing. Then after that, 5%. After that, 20%. After that, it is 30%. So this is the total tax which you have to pay. On this, you have to levy surcharge. Now in this case, no surcharge is applicable because the total income is only 16 lakh rupees. Total income, if it is more than 50 lakhs, then only surcharge will come. So surcharge will be levied on tax amount. Health and education cess of 4% will be levied compulsorily on the amount, basic tax plus surcharge on the total amount. Health and education cess will be levied. So your net tax liability comes to 3,04,200 rupees. So how do I compute this? Sir, can I use this in examination? No, this is just for explanation purpose. So first 2.5 lakhs, tax rate is 0. So tax amount also 0. Next 2.5 to 5, 5%, 12,500. 5 to 10, 20%, 1 lakh rupees. And more than 10, 30%, 1,80,000 rupees. So this computation which is there, no, compulsorily should show in your examination. Of course, you will be using your calculator and solving this, but the examiner does not know about this. You will have to tell him that I have done this calculation using my calculator and this is how I did. Okay, so this is something which you should compulsory show in the examination. So add surcharge, then you will get your tax amount including surcharge, add health and education cess, that will give you your net tax liability. Now when there is a surcharge applicable, how will I compute the incomes? How will I compute the tax? So let us say your income is 83,50,000 rupees. So can I say my income is more than 50 lakhs? If your income is more than 50 lakhs, 10% surcharge will come. So first compute the tax on 10 lakh rupees. I mean, you can compute separately up to 2.5 lakhs, then 2.5 to 5, 5 to 10. The amount will remain same, 1,12,500. And more than 10 lakhs, what is the income more than 12 lakh rupees, sir? 73,50,000 on that 30%. So you got the basic tax amount. On this basic tax amount, you will levy a surcharge of 10%. On this basic tax amount, the surcharge is how much, sir? 10%. And then add health and education cess, you will get your net tax liability, which is 26,51,220 rupees. Now, please see. If you are a person who is born on 1st of April 1966 or 1st of April 1946, what is the limit applicable to you? See, they say who is a senior citizen? A person who is of 60 years or more, he is a senior citizen. So if you are a senior citizen, limit of 3 lakhs will be applicable to you instead of 2.5 lakhs. Correct? So the question is whether I will fall under the category of senior citizen or not. So if you are a person who is born on this date, lawmaker says you complete 60 years on 31st of March 2026. So he completes 60 years on 31st of March 2026 and therefore he will be treated as senior citizen. See, if I am born on 1/4/1966, I will be celebrating my 60th birthday on 1st of April 2026. I will be celebrating my 60th birthday because I have completed 60 years on one day before that. So they say you will be treated as senior citizen. Now, see, there are two tax regimes. One is optional tax regime and one is default tax regime. Whatever we are seeing right now is what's an optional tax regime. Okay, this tax regime which we are seeing is which regime, sir? It is a regime called as optional tax regime. Correct? Now, this is what's an optional tax regime. So for those people who opt to pay tax under optional tax regime, for them they will get a rebate under section 87A. They'll get a rebate. Rebate is what's it is a type of discount or a relief given by the lawmakers. So rebate will be given if you are a resident individual. So there are some conditions. It is not that rebate will be given to everyone. No. So there are some conditions for giving rebate also. Rebate will be given to you only if you are a resident individual. Rebate will be given to a resident individual if his total income is up to 5 lakh rupees. Rebate will be given if you are a resident individual and if your total income is up to 5 lakh rupees. The rebate under section 87A will be the tax amount or 12,500, whichever is less. A rebate will be given only if you are a resident individual and if your total income is up to how much, sir? 5 lakh rupees. Rebate will be given if you are a resident individual and if your total income is up to 5 lakh rupees. And rebate will be given how much, sir? Whatever tax is there, you have calculated, or limit is there, maximum you will get a rebate of 12,500, whichever is less. Now please note, this rebate is something which is given before adding surcharge and cess. So normally I compute the tax, correct? I compute the tax. So from here only I'll subtract rebate. Then I'll add surcharge and cess. So rebate will be given if you are a resident individual under optional regime and if your total income is up to 5 lakh rupees, rebate will be tax amount or 12,500, whichever is less. Now we have a beautiful concept called as concept of marginal relief. They may test you this point in your MCQ. They may give some question and they may test you this point in MCQs. What is marginal relief, sir? See, what happens sometimes, because my income has crossed the surcharge limit, surcharge will come. Let us say my income is 50 lakhs, up to 50 lakhs, I don't have to pay any surcharge. Extra tax is not there. But if my income is 51 lakhs, I will have to pay surcharge. Now my income has just crossed. The extra income which I have earned is only 1 lakh rupees. Now the extra income earned by me is only 1 lakh rupees, but on this extra income, the surcharge which I may have to pay may be more than 1 lakh rupees. Meaning, because of applicability of surcharge, the extra tax which a person has to pay can be more than the extra income which is earned by him. Lawmaker says, because the extra tax is more than the extra income earned by you, the difference between this will be given to you as marginal relief. Sir, repeat. Because of applicability of surcharge, when my income crosses 50 lakhs or 1 crore or 2 crores or 5 crores, depending upon which category or which type of person I am, when my income crosses the surcharge limit, because of applicability of surcharge, I may have to pay some extra taxes because of course surcharge is applicable. That means you have to pay extra taxes. Now this extra tax amount which is there, this extra tax amount may be way more than the extra income which is earned by me. Correct? So if the extra tax amount and the extra income amount, there is a gap between that, the difference between this will be given to you as what's a marginal relief. So what is marginal relief? Marginal relief is applicable only when the taxpayer has a total income slightly or marginally more than the income on which surcharge is applicable. So when will the marginal relief will be applicable, sir? Marginal relief will apply when your total income is slightly more than the income on which surcharge is applicable. So the concept of marginal relief is applicable to all types of person. It does not matter whether you are an individual HUF, PPI, company, body corporate, partnership firm, etc. It is applicable to everyone if their total income is slightly more than the surcharge limit. Any limit, it is 50 lakh, 1 crore, 2 crores, etc. What is marginal relief, sir? It is the extra tax which you are paying. Increase in tax, that is extra tax, less the extra income. The difference between this is your marginal relief. Extra tax is more than extra income, marginal relief will come. Extra tax is less than extra income, there will be no marginal relief. Now, for example, you see over here, my total income is 50 lakh 10,000, correct? Because my total income is 50 lakh 10,000, that means it is more than 50 lakhs. Now, because it is more than 50 lakh rupees, that means surcharge is going to come. Now, how much is the surcharge coming? I have to pay 10% surcharge. See now, because of applicability of surcharge, I may have to pay extra tax of how much? 1,31,550 rupees. Correct? No? Extra I am paying this much. But if you see, if my income would have been only 50 lakh rupees, I would have not paid surcharge. If my income would have not been 50 lakh 10,000, if it would have been only 50 lakh rupees, would I have paid this surcharge, sir? No. So therefore, because I earned extra 10,000 rupees, meaning more than 50 lakhs, how much I have earned extra? Only 10,000 rupees. Because I have earned extra 10,000 rupees, I have to pay surcharge. Now, how much is the surcharge which I am paying, sir? 1,31,550 rupees. Meaning my extra income and extra tax, if you see, the difference is huge. The extra income is only 10,000, whereas the extra tax is 1,31,550 rupees. Therefore, lawmaker says, you see the difference of this. What is the difference of this? The difference will come to 1,31,000 minus 10,000, which is 1,21,550 rupees. I will give you this as marginal relief. This will be given to you as what, sir? Marginal relief. Okay. So this will be given to you as marginal relief. I mean, I just directly computed from the surcharge and extra income. You should see the total tax difference and the total income ka difference. Surcharge is a beautiful, marginal relief is a beautiful concept. Next, default tax regime. 115 BSc. One more thing I would like to tell you. See, here, because of time constraint, we are going through all the provisions, correct? So if you want, say, let us say the questions to be, if you want, let us say, sir, we will also practice the question, then I would recommend you to watch CA Inter Marathon for direct taxes. CA Inter Marathon for direct taxes. In that, I have solved for after every concept. I have solved question also, because there was huge amount of time available at that time, and that marathon is also almost of 24-25 hours. Okay, direct taxes. If you want to, if you may say, if while discussing, if you find that okay, this concept I have to see an extra question, etc. Here we are just discussing the question. There I have solved the question. Okay, so if you want to understand the actual steps or etc., then you can definitely go to that particular provision. Don't if you want to see the entire marathon from there only, no problem, great. But if you want to go to some specific topic, then you can do this particular procedure. Or of course, you have the opportunity of recorded classes, etc. You will be having your own recordings, etc. You can watch that also. Okay, section 115 BAC, very important, which is your default tax regime. Normally, one question which students normally keep on asking is, sir, I have to pay the tax, sir. I have to pay the tax, sir. I have to compute the question. In the examination, they have given a question, and the question is silent. The question is not telling whether to compute the tax under default regime or optional regime. The question is silent. The question is not telling whether to compute the income under default regime or optional regime. What should I do, sir? Compute under default tax regime. If the question is silent, please note the question should be silent. That is important. That means you should read the question carefully, and then you should come to a conclusion whether the question is asking me to solve under default regime or optional regime. If the question is not telling anything, normally question will tell you 100%, it will tell you please do it under optional regime, please do it under default regime, etc. 100% they'll tell you. But if the question is silent, then Go for which regime, sir? Default tax regime. Compute the income as well as tax under default tax regime. Okay, with that being said, we'll start with default tax regime. Whatever tax rates we just now saw, that was under what regime? Optional tax regime. Section 115 BAC, default tax regime. This section is applicable to an individual HUF, AOP, BOI, AJP. This section is applicable to whom, sir? Individual HUF, AOP, BOI, AJP, meaning those people to whom slab rates are applicable. Okay, those people to whom slab rates are applicable, for them this section is applicable. Section 115 BAC is applicable to both resident as well as non-resident, irrespective of their age, irrespective of whether you are 50 years, 60 years, 90 years, etc. Meaning whether senior, super senior, no discrimination over here. Is irrespective of your age, this provision will be applicable to you. Which provision will be applicable to you, sir? 115 BAC, default tax regime will be applicable to you. So what is the tax rate under default tax regime? Very simple, very easy. Up to 4 lakhs, no tax. 4 lakhs to 8 lakhs, 5%. 8 lakhs to 12 lakhs, 10%. 12 to 16, 15%. 16 to 20, 20%. 20 to 24, 25%. And more than 24, 30%. Meaning up to 4 lakh rupees, you don't have to pay anything. If your income is from 4 lakh rupees to 8 lakh rupees, pay 5%. 8 lakhs to 12 lakh rupees, pay 10%. Then 12 lakhs to 16 lakhs, 15%. 16 lakhs to 20 lakhs, pay 20%. 20 to 24, 25%. And more than 24, it is 30%. So what is happening over here? Income is increasing by 4 lakhs. Tax is increasing by 5%. Income increases by 4 lakhs. Tax increases by 5%. Up to 4 lakh. Under default tax regime, up to 4 lakh rupees, no tax. 4 lakhs to 8 lakhs, 5%. 8 lakhs to 12 lakhs, 10%. 12 lakhs to 16 lakhs, 15%. 16 lakhs to 20 lakhs, 20%. 20 to 24, 25%. And more than 24, 30%. And by the way, all those who are watching me live on YouTube, anyone has any question, you can definitely ask me on the chat box. Surcharge is also applicable for under default tax regime. Surcharge is applicable same if your total income is more than 50 lakh rupees. Surcharge will be applicable. Surcharge is also same. Rates are also same. If your income is more than 50 lakhs up to 1 crore, 10% of the tax. If the income is more than 1 crore up to 2 crores, it is 15% of the tax. If the income is more than 2 crores, it is 25% of the tax amount. So here you don't have that 37% category of surcharge. Then health and education cess will be applicable. Health and education cess will be applicable, same 4% of tax amount including surcharge. Then of course you have to pay something called as marginal relief. Marginal relief will be applicable to you. Okay. Then rebate is there. Rebate, these people also will get. Now here for them the rebate calculation is beautiful because there are 2 separate calculation method for computing the rebate. Okay. So rebate under section 87A. Rebate means what's a relief discount. If you are following default tax regime, when will the marathon be available? You are right now, you are watching marathon only. So it is available to you right now. Yeah. This will be, always be present, available online. You can watch anytime. Yeah. Rebate under section 87A. Rebate will be given to you if you are a resident individual and if your total income is up to how much, sir? 12 lakh rupees. So here you get a rebate up to 12 lakh rupees of income. So rebate under section 87A says rebate will be applicable if you are a resident individual and if your total income is up to 12 lakh rupees. The rebate under section 87A will be the tax amount or limit of 60,000 whichever is less. Tax amount of 60,000 whichever is less. Now this is normally the rebate which will be given to you. Sometimes what may happen is your income may be more than 12 lakhs. It may be possible that your income is more than 12 lakhs. So if your income is more than 12 lakhs, then also will I get a rebate, sir? Under default regime, answer is yes. Under default regime, you get an extra benefit of rebate even when your income is slightly more than 12 lakhs. So where the total income is slightly more than 12 lakhs, to be precise, if the income is up to 12,70,585 rupees, then also you'll get a rebate. If the income is up to this amount, you will get a rebate. How much rebate will I get, sir? Very simple. Calculate the. So there is this 3-step process which you have to follow. First, compute the tax on the total income. Whatever total income is there, on that compute the normal tax. Then see the income more than 12 lakh rupees. See the difference between total income and 12 lakhs. See what is the income more than 12 lakhs. Then step number 3 is step 1 minus step, if the step number 1 is more than step number 2, meaning if the tax on total income and the difference between total income and 12 lakhs, if the difference is positive, then this difference is your rebate. Meaning if your tax on total income is more than the extra income which is earned by you, the difference will be taken as rebate. That difference will be the rebate given to you. Now you see over here, so Dilip has a total income of 36 lakh rupees. Under both the regimes, what will be the answer? So under default tax regime, up to 4 lakhs, no tax, 4 lakhs to 8 lakhs, 20,000, then 40, 60, 80, 1 lakh, 3 lakhs, 60,000 for income more than 24 lakhs. Then surcharge is not applicable because income is not crossing 50 lakh rupees. Then add health and education says under my net tax liability would be how much, sir? 6 lakh 86,400 rupees. Under optional regime, up to 2.5 lakhs, no tax, 2.5 to 5, 12,500, 5 to 10, 1 lakh rupees, and more than 10, 7 lakh 80,000 rupees. Add surcharge, not applicable. Why, sir? So here if you see, up for income more than 12 lakh rupees, 10 lakh rupees only, I am levying 30%. But here when the income is more than 24 lakhs, I levy 30%. So that is the difference which is there. And based on that, you see the tax difference also almost 3 lakh rupees ka difference is there under optional regime and default regime. Then we have special tax rates. Special tax rates are something which are given where, sir? Special tax rates are something which are given in Income Tax Act. Special tax rates are something which are given where, sir? Special tax rates are given in Income Tax Act. So section 112 is talking about long-term capital gain. Okay. What is long-term capital gain? We'll see under capital gain chapter. Of course, you'll be knowing what is long-term capital gain, but still, we'll see in detail in capital gain chapter. So long-term capital gain 112 tax rate is 12.5%. For long-term capital gain 112A, the tax rate is 12.5% for gain in excess of 1,25,000 rupees. For short-term capital gain 111A, tax rate is 20%. For casual income, the tax rate is 30%. What is casual income? Winning from lottery, betting, horse race, TV shows, etc. Online money games also 30%. And for undisclosed income or deemed income, black money, 60% is their tax rate. Now for capital gain, we'll discuss again in future in detail. Now please see, capital gain, basically there are two types of capital gain. One is long-term capital gain, one is short-term capital gain. Long-term capital gain is taxable under 112 and 112A. Short-term capital gain is taxable under 111A and 111. Now 112A, 111A has only 3 types of income covered over here. Okay, only 3 types of transfer is covered over here. Only 3 types of transfer is covered over here. If you have income from these 3 types of 3 categories, then only it will be taxable under 111A or 112A. All other capital gain, long term or short term, is taxable under 111, 112. So what are the incomes which are covered under 111A and 112A? Following capital assets are covered under 111A and 112A. Listed equity shares on which security transaction tax has been paid at the time of purchase as well as sale. Equity oriented mutual fund on which security transaction tax has been paid at the time of sale. Units of Business Trust of India on which security transaction tax has been paid at the time of sale. Units of Business Trust of India, also called as units of Unit Trust of India. So only 3 items are covered. What are these 3 items, sir? Listed equity shares, equity oriented mutual funds, and units of Business Trust of India. For these things, if it is a long-term capital gain, 112A, short-term capital gain, 111A. What is the tax rate for short-term capital gain? 20%. For long-term capital gain, 12.5% for gain in excess of 1,25,000. Now, special tax rate is same for everyone, irrespective of which type of assessee you are, irrespective of which regime you are following. Now, in your examination, when I have a question, the question is having income which are taxable at special rates as well as the income which are taxable at normal rates or slab rates. How do I do the computation? See over here, salary and house property, these are the income taxable slab rates. But capital gain and lottery, etc., these are the income taxable special rates. So my income of total income of 19,20,000 has both slab rate as well as special income. How do I do the computation? Lawmaker says very simple. Very simple it is. What is the simplicity, sir? Lawmaker says first compute the income for special rates. First compute what, sir? First compute the income for special rates, meaning first compute the income for long-term capital gain 112, long-term capital gain 112A, short-term capital gain, meaning first compute the income for special rates. After that, whatever is left over, that is taxable at slab rates. No. So then total this, whatever is left over, slab rate, just total this and compute the tax under slab rate. So long-term capital gain, short-term capital gain, lottery income, for this you compute based on whatever tax rate is there, compute the income. And then you have balance total income of whatever amount it is, you compute the income on that. Compute the tax, you will get your total tax liability. Now please see, you do the total of the tax first. Okay, you get the total of the tax. On that amount, surcharge will be applicable. Surcharge is not applicable separately for only balance the slab rate income. No, surcharge first compute the tax on your total income. On the total income, surcharge will be applicable. Add health and education cess on that amount. So this is true for both the regimes. Now, some different categories of persons are there. Okay, for them, what is the tax rate? See, normally at intermediate level, they will test you only from individual and HUF point. And there is one concept for partnership firm. They may test you 40B with respect to partnership firm, but normally they will test you from whose angles, sir? Individual and HUF. So company and all, they may not test you, but still rates may be important from MCQ point of view. Tax rates for company for previous year 25-26, assessment year 26-27. If you are a domestic company, tax rate is 30%. If you are a foreign company, tax rate is 35%. Very simple. Domestic company 30%, foreign company 35%. Note, if the turnover or gross receipts of domestic companies up to 400 crores in the previous year 23-24. So in which year, sir? In the year 23-24. In which year? In the year 23-24. If your tax rate is up to, if your turnover or gross receipts is up to 400 crores, then the current year for 25-26, the tax rate is only 12.5% for you. If in which year? If in that year means what, sir? If in the year 23-24, if in the year 23-24, if your income is up to, if your turnover or gross receipt is up to 400 crores, then in the current year for you, the tax rate will be 25% only. Okay. So normally it is 30%, but you can take the benefit 25% if your gross receipts or total turnover is up to 400 crores. Now surcharge you have to pay. Surcharge is applicable if the total income is more than 1 crore up to 10 crores, 7% on tax. For foreign company, 2% of tax. If the total income is more than 2 crores, for domestic company it is 12% and foreign company it is 5% of tax. Health and education cess will apply, of course. Margin fee also will be applicable as usual. Now here you see, for companies tax rate is 25% or tax rate is 30%. That is a flat rate. So if my total income is so here my total income is how much, sir? 5 crore rupees into 25% straight away. If my total income is what, sir? 5 crore rupees, flat 25% I should apply. 5 crores into flat 30% I should apply. Then tax rates for partnership firm, LLP, local authority. For partnership firm, also flat 30% is the tax rate. Surcharge will be applicable of 12% if the total income of the firm, LLP, a local authority is more than 1 crore rupees. Health and education cess also will be applicable as usual, and margin will apply. Tax rates for cooperative society. So for cooperative society up to 10,000, the tax rate is 10%, meaning even 1 rupee you have to pay 10% tax. 10,000 to 20,000, 20%, more than 20,000, 30%. Surcharge will be applicable if the total income is more than 1 crore up to 10 crores, 7% of tax, and total income is more than 10 crores, 12% of tax. Health and education cess of 4% on tax will be applicable, and margin will be applicable as usual. Now, some important points which you should keep in mind from this chapter, the first chapter point of view, which is the tax rates chapter. Okay. The total income and the tax amount, that should be rounded off to that. Now, please note, people will still get confused. Not each and every head of income. No. Not each and every head of income. So once you compute all the heads of income, the total of that, all the heads of income is called as gross total income. From that subtract deductions, you will get your total income. The total income, okay, and as well as the tax amount. Tax amount under what, sir? Again, the tax on the total income, not tax of separately for slab rate income and not separately for special income, etc. The total tax amount. Okay, like for example, in this case, if you ask me, where we did special income, etc. See, these are separate taxes you are computing under each and every head, etc. But I am talking about what, sir? This total tax, net tax, final tax amount. The total income as well as the tax amount, they both should be rounded off. The total income and tax amount should be rounded off to the nearest multiple of 10. They should be rounded off to the nearest multiple of 10. Meaning what, sir? Let us say your income or the tax amount is 14,56,748. I should round it off to the nearest multiple of 10, which is 48 is the last thing. So 50. 14,56,750. 12,78,342, round it off the previous multiple, 12,78,340. So if the last digit is up to 4, then round off to the previous multiple. If it is 5 or more, round it off to the next multiple of 10. Then on undisclosed income or on deemed income, tax rate is 60%. Undisclosed income, black money. On undisclosed income or deemed income, the tax rate is 60%. And of course, you have to pay something called a surcharge on this compulsorily. Even 1 rupee income, you have to pay a surcharge of 25% of tax. And health and education cess also will apply 4%. It shall always apply to them irrespective of the amount of income. Therefore, what is the effective rate of tax for them? Effective tax rate is 60% 12 plus 12.5% plus 4%, which is 78%. So for example, if I have a undisclosed income or black money of 5 lakh rupees, on that flat 60%, which is 3 lakh rupees is tax which I have to pay. Add on this 3 lakh 25% surcharge I will pay. That will give me 3,75,000. Then health and education cess of 4%, which is 15,000 rupees. The tax which I have to pay is 3,90,000 rupees. Then rebate under section 87A, very important point. This is a new change or amendment which you have to keep in mind. Rebate under section 87A is not applicable or not available against some income. So if you are a person who is following optional tax regime, you will not get a rebate for long-term capital gain under section 112A. And if you are a person who is following default tax regime, you will not get a rebate against any type of special income. Rebate means what, sir? That benefit of relief, discount, etc. Correct? No? So if you are a person who is opting for optional regime, then that rebate will not be available against one income only, which is long-term capital gain under section 112A. But if you are a person who is following default tax regime, then that rebate will not be available to you against any type of special income. Then normally basic exemption limit should be adjusted against income taxable slab rates. So whatever basic exemption limit is there, basic exemption limit means what, sir? Up to 2.5 lakhs, no tax is there. Up to 4 lakhs, you don't have to pay any tax. That basic exemption limit. Normally, basic exemption limit should be adjusted against income which are taxable at what rates? Slab rates. But if the basic exemption limit is not fully adjusted or utilized against income taxable at slab rates, then the unadjusted basic exemption limit will be adjusted against income taxable special rates, except against casual income and undisclosed income. What is the timing for online classes? Which online classes? Not recorded but live. This is going on live only. Right now what is happening is live only. So whatever we are seeing right now, 8 o'clock to 8 o'clock will be the timing, hopefully today's time. If we complete before, we may leave before also. And this recording will always, this live class will always be available online on the channel, so you can watch it anytime later also. But yes, if you watch live, if you have any question, you can ask me immediately then and there itself. Sir, in this marathon, all previous year questions are covered. Now, please note, unlike other papers, tax paper is something wherein previous year question paper are of no use to you. Why, sir? Previous year questions are of no use to you because previous year, whatever the tax law is a kind of law wherein changes will be made every year and you have to study the new law every year. Correct? You see your institute also every year during the month of February or March, they'll release a new material for tax, not for other subject. Why, sir? Because tax is a paper which will have changes, and whatever you studied in last year, current year, the same thing will be applicable? No. Okay. So basic exemption limit which is there, no, basic exemption limit is a limit up to which you don't have to pay tax. That is first adjusted against that income which is taxable at what rates, sir? Slab rates. But if you don't have a slab rate income, can I adjust against special income? Yes, you can definitely against special income, except against casual income and undisclosed income. Then, so we have 4 incomes, which is long-term capital gain 112, long-term capital gain 112A, short-term capital gain 111A, and dividend income. On this 4 income, the maximum amount of surcharge which you can collect is only 15%. The maximum amount of surcharge on below income is restricted to 15%. It is restricted to 15%. On this income together, maximum how much can you collect, sir? 15%. That is your tax rate ka chapter. Okay, that is your tax rate ka chapter. So from MCQ point of view, yes, it is important, and separate question may not come from this. Basically, they'll ask you along with your total income ka question, find the tax amount. Okay, tax rate important chapter, very important chapter, because that forms the base for all other chapters. Therefore, we discuss that chapter first. Now, residential status is the first topic which we are going to start our discussion. Residential status, very, very important chapter. 7 marks is going to come from this chapter. Residential status plus scope of total income. So this is the name of the chapter. Residential status. So you can be resident or you can be non-resident. So why is residential status chapter important? The first question is, why is this chapter first of all important, sir? Why should I study this chapter? What is the reason why I'm going to what is the reason why I have to study this chapter? The main reason why you have to study this chapter is because whether a person has to pay tax in India or not, that completely depends on his residential status. Meaning, whether you have to pay tax in India or not, if you want to know that, then first I will have to determine whether you are a resident person of India or not. If you are a resident of India, then definitely you will have to pay tax in India. If you are not a resident of India, you don't have to pay any tax in India. So a person can either be resident or he can be a non-resident. If you are a resident person, then you have to pay tax in India for Indian income as well as foreign income. But if you are a non-resident person, you have to pay tax in India only on your Indian income. So this we will see separately. First we will determine what is this residential status, etc. Okay, this is scope of total income, what is Indian income, what is foreign income, all those things we'll see separately. Now many people get confused with citizenships and residential status. Please note they both are not same. Section 6 of income tax law talks about residential status. Section 6 subsection 1 says about residential status of individual, which is the most important thing. Section 6.2 residential status of HUF, 6.3 company, and 6.4 is others. Please note 6.1 is most important. Meaning residential status of individual is most important. Section 6 subsection 1 gives the basic condition for determining whether an individual is a resident or not. Section 6 subsection 1 basic condition. So basic condition says a person can either be resident or you can be non-resident. What is basic condition telling, sir? Repeat. See, please note. Basic condition. Basic condition. Section 6 subsection 1. The basic condition says an individual can either be resident or he can be non-resident. So there is some condition which we are going to see very soon. Okay. If you satisfy the condition given in section 6 subsection 1, you are a resident. If you don't satisfy this condition, you are a non-resident. Now, sir, will the PDF be available? Yes, PDF will be uploaded. Maybe later they'll upload. I don't know. In the description, you can find it. If it is not available right now, or you can go to any other, you can go to, let us say, the CA Marathon. It is already uploaded over there. You can download the material from there. But I'll make sure that this is also uploaded separately, the material which we are discussing. Okay. But on urgency basis, if you need, you can download it from there. Because the provisions are same with respect to direct taxes. Only in direct taxes there is a change. Okay. Individual, to check whether he is a resident or not, we should see the basic condition given in section 6 subsection 1. If an individual satisfies the basic condition, he will be called as resident. If he does not satisfy the basic condition, he will be called as non-resident person. Now, once he satisfies the basic condition, once he is a resident, section 6 subsection 6, additional condition should be checked for that person. Once he satisfies the basic condition, check for additional condition. Now, if he satisfies the additional condition also, he will be resident and ordinary resident. If he does not satisfy the additional condition, he will be resident, but he will not be an ordinary resident. So, sir, repeat. An individual, if he satisfies the condition given in section 6 subsection 1, basic condition, then he will be called as a resident. If he does not satisfy, he is a non-resident person. Once an individual satisfies the basic condition, I should see for additional condition. Okay, if he satisfies the additional condition, he is a resident and ordinary resident. If he does not satisfy the additional condition, he is a resident but not an ordinary resident. So in simple words, Dilip as an individual can have 3 types of residential status. Either I can be resident and ordinary resident, or I can be resident but not ordinary resident, or I can be a non-resident person. Okay, I can have 3 residential status. So if I satisfy the basic condition, I am resident. So once I am resident, I should see for additional condition. If I don't satisfy basic condition, I am a non-resident person. Now, what is this basic condition, sir? Talk about that now, sir, please. Residential status for individual. Section 6 subsection 1, basic condition, which says an individual is said to be resident if he satisfies any one of the basic condition. So if you are an individual and if you satisfy any one of these conditions which you are going to see, then you will be called as resident. An individual is said to be resident if he satisfies any one of the basic condition. What is the basic condition? He should stay in India for 182 days or more during the previous. So there are 2 conditions, meaning either this or you satisfy this. Anyone you satisfy, you are a resident. So what is this basic condition telling, sir? You should stay in India for 182 days or more in the previous year. You should stay in India for how many days, sir? 182 days or more in the previous year, or you should stay in India for 60 days or more in the previous year and 365 days or more in 4 preceding previous years. You should stay in India for 182 days or more in the previous year, or you should stay in India for 60 days or more in the previous year and 365 days or more in 4 preceding previous years. So, for example, for our examination, the previous year is 25-26. Stay in India means what, sir? I should have stayed in India. As simple as that. I should have stayed in India. Which part of India, which location, all that does not matter at all. So, for example, for our examination, the previous year is previous year 25-26. I should stay in this year. I should stay in India for 182 days or more. Then I will be called as a resident. Or I should stay in India for 60 days or more in the previous year and 365 days or more in 4 preceding previous year. Meaning, in the previous year, I should stay for 60 days or more. And out of the 4 preceding previous year, I should stay for 365 days or more. Now, what is important point over here? Date of coming to India and date of leaving India shall be included while computing the number of days stay in India. So the date when you have come to India, the date when you are going to go out of India, both the dates will be included while calculating the number of days stay in India. And stay at one place is not mandatory. It does not matter whether you are staying at one places or you are multiple places. Let us say some days I am at Bangalore, some days I am at Chennai, some days I am at Coimbatore, some days I am at Delhi, some days I am at Kolkata, etc. It does not matter whether you are staying at one location or multiple locations. Stay should be in India. And stay in India need not be continuous. I can come, go, etc. Stay need not be continuous. Then we have section 6 subsection 6 which talks about additional condition. Additional condition, please note, once you satisfy basic condition, you will be resident. Once you satisfy the basic condition, then only I'll come and check for additional condition. Additional condition says, you should be resident for a period of 2 or more previous years in 10 preceding previous year. So in the 10 preceding previous years, you should be resident for, in the last 10 years, you should be resident for at least 2 years. You should be resident for a period of 2 or more previous years in 10 preceding previous year. In last 10 years, you should be a resident of India for at least how many years, sir? 2 years. And you should stay in India for 730 days or more in 7 preceding previous year. In last 7 years, you should stay in India for 7 preceding. In last 7 preceding previous years, you should stay in India for 730 days or more. Additional condition, both the additional conditions should be satisfied. The word used over here is and. You should be resident for a period of 2 or more previous years in 10 preceding previous year. In the last 10 years, I should be a resident of India for at least 2 years. And in the last 7 years, I should have stayed in India for at least 730 days. See, in the previous year 25-26, I should satisfy basic condition, and I should satisfy additional condition in the last 10 and 7 years. Now, see, normally, sir, is residential in residential status, please cover provisions of foreign nation, Indian citizen, person of Indian origin with some examples. Yeah, we'll be seeing that. Okay, following are exception to second basic condition. Exception means what, sir? In these cases, second basic condition will not be seen. So we have seen the basic condition, which has two conditions, 182 days condition plus 60 plus 365 days condition. Now these are exception for second basic condition, meaning 60 plus 365 condition will not be seen in these scenarios. Following are exception to second basic condition. In below cases, second basic condition shall not be checked. In which cases, sir, an Indian citizen who leaves India during the previous year. So if you are an Indian citizen who is leaving India, who is going out of India during the previous year, why are you going out of India? For employment outside India. You got an employment opportunity outside India, therefore you are going out of India. Or as a crew member of Indian ship. Either you are going out of India because you got a job opportunity outside India, or you are going out of India as a crew member of Indian ship. In these two scenarios, I will see 182 days condition to check whether you are resident or not. So if you are an Indian crew, if you are a crew member of Indian ship, or if you are going out of India for employment opportunity, not for education, not for vacation, if you are going out of India for employment, then in the previous year, whether you are resident or not, I will see how many days condition, sir, 180 days condition. Or if you are an Indian citizen, or if you are a person of Indian origin, if you are an Indian citizen, or if you are a person of Indian origin who is coming to India for a visit, if you are an Indian citizen or a person of Indian origin who is coming to India for a visit during the previous year, then for you, I will see your total income. Is your income less than 15 lakhs or is the income more than 15 lakhs? If the income from Indian sources, if the total income of Indians, please see, we are talking about whom? That person who is an Indian citizen or a person of Indian origin. Indian citizen means a person who is citizen of India, of course. Person of Indian origin means what, sir? Either you or your parents or your grandparents are born in undivided India. So if you are an Indian citizen or a person of Indian origin who is visiting India, who is coming to India for a visit, who is visiting India, in such cases, I will see two things. I will see one thing only, basically, whether his income is less than equal to 15 lakhs from Indian sources or his income is more than 15 lakhs from Indian sources. If his income is less than 15 lakhs from Indian sources, then same 182 days condition will be checked. He will be treated as resident of India if he satisfies the first basic condition. If his total income from Indian sources is more than 15 lakhs, then if the total income from Indian sources is more than 15 lakhs, then he will be treated as resident if he satisfies any one of the following condition, which is 182 days condition or 120 plus 365 days condition. Please see. Normally, we are studying about exception to second basic condition, meaning 60 plus 365 should not be checked. When, sir, if you are a person, if you are an Indian citizen who is going out of India for employment or as a crew member of Indian ship, 182 days condition. And if you are an Indian citizen or a person of Indian origin who is coming to India, then your income is less than 50 lakhs, equal to 15 lakhs, 182 days. If your income is more than 15 lakhs, they are telling, yes, I will check 182 days condition. But because the income is more than 15 lakhs, I want to see, I want to give an extra option to you to check 120 plus 365 days condition. If he stays in India for 120 days or more during the previous year and 365 days or more during 4 preceding previous year, then also he will be treated as resident of India. Now please note, if you are a crew member of Indian ship, then the date which is mentioned by you in the continuous discharge certificate, if you are a crew member of Indian ship, the date mentioned by you in the continuous discharge certificate as the date of joining the ship and the date of signing of the ship, these dates will be excluded for calculating the number of days stay in India. If you are a crew member of Indian ship, the date of joining and the date of signing of, period between that, including these dates, will be excluded while calculating number of day stay in India. Now, see this question. Mr. X, aged 19 years, left India for the first time on 31st of May 2025. Determine his residential status if he left for employment purpose. So if you leave for employment purpose, can I say 182 days condition I should see? If you leave for world tour, I can see either 182 days condition or I can see 60 plus 365 days condition. Now because he left for the first time, that means before this date he was always in India. And in current year, he left in the month on 31st of May. Therefore, 30 days of April plus 31 days of May, 61 days in the current year, he was in India only. Now, if he goes out of India for employment purpose, then I cannot see 60 plus 365 days condition. I should see 182 days condition. He was not in India for 182 days. Therefore, he is not a resident of India. But if you are leaving for world tour, then 182 days condition I can see, or I can see 60 plus 365 days condition. So over here 60 plus 365 days condition is getting satisfied. Now we have a small concept called as deemed resident. Section 6(1) capital A, deemed resident. This concept says if you are an Indian citizen who is living outside India, who stays outside India, lives outside India, and who is coming to India for a visit, even one day, it does not matter, who is coming to India during a visit during the previous year, and the total income which you have from Indian sources is more than 50 lakh rupees. And if you are not a resident of any other country, then you will be deemed to be resident of India. If you are an Indian citizen who is living outside India, who is coming to India for a visit, and whose total income from Indian sources is more than 15 lakh rupees, and you are not a resident of any other country, that means I'm going to assume, I'm going to deem that you are a resident of India. See, because only if you are a resident of any country, you have to pay tax in that country. When you are not a resident of any country at all, that means you are not going to pay tax in any country. Lawmaker says, sorry, you will have to pay tax in India. If you have more than, this is important, your income from Indian sources should be more than 15 lakhs and you should be an Indian citizen. That two conditions also are important. Now, residential status for HUF, very simple. For HUF, I will see control and management. So in case of HUF, I should see control and management of HUF. If the control and management of HUF is wholly or partially in India, HUF is resident of India. If control and management is wholly outside India, HUF is a non-resident person in India. What will I see, sir? Control and management. If it is fully in India or partially in India, even 10%, 1%, I don't care. If it is wholly or partially in India, then that HUF will be called as resident of India. If the control and management is wholly outside India, completely outside India, then that HUF will be called as a non-resident of India. Now, once the HUF becomes resident, we need to check for additional condition. Once HUF is becoming what, sir? Resident, you check for what? Additional condition, which is given under section 6(6). If the Karta satisfies additional condition, please note. To check whether HUF is resident or not, we should see condition given in section 6(2). To check whether HUF is resident or not, we should see the condition given in 6(2). HUF satisfy the condition given in 6(2), HUF is resident. If it does not satisfy, HUF is non-resident. Now, once HUF becomes resident, I should check for Karta. I should check for what, sir? Karta. Now, please note, to check whether HUF is resident or not, I am not going to check Karta's residential status. But once HUF becomes resident, I will now check for additional condition for Karta. Once HUF becomes resident, I will check for additional condition of Karta. If Karta satisfied additional condition, HUF will be treated as resident and ordinary resident. If Karta does not satisfy additional condition, HUF is resident but not ordinary resident. So once HUF is a resident of India, we need to check for additional condition under section 6.6 for Karta. If Karta satisfies additional condition, HUF is resident and ordinary resident. If Karta does not satisfy additional condition, HUF is resident but not ordinary resident. Now see over here. The business of a HUF is transacted from Australia and all the policy decisions are taken there. Mr. E, the Karta of HUF, who was born in Kolkata, visits India during the previous year 25-26. After 15 years, he comes to India on 1/4/25 and leaves India for Australia on 1/12/25. Determine the residential status of Mr. E and HUF for the assessment year 26-27. So see, HUF though very simple, it is very simple HUF because all the policy decisions are taken outside India. It is not a resident. This Karta, he came to India after 15 years and in this year he was in India from 1st April till 1st of December. That means he was more than 180 days. He is a resident person. Residential status for Mr. E, which is Karta. Since Karta has stayed in India for 245 days in the year 25-26, he satisfied the first basic condition. Therefore, Karta is a resident. However, as he does not satisfy any of the additional condition under 6.6, he is resident but not ordinary resident. HUF, since control and management is wholly outside India, HUF is not a resident. Section 6, subsection 3. Residential status of a company. So if you are an Indian company, you are always a resident of India. Domestic company is always a resident of India. But for all the other types of company, I should see POEM. What is POEM, sir? Place of effective management. If the place of effective management is in India, then it is a resident of India. If the place of effective management is not in India, then it is not a resident of India. Next. Residential status for other people, very simple, same. Control and management you check. If the control and management is wholly or partially in India, it is a resident. If it is wholly outside India, it is a non-resident. Other people means what, sir? Firm, LLP, AOPPY, etc. Section 5, scope of total income. Section 5 talks about scope of total income. Now, residential status is required to be compulsory studied with scope of total income, or scope of total income should compulsory be studied with residential status. Why, sir? Because they both are equally important topics. Now, scope of total income means what, sir? This topic is going to tell whether you are supposed to pay tax in India or not on a particular income. Who is going to tell about that? Scope of total income is going to talk about whether tax is required to be paid in India or not on any income. So understand in a simple way. Residential status for individual can be 3, or HUF also it can be resident, ordinary resident, resident, not ordinary resident, and non-resident. For other category, it can either be resident or it can be non-resident. There is no in-between concept. Okay. So income, let us divide the income into 2 categories. Indian income, foreign income. What is Indian income? We will see. What is foreign income? That also we will see. Okay. Right now, divide the income into 2 categories. Indian income and foreign income. Now, if it is an Indian income, it does not matter who you are. If it is an Indian income, it does not matter who you are. Whether you are a resident, ordinary resident, not ordinary resident, or a non-resident, you will have to pay tax in India. On Indian income, who has to pay tax in India, sir? Everyone has to pay tax in India on Indian income. On foreign income, only resident and ordinary resident has to pay tax in India. Others don't have to pay tax in India. I'll repeat. On Indian income, who has to pay tax in India? Everyone. Resident and ordinary resident but not ordinary resident, and a non-resident person. And on foreign income, who has to pay tax in India? On foreign income, resident and ordinary resident will have to pay tax in India. Resident but not ordinary resident will also have to will not have to pay tax in India, and non-resident will not have to pay tax in India. On foreign income, who has to pay? Only resident and ordinary resident. Not ordinary resident and non-resident does not have to pay tax in India until it is, see, a non-resident will never pay tax on foreign income in India. a resident but not ordinary resident also will not pay tax in India for foreign income. But there is one foreign income. There is one foreign income on which a resident but not ordinary resident also has to pay tax in India. Which is that, sir? If the income is from a business controlled from India or a profession set up in India. If a resident and not ordinary resident is earning an income from business controlled from India or a profession set up in India, he has to pay tax on that particular income in India. Okay. So what is an Indian income? Income received in India is an Indian income. Income received in India. Now please see. We are going to talk about Indian income. Whatever is not Indian income is a foreign income. So foreign income means any income other than Indian income. Indian income means income received in India. If you are receiving any income in India, that means it is an Indian income. So it does not matter where the income is earned. For example, I sold the sari to you in Bangalore. You gave the money to me. It is an Indian income. I sold the sari to you in London, but you gave the money to me in India. It is an Indian income. Though the sale happened outside India, it does not matter. Because the money was received in India, it is an Indian income. I sold the sari to you. There were some services which you had taken when you went outside India, but the money was paid by you to that person in India. It is an Indian income. As simple as that. So if the money is received in India, it is an Indian income. Income deemed to be received in India. Now, this is not actually the income which is received by you in India, but we are going to assume that this income is received in India. This is income deemed to be received in India. Assumed to be received in India. So there are totally 4 incomes covered over here. If you have this 4 income, all these are salary chapter income. So this is something which is covered under salary. This 4 income, always it will be assumed that it is received by you in India. What are those incomes? Employer ka contribution. Employer's contribution to recognized provident fund more than 12% of salary. Interest credited to employee on recognized provident fund more than 9.5% per annum. So first employer ka contribution, then interest on which is credited on the money which is there in recognized provident fund more than 9.5% per annum. If the rate of interest is more than 9.5%. Transfer from unrecognized provident fund to recognized provident fund if you are transferring money from URPF to RPF. Or employer ka contribution to 80CCD pension fund. So these incomes will always be treated as income deemed to be received in India. Then income accrue or arise in India. Income accrue or arise in India means what, sir? Income is getting generated, originating from India. So let us say if Obama has a house in Mumbai and if it is given on rent to someone, then can I say this rental income will be deemed to accrue or arise in India? Correct, no? Because it is getting generated from India, therefore it is deemed to accrue or arise in India. So Obama has a house in Mumbai. Now if he gives this house on rent, whatever income is there, that income will be accruing or arising in India. So what is income deemed to accrue or arise in India? Deemed to accrue or arise in India means what, sir? Deemed to accrue or arise in India means actually it is not getting generated or origin in India, but we are going to assume that this is getting origined or it is getting accrue or arise in India. Income from business connection in India. Dividend from any Indian company. Some foreigner has invested in Indian company, that Indian company is doing business worldwide. It does not matter. That foreigner is getting a dividend from Indian company. That income is going to deem to be accrue or rise in India. Salary payable by government of India to an Indian citizen for services rendered outside India. So many people from India are working outside India and the government of India is paying them salary. So whatever salary is paid by the government of India to those people who are working outside India, that is to the Indian citizen. Like for example, we have Indian embassies are there in foreign countries. We have Indian agents working outside India, etc. Non-resident receiving an income by way of interest, royalty, fee for technical services from Indian government, from a resident individual or a non-resident having a business or profession in India. So if any person who is outside India, a non-resident person, basically he is receiving interest or royalty or fee for technical services from whom, sir? From an Indian government, from a resident individual or non-resident having business or profession in India. Income from sale of any capital asset in India, gift which is given by you to a non-resident, etc. Now please note, if you are a resident and ordinary resident, you have to pay tax on global income in India. Resident and ordinary resident. Because you are a resident of India and ordinarily also you are a resident of India, any income earned by you anywhere in the world, you have to pay tax in India. Past untaxed income brought to India during the current year is not taxable in India. Okay, any income which was earned by you few years ago, now if you bring that income in India in the current year, will it be taxed in India? No. Now we'll see one question which covers all the adjustments, major adjustments. See, whenever a question is given, check the question carefully. Check whether that income is an Indian income or foreign income. So if it is an Indian income, everyone has to pay the taxes. If it is a foreign income, only resident and ordinary resident has to pay the taxes. Like interest from UK development bonds, 50% is received in India. So total income is 10,000. So because it is UK bonds, it is a foreign income. But because 50% is received in India, 50% will be treated as Indian income. So 10,000 will be fully taxable for resident and resident and ordinary resident, and for other people only 5,000, which is whatever is received in India, that will be taxable in India. Income from business in Chennai. Business is in Chennai, that means it is an Indian income, accrue or arise in India, taxable for everyone. Short-term capital gain on sale of shares of Indian company received in London. So shares are of Indian company, that means it is an Indian income. It does not matter where it is received. Dividend from British company received in London, foreign income. Company is also outside India, money is also received outside India, foreign income. Who has to pay tax in India? Definitely a resident and ordinary resident has to pay tax in India, others will not have to pay tax in India. Long-term capital gain from sale of plant in Germany. So plant, where is the plant located, sir? Plant is located in Germany. 50% of the money is received in India. So 50%, can I say Indian income? Entire 40,000 will be taxable for resident, ordinary resident, and for others only Indian part, which is 20,000, will be taxable. Income earned from business in Germany, which is controlled in Delhi. Business is in Germany and it is controlled from where, sir? Delhi. Now please note, business is in Germany, controlled from Delhi. 40,000 is received in India. 40,000 is definitely an Indian income. Now business outside India, controlled from India, this is actually a foreign income. Now many people get confused only on this point, because it is getting controlled from India, they will assume it to be Indian income. No, it is a foreign income, but it will be taxable for resident and ordinary resident as well as resident but not ordinary resident. For non-resident, only what is received in India, which is 40,000, will be taxable, and for these two, 70,000 fully taxable. Okay. So income from business controlled from India or profession set up in India, these two cases, it will be taxable for, though it is a foreign income, it will be taxable for resident and ordinary resident as well as not ordinary resident. Profits from business in London but managed entirely, profit from business in Delhi managed from London, no problem, because business is in Delhi, it is a Indian income, taxable for everyone. Income from house property in London deposited in London, brought to India later. See, property is outside India, money is also deposited, earned outside India, received outside India, later you gave it to India, I don't care. So is it an Indian income? No, it is a foreign income, therefore taxable only for resident and ordinary resident. So is it not past untaxed profit? No, past untaxed profit means that income only should be of any past years. Interest on debenture in Indian company received in London, debenture of Indian company, okay. Indian company, that means Indian income, taxable for everyone. Fee for technical services rendered in India, services are rendered in India, Indian income, taxable for everyone. Profits from business in Mumbai, business is in Mumbai, taxable for everyone. Income from property in Nepal received there, foreign income, taxable for resident and ordinary resident. See, this is a question which covers everything actually. Past foreign untaxed income brought to India during the previous year. Past foreign untaxed income that is brought to India during the previous year. Now, this was an income of past years, foreign income. Now you are bringing into India. Will you pay tax in India? Answer is no. Gift received on the occasion of wedding is taxable under 56(2)(10). Because it is on wedding, not taxable, Income from profession in Kenya, which was set up in India, received there but spent here. Profession is in Kenya, but it was set up in India. Foreign income but taxable for resident, ordinary resident as well as resident, not ordinary resident. Interest on saving bank account deposit of SBI, taxable in India. Income from business in Russia, controlled in Russia, foreign income, taxable only for resident, ordinary resident. Dividend from Reliance, taxable in India for everyone. Agricultural land in London, except. So royalty received from BHI Limited, an Indian company for product design to be used in India in Germany bank account. Is it taxable only for resident? Right. Now please see who is receiving. That is important over here. If it is received from an Indian company for a product, now who is receiving is important. If it is received by non-resident or is it received by resident? If it is received, see, the money is paid by an Indian company, that means income is accruing from India. It is taxable for all types of person. Now what I'll do is, after every topic, model text question paper was there, no? Yeah, MCQ we'll see at the end, but apart from MCQ, the descriptive part of the question paper, that we'll do right away here only. So I'll add it. Descriptive question paper will questions will discuss chapter wise. Okay, so section B, first question is RAM provides the following textbook question. It is your textbook question. It does not matter where the product design was used. Who is paying the money? Income accrue or arise is where? RAM provides the following details of income. Calculate the income which is liable to be taxed in India for the assessment year 26-27, assuming that he is an ordinary resident or not. Okay. Salary received in India from a former employer in UK. But see, the income is received in India, therefore it is an Indian income. It is taxable for all the three. Okay, resident, ordinary resident, not ordinary resident, non-resident, taxable for all the three, full amount. Income from tea business in Nepal being controlled from India, it is taxable. Controlled from India, it is taxable for first two people, not taxable for non-resident person. Because business is outside India, foreign income. Control is happening in India, so taxable for resident, ordinary resident, not ordinary. Interest from company deposit in London. So 30,000 will be taxable for first person. For other two person, only 1/3 which is received in India will be taxable. Profit from a business in Mumbai controlled from UK, because business is in Mumbai, taxable for all. Profit of 23-24 from business in Tokyo remitted to India. Now the past untaxed profit, ignore. Income from property in India but received in USA. Property is in India, so 45,000 will be taxable for everyone. Now please note, income from property, if it is a house property, then 45,000. Sometimes what will they give you? They'll give you rent from a house property in India, 45,000. In that case, 45,000 minus 30% standard deduction you should give and take the balance amount. But here they are directly talking about income from property, not the rent amount. Income from a property in London received in Delhi. Received in Delhi, taxable for everyone. Property in London received in Canada, taxable only for resident and ordinary resident. Income from business in Zambia controlled from Turkey, taxable only for resident and ordinary resident. Others it is not taxable. So this is the answer for your first question, which is this. Now next, one more small topic, we'll see agricultural income. And take a small break, then continue. Section 10, agricultural income. Agricultural income. Now see, please see, section 10 is a section which talks about those incomes which are exempt, meaning there are some incomes on which you don't have to pay any tax at all in India. Agricultural income is exempt from payment of tax in India if such agricultural income is from an agricultural land in India. Agricultural income is exempt from payment of tax in India. You don't have to pay tax on agricultural income if such agricultural income is from what, sir? If such agricultural income is from an agricultural land in India. Now, what is an agricultural income? Agricultural income is what, sir? Any rent or revenue derived from an agricultural land in India and which is used for agricultural purpose. Any rent or revenue which you are deriving, which you are earning from an agricultural land which is there in India and which you are using it for what purpose? Agricultural purpose. Income from agricultural operations. And what else is agricultural income? Agricultural income means what, sir? Income from agricultural operations. Okay. What do you mean by agricultural operation? Agricultural operation means check whether you are doing basic operation or subsequent operation. Agricultural operations are divided into two categories, basic and subsequent. Basic means all the operation up to the stage of germination of seeds is called as basic operation. Anything after that is subsequent operation. So income from agricultural operation. Income from a farmhouse or a dwelling unit situated on agricultural land located in rural area. Farmhouse or a dwelling unit which is situated on agricultural land, and that agricultural land should be located in rural area. Now, what is a rural area, sir? Rural area means an area which is not an urban area. See, basically they have given the meaning of urban areas to us. Urban area is an area whose population as per the latest census before the beginning of the previous year is 10,000 or more. So if you are staying in an area whose population is 10,000 or more, that means you are staying in urban area. If your area's population is more than 10,000 up to 1 lakh, your area of course is an urban area. From your area up to 2 kilometer area is also urban area. If your area's population is more than 1 lakh up to 10 lakh, of course your area is an urban area. From your area up to 6 kilometer area is an urban area. If you are staying in an area whose population is more than 10 lakhs, your area of course is an urban area. From your area up to 8 kilometers area is also an urban area. Okay, so anything apart from this is called as what, sir? Rural area. Farmhouse or dwelling unit should be located in agricultural land in rural area. Income from nursery, plantation, seedling, etc. That is also agricultural income. Now we have a rule called as rule number 7. This is important from exam point of view. Rule number 7, which talks about how to compute the income when you have what, sir? When you have agricultural income as well as non-agricultural income. How do I compute the income? When you have a composite income. Composite income from sale of agricultural produce. See, agricultural produce can either be sold in raw form or it can be sold after some process. Let us say I have potatoes. Now these potatoes are actually something which are there under the earth. So I can directly extract the potatoes from under the earth and I can sell it to someone. So if I do that, that means potatoes are sold in raw form as it is, extracting, selling. Or I can sell them after some processing. Let us say I extracted the potatoes from the ground, washed them and then sold it after some processing. Or I chopped them, made potato chips and then sold it. So after some processing. Okay. So agricultural produce, is it sold in raw form? If it is sold in raw form, the income which I am going to get is agricultural income and therefore it will be fully exempt. If it is sold after some processing, check whether the process which is applied by me, is it a mandatory process or is it not a mandatory process. If the process applied by me, if it is a mandatory process, then the entire income will be agricultural income, therefore fully exempt. If the process applied by me is not a mandatory process, then my income which is there will be divided into agricultural income and business income. How much will be agricultural income? See the market value, fair market value of agricultural produce which is used for further processing. What is the market value of agricultural produce which is used for further processing? From that, subtract the cost of cultivation. How much expenses you have incurred for cultivating it? That will give you agricultural income. So, see, please note, potato sold in raw form, entire income is agricultural income. Potato sold after some process which is a mandatory process, entire income is agricultural income. Potato sold after some process which is not a mandatory process, now income will be agriculture as well as business income. How much will be agricultural? Now because the process is not mandatory, your agriculture income will be fair market value of agricultural produce used for further processing less cost of cultivation. Difference is your agricultural income. Fair market value of agricultural produce used for further processing less cost of cultivation. Meaning, if I would have not used it for, see, whatever agriculture produced is there, which is used for making potato chips. If I would have not used it for making potato chips, I would have sold in the market. So what is the market value of agriculture produce which is used by me for making potato chips? Take that. From that, subtract the cost of cultivation, you will get your agricultural income, which will be exempt. What will be business income, sir? Take the sale value of processed product. Sale value of processed product, subtract cost of processing, subtract cost of processing, subtract what, sir? The market value of agriculture produce used for further processing. That will give you business income or non-agriculture income. Meaning, what is the amount which I got by selling potato chips? From that, subtract what is the amount incurred by me for making potato chips, subtract fair market value of agricultural produce used for further processing. What is the market value of agriculture produce which is used by me for making this agriculture produce? Will give me my business income. See, for example, over here, Mr. B grows sugar cane and uses the same for the purpose of manufacturing sugar in his factory. 30% of sugar cane produced is sold for 10 lakh rupees. Okay, and the cost of cultivation of this is 5 lakh rupees. The cost of cultivation of balance 70% is 14 lakhs and the market value is 22 lakhs. After incurring 1,50,000 of manufacturing expenses of the balance sugar cane, the sugar cane was sold for 25 lakhs. Compute base business income and agriculture income. Now see, 100% is my total sugar cane. Out of which 30% I sold in raw form. As it is, I sold. So 10 lakhs I received from that. For making this, I incurred 5 lakh rupees. So the difference is your agriculture income. Balance 70% I sold after some processing. Now please see, because I sold after some processing, meaning I made sugar cane into sugar and then sold it. So agriculture income will be fair market value of sugar cane, which is 22 lakhs. Meaning if I would have not used it for making sugar cane, if I would have sold it as it is, I would have got 22 lakhs. And for cultivating this, I incurred 14 lakhs. The difference of 8 lakh rupees is my agriculture income. How much is my business income? Take sale value of sugar cane. What is it, sir? 25 lakhs. Less cost of processing, 1.5 lakhs. Less fair market value of sugar cane, 22 lakhs. That will be your business income, which is 1,50,000 rupees. Agriculture income and business income. This is the answer. Now there are three businesses: tea business, coffee business, and rubber business. For this, they have only directly given you what is the percentage. So if you are a person who is growing and manufacturing tea, coffee, and rubber, if you are growing and manufacturing tea, coffee, or rubber, they have only directly given you how much is your agriculture income and how much is your business income. If you are a person who is growing and manufacturing tea, 60% of your total income which you receive, meaning let us say I received 10 lakh rupees, into 60% take it as agriculture income, into 40% take it as business income. If you are growing and manufacturing coffee, 75% of your income will be agriculture income, 25% of your income will be business income. Now this coffee is grown and cured by you. There is one more form of coffee which is grown, cured, roasted and grounded. 60% is your agriculture income, 40% is your business income. If you are growing and manufacturing rubber, 65% is your agriculture income and 35% will be your business income. Okay, so straight away you just have to multiply with whatever income they have given you, multiply whether it is 60, 40, 65, 35, 75, 25, etc. Then also then one more concept, last concept in your agriculture income chapter, the concept of partial integration. There is a small concept called as what's the concept of partial integration. Now what happens? What is this concept of partial integration? Partial integration is a concept which is applicable to those people for whom slab rate is applicable. Partial integration is applicable to individual HUF, AOP, BOI, AJP if their agricultural income is more than 5,000 rupees. When is it applicable? If your agricultural income is more than 5,000 and if your non-agricultural income is more than basic exemption limit 2.5 lakhs or 3 lakhs, etc. Concept of partial integration will be applicable if your agricultural income is more than 2.5 lakh, agricultural income is more than 5,000 and non-agricultural income is more than basic exemption limit. So here the computation of tax is little different. What is it? We will see. Now note number 1. Partial integration shall apply only if all the above 3 conditions are satisfied, and concept of partial integration shall not apply if an assessee opts to pay tax under default tax regime under section 115 BSC. Now all the 3 conditions should be satisfied. So tax which you have to pay if concept of partial integration is applicable will be what's that? First, compute the tax on your income, meaning include agriculture income with non-agriculture income. You find that, take the total of this. Take your agriculture income, add it with non-agriculture income, take the total of this, compute the tax on that. Then take your agriculture income, add it with basic exemption limit and compute the tax. First step, tax on agricultural income plus non-agricultural income. Combine both the amounts and compute the tax. Second is what, sir? Agricultural income with basic exemption limit, compute the tax. Now, the tax which you have to pay will be step 1 minus step 2. Step 1 minus step 2 means what, sir? The tax which you have to pay will be the tax on agricultural income plus non-agricultural income minus tax on agricultural income plus basic exemption limit. The difference is something which you have to pay. Okay, so yeah, this is about your agricultural income. Next chapter which we have is income from salary. Now, before we discuss income from salary, let us take a break of 15-20 minutes. Okay, we'll meet after a short break of 15 minutes. So I'll just write it over here. Welcome back, students. Welcome back. So let us start the next topic, income from salary. Income from salary section 15, 16, 17 are the three sections which are there. Section 15 is the charging section, 16 talks about deductions, and 17 talks about the meaning of salary. Very nice and very simple chapter it is. Now, what does this income from salary says? Now, one beautiful thing about this chapter is what, sir? This is an important chapter and compulsory one question is going to come in the examination. So one important thing about this chapter is what, sir? That this chapter says, if you want to tax any income under this head, then what is important, sir? Relationship is important. If you want to tax any income under this chapter, what is important, sir? Relationship is important, meaning there should be two people. Who are these two people? Employer and employee, master and servant. And these two people should be in relationship. What type of relationship? Employer-employee relationship. And the payment should be made in the capacity of employer. Whatever payment you are making, that payment should be made in what capacity, sir? That payment should be made in the capacity of employer. Then only that income will be taxable under the head salary. Now, charging section 15 says, salary is taxable either on due basis or on receipt basis, whichever is earlier. Salary is taxable on what basis, sir? Either on due basis or on receipt basis, whichever is earlier. Meaning whether it is due or whether it is received by you. Depending upon that, whoever is earlier, the salary will be taxable. Salary can be in cash or it can be in kind. You can receive the salary in cash or you can receive the salary in kind. Salary forgone is also taxable. So if you forgo the salary, then also it is taxable, except in case of central government and state government employees. If you forgo to them, then it is not taxable. So salary can be in cash or in kind means what, sir? Monetary terms or non-monetary terms also, like perquisites company gives you, that is also a salary. Now, different components of salary are there. Once we complete the discussion on all these components of salary, this chapter will be over. So one by one, we'll straight away start the discussion. First is your basic pay. Basic pay is your base salary. It is the base component of your salary, meaning this is the minimum amount of salary which you are going to get. So basic pay is your base salary. It is a taxable component of salary and it is fully taxable. The important checkpoint which you should keep in mind is the date of joining the company, date of retirement, date of resignation, date of increment in the salary, etc. All these are important points, because many times what will happen is the question will tell you to find the salary for the previous year 25-26. Now, because the question has asked you to find the salary for the previous year 25-26, what you may do? You may find the salary for full year. But if the person has joined the company from 1st of June, then finding the salary for full year, you will make a mistake. So if a person has joined on 1st of June, date of joining is important over here. If I have joined on 1st of June, then from 1st of June till I was in the company, I will have to compute the salary. Now, sometimes what may happen is the salary can be given to you in grade pay basis or grade scale pay basis. Now, what is this grade pay or grade scale pay, sir? Let us say you have joined a company at that time. So grade pay, they'll give you in this format: 20,000, 2,000, 30,000. Now, what does this mean? This means that when you joined the company, your salary was rupees 20,000 per month. When you joined the company, how much was your salary? 20,000 rupees per month. And for every year you completed in the company, there will be an increment of 2,000 rupees. And this increment will be till the salary becomes how much, sir? 30,000 rupees. So this is your grade pay or grade scale pay. So 20,000 is your base pay. Okay. So every year you complete, 2,000 increment will be there. So second year your salary will be 22,000. Third year your salary will be 24,000. Then 26. Then 28. And then 30,000. So this increment will be done every year till your salary becomes 30,000 rupees. Now, sometimes what may happen, like in this question, the person has joined the company on 1st of July 2022. Now, the next increment will happen from 1st of July 2023, correct? So, every year you complete increment will happen. So, what may happen is, for some period in a year, you may have a reduced salary, and for some period, you may have increased salary. So, please be very careful. The dates are very important in this chapter. Next, you have dearness allowance, also called as DA. Now, what is DA, sir? It is an extra amount given to you so that you can meet the increased cost of living. So, it is an amount given for meeting increased cost of living. Sometimes what may happen is, because of inflation, because the place where you stay, the cost of inflation or the standard of living of people over there, or the cost of living at that location may be high. Therefore, the company may give you some extra money called as dearness allowances. It is a amount given for meeting increased cost of living. It is a taxable component of salary and it is fully taxable. Now, DA can be in terms or it cannot be in terms. DA can be in terms or not in terms means what, sir? DA in terms means DA which is forming part of retirement. DA not in terms means DA which is not forming part of retirement. DA in terms meaning that portion of your dearness allowance. See, let us say 10,000 is DA. They say 60% forms part of retirement. That means it is that portion, 60% meaning 6,000 rupees DA will form part of my retirement benefit calculation. You will understand that later when we discuss different formulas. You will understand what is DA in terms and what is DA not in terms. But it does not matter whether it is in terms or not in terms. The entire DA is a taxable component of salary. But yes, this bifurcation is there, DA in terms and DA not in terms. Now, sometimes the DA will be given to you in the question in percentage format. They'll tell you DA is 40%. So, 40% of what, sir? DA will be 40% means 40% of basic pay. And beauty is, sometimes the DA, the question may be silent about DA. The question may not tell you whether DA is in terms or DA is not in terms. In such cases, CMA students, in such cases, you should assume it to be DA in not in DA in terms. Sorry. Please see, for CA and CS students, for CA and CS student, their institute assumes it to be DA not in terms if the question is silent. But for CMA student, please don't do this mistake. If the question is silent, normally it will not be silent. But if the question is silent, meaning if the question does not specify whether it is a DA in terms or DA not in terms, then assume the DA to be in terms and do your calculation. Okay, this point is very clear, very important. You will understand the importance of this very soon when we are discussing the few topics. Now, commission or fees. It is a taxable component of salary and it is fully taxable. The commission or fees, what is it, sir? It is a taxable component of salary. And how much is taxable? Fully taxable. Commission can be based on turnover or profits or product. Commission can either be based on turnover, or it can be based on profits, or it can be based on products. Now, important checkpoint over here is, if the commission is given in percentage form, if the commission is given in what format, sir? If the commission is given in percentage form, then that turnover, meaning that they say that the commission is 20% of turnover. That means that is a turnover commission. Okay, and if the question is silent, nothing mentioned whether it is a turnover commission or not, just assume it to be normal commission. Sir, but why are you specifying this? Again, you'll understand, because there are some formulas which says you should take turnover commission. So only if they have given that it is a turnover commission, assume it to be turnover commission. Advance salary. Advance salary means what, sir? Salary received by you in advance. Advance salary means it is a salary received in advance. It is a salary received in advance. Salary received in advance means what, sir? I have not worked in the company. I have not worked in the company. Okay, say for example, right now the month which we are in is May month. Okay, May 26 we are in. Okay, I have not worked for June and July month. I am telling the company, please give me the money for June and July also. That is called as what, sir? Advance salary. salary received in advance. It is a taxable component of salary and it is fully taxable. And it is taxable on what basis, sir? It is taxable on receipt basis. If you receive it, you will have to pay the taxes. Example. Dilip has a salary of 50,000 per month. He has, now please note, there is a difference between advance salary and advance against salary. Advance salary means what, sir? That salary which you have received in advance. Advance against salary means a loan. Advance against salary is a form of loan. Dilip has a salary of 50,000 per month. He has taken an advance against his salary of 5 lakh rupees. 10,000 rupees from his salary is adjusted against advance. So what is the taxable salary? My monthly salary, which is 50,000. Sir, 10,000 they are adjusting a day against advance. No, sir. Yes, it is as good as I have received that and I am giving back that money to them. Arrears of salary. Arrears of salary means what, sir? Past untaxed salary which you are receiving in the current year. Any increment in salary with a retrospective effect which was not taxed in earlier years. Whatever increment in the salary is there, with retrospective effect on which I did not pay any tax in the earlier years. It is a taxable component of salary and it is fully taxable, and it is taxable on receipt basis. What is taxable on receipt basis, sir? Your arrears of salary is taxable on receipt basis. See, three salary is taxable on receipt. Three components of salary are taxable on receipt basis. One is your bonus. Only when you receive, you have to pay the taxes. Advance salary. Only when you receive, you have to pay the taxes. Arrears of salary. Only when you receive, you have to pay the you should pay the taxes, in the sense you should include in your salary computation. Now we are starting with our main point, which is retirement benefits. The first type of retirement benefit is what, sir? First type of retirement benefit is gratuity. First retirement benefit is what, sir? Gratuity. What is gratuity, sir? Gratuity means what, sir? An employee has given 30 years, 25 years, 10 years, 20 years, whatever number of years of his life to the company, working in the company. So he has given a good amount of time. He has given a good amount of time to the company, working in that company. So the company wants to say thank you to him when he retires from the company. So how is the company going to say thank you? By giving some money to them, called as gratuity. So gratuity that can be received by you during your employment, or it can be received by the employee when he retires from the company, or it can be received by the legal heirs upon death of the employee. If the gratuity is received by the employee when he is still working in the company, then that will be fully taxable. Whether you are a government employee or a non-government employee does not matter. Okay. If gratuity is received during your employment, it is fully taxable, whether you are a government employee or a non-government employee. But if the gratuity is received by legal heirs, employee has died, who is receiving the gratuity? Legal heirs are receiving the gratuity. Now lawmaker says legal heirs never worked in the company, so I cannot tax, and they are already in a sorrow of death in their family member, etc. Therefore, we are not going to tax them. But if the gratuity, see, gratuity is basically a retirement benefit. See, gratuity received at the time of retirement. This is something which you have to keep in mind. This is something which is important also for us, and they are going to ask this only if they are going to ask about this. Gratuity received by you at the time of retirement is exempt under section 1010. Gratuity received by you at your retirement is exempt under section 1010. How much is exempt, sir? It depends on who you are. If you are a government employee, whatever you receive, full amount of gratuity is exempt. But if you are a non-government employee, then the exemption depends on whether you are a POGA employee or you are a non-POGA employee. Sir, what do you mean by this? Whether you are an employee covered under Payment of Gratuity Act, or you are an employee who is not covered under Payment of Gratuity Act. Sir, what is this covered under Payment of Gratuity Act, not covered under Payment of Gratuity Act? See, what happens is, companies know, the company, let us say, I have Priya Saris Private Limited, and we are registered under Payment of Gratuity Act. So the employees who are working for Priya Saris will be the employee who is covered under Payment of Gratuity Act. If we are not registered, then that employee will not be covered under Payment of Gratuity Act. As simple as that. Now, gratuity received at the time of retirement by government employee is fully exempt. By non-government employee, exemption will be whether he, based on his coverage, whether he is covered under Payment of Gratuity Act or not. If he is an employee covered under Payment of Gratuity Act, then 15 by 26 into salary per month into completed year of service, actual gratuity received, or limit of 20 lakh rupees, whichever is less, will be exempt. 15 by 26 salary per month or completed year of service, actual gratuity received, or 20 lakhs, whichever is less. If you are a non-POGA employee, half of average salary per month, completed year of service, or actual amount received, or 20 lakhs, whichever is less. So basically, if you see actual amount and 20 lakhs is same, apart from this, only the main calculation part is different. So first we will discuss about POGA employee. If you are an employee covered under what, sir? If you are an employee covered under Payment of Gratuity Act. If you are an employee covered under Payment of Gratuity Act, 15 by 26 into salary per month into completed year of service. 15 by 26 is fixed. See, basically they say in a month there are 30 days. Half of this is 15. Out of this 30 days, 4 days are Sundays, so 26 days. So 15 by 26 into salary per month into completed year of service, actual amount received, or limit of 20 lakhs, whichever is less. So salary per month is what, sir? So 15 by 26 is fine. Salary per month is your last drawn salary. Salary per month is your last drawn salary. Last drawn salary means what, sir? The salary which you are drawing at the time of your retirement. Last drawn salary, which is your basic pay plus DA, whether it is in terms or not in terms, complete DA. That will give you your salary per month. Now, they say completed year of service. What do you mean by completed year of service? How many years you have completed working in this particular company? That is completed year of service. Now, what happens is sometimes you may have fraction in completed year of service. Sir, what do you mean by fraction in completed year of service? Fraction in completed year of service means, let us say a person has worked for 26 years, 9 months. So what should I consider? 26 years or 27 years? Lawmaker says, if you are a POGA employee and if you have a fraction and if the fraction is more than 6 months, then consider it to be full year. If you are a POGA employee and if you have a fraction and if the fraction is more than 6 months, consider it to be full year. So 26 years 9 months is 27. 26 years 3 months, not more than 6 months, therefore 26 only. 26 years 6 months is 26 years. Okay. If you are a non-POGA employee means the employee who is not covered under Payment of Gratuity Act, then half of average salary per month into completed year of service, actual amount of gratuity received, or limit of 20 lakh rupees, whichever is less. Half of average salary per month or into completed year of service. What is the average salary per month, sir? See here, last drawn salary means when I was retiring from the company, what was my salary? That salary. Average salary per month, you should take last 10 months ka average of last 10 months, which will include your basic pay plus DA only in terms ka DA. Here you take the full DA amount, but in case of non-POGA employee, you take only DA in terms, and you should also consider turnover commission. Then if you have any fraction in completed year of service for which employee, sir? For POGA employee. If non-POGA employee, if you have any fraction, then that fraction should be completely ignored. Now, very important notes. For calculating salary per month and average salary per month, the month of retirement should be ignored. Meaning, if a person is retiring in the month of July, ignore the month of July, take June month ka salary, or take last 10 month ka salary from June month onwards. Statutory limit of 20 lakh rupees is applicable to an individual as an employee throughout his lifetime, irrespective of any number of employers he has. Meaning, 20 lakh limit which is there, 20 lakh rupees ka limit, it is applicable to one single person for his entire lifetime. It does not matter how many companies you leave. So let us say I worked in 5 companies. Every time I get gratuity, that 20 lakh limit will be reduced. Okay, that 20 lakh limit will be reduced. If the question is silent whether he is a POGA employee or non-POGA employee, very good. Assume him to be a non-POGA employee. Now see this question. Mr. Ravi retired on 15/6/25 after completing 26 years 8 months of services and received a gratuity of 15 lakh rupees at the time of retirement. His salary was, basic pay is 50,000 rupees, dearness allowance is 10,000 rupees per month, and 60% forms part of retirement. Commission is 1% of turnover, and turnover of last 12 months is 1 crore 20 lakhs, and bonus is 25,000 per month. Compute the taxable gratuity. If he is a private sector employee, covered under POGA, not covered under POGA, and gratuity. So all the cases they have given. So how do I do the computation? First, name of the assessee, previous year, assessment year, computation of taxable gratuity. Particulars, rupees. First, amount received by me is how much? How much have I received, sir? I have received 15 lakh rupees. I have received how much? 15 lakh rupees. Less exempt under section 10(10). How much is exempt? POGA employee formula says 15/26 into salary per month into completed year of service. 15/26 is same. Salary per month means your basic plus DA. So basic is 50,000, dearness allowance is 10,000. So basic plus DA is 60,000 rupees. So 15/26 into 60,000 into completed year of service. How many years I have completed, sir? 26 years 8 months. That means fraction more than 6 months, round off to the, it is considered as 1 full year. So 27 years. You get this. Actual amount is 15 lakhs, limit is 20 lakhs, whichever is less. 9,34,615 is the least. This will be exempt. So taxable gratuity is 5,65,385. So if you are a non-POGA employee, half of average salary per month into completed year of service. Half will remain half. 66,000, which is what, sir? Average salary per month. What will you take? Basic plus DA only in terms you will take, and turnover, commission. So basic pay is 50,000. DA in terms 10,000 into 60% only is in terms. So 6,000 is DA in terms. Turnover, commission. So they have given 1% of turnover. Turnover commission is how much, sir? 1% of turnover. So they have given 1.2 crores as the turnover for 12 months. So divided by 12 months will give me turnover of 1 month, which is 10 lakhs. 10 lakhs into 1% is 10,000 rupees. So this is my turnover commission. So non-POGA employee, half of average salary per month into completed year of service, you get 5,85,000 rupees. So basically the actual game revolves around calculating the salary amount properly. Of course, remembering the provision also, the formula also. So sometimes what may happen is there may be an increment in the salary. Okay, there may be an increment in the salary. So when you are taking last 10 month ka salary, you should be very careful. Now please note, in this question you see, they have given salary per month as 10,000 rupees. And they have given date of increment was 1/4/25. So the question is whether this salary is before increment or after increment. They have told salary has been increased by 1,000 rupees. So the question over here is this 10,000 rupees is after increment or before increment. So this is a very big, this is a very important point. This is a very important point because a lot of students will make this mistake. This 10,000 rupees, whether it is before increment or after increment, lawmaker says very simple, Dilip. Lawmaker says very simple, Dilip. What is very simple about this? Lawmaker says this 10,000 rupees, whether it is before increment or after increment, you want to know now. Very simple it is. See, if a person is leaving the company, the salary given will be after increment. If the person is leaving the job, then the salary given to you will be after increment. But if the person is still in the company, he is still working, then the salary which they'll give you will be before increment. So if he is leaving the job after increment and he's still working in the company, that means the salary which they have given is before increment, and this is additional information. Okay, be very careful with this. Then the second type of retirement benefit which we have is called as your the second type of retirement benefit which you have is called as what, sir? Your pension. Pension is what, sir? That amount of salary which you receive on monthly basis once you retire from the company. Pension can be uncommuted pension or it can be commuted pension. Sir, what is uncommuted pension? What is commuted pension, sir? Uncommuted pension means that pension which you are going to receive on monthly basis. Commuted pension means that pension which you are going to receive in one lump sum. Uncommuted pension is your monthly pension. It is always taxable whether you are a government employee or a non-government employee. Uncommuted pension is what, sir? Your monthly pension. It will always be taxable whether you are a government employee or non-government employee. So once you leave the job, after leaving the job, you may receive pension on monthly basis. Correct? After leaving the job, you may receive the pension on monthly basis. That is your uncommuted pension. That is a taxable pension. Whatever you receive every month, that is taxable under salary. So let us say your parents were working as a government employee. Now they are receiving pension. Whatever they are receiving every month, that is a taxable pension. Commuted pension means one lump sum pension. What people can do is, this pension which you are going to receive every month, you can commute that. You can convert them into lump sum pension. So that lump sum pension will be exempt under section 1010A. How much will be exempt, sir? That depends on whether you are a government employee or you are a non-government employee. If you are a government employee, then it will be fully exempt. But if you are a non-government employee, then check whether you as an employee have also received gratuity or you have not received the gratuity. If you have also received gratuity, 1/3 of total pension is exempt. If you have not received gratuity, half of total pension is exempt. Sir, repeat. See, pension is the money given to you after retirement. Normally, it will be given to you on monthly basis. Normally, it will be an uncommuted pension. But some people can convert that and take it in lump sum also. Many people do that. So after their retirement, let us say after 6 years, 7 years, 10 years, etc., if their daughter is getting married, they may convert that pension, monthly pension, into lump sum pension. So this uncommuted pension is a pension which is always taxable. Commuted pension is lump sum pension which will be exempt under 1010A. Government employee, fully exempt. Non-government employee, the exemption depends on whether that non-government employee has also received gratuity or he has not received gratuity. Whether he has also received gratuity or what, sir? He has not received gratuity. If you have also received gratuity, then 1/3 of total pension. Please note, they are not giving 1/3 of the money received by you. No. Whatever is the total amount of pension into 1/3, 1/3 of total pension will be exempt. If you are not receiving gratuity, then half of total pension will be exempt. What is total pension, sir? Computation part you understand. If you understand this part, then nothing else is there in your pension topic. Dilip retired on 30th of June 2025 and the monthly pension was fixed to be 10,000 rupees per month. He commuted 60% of his pension and received 6 lakh rupees. And when did I do the commutation, sir? On 1st of January. Now please see. 60% of my pension I commuted. I took it as lump sum, and after commuting that, what did I receive, sir? 6 lakh rupees. That means what, sir? My total pension will be 6 lakh divided by 60%, because 10 lakhs ka 60% is what I received as a commuted pension, correct? 6 lakhs divided by 60%, 10 lakh rupees. This 10 lakh rupees is what, sir? This 10 lakh rupees is my total pension. What is this 10 lakh rupees? This is my total pension. Now this total pension ka 1/3 will be exempt if I have also received gratuity. If I have not received gratuity, then half of total pension will be exempt. Now, what am I receiving after my retirement as a monthly pension, sir? 10,000 rupees. Now, because I commuted this monthly pension, so because I commuted 60% of my pension, so I was receiving 10,000. Because I commuted 60% of my pension, whatever is left over is only 40% now. So I will receive, after commutation, I will receive only 40% of my monthly pension, meaning my monthly pension also will be reduced to 4,000. Sir, I'm sorry, I did not understand. Can you please repeat? Yes. See, my monthly pension was 10,000. 60% of my total pension is commuted, meaning out of total pension only 40% is left over. So this 40% only I will receive after commutation. So from 1st of January, which is the date of commutation, I will not receive 10,000. I will receive only 40% of this 10,000, which is 4,000 every month from 1st of January. So my uncommuted pension will be 10,000 into 6 months. Why 6 months, sir? because from 1st of July till 31st of December, I received 10,000. Then I will receive 10,000 into 40% leftover part for balance period. Pension. Next is your leave salary. Leave salary means what, sir? Leave salary is very simple. If you are taking a leave, company may have a policy that even if you take leave, even if you work on your leave day, I will give you salary. Okay, because you are working on the day when you are not supposed to work, I am very happy. So lawmaker says, I want to compensate that to you. How will I compensate that, sir? By giving you salary. How will I compensate that? By giving you salary. That salary which is there, that will be called as what, sir? Leave salary. That salary is called as leave salary. Leave salary or leave encashment. Let us say company has a policy that 1 month will have, in every month, you can take leave for 2 days. Even if you take leave for 2 days in a month, I will pay you the salary, and the salary, even if you take 2 days leave in a month, I will pay you salary for that. Okay. So in a year, I can take leave for how many days? 24 days. I can take leave for how many days, sir? 24 days. Now 24 days is there. Out of that, I have taken leave only for 4 days. Out of 24 days which are there in a year, I have taken leave only for 4 days. So this is leave taken by me or leave availed by me. Out of the 24 days, which is the leave which is allowed to me, I have taken only for 4 days. Balance 20 days I have not taken. This balance 20 days ka leave is my unutilized leave or leave credit or leave available with me or leave balance. Okay, leave credit is leave allowed minus leave taken. Now leave salary means what, sir? Leave salary means encashment of leave credit. Leave salary means what, sir? See, these words are important. Leave allowed is the total number of days leave company is allowing me that I can take. Leave taken or leave utilized is the number of days leave I have taken. Unutilized leave or leave credit or leave balance is that leave which I could have taken but have not taken. So this will be paid by the company to me. That is called as earned leave or leave credit ka encashment. Leave salary means encashment of leave credit. Leave salary means what, sir? You are converting, encashing the leave credit. Now, as per income tax law, say company may give you 2 months ka leave in a year, 3 months ka leave in a year. That is company policy. But as per income tax law, only 1 month leave is allowed for every completed year of service. So every year you complete in the company, I'll give you 1 month ka. I will give you 1 month ka leave as per income tax law. Now, taxability of leave salary. Leave salary, when are you receiving it? Received during employment. If you are receiving it during your employment, then it is fully taxable. See, basically, anything given, we are studying retirement benefits. So whatever is given to you at the time of retirement, only then it will be exempt. Correct? So if you are receiving the leave salary during your employment, then it will be fully taxable, whether you are a government employee or a non-government employee. But if you are receiving it at the time of your retirement, then it will be exempt under section 1010 AA. If you are receiving it at the time of your retirement, it will be exempt under section 1010 AA. So it depends on whether you are a government employee or you are a non-government employee. If you are a government employee, fully exempt. If you are a non-government employee, then exemption will be leave credit into average salary per month, 10 months into average salary per month, actual amount received, or limit of 25 lakhs, whichever is less. Government employee, fully exempt. Non-government employee, leave credit into average salary per month, 10 months into average salary per month, actual amount received, or limit of 25 lakh rupees, whichever is less. Now, what is average salary per month over here? Same. You should take last 10 months ka average till the date of retirement, which will include your basic plus DA income plus turnover commission. Now, when you are calculating the leave credit, please calculate the leave credit as per income tax law. Okay, you should calculate as per income tax law. What is income tax law telling? For every year, I will allow only 1 month. Month of retirement should also be considered. Over here, you should also include the month of retirement. Fraction in completed year of service. So if you have any fraction in completed year of service, if a person has worked for 26 years, 9 months, then take only 26 years. Ignore the fraction. See over here. Mr. Gupta is there. He retired on 1st of December 25 after 20 years of service and received a leave salary of 5 lakh rupees. Other details of his salary is basic salary is 5,000 rupees and 1,000 rupees was increased with effect from 1st of April 2025. So the salary given by them, is it before increment or after increment? As I told you, if a person is going out of the company, that means it is after increment. Dearness allowance is 3,000, 60% forms part of retirement. Commission is 500 per month, bonus is 1,000 per month, leave availed is 480 days, and leave credit is 30 days in a year. Calculate taxable leave. Now please see. For government employee, 5 lakh minus 5 lakh fully exempt. For non-government employee, I should take leave credit. Now what is the leave credit? See, they have told leave availed. Availed means how many days he have taken. Leave entitled. So he has worked in the company for 20 years. So 20 years into 30 days leave company is giving. So company is giving a total leave of 600 days. Out of 600, 480 days ka leave you can take. So only 120 days ka leave is 120 days ka leave is what? Only 120 days ka leave credit you have. Correct? This is the leave credit. So this is the leave allowed by the company. This is the leave taken by you. So the credit is 120 days. Now, leave credit, which is 120 days divided by 35 to 4 months into average salary per month. This calculation is important. Take your basic pay. Last 10 month ka average. So for, because there was an increment from 1st of first of April. So from April till December, you will take 5,000. Before the 2 months, you will take 4,000. Dearness allowance, you take whatever is in terms, and turnover commission not given, therefore ignored. So your 10 months ka salary is how much, sir? 66,000. But you should take average of this divided by 10, 6,600. So leave allowed is 30 days into, okay, this is already done. 4 months into 6,600. 10 months into average salary per month, 10 months into 6,600. Actual amount received by lakh rupees and limit of 25 lakh rupees, whichever is less. Mr. Das retired on 31/3/26. At the time of retirement, 18-month leave was lying to the credit of his account. He received leave encashment equivalent to 18 months basic salary of 1,26,000. His employer allows him 1.5 months leave for every completed year of service. During his tenure, he availed 12 months leave at the time of retirement. He also gets DA forming part of retirement of 3,000 per month. Find taxable leave encashment. Okay. So similarly here, see, now here what is the difference is, see, main thing which you have to find in leave salary question is your leave credit, and that should be found as per income tax. Now here what has happened is, company gives you a leave of 1.5 months for every year, but income tax allows only 1 month. So though they have given you the leave credit of 18 months over here, this is as per the company policy, which is wrong. We should find it as per the income tax law. So though they have given it as per company policy, I'll have to recompute the leave credit as per the income tax law. So leave credit as per income tax law is only 8 months. Sir, how will I compute, sir? That is completely based on the information given in the question. So in this question, it is a different. If you see the next question, again the computation part is different, but the base formula is will remain same. Leave credit is equal to leave allowed minus leave taken. Now this, if they have given as per company policy, using this, find the missing figure, then find the leave credit as per income tax. For example, over here, leave credit they have given 18 months, but allowed leave is how much? 1.5 months. And leave availed by him, taken by him is 12 months. Here they have not given how many years he has worked in the company. So number of years in the service, I will take it as X. I will find how many years he has worked in the company. Using this information now, I will find the leave credit as per income tax law. Next is retrenchment compensation. See, retrenchment compensation and VRS compensation, normally they will ask these 2 points in your MCQs. They will not test you in other places. Normally they will test you in MCQ only. As a question, they may normally not ask you these 2 points. Retrenchment compensation is exempt under section 1010B. How much is exempt? It depends on whether you are a government employee or you are a non-government employee. If you are a government employee, as usual, fully exempt. If you are a non-government employee, then 15/26 into average salary per month into completed year of service, actual amount received or limit of 5 lakh rupees, whichever is. This average salary per month is here
See, everything else is same here. Average salary per month, you should take last 3 months ka average. That is the important point, which will include here. Basic plus DA in terms plus turnover commission. Fraction in completed year of service. If the fraction is more than 6 months, consider it to be 1 full year. So yeah, this is there. VRS compensation. It is exempt under section 1010C. For both government and non-government employee, the exemption amount is same. Salary per month into 3 months into completed year of service. Salary per month into remaining months in service. I have taken VRS. If I would have not taken VRS, I would have stayed in the company. So how many months I would have completed? Actual amount received or limit, whichever is less. Now salary per month is basic pay plus DA in terms plus turnover commission. Fraction in completed year of service. If you have any fraction, ignore it. Now comes the important point, which is allowances. The next point or important point is what's up? Allowances. Normally they may test you on allowances. Allowances are monetary benefit given by the company. See, what company does is that it can do two things. It can either give you perquisites or it can give you allowances. Perquisite means what? If company is giving you money to meet a particular type of expenditure, it is an allowances. If the company gives you that particular thing, it is a perquisites. For example, company is giving me a car. If the company is giving me a car, that means it is an perquisites. If the company is giving me 5,000 rupees per month for my transportation, that means it is an allowances. So allowances are what, sir? Allowances are normally monetary benefits given by the company. Perquisites are normally non-monetary benefits given by the company. As simple as that. So that is the only difference. Allowances are monetary terms. No, perquisites are non-monetary terms. So that is the only difference between allowances and perquisites. Allowances. See, you cheat is limit-based exemption will be given to you. Duck hat is spend-based exemption. Apart from that, any other type of allowances is fully taxable. HRA is also exempt, that you will see separate. Under allowances, what is the most important allowances, sir? HRA is most important allowances. And also they may test you on children education and hostel allowance. Anyways, we'll start the discussion. What is an allowances? Allowances are monetary benefits given by a company to meet a particular type of expenditure. So what is an allowances, sir? It is a monetary benefit. What do you mean by monetary benefit? Something which is given by the company in the form of money. Monetary benefit given by the company to meet a particular type of expenditure. Particulars remarks. Commutation allowance. Commutation allowance, also called as transport allowance. So commutation allowance or transport allowance is a allowance which is fully taxable. So commutation allowance means what, sir? Money given by the company to you for travel between office to home and home to office. This is called as commutation allowance or transport allowance. Commutation means from office to home and home to office. This is fully taxable. Rupees, however, if you are an handicapped employee, blind employee, deaf employee, etc., then rupees 3,200 per month will be exempt for. Children, hostel allowance. Children, what allowance are? Children, hostel allowance. Maximum rupees 300 per month per child. For a maximum of 2 children, you can claim exemption. Children, hostel allowance, you can claim exemption of how much, sir? Rupees 300 per month per child. For how many children? Maximum 2 children, you can claim this exemption. Children education allowance. Again, maximum rupees 100 per child per month. For a maximum of 2 children can be claimed as exemption. Tribal area allowance. If the employee is working in a tribal area, some forest area, etc., then 200 rupees per month exemption you can claim. Truck driver allowance, or basically it is an allowance which is given to employees who are working in a transport company. Actual amount into 70% or limit of 10,000, whichever is less, is exempt. Underground allowance, if you are working in coal mines, underground somewhere like KGF, etc., then maximum rupees 800 per month will be exempt. That is you cheat. Duck hat, daily allowance, uniform allowance, conveyance allowance, helper or assistant allowance, academy allowance or research allowance or professional development allowance, traveling allowance, tour allowance or transfer allowance. All these types of allowances are exempt based on the amount received by you or actual amount spent by you, whichever is less. Amount received by you or actual amount spent by you, whichever is less. So house rent allowance HRA is exempt under section 1013A. How much is exempt? So this is important. 40% of salary or 50% of salary, actual HRA received by you, rent paid minus 10% of salary. 40% of salary or 50% of salary, actual HRA received or rent paid minus 10% of salary. 40% or 50%, sir, what should I take? 40 or 50? Normally, you should take 40% of salary. You should take 50% of salary if the employee is residing in these 4 places, residing in any of these 4 metro cities, which is Delhi, Mumbai, Chennai, Kolkata. If you reside over here, then you take 50% of salary. Sir, what is salary over here? Salary is your basic pay plus DA incomes plus turnover commission. Now, place of residence is important, not the place of employment. Any allowances apart from this is fully taxed. HR is important. Education allowance, hostel allowance, children education, children hostel is also very important. Now, Mr. Srikanth has 2 sons. He is in receipt of children education allowance 150 rupees per month, and for his elder son, and rupees 70 per month for younger son. Both of his son are going to school. He also receives following allowances: transport allowance and tribal area allowances, Srikanth, etc. So child 1 he is receiving 150, but maximum how much, sir? 100 rupees I can claim. Second child I am receiving 70 rupees and I can claim 70 or 100, whichever is less, 70 rupees. Transport allowance I am receiving, tribal area allowance 500 rupees I receive, 200 rupees exemption I claim. Next, after allowances you have your provident fund, etc. Now, provident fund can be employee provident fund or public provident fund. Public provident fund is not related to this chapter. Employee provident fund is covered under salary chapter. Now, employee provident fund can be of 3 types: statutory provident fund, recognized provident fund, and unrecognized provident fund. Statutory, recognized, and unrecognized provident fund. Now, statutory provident fund. See, basically what is a provident fund? Basically, it is a fund. It is a fund which is created for the welfare of employees. Okay, once he leaves the job, so it is a form of a technique which is going to help the employee save for his future. Okay, so statutory provident fund is there. Employee contributes to this fund. Whatever contribution employee is making, he is making out of his own salary. Therefore, ignore it for salary computation. And whatever contribution is made by him, that can be claimed as deduction under section 80C. Whatever contribution employer makes to this fund, it is an extra money, correct? No, which company is going to pay to this fund. This, because it is an extra money, it should be taxable in the hands of employee. Lawmaker says no, it is not taxable. So if employer makes contributions to statutory provident fund, it is exempt. Now you receive interest on employee ka contribution, interest on employer ka contribution, both the interest, whether it is on employee or employer contribution, it is exempt. Whatever lump sum amount you receive at the time of your retirement, that lump sum amount which you receive at the time of your retirement, that is also exempt. Meaning lump sum amount received means what, sir? When you leave the job, whatever amount you receive, that is exempt. So statutory provident fund is basically very simple. Why, sir? It is very simple. Because everything is exempt. Your contributions are exempt. Interest is exempt, lump sum amount is exempt. Basically, it is for government employees. What is important is RPF, Recognized Provident Fund. Now, let us create a fund called as Recognized Provident Fund. Employee is going to make the contribution to this fund. Employee contribution should be ignored and he can claim a deduction under section 80C for his contribution. Employer contribution is exempt. Whatever employer contributes in this fund, meaning employee is you, employer is Dilip. So whatever contribution employer is going to make, that will be exempt in the hands of employee only if the contribution is up to 12% of salary. If it is more than 12%, then 12% of salary will be exempt. So salary is what, sir? Basic plus DA incomes plus turnover commission. Now interest on employee ka contribution, interest on employer ka contribution will be exempt up to 9.5% per annum. Interest, both interest on employee as well as employer contribution will be exempt up to 9.5% per annum. Now, in this fund, your contribution, my contribution, interest on your contribution, interest on my contribution is there. This amount, when we withdraw the lump sum amount from this fund, the lump sum amount which is received by the employee during his retirement, that will be exempt. If minimum 5 years in service is completed, if you complete minimum 5 years in service, then whatever lump sum amount you receive from this fund will be exempt. Except in these 3 cases. In these 3 cases, exemption will not be applicable. If you retire because of your ill health, if employer has discontinued his business, or if the transfer is, if they transfer the balance of recognized provident fund from the old employer to the new employer, or they transfer the money in this fund to ATCCD pension fund. Now, with respect to interest, there is one important catch. See, basically, normally the question will revolve over here. RPF, employee contribution, ignore. Claim deduction under ATC. Employer ka contribution exempt up to 12% of salary. Interest on employee ka contribution and interest on employer ka contribution exempt up to 9.5% per annum. Lump sum amount withdrawn by you at the time of retirement is also exempt if you complete minimum 5 years in service. Now, interest part is very important over here. Interest on employer ka contribution, interest more than 9.5% per annum will be taxable as salary. For employer ka contribution, interest on employee ka contribution, interest in excess of 9.5% of salary will be taxable. Interest in excess of 9.5% per annum will be taxable in the hands of employee as salary. Now, there is one more important point over here which says, if the employer contributes money in this fund, what's up? If the employee, not employer, if the employee has contributed more than 2,50,000 rupees, if the employee has contributed more than 2,50,000 rupees, then the interest on that contribution in excess of 2.5 lakhs is fully taxable. If employee has contributed more than 2.5 lakhs, then whatever interest is there, that interest will be fully taxable. Next, I have what's sir? URPF, unrecognized provident fund. And I mean, this is simple. And of course, they ask this in examination, but very simple. What is beauty about this is, whatever contribution you make is exempt. Only when you withdraw, it is taxable. Unrecognized provident fund, URPF, employee ka contribution ignore, employer ka contribution exempt. Interest on employee ka contribution, interest on employer ka contribution is also exempt. Basically, whatever contributions and interest you are earning during the period when money is contributed in this fund is exempt. Only when you withdraw the money from this fund, you have to pay the taxes. Lump sum amount received by employee has on his retirement. This lump sum amount will be divided into 3 categories. Employee ka contribution, interest on employee ka contribution, employer ka contribution, interest on employer ka contribution. Employee ka contribution, that is not treated as income. Why, sir? Because my own money I have put, I'm withdrawing my own money, not treated as income for me when I withdraw that money, therefore ignore it. Interest on employee ka contribution. Now I have put the money, whatever my money I am withdrawing, that is not taxable, that is required to be ignored. But interest on that money which is there, that is taxable under income from other sources. Employer ka contribution as well as interest on employer ka contribution, meaning employer ka contribution, my contribution, I have put the money in the fund, and whatever interest you are earning on that, that will be taxable in your hands when you withdraw it under the head salary. Superannuation fund, normally they will not test you on this fund in the examination, but anyways, if it is approved superannuation fund, exactly just like your statutory provident fund, unapproved exactly like your unrecognized provident fund. Approved superannuation fund, employee ka contribution ignore, you can claim deduction under ATC. Employer ka contribution exempt up to 7.5 lakhs per annum. Interest on employee ka contribution, interest or employer ka contribution is exempt. Lump sum amount received by the employee on his retirement is exempt. Unapproved superannuation fund, employee ka contribution ignore, employer, see, exactly same as your unrecognized provident fund. So your contribution and interest is exempt. However, lump sum amount when you withdraw, your own contribution ignore. Interest on your contribution is taxable under IFOS. Employer contribution and interest on employer contribution is taxable under salary. ATCCD pension fund, basically it is a concept from your deduction chapter. We'll cover over there. Now, this is important. Deductions under salary. Deductions under salary. Section 16 talks about deductions. There are totally 3 deductions which you can make from your salary income. What are these 3 deductions? Deduction number 1 is your standard deduction. which is available to all types of employees. The amount of deduction is whatever employee pays under, okay, the deduction, amount of deduction depends on whether you are a person opting for optional tax regime or you are a person who is opting for default tax regime. The amount of deduction will depend on whether you are opting for optional regime or default regime. Standard deduction, meaning if a person has an income under the head salary, this is the flat fixed amount of deduction which I am going to give. How much is the deduction? If you are opting for optional regime, whatever salary you are receiving or 50,000 rupees per annum, whichever is less. If you are opting for default regime, salary received by you or 75,000 rupees, whichever is less. 75,000 rupees per annum, 50,000 rupees per annum. Now, sir, what if I am working in 5-6 companies? Will I get this deduction separately from all the companies? No. It is for an employee, meaning Dilip works in 5 companies. Will I get 50,000, 50,000, 50,000? No. 50,000 is for me as a person. So, if employee has received salary from more than one employer, deduction will be allowed only once. Entertainment allowances. What is the next allowances which we have? Entertainment allowance. Entertainment allowance. So basically it is an allowance. Because it is an allowance, did we study anything about entertainment allowance? No. So if it is something which we have not studied about, that means it is a taxable allowance. So first you should add it in your salary computation. So when you are computing the salary, please add it to your salary computation. Entertainment allowance should first be added to your salary computation. Okay. Then deduction will be allowed only if you are a government employee. First you should add to salary. Then deduction I will give under section 16 subsection 2 only if you are a government employee. How much deduction will be given, sir? 20% of your basic pay or the actual amount received by you or the limit of 5,000 rupees per annum, whichever is less. 20% of basic pay or actual amount received by you or 5,000 rupees, whichever is less, is the amount of deduction which will be given to you. Now, this entertainment allowance deduction which is there will not be given to you if you are an employee opting for default tax regime. See, first of all, this will be allowed only for government employees, correct? And if that government employee has opted for default tax regime, then the deduction will not be given. Then we have professional tax, important, again, good deduction it is. What is professional tax basically? See, you are working in a state, that state government is not collecting any tax from you because on income, whatever tax is there, tax will be collected by whom, sir? Central government. So the state government wants some money from you. So what will state government do? The state government will collect something called as professional tax from you. So what is professional tax? It is a tax on employment which is collected by state government. What is professional tax? It is a tax on employment which is covered, collected by whom, sir? State government. It is allowed as deduction only if it is paid by government employee. It is allowed as deduction only if it is paid by employee, meaning professional tax is my liability as an employee. As an employee, I have to pay the professional tax. Only if you pay it, you can claim it as deduction. Now, if employer pays, let us say you are the employee, I am the employer, it is your responsibility to pay professional tax. But if I am paying the professional tax on your behalf, lawmaker says first it will be added to gross salary, then deduction will be claimed under section 16. How much is the deduction which I am going to claim, sir? Maximum 2,500 rupees per annum. How much deduction, sir? 2,500 rupees per annum. If employer is paying, add it, then claim the deduction. Sir, what if I pay professional tax for multiple years in a single year? So last 5-6 years I did not pay professional tax. Everything I am paying in this year only, sir. Lawmaker says no problem. If your outstanding professional tax of earlier years are paid in the current year, then also deduction will be allowed in the current year. Then also you'll get a deduction in the current year, but maximum how much will I give? 2,500 rupees. No professional tax deduction will be given if the employee is opting for default tax regime. So basically, if an employee is opting for default tax regime, he is going to get only one deduction, which is standard deduction. How much, sir? 75,000 rupees. Now, the last part of this salary is your perquisites, which is important part of salary. What is perquisites? Extra benefit given by the company. Let us say, I tell you guys, students, you attend my class. In the class which you are going to attend, of course, studies will be there. Of course, I am going to give you books also. Apart from that, instead of sitting on normal benches, I will arrange sofa for you. Apart from that, anytime if you are feeling hungry, I'll make sure that there is a person who comes with whatever food you want and he'll serve that food to you. If you are feeling tired in the classroom, there will be a person who will come and massage you. Okay, just imagine if this kind of extra benefit is given, then that will be called as what, sir? Perquisites. What is perquisite, sir? Perquisite is an extra benefit given by the company. So it is an extra benefit given by the employer, or it is an extra benefit given by the company. Normally, perquisites are non-monetary benefits, meaning it is not in terms of money, because if it is a monetary benefit, then it is a allowances. But sometimes what may happen is you cannot give it in non-monetary terms, so you'll have to give in monetary terms sometimes. Like for example, a company may not purchase an aeroplane for transportation of employee, it may book tickets for employee, correct? So sometimes it can be non-monetary terms also. Reimbursement of expenses or any expenditure of employee which is incurred by the employer, that is also perquisites. So if any expenses is there which you are supposed to incur, but if I am incurring that expenditure on your behalf, that will be treated as perquisites. What will that be treated as, sir? That will also be treated as perquisites. Now, first perquisites which we have is leave travel concession. Again, good perquisites, important perquisites. LTC, leave travel concession. What is leave travel concession? You want to go anywhere in India, I will take care of your travel expenditure, leave travel concession. So it is a travel benefit given by the company for travel anywhere in India. So employee can travel anywhere in India. For that I am giving some benefit, the money, that is called as leave travel concession. It is exempt under section 10(5). Leave travel concession is exempt under section 10(5). You are traveling by air or you are traveling by any other. If you are traveling by air, then how much is the exemption, sir? Actual expenses or economic class ka airfare, whichever is less. Now it does not matter how you are going. You may go through business class. You can go by any mode. Okay, you can go by business class, first class, etc. But I will take the actual expenses. Compare that actual expenses with whom, sir? Economic class ka airfare. So aeroplane has different classes. I'll take economic class ka airfare, whichever is less. If you're traveling by air, no sir, I am not traveling by air. I am going by my car. I am going in a train. I am not traveling by air. So if you travel by any other mode, if you are traveling by car or bus or train, etc., any other mode, check whether the place where you are going is railway facility available at that location or railway facility is not available at that location. Please note, it does not matter whether you are going by train or not. It does not matter whether you are going by train or not, but the place where you are going is railway facility available at that location or is railway facility not available at that location. Yes, sir. Railway facility is available at that location. The railway facility is available at that location. I am going by car. I am going by bus. No problem. Is railway facility available? Yes, sir. Then take your actual expenses, whatever you have incurred by going by car, bus, etc. Compare that with first class AC ka rail fare. Take whichever is less. Railway facility is not available at that location. Sir, wherever I am going, no sir, there train does not go at all. Sir. Railway facility is not available at that location. Then check whether any recognized public transport facilities available or not. Check what, sir? Check any recognized public transport facilities available or not. Recognized public transport facility means what? Bus facility. Correct? Take your actual expenses. Compare that with deluxe class ka bus fare, whichever is less. Sir, what if that is also not there? If recognized public transport facility is also not available at that location, then take your actual expenses, compare that with first class AC rail fare for similar distance, take whichever is less. Note, important point. Sir, if I am going somewhere, if I go alone, problem is there, sir. So can I take someone with me? Yes, lawmaker says leave travel concession ka exemption is available for employee himself. Along with him, he can take his spouse, his children, and his dependent relative. Dependent relative will include father, mother, brother, and sister only if they are dependent on him. Leave travel concession is available only for 2 children born on or after 1/10/1998. Meaning, if the children are born on or after 1/10/1998, maximum 2 children's ka exemption you can claim. And what is important over here is, if in second pregnancy multiple births happens, multiple birth in second pregnancy is considered as one. 2 journey exemption can be claimed in a block of 4 years. So one block. So basically, how many times I can claim this leave travel exemption, sir? Sir, I like traveling, sir. Can I travel every month, every 2 months, etc.? Lawmaker says don't do base. Leave travel concession exemption which is there, that will be given to you. Leave travel concession exemption which is there will be given to you only for 2 times in a block of 4 years. So one block has 4 years. In a year, here over here means calendar year. The present block is 22 to 25. Now, sir, what if I have not traveled at all in the previous block? Now, can I use or carry forward the exemption the next year? Yes. If you have not at all traveled in the previous block, then you can carry forward the travel in the current block. Carry forward is possible. And how many carry forward you can do? You can carry forward only one travel, which should be used in the first year itself. Employee can carry forward one travel from the previous block, which should be used in the first year of the present. Please note, carry forward is possible only when you have not at all traveled in the previous block. Not even one travel. Then medical facility is there. Then what is there, sir? Medical facility. Medical facility means what, sir? Company is giving you money. Company is giving you money so that medical facility you can take care of your medical expenditure, etc. Now in this medical facility you should see where is the treatment happening. Treatment is happening in India. If the treatment is happening in India, then check in India where the treatment is happening. If it is happening in government hospital or government approved hospital or employer ka own hospital, then exemption is available. The treatment is happening in government hospital, government approved hospital. Government approved hospital means like we have AIMS or we have Rajiv Gandhi Hospital, which is the government hospital basically in Chennai, etc. Or employer ka own hospital. Employer himself has his own hospital. If the treatment is happening in these different places, lawmaker says completely it is exempt. All other cases it will be fully taxable. In all other cases it will be fully taxable. Treatment is happening outside India. Treatment is happening where, sir? Outside India. Now, expenses for treatment and stay will be exempt as per the RBI limit. If the treatment is happening outside India, whatever expenses you are incurring for your treatment and whatever expenses you are incurring for your stay, that will be exempt as per the RBI limit for patient and one attendant. If the expenses is for travel, normally it will be taxable. However, if the employee's gross total income before this traveling expenses is up to 8 lakh rupees, then even the travel expenses will be exempt. Now, what is important point to be noted over here? Exemption is for treatment of employee, spouse, children, dependent relative. Meaning employee himself is not feeling bad, and spouse of employee or children or employee, dependent relative, then it is exempt. Now, please note, this is an important amendment over here. You please mark this point. Okay, this is an important amendment. 8 lakh rupees is the new limit. Before the limit was 2.5 lakhs or 2 lakhs. Now it is 8 lakh rupees. So this is important amendment. Treatment is outside India. So expenses for treatment as and stay as per RBI limit, exemption will be there. For travel, normally it will be taxable. However, if the employee's gross total income before travel expenses is up to 8 lakh rupees, then even the travel expenses will be exempt. Mediclaim or health insurance taken by the company for employee, exempt. Life insurance taken by the company is taxable. Gift by employer. Gift, if it is in cash, taxable. If the gift is in kind, then market value of the gift is more than 5,000 rupees, taxable. If the market value of the gift is less than 5,000 rupees, then it is exempt. Loan given by employer without interest or at concessional rate of interest. See, please note, gift limit is 5,000. More than 5,000 equal to 5,000 fully taxable. Loan given by the employer. Loan given by the employer means company is giving the loan. Loan given by the employer. How is the loan given? Without interest or at concessional rate of interest. Concessional rate means 10% is the market rate. I am giving only at 4%. Correct? No, 6% benefit you are getting. Basically, what is perquisites? Perquisites are nothing but benefits. Loan is given for medical treatment. If the medical if it is a specified disease, leprosy, TB, cancer, etc., fully exempt. If it is for any other purpose, loan amount is up to 20,000 rupees, exempt. Loan amount is more than 20,000, it will be taxable. How much is the taxable amount, sir? Loan amount outstanding at the end of the month. Take the loan amount outstanding at the end of the month, multiply it by what is the rate of interest charged by the State Bank of India. Please note RBI. RBI means what? State, so not RBI, sorry, SBI. State Bank of India ka rate of interest as on first day of previous year. I would have taken the loan in the month of December. Lawmaker says no problem. You go to 1st of April 25, meaning first day of the previous year. On that date, what was the rate charged by the Reserve, the State Bank of India? Take that rate minus the rate charged by the employer. So that is the benefit into the loan amount outstanding at the end of every month. So this calculation you should do every month. This calculation you should do every month. What is a month, sir? Month is of course a month. Now we get something called as ESOP. ESOP means what, sir? ESOP means what, sir? Employee stock option plan. Sometimes what may happen is company may give some benefits to employees. Company may give some benefits to employees. What type of benefits, sir? In the form of shares of the company. You work in the company, I'll give you shares of the company. So that is also one form of benefit which the company may give to make sure that the employee remains in the company. ESOP means shares of the company are offered to employees at a concessional rate. Taxable perquisites will be fair market value of shares as on the date of exercising the option. What is the market value of the shares on the date of exercising the option minus what is the issue price of the shares into the number of shares issued. Market value of the shares on the date of exercising the option less issue price of the shares. At what price is the company issuing the shares to you? At what price the company is issuing the shares to you into number of shares which is issued by the company into number of shares issued. Notes for capital gain. Now please see, this is the value of perquisites. Capital gain is also applicable in case of ESOP. So some important points which you have to remember from capital gain point of view is that the cost of acquisition of shares acquired through ESOP shall be, so whatever shares I get through ESOP, what is the cost of acquisition of these shares for me? It will be fair market value of the shares as on the date of exercising the option. On the date when you are exercising the option, what is the market value of these shares? The period of holding of these shares shall be taken from the date of allotment of these shares. So period of holding means what, sir? From which date, whether it should be treated as long term or short term, from which date I will count. That is the date of acquisition. So it will be taken from the date of allotment of the shares. And if you gift the shares which is acquired by through ESOP, then that gift of shares acquired by you through ESOP is also what, sir? The gift of shares acquired by you through ESOP, that is also treated as transfer. Education facility. Education facility is what, sir? Education facility means the company is giving you you or your family members or your anyone whom you say education facility. Education, basically, if let us say I want to do some higher studies, I want that education facility, I can ask my company to give it to me. In that case, this is covered. Education facility. If the education facility is given to the employee itself, exempt, no perquisites in the hands of employee. If the education facility is given to employee himself, a company is getting benefited. No, if the company is educating me, an employee, then who is getting the benefit? Company is getting the benefit. Lawmaker says if the education facility is given to the employee, then if the education facility is given to the employee, then no perquisites in the hands of employee, completely exempt. If the education facility is given to any person other than employee ka children, then it is fully taxable. If the education facility is given to employee ka children, if the education facility is given to whom, sir? Employee ka children, then check where the education is happening. If the education facility is given to employee ka children, check where the education facility is happening. Is the education happening at employer ka own institution or tie-up institution, or is it happening in any other institution? If it is own institution or tie-up institution, value of the education is less than equal to 1,000 rupees per month, exempt. If it is more than 1000 rupees per month, then it will be taxable. Any other institution, does not matter how much you are paying for it, fully taxable. Now, this is important. Movable assets are given. Movable assets means what, sir? Company is giving you a washing machine, company is giving an AC, TV. In such cases, what will happen? Except car, any type of movable assets are given by the company. Lawmaker says very simple. Check whether the movable asset given by the company, check whether the movable assets given by the company, is it owned by the company or is it taken on rent by the company? Whatever movable asset is there, whether the company is owning it or the company has taken it on rent. If the company is owning it, value of perquisites will be 10% of the cost. But if the company has taken it on rent, value of perquisites will be rent or higher charges paid by the company. Company owns it, 10% of the cost of that asset. Hey, please note, many people will get confused over here. 10% of cost of asset should be taken, not 10% of WDV of the asset. No. 10% of cost of that asset, actual purchase price. And if the company has taken the asset on rent, whatever rent company is paying. Now, sometimes, let us say company purchase an AC for 25,000, 10% of the cost I will take, 2,500 will be taken as value of perquisites. Now, company is recovering 500 rupees from me. So, now the value of perquisite will be only 2,000. So, because this is the benefit which I am getting, correct? Amount recovered by the employer from the employee shall be reduced. And if the company is giving a laptop or a computer, then it is exempt. That will not be taxed. Next, sale or transfer of movable assets by employer to employee. Now, this is what, sir? Sale of movable assets or transfer of movable assets. Sale means what? Let us say company is giving an asset to me for my use. That is what? Company is giving an asset to me for my use. That is what, sir? That is giving the asset. Sale means what, sir? Let us say there is an AC which the company had given it to me. I am using it from last 5 years. Now I am leaving the job. I am telling the company, can you please transfer this AC to me? Then it will be treated as sale or transfer of the movable assets when they are selling it to me, basically. So if they are selling, so value of perquisites in all the cases is same. The value of perquisites is WDV minus consideration charged. It is WDV minus consideration. But what is this consideration that is important? Sorry, what is this WDV that is important? Sale or transfer of movable assets. If the company is selling laptop or a computer, if the company is selling what? Laptop or a computer, then perquisites will be WDV minus consideration paid by employee. Depreciation. So how will I find the WDV? WDV is required to be found by claiming depreciation at the rate of 50% per annum under WDV method. If the company is transferring car, then perquisites will be same WDV minus consideration, wherein the WDV will be calculated by taking depreciation at 20% per annum under WDV method. If the company is transferring me any other type of asset other than this, then the perquisites will be WDV minus consideration, wherein the depreciation should be calculated at 10% per annum by using which method, sir? Straight line method. Please see. For car and laptop computer, find the depreciation by using WDV method. But anything else, TV is transferred, AC is transferred, washing machine is transferred, refrigerator is transferred. Calculate the WDV by giving the depreciation at 10% per annum under straight line method. Note, depreciation should be computed for a completed year. Depreciation should be computed for what year, sir? Completed year. Meaning part of the year should be ignored. If there is a part of year, let us say I am using it for 5 years, 4 months. Ignore 4 months. Only 5 years should be taken. Completed year should be calculated from the date of acquisition. Completed year should be calculated from which date, sir? Date of acquisition till the date of transfer of the asset. Date of acquisition till the date of transfer. Now, company gives you lunch facility or meal facility. Company may give this. If the value of the meal is up to 50 rupees, fully exempt. More than 50 rupees, amount in excess of 50, the extra amount is exempt. Refreshments, snacks, non-alcoholic beverages, etc. provided by the company at the office, fully exempt. Remote location or offshore duty if you are going, then also it is fully exempt. Transportation facility is given by the company. Transportation facility. if you are an employee of transport company, meaning I am working for Indigo, I am working for Indian Railway, etc. If you're or you're working for KSRTC, BMTC, whatever transport, MTC. So if you are employee of a transport company, either a railway company employee or an airline company employee, then it will be exempt for you. If you are employee of any other transport company, it is taxable. Now please see. Let us say you are an air hostess. Okay, so you are a person who stays in Chennai. You will be traveling from Chennai. Let us say in a flight, the flight starts from Chennai, it goes to Bombay, it goes to Delhi, it goes to Kolkata. Now you are at Kolkata, but you are supposed to go back to your home at Chennai. So what will the company do? If the aeroplane company do, if there is a seat vacant, they'll give you, they'll send you from where, sir? Kolkata to Chennai. So this is the transport facility given by the company to you. So that will be exempt. But if you are not an airline or railway employee, then it will be taxable. You are any other type of employee, then also it will be taxable. Now, if the transport facility is for transportation from office to home or home to office, then it is always exempt for all types of employee. Very important is rent-free accommodation in car facility. Now we'll say rent-free accommodation. It is just like your HRA. HRA is what, sir? House rent allowance. It is an allowance. Rent-free accommodation is company itself is giving you a house to stay. Government employee, non-government employee. If you are a government employee, taxable as per the license fee decided by government. If you are not a government employee, check whether it is owned by the employer or it is rented by the employer. Government employee, depending upon your rank, your inspector, sub-inspector, constable, what, okay, depending upon your rank, they will only tell you what is the taxable amount. But if you are not a government employee, now whatever house is given to you to stay, whether that house is owned by the company or the company itself has taken that house on rent. If that house is owned by the company, the value of perquisites is 5% or 7.5% or 10% of salary. 5%, 7.5% or 10% of salary. If the house is taken by the company on rent, then 10% of salary or rent paid, whichever is less. In all the above cases, if the accommodation is furnished, is along with furniture and other assets, then if it is owned, then 10% of cost. If it is rented or hired, then rent or hire charges paid by the company. Now, note, amount recovered by the employer from his employee should be reduced from the value. So, company is recovering something from me, that should be reduced. Okay, let us say the value of perquisites as per the above comes to 15,000. Company is recovering 5,000 from me. So, taxable perquisite will be only 10,000 rupees. Now, sir, 5% or 7.5% or 10% of salary, how will I come to know? That depends on where the person is working. So, population as per the latest census of the place where the rent-free accommodation is provided. If the population is up to 15 lakhs, meaning the number of people who are staying in that area where you have the house or the house is provided to you, if it is up to 15 lakhs, 5% of salary. If the population is 15 lakhs to 40 lakhs, 7.5%, more than 40 lakhs, 10% of salary. Now, the perquisite value should be computed from the date when you are staying in the house, not from the date when the company has given you. Perquisite value should be calculated from the date of occupying the house and not from the date of allotment of the house. Now, what is salary for the purpose of perquisites? Salary for the purpose of perquisites is BD-BUMC. What is BD-BUMC, sir? Basic pay plus dearness allowances. In terms only I should take. Bonus, allowances, all types of allowance, only the taxable amount. Monetary benefits given by the company. And commission, any type of commission. Now, while calculating the salary, retirement benefits, perquisites, contribution to any fund, advance salary, arrears of salary, they should all not be considered. Now, sometimes what may happen, because you are getting transferred from one place to another place, the company may give you two houses. So, which house value should I take, sir? Lawmaker says if two houses are given to you for a period of 90 days, you can take the value of house 1 or house 2, whichever has a lower perquisite value. Even after 90 days, if you have both the houses, then both the houses' value will be taxable as rent-free accommodation. Where two houses are allotted to an employee due to his transfer or because of any other reasons, he can claim exemption for one of the house whose perquisite value is higher. Claim the exemption for that house for a period of 90 days. And thereafter, the value of both the houses will be taxed. If the same house is given for more than 1 year to the employee, then the value of perquisites for the current year would be restricted to value calculated for the first year in which the house was given into index for the current year divided by index for first year. Meaning, let us say I joined the company 6 years ago. Even today I am staying in the same house. Lawmaker says 6 years ago the value of perquisites would have been low. Now today, because of increase in your salary, if I take 10% of salary, the perquisite value can come high. Therefore, they are telling what was the value of the house for the first year. For first year, what was the perquisite value multiplied with indexation. Index for the current year divided by index for that year when the house was first given to you. That is the maximum it can be. If the company is giving a hotel benefit to you, then value of perquisites will be 24% of salary or rent charges paid, whichever is less. And if the hotel benefit is also given only for 15 days period because of your transfer, then it is not taxable. Most important thing, car facility is given by the company. Car facility, car. Now, the car given by the company, the car which is given by the company to you, for what purpose are you using the car? If the car is used by you only for office purpose, please, what is perquisite by the way? Perquisite means extra benefit, some benefit you are getting in life, correct? But if the company is giving you a car and if the car is used by you only for your office purpose, what benefit are you getting? Are you getting any benefit? No, sir. Therefore, no perquisites. But if the car is used by you only for personal purpose, maja is there. Now, if car is used by you only for your personal purpose, that means maja is there. Now, check whether the car is owned by the company or the car is rented or hired by the company. If the car is owned by the company, 10% of cost is the value of perquisites. If the car is rented or hired by the company, then value of perquisites will be rent or hire charges paid. Perquisite value of the car. Now, sometimes so you take the perquisite value of the car. Now, add running and maintenance charges. If the company is paying running and maintenance charges, add that running and maintenance charges. Add driver or chauffeur's salary if it is paid by the company. That will give you taxable value of perquisites. Now, the car is partly used for personal purpose and partly used for office purpose. If the car is partly for personal purpose, partly for office purpose, now check whether the car is owned or the car is rented. If the car is owned by the employer or the car is rented, this is important. Why, sir? See, if I am using only for personal purpose, only for office purpose, no benefit. Only for personal purpose, yes, benefit is there. We should add also. But if I use partly, whether it is 10% personal purpose, 90% office purpose, 50% personal purpose, 50% office purpose, it does not matter. If it is partly, this concept is applicable. If the car is used partly for personal purpose and partly for office purpose, check whether the car is owned by the company, employee, or the car is owned by the employer. If the car is owned by the employee, let us say you are the employee, I am the employer. Car is owned by the employee. Running and maintenance charges is paid by the employee. So car belongs to you. Running and maintenance charges you are only paying, and you are using for your personal purpose as well as office purpose. What benefit are you getting? Car belongs to you. Maintenance, running charges also you are only paying. Then what benefit are you getting? There is no benefit which you are getting. Therefore, there is no perquisites. Correct? Car belongs to you, but I am paying the running and maintenance charges. If the car belongs to you and I am paying the running and maintenance charges, whatever running and maintenance charges are paid by me, take that, subtract the value of car. How much will I subtract the value of car to be equal to 1800 per month if the car ka value is up to 1000, if the car ka engine capacity is up to 1600 cc, 2400 per month if the car ke engine capacity is more than 1600 cc. If it is owned by employer, meaning car ka owner is the company, running and maintenance charges are paid by employee or the employer. Car is owned by company, I am paying running and maintenance charges. Lawmaker says If the car is up to 1600 cc or up to 1.6 liters, 600 per month is the value of perquisites. If it is more than 1600 cc, then 900 per month is value of perquisites. If it is owned by employer and running and maintenance charges are also paid by the employer, then value of perquisites will be, if it is up to 1600 cc, 1800, more than 1600 cc, 2400 per month will be taken as value of perquisites. Note, if employer also provides driver, then rupees 900 per month should be added to the above specified value. Meaning, car ka value to we saw. If along with car, driver or chauffeur is also provided 900 per month will be added. If the company gives you more than one car for personal and office purpose, you are using it for personal and office purpose, more than one car, then you can take the benefit of partly personal, partly office for only one car, and all other cars will be treated as fully personal purpose. So if more than one car is used for partly office and partly personal purpose, one car will be treated as partly office and partly personal, and all other cars will be treated only personal for determining the value of perquisites. Month means a completed month, that is part of month should be ignored. If the car is used for 9 months 20 days, ignore 20 days, take only 9 months. Any amount recovered by the employer from the employee, whatever company is recovering, shall be reduced from the above value of perquisite. Yes, I am teaching salary. Now, other perquisites, companies giving you a gas facility, electricity facility, water facility, fully taxable. Companies giving you servant, gardener, watchman, personal assistant, that is also fully taxable. In case 1 and case 2, meaning in case of car, gas facility, etc., in case of servant, etc., including car facility, if the facility is provided by the employer to the employee, then it will be taxable only if you are a specified employee. Who is a specified employee? Director of the company, K managerial person, or any employee whose salary is more than 44 lakh rupees in a year. If the cost is reimbursed, then it will be taxable for all types of employees. Credit card facility, credit card is used for office purpose or personal purpose. If it is used for office purpose, then exempt, because you are using credit card only for office purpose. Personal purpose, if you are using, then it is taxable. Club facility, fully taxable. However, corporate club, sports club, health club, not taxable. Employee obligation is incurred by employer or reimbursed by employer, taxable. Employer contribution to recognized provident for approved superannuation fund, 80CCD pension fund in excess of 7,50,000 rupees per annum is in total in a year. That excess amount is taxable. Following perquisites are always taxable. Laptop or computer given, always exempt, not taxable. This will always be exempt. Laptop or a computer given by the company, mobile telephone given by the company, tea, coffee, snacks, etc. Non-alcoholic beverages given at the office, goods given by the company at a concessional rate to you, health insurance, mediclaim, personal accident policy, or employee group insurance policies. Now, one important point. If an employee is opting for default tax regime, if an employee opts for default tax regime, what is going to happen, sir? If an employee opts for default tax regime, allowances under section 1014 will be taxable. All the allowances which you saw, you cheat, duck, hat, HRA, etc., all the allowances will be taxable, except, meaning these allowances will be exempt. Daily allowances will be exempt. Transport allowances for handicap employee will be exempt. Conveyance allowance will be exempt. Tour and traveling allowance will be exempt. HRA under section 1013A would be fully taxable. Leave travel concession would also be fully taxable. No deduction will be given to you under section 16, except standard deduction, which is 75,000 will be given. Now, we'll do, so this is all about your salary chapter. After that, we have income from house property. So before we go to income from house property, let us do the question. See, practice test paper. Actually, your institute has two things. One is practice test paper and model test paper. Practice test paper, we are seeing direct indirect taxes. We'll see this question, practice test paper. One second. Model question paper is also there, which I was just seeing. Now please see. One second, we'll check that also. CMA Inter model question paper. That is a complete different concept. There are two sets, set 1 and set 2, correct? Now please see, if you guys, not only for my subject, any other subject also, if you guys cover your model test papers, two sets are there, correct? If you cover this model test papers, you can expect around 14 to 20 marks from this model test papers only. Complete straight away they will lift from this question paper and give, meaning at least 2 questions you can expect from model test paper. Okay, exactly same, or they may change the figures, similar question can be asked. So please make sure that you do this. Not only for my subject I am telling, I am talking about all the subject. I am talking about what subjects are? All the subject. Please cover what? Model test paper. Model test paper is compulsory, which you have to do. Now we are seeing what's a practice paper. Where is this practice paper here? This practice test paper, let us see. So we had solved this question, which is question number 1. Let us see the question number 2 from salary chapter. I'll do one thing, I'll take with answers, so we can directly discuss the answer where required. Model question paper practice. See, practice, please see the difference. What is this? Practice test paper is what we are discussing in class. Model question paper also they have given. From that, around 14 marks question directly is asked. If possible, I'll upload a video on that. Because of time constraint, I don't think it will be possible, but still, yeah. So practice test paper we are discussing over here. Miss Suti has the following salary. What is the salary which she has, sir? Basic salary 15,000 rupees. Okay. Dearness allowance 5,000 rupees per month, not forming part of retirement benefit. They have given DA, not in terms it is. Hostel allowance is 1,000 per month, does not have any children. Now when I don't have any children and if I get hostel allowance, will I get the exemption? No. Tiffin allowance 500 per month, transport allowance 200 per month, all are taxable. Bonus 20,000 per annum, commission 15,000 per annum, free refreshment in office worth 5,000 rupees, mobile facility given by employer exempt, computer facility also is exempt. She has been provided with a rent-free accommodation in Kolkata. Okay, Kolkata rent-free accommodation. The house was allotted to her with effect from 1st of May 25, but she could occupy the house from 1st of June. So I will calculate perquisite value from the date of occupying. Calculate the gross salary. Very simple question, very easy question. Good question. See, you have, if you actually see, you have practice test paper, model test paper 1, model test paper 2. Cover these 3 for your practice, more than sufficient. Meaning you will get fair idea of how the question paper pattern will be there. You will get fair idea of what they are going to ask in the examination. So please make sure that you cover these 3 compulsorily. One of these is something which you are going to cover in the classroom only, in this marathon only, but make sure you cover the other things. Now, so I'll do it roughly. Basic pay is how much, sir? 15,000 per month. 15,000 into 15 into 12 months is 1,80,000. So dearness allowance also is fully taxable. Day is 5,000, 60,000 rupees. Hostel is also fully taxable. Hostel allowance, children hostel allowance is how much? 1,000 rupees, 12,000 rupees. Tiffin allowance is also fully taxable. 500 rupees, 6,000 rupees, 512. Transport allowance is also fully taxable. See, this calculation you should show, okay, 1,000 into 12. Calculation is compulsory. I'm just roughly doing it, not showing the calculation. Transport allowance is 200 into 12. 2,400. Bonus fully taxable. Bonus 20,000. Commission fully taxable. Commission is 15,000. Refreshments in office. So refreshment provided in office is exempt. If they would have given the value less than 50 per day, etc., then you would have exempted accordingly. Mobile phone, computer also exempt. Mobile, computer. Leftover part is rent-free accommodation. Now, rent-free accommodation, she is staying in Kolkata. She is staying in Kolkata. So I should first find the BD Bumsi salary. Salary for the purpose of perquisite and take then 10% of salary because she is staying in Kolkata. Kolkata's population is more than 40 lakh. So salary for rent-free accommodation. Basic pay I'll take 1,80,000. I should take DA only in terms. They have told DA is not in terms, so I'll not take DA. Children hostel allowance I'll take allowances. I'll take only the taxable component, which is 12,000. Tiffin allowance 6,000. Transport allowance 2,400. Bonus and commission also I'll take 20,000 and 15,000. Basically, I'm taking everything here. Calculator, calculator. One lakh 80,000, 12,000, 6, 2,400, 20,000, 15,000, 2,35,400. So our rent-free accommodation will be how much, sir? 2,35,400 into 10%. 23,540. This is for 1 year. June to March. So 10 divided by 12 into 10% into 10 divided by 12. 19,617 I will do. I'm rounding off to the nearest multiple. 19,617. So total comes to 235,400. 2,55,017 rupees is my gross salary. Let us see the answer for this question. One second, we'll see some totaling mistake. Oh, DA I have not added, sorry. 1,80,000 plus 60,000 plus 12, 6,000, 2,400, 20,000, 15,000 plus 19,617, 3,15,017 rupees is the answer, which matches with this answer, correct? So see house, I think we hardly took around 6-7 minutes to solve this question. So it will take so much time only. It will not take too much time for you to solve. So make sure that you practice properly. Okay. Next is your house property. Okay. Time is 12:15. 1 second, I'll take a break for 2 minutes. I'll just use washroom and come. Okay. Income from house property. Very simple, very easy chapter. Important chapter. One question for sure is going to come. For how many marks, sir? 7 marks. Very easy chapter. Okay, see these chapters and all you should not miss. Salary chapter, very easy chapter. Only thing is you should, there are few points which you have to remember. House property, very easy chapter. Nothing to remember also. It is that simple chapter, correct? So you should not miss out these type of chapters. Section 22, charging section of income from house property says rental income or annual value of a house property will be taxable under the head income from house property if two conditions are satisfied. Two conditions. What are these two conditions? There should be a house property and assessee should be owner of that house property. Two conditions. There should be a house property and assessee should be owner of that house property. What is house property means? House property means building and land appertaining to that building, and you should be owner of that particular house property. Building and land appertaining to that building. It does not matter what type of building it is, residential, commercial, factory, etc. Industrial building, it does not matter. Any type of building and land attached to that building is treated as house property. Now, for the purpose of, so transport allowance is not exempt. Yes, it is not exempt. Transport allowance is not exempt. Transport allowance is not exempt only for handicapped employee, then deaf, dumb, etc. Those blind employees, for them it is exempt 3,500 rupees per month. Sorry. Types of house property. For the purpose of computation of income from house property, or house property is divided into two categories. One is let out property, another one is self-occupied property. Let out property is a type of property which is taxable, always taxable, and is taxable under income from house property. Self-occupied house property, two arrows. Self-occupied house property, check whether it is self-occupied for residence purpose or self-occupied for business purpose. If it is self-occupied for business purpose, please ignore it. Ignore it because already you are using this property for generating a business income. Therefore, ignore this. But if it is self-occupied for residence purpose, self-occupied for residence purpose, how much property you have, I will check. So self-occupied for residence purpose, if you have up to 2 self-occupied property, then exemption will be given to you. Meaning two properties exemption you can claim. If you have more than 2 properties, then for 2 properties claim the exemption. For remaining self-occupied property, treat it as deemed to be let out property and it will be taxable under income from house property. Sir, repeat. For the purpose of computation of income under the head house property, or house property is divided into 2 categories. Let out, self-occupied. Let out means that property which you have given on rent. Self-occupied means that property which you are using for your own purpose. Let out property is a taxable property. It is always taxable and taxable under income from house property. Self-occupied property, that property which you are using it for your own purpose. Check whether it is self-occupied for residence purpose or self-occupied for business purpose. Self-occupied for business, ignore. Self-occupied for residence purpose, up to 2 self-occupied property, claim the exemption. And if you have more than 2 self-occupied property, then for 2 property claim the exemption. For remaining property, assume it to be let out property, deemed it to be let out property. Though it is not given on rent, lawmaker says you can claim the benefit of exemption only for 2 property. All other property will be deemed as let out. Though it is not given on rent, I am going to assume that it is rented. For example, I have 5 properties. 2 properties ka benefit, 2 properties for residence, 2 properties used for business, and 1 property is let out. 2 property which is used for residence, you can claim the exemption because up to 2 property you can claim exemption. 2 property which you are using for business purpose, ignore for computation of income over here. And 1 property which is let out is taxable. Now please see. If you have a property which is not occupied by you, if you have a property which is not what, sir? Occupied by you, unoccupied house property. If you have a house property which is not occupied by you, if it is an unoccupied house property, then that unoccupied house property will be treated as self-occupied property. If you have an unoccupied property, it will be treated as self-occupied property. Now, how do I compute the income from house property? How do I compute the income from house property? Let us say I have given a house on rent to a person for 50,000 rupees per month. I have told that person to give me 5,000 in bank, balance 45,000 in cash. So is my income from house property only 5,000 rupees? Answer is no. Meaning cash no one knows, therefore I will not consider that. Will government accept this? Lawmaker says no. We are not going to accept it. We are not going to accept it. What lawmakers are telling over here, if you have a property, house property, and if you have given that house property on rent, then computation will be done in the following manner. Whatever your actual rent is there, that will be compared with expected rent, and whichever is higher will be taken as annual value of the property. Actual rent which you have, compare that with expected rent and take whichever is higher as your gross annual value. Now, municipal value of the property will be compared with fair rent. What will be compared, sir? Municipal value of the property will be compared with fair rent, and I am going to take whichever is higher. That whichever is higher I am going to compare with standard rent, and I am going to take whichever is lower. That whichever is lower will be taken by me, that will be my expected rent. That expected rent will be compared with my actual rent and take whichever is higher. Please see, municipal value, compare that with fair rent. Municipal value, compare that with fair rent, take whichever is higher. Whichever is higher will be compared with standard rent, and you take whichever is lower. That whichever is lower is called as my expected rent. Now that expected rent which is there, that expected rent will be compared with whom, sir? That expected rent will be compared with my actual rent, and I am going to take whichever is higher. That amount is taken as what, sir? That amount is called as gross annual value. That amount which you have, that amount will be taken as your gross annual value. From your gross annual value, you subtract your municipal taxes. From what, sir? Gross annual value, you subtract your municipal taxes, you will get net annual value. From that net annual value, you subtract your deductions under section 24, that is 24A standard deduction, and 24B interest on loan. Now what you get is called as your income from house property. So the base format is, see, for 2 house property which is self-occupied, you will not have any of these figures because it is exempt. Only thing which you can have is interest on loan. Interest on loan if you have taken some. So for 2 self-occupied properties for which you can claim exemption, the income will always be 0, or it can be negative if you have taken a loan and paying interest on that loan. And for let out property, all the figures will be there. There is some income also. And for deemed to be let out property, deemed to be let out means if you have more than 2 self-occupied property, you will have some income from house property. Now we have different items over here: municipal value, fair rent, etc. Sir, what is municipal value? Municipal value means the value of the house property as per municipal records. What is municipal value? It is the value of the house property as per municipal records. Sir, what is fair rent, sir? It is the reasonable amount of rent which is charged for similar type of property in that same locality, in that same area, in that same locality, in that same area or same locality. If there is any other property like that, how much is the rent which you are going to pay? That is called as what, sir? Fair rent. Standard rent, it is the rent as per Rent Control Act. Rent as per Rent Control Act. It is the maximum amount of rent which can be legally recovered by the owner from his tenant. It is the maximum amount of rent which the owner can recover from his tenant. Actual rent, it is rent received plus rent receivable minus unrealized rent. What is actual rent, sir? The rent which is received by you plus rent which is receivable by you minus unrealized rent. Municipal taxes. Municipal taxes is important part which you should keep in mind. What is actual rent? We'll come back to that. Okay. Municipal taxes very important. What is municipal taxes? It is the tax on the house property which is levied by municipality or local authority. Okay, it is also known as house tax or property tax or sewerage tax or local tax. It is allowed as deduction on payment basis, meaning if you pay this, you can claim deduction of that. It is allowed as deduction on payment basis. Municipal taxes, if it is paid, allowed as deduction. Municipal taxes, if it is payable, not allowed as deduction. Now, municipal taxes will be allowed as deduction only if it is paid by the owner. If municipal taxes are paid by the owner, then only deduction will be given. No deduction will be allowed if it is municipal taxes are paid by the tenant. See, please. Municipal taxes, I am the owner of the property. It is my responsibility to pay the municipal taxes. But if my tenant is paying, I cannot claim the deduction. But sometimes what may happen, tenant will pay municipal taxes. I am going to recover that municipal taxes. Now can I claim the deduction? Yes, definitely yes. Meaning tenant is paying the municipal taxes. I am not recovering, reimbursing the municipal taxes to him. Yes, because you incur the expenditure, I gave back that money to you. It is as good as I have incurred the expenditure. If municipal taxes is given in a percentage form in the question, then it should be calculated as a percentage of municipal value. Now comes the actual rent. What is actual rent? Actual rent is rent received by you, rent receivable by you minus unrealized rent. Minus what, sir? Unrealized rent. Now, rent received is what? Say, let us say there is a house which I have given on rent for 12 months. Okay. Now the person whom I have rented, he has paid the rent for 9 months. 3 months ka rent is unpaid. So rent received is 9 month ka rent which I have received. Unpaid rent of 3 months, that is my rent receivable. Now out of this rent which I am supposed to receive, rent receivable which I have never received rent for 2 months. Let us say I have never received rent for 1 month. That is my unrealized rent. What is unrealized rent, sir? Unrealized rent is basically bad debts of rent. Unrealized rent is basically what, sir? Bad debts of rent. Actual rent is rent received plus rent receivable minus unrealized rent. So 90 plus 30 minus 10. Rent received is whatever I have actually received. Receivable is what I am supposed to receive. That is my outstanding rent. Unrealized rent is bad debts. I am never going to receive. Now this unrealized rent can be subtracted while calculating the actual rent if 4 conditions are satisfied. What are these 4 conditions? The tenancy should be bona fide. You should have genuinely given the house on rent to someone. The tenant should have vacated the house property. The tenant, the person to whom you have given the house, he should have vacated the house property. Tenant should have not occupied any other house property of the same assessee. The tenant should have not occupied any other house of the same assessee, and reasonable steps should have been taken by the owner to recover that unrealized rent. Please see. 4 conditions. What are 4 conditions? Tenancy should be bona fide. I should have genuinely given the house on rent to someone. Tenant should have vacated the house property. The person to whom I have given the house on rent, he should have vacated the house. Tenant should have not occupied any other house of the same assessee. The person to whom I have given the house on rent, he should have not occupied any other house of mine, and I should have taken reasonable step to recover that unrealized rent. I should have given police complaint. I should have told him to, repeatedly asked him to pay the rent, etc. Reasonable steps should have been taken by me to recover that unrealized rent. All the 4 conditions are satisfied, then only I can subtract that unrealized rent. If question is silent, then assume that all the conditions are satisfied and subtract it. Deduction under section 24. So from your net annual value, subtract 2 deductions. One is stamp deduction, flat 30% of NAV, and interest on loan. See, whenever you have a house, you may incur a lot of expenditure for house like repairs, electricity, water charges, maintenance charges, parking charges, insurance charges, etc. All these expenses will not be allowed as deduction to you separately. They will not be allowed as deduction. All these expenses will not be allowed to you as deduction. In the question, if you see any of this expenditure, ignore. Okay, only interest on loan will be given. All other types of expenses ignore. But they are going to give you flat 30% of NAV as your standard deduction. They are going to give you a standard deduction equal to how much, sir? 30% of NAV. So house property is self-occupied, let out or deemed to be let out. If it is a self-occupied property, NAV is, there will be no NAV. If there is no NAV, no standard deduction. If it is a let out or deemed to be let out property, of course I am going to have a net annual value. If I am going to have a net annual value, of course I will get standard deduction. Section 24B, interest on loan import. Section 24B, interest on loan import. So if I have a house property, now from this house property, if on this house property if I have taken any loan, the loan can be taken by me from bank, financial institution, family members, or any friend. Whatever interest I pay on this loan, that interest will be allowed as deduction under section 24B. Now the loan should be taken for construction, purchase, repairs, or renovation of house property. Meaning it should be taken for house property. What purpose, sir? Construction, repairs, renovation, or purchase of house property. Then only the interest will be allowed as reduction in section 24B. Now please, very important point. Interest on loan is allowed as reduction under section 24B if the loan has been taken for the purpose of house property, which is construction, purchase, repairs, renovation of house property. Loan can be taken from any person. Interest on loan will be allowed as reduction whether it is actually paid or not. Penal interest, which is nothing but interest on interest, it will be never allowed as reduction. Interest paid on fresh loan which is taken for repayment of existing house property loan. So if you take a new loan to repay your old house loan, can I claim deduction of that interest also? Lawmaker says yes. And whatever interest is paid by you outside India to a non-resident, that is also allowed as reduction if TDS has been deducted on that interest. Now sir, what I understood is interest is allowed as reduction. Correct sir? Yes, interest is allowed as reduction. Sir, my question is how much interest is allowed as reduction? How much interest is allowed as reduction, sir? Limit of interest allowed as reduction under section 24B. If it is a let out property or deemed to be let out property, that means you are having some income from these properties. So if it is a let out property or deemed to be let out property, there is no limit. Any amount of interest paid by you will be allowed as reduction. Any amount of interest will be allowed as reduction. There is no limit. But if it is a self-occupied property, normal cases maximum 30,000 rupees per annum. Per property, per annum. Maximum how much? 30,000 rupees will be allowed as deduction. And if it is a self-occupied property for residents, and if it is special cases, meaning if it is not falling under normal cases, then interest will be 2 lakh rupees per annum. Maximum how much interest will be allowed, sir? 2 lakh rupees per annum. Now please see, normally how much? 30,000, but special cases will get 2 lakh rupees per annum. Now when will I get 2 lakh rupees, sir? I want higher limit, sir. When will I get 2 lakh rupees interest deduction? If the loan is taken on or after 1/4/1999. If the loan has been taken by me on or after 1/4/1999, then I'll get how much, sir? 2 lakh rupees. If the loan is taken for construction or purchase of house property, if the loan is taken on or after 1/4/1999, if the loan has been taken for construction or purchase of house property, then also I'll get a limit of how much, sir? 2 lakh rupees. If the loan is taken for construction, please see, loan should be taken on or after 1/4/1999. Loan should be taken for construction purpose or of purchase of the house property. Now, if the loan is taken for construction, then the construction should be completed within 5 years from the end of the financial year in which loan was taken. If the loan is taken for what purpose? Construction. Then within how many years I should complete the construction? Within 5 years from the end of the year in which loan was taken. So if these 3 conditions are there, then 2 lakh rupees, or else I'll get 30,000 rupees for self-occupied property ka interest. 30,000 rupees will be loan taken before 1/4/1999. Loan is taken for repairs of the house property or renovation of the house property, or if the construction is not completed within 5 years. Now, one of the most important point is this point. Please see. Now, before this, just 2 examples. Let us say I have a self-occupied property. On that self-occupied property, I am paying interest of 3 lakh rupees. How much deduction will I get? Maximum 2 lakhs. Please note, very important. For a self-occupied property, maximum amount of interest on loan allowed as reduction for all self-occupied properties is restricted to 2 lakh rupees. Maximum interest allowed as reduction is how much, sir? 2 lakh rupees. So if I have two house properties, both are self-occupied by me, I can, interest is 5 lakh rupees. How much can I claim? Maximum 2 lakh rupees. Sir, but two properties are there? No, sir, no problem. Maximum you can claim 2 lakh rupees only. For all the properties combined together, self-occupied, maximum 2 lakh. I have two house properties. Both are let out properties. Interest is 5 lakhs. How much can I claim? Full 5 lakh rupees. Let out, there is no limit at all. Two properties are there. One is self-occupied, one is let out. 2 lakh rupees for self-occupied interest I am paying. 4 lakh rupees I am paying for let out. I can claim full 6 lakh rupees because within the, for let out there is no limit. For self-occupied 2 lakh rupees. Now, very important is this note. If an assessee opts to pay tax under default tax regime, if an assessee is paying tax under what, sir? Default tax regime. If an assessee opts to pay tax under default tax regime, then he will not get any deduction under section 24B for interest paid on loan taken for self-occupied property. Sir, repeat. If you are taking a loan, for what, sir? Self-occupied property. If you are taking a loan for self-occupied property, and if you are opting to pay tax under default tax regime, then whatever interest you are paying will not be allowed as deduction. If the assessee opts to pay tax under 115 BAC default tax regime, then any amount of then he will not get any deduction under section 24B for interest paid on self-occupied property. Please see, assessee has two options. Either he can opt for optional regime or he can opt for default regime. If he is opting for optional regime, let out or deemed to be let out, any amount of interest paid by him is fully allowed as deduction. For self-occupied, maximum 30,000 or 2 lakh rupees he can claim deduction. But if it is the default tax regime, if he is opting for default tax regime, let out and deemed to be let out, fully allowed as deduction, no limit. Self-occupied property under default tax regime, no interest will be allowed as deduction. Self-occupied under default tax regime, no interest will be allowed as deduction. No interest will be allowed as deduction. Okay. Now we have a small concept called as pre-construction period interest. What is pre-construction period interest or pre-acquisition period interest? Pre-construction period interest or pre-acquisition period interest means what? The interest paid by you for the period before the year in which construction was completed. So repeat. The interest paid by you for the loan which is taken by you before the year in which construction or acquisition was completed. So pre-construction period interest or pre-acquisition period interest means all the years. Pre-construction period means all the years before the year in which construction was completed. Pre-construction period interest is allowed as deduction in 5 equal installment starting from the previous year in which construction was completed. Pre-construction period interest will be allowed as deduction in how many installments, sir? In 5 equal installments starting from the year in which the construction was completed. Now, how much is the amount of deduction which is going to be given to you? Interest for that particular year plus share of pre-construction period interest for that year. Let us say the loan will be continuing for this year, and share of pre-construction period interest which is applicable for this year I will add. That is the total deduction which will be given to me. So repeat. See, pre-construction period interest is allowed in 5 equal installment. Now current year interest plus 1/5 of the pre-construction period interest is the total interest deduction which you can claim for current year. Okay. Now the total deduction, so this is the total amount of interest, but total deduction will depend on whether it is a self-occupied property or let out property. Self-occupied property maximum 2 lakh rupees. Let out property, of course, there is no limit at all. Now, what if there is a co-owned property or jointly owned property? If it is a co-owned property or jointly owned property, then what will happen, sir? In case of co-ownership, in case of co-ownership or joint ownership, what will happen, sir? In case of co-ownership or joint ownership, how do I compute the income? I just started seeing that video again. Yeah, co-ownership or joint ownership. If it is a co-owned property or jointly owned property, very simple. Compute the income from house property normally. Ignore everything in life. Compute the income from house property normally as if there is no co-ownership or joint ownership. Compute the income from house property normally. Now, whatever income you get, that income divide between the co-owners in the ratio of ownership. So step number 1, compute the income from house property as if there is no co-ownership or joint ownership. Just compute the income from house property normally as if there is no co-ownership or joint ownership. Step number 2, whatever income you have got, divide between co-owners in the ratio of ownership. So when will I call it as a co-owned property? Where the house property is jointly owned by 2 or more person, then such house property is called as co-owned or jointly owned house property. The owners of such house property are called as co-owners. Computation of income from house property in case of co-ownership. Step 1, compute the income from house property as if there is no co-ownership and divide the income from house property under step number 1 between the co-owners in the ratio of ownership. So first compute the income normally. Whatever amount you have got, divide between co-owners. Sir, it is a co-owned property. Let us say 3 owners are there or 4 owners are there. 4 owners are there, sir, for a property, but they have not given how much is how much each owner ka share is there. Now what will I do? Take it equally. If the ratio of ownership is not given, assume it to be equal. Note, if self-occupied property is co-owned, so my house in which I am staying, if it is a co-owned property, then each co-owner will get the interest benefit of 30,000 or 2 lakh rupees. Each co-owner will get that benefit. Concept of vacancy. Concept of what, sir? Vacancy. What do you mean by vacancy? Vacancy means the house property is not occupied by anyone. The house property is empty. Concept of vacancy. Vacancy means the house property is empty or it is available for rent. See, unrealized rent and vacancy rent are not same. Unrealized rent is bad debts. Vacancy rent is house property is not occupied by anyone at all. For example, I have a house which I gave on rent to Virat Kohli from 1st April till 30th of September. Now Virat Kohli left the house on 30th of September. The next tenant, Mahendra Singh Dhoni, came on 1st of December. So in between for 2 months, the house was not occupied by anyone. I wanted to give the house on rent, but there is no tenant who is coming. So this 2 month period is called as what, sir? Vacancy. This 2 months period is called as vacancy. What should I do in vacancy? See, normally what do I do, sir? My gross annual value is actual rent or expected rent, whichever is higher. In case of vacancy also same. You compare your expected. So my gross annual value normally is expected rent or actual rent, whichever is higher. In case of vacancy also compare your expected rent with actual rent plus vacancy period rent. See, in case of vacancy, what will I do? See, normally what do I do? Expected rent you compare with actual rent, take whichever is higher. Whenever there is a vacancy, compare your expected rent with your actual plus vacancy rent. Now, if your expected rent is higher, then gross annual value is, if your expected rent is more than actual plus vacancy rent, then gross annual value is your expected rent. If your expected rent is less than actual plus vacancy period rent, or if your expected rent is equal to actual plus vacancy period rent, in such case your actual rent will be taken as your gross annual. Okay, so this is concept of vacancy. Next important concept, what if it is a partly let out and partly self-occupied house property? Partly let out, partly self-occupied means what, sir? 2 possibilities are there. One house, 4 months given on rent, 8 months self-occupied. Partly let out, partly self-occupied. One house, 2 floors, ground floor let out, first floor self-occupied. Partly let out, partly self-occupied. So the first case was time wise. For some period of the year I am giving on rent, for some period of the year I am using it for myself. Second case was partly let out, partly self-occupied, area wise. Area wise means first floor, second floor. First floor 50% is self-occupied, 50% is let out. So partly let out means the house property is self-occupied for a few months, or some portion of the house property is self-occupied and the balance is let out in the same previous year. Partly let out property, area wise and time wise. So if it is a partly let out property area wise, let us say 60%, 40% let out and self-occupied. Computation of income from house property. Again, notes, one more request has come, sir, notes. Notes will be uploaded in the description. Okay, or if you don't find in the description right now, if you want the notes, then you can go to CA Inter Marathon. From there you can download the notes, because the syllabus is almost same for direct taxes. You can take the notes, download the notes from there. Okay, partly let out property, what wise, sir? Area wise means first floor, ground floor, 50% self-occupied, 50% is let out. 60% self-occupied, 40% let out. How will I do the computation? Lawmaker says, if it is a partly let out, partly self-occupied, area-wise. If it is a partly let out, partly self-occupied, area-wise, then compute the income from house property separately for let out portion and for self-occupied portion. Do the computation of income from house property separately for let out portion and for self-occupied portion. How, sir? By taking municipal value, fair rent, standard rent, municipal taxes, interest, proportionately for let out and self-occupied portion. Repeat. Compute the income from house property separately for let out and self-occupied portion. Compute the income from house property separately for let out portion and self-occupied portion. How, sir? By taking your municipal value, fair rent, municipal taxes, standard rent, interest, proportionately for self-occupied and let out portion. Now the interest which is there, no, that also you divide between self-occupied and let out portion. For self-occupied, maximum you can claim 2 lakhs. For let out, there is no limit. So repeat. Let us say there is a house which I have, 60% is self-occupied, 40% is let out. Now everything I should divide except actual rent, because actual rent I will get only for let out portion. Everything I should divide based on 60% of 40% ratio. So if municipal value is 100 rupees, 60 rupees, 40 rupees. Fair rent also 60%, 40%, standard rent, municipal taxes. See, please note, this can be 75-25, this can be 50-50, any ratio which they have given in the question. Actual rent will be there only for let out portion, and standard deduction also will be there only for let out portion. Now interest on loan for self-occupied, maximum you can claim is 2 lakhs, meaning whatever interest is there, first you divide between self-occupied and let out, and for self-occupied, maximum you can claim is 2 lakh rupees. Time wise, if it is a self-occupied property, time wise, meaning there is a house, 8 months let out, 4 months self-occupied. You compute your income from house property assuming the house property is rented for whole year. If it is time wise let out, then compute your income from house property as if the house property is let out for the whole year. However, actual rent should be taken only for let out period. Whatever actual rent is there, you take it only for let out period. Meaning, you don't have to divide anything proportionately for 8 months, 9 months, nothing like that. You just take municipal value, fair rent, standard rent, municipal taxes, interest, etc. for full year. Take this for full year for computation. Interest also will be allowed for full year. Meaning, if it is time wise, partly let out, partly self-occupied, assume the property is let out for full year. Now, whatever actual rent is there, no, that you should take only for let out period. So if the property over here, 8 months it is let out. Now, when you're taking municipal value, fair rent, standard rent, municipal taxes, take it for full 12 months. But actual rent, you take it only for 8 months. And do the computation. Very good questions are there. Ajnabi question is good for exam point of view. Mr. A, Mr. B question is there one. That is very good. Like 2 brothers, Arun and Bimal. Too many times I have asked this question in examination. Now, section 25A talks about what, sir? Taxability of arrears of rent and unrealized rent. Arrears of rent means what, sir? Rent under dispute. Rent under dispute means arrears. Does not means outstanding. That is what accounts says. But here arrears means past rent which is received by you. Now, arrears of rent means rent under dispute, and unrealized rent means bad debts of rent. Both arrears of rent and unrealized rent will be taxable in the year when you are going to receive it. The taxable amount will be the amount received by you into 70%. Whatever amount you have received into 70%. Note, arrears of rent and unrealized rent will be taxable in the year when it is received under income from house property, even if the assessee is not the owner of such house property. Okay, even if you are not the owner, you will have to pay the taxes in the year when it is actually received. Now, one more important type of question which they can ask in the examination is computation of income from house property. Computation of income from house property when there are more than 2 self-occupied properties. See, I can claim the exemption only for 2 properties, correct? No? If I have 5 house properties which is self-occupied by me, only for 2 properties I can claim the benefit of exemption. Remaining properties will be deemed to be let out property. So for example, Dilip has 5 house properties, out of which 2 I can claim exemptions, remaining 3 I should compulsory treat it as deemed to be let out property. So if the house property, if income from house property is more than, so which property will I take as self-occupied, which I will take it as let out, sir? That depends on income from house property. That property which has a higher income, call it as self-occupied, and which has a lower income, call it as deemed to be let out. That is will be beneficial to you. In simple words, let us take an example. Let us say I have 3 houses, and all houses I am using it for my own residence. I have a house in Bangalore, house in Chennai, house in Coimbatore. Whenever I am in Bangalore, I stay in Bangalore house. When I am in Chennai, I stay in Chennai house. When I am in Coimbatore, I stay in Coimbatore house. Case 1. SOP. Case 1. So, because all of these are self-occupied, I can take only 2 property as self-occupied. 1 property I should compulsory treat it as let out. Now, which property should I treat it as deemed to be let out, sir? Lawmaker says 3 possibilities are there. See, if you treat first 2 house as self-occupied, then 3rd house you should treat it as deemed to be let out. If you treat first house and 3rd house as self-occupied, you should definitely treat the 2nd house as deemed to be let out. If you treat 2nd and 3rd house as self-occupied, 1st house you should treat it as deemed to be let out. Correct? No? So there are 3 scenarios will be there. Case 1, treat first 2 house as self-occupied, 3rd house as let out. Case 2, self-occupied, house 1 and 3 deemed to be let out, house 2. Case 3, house 1 deemed to be let out, other 2 houses self-occupied. Now you find the income of these properties in these 3 scenarios or cases. In these 3 scenarios, normally they will ask only for 3 houses in the examination. Okay, compute the income from house property in all these cases. Whichever case the income is least, that is the best option. Okay, because our goal under income tax law is to pay less taxes. When will I pay less taxes? When my income is less. So in whichever scenario my income is least, that is my best option, or that is my best case. Now, what is the best method of solving this? First, compute the income from all the houses as if they are self-occupied. Then compute the income from all the houses as if they are deemed to be let out. Then select the best option. Now, some theoretical points. Concept of composite rent. What is composite rent, sir? If you are renting a house along with other assets, then the rent which you receive is called as composite rent. When a house property is rented by the owner along with other assets, then the rent so received is called as composite rent. Tax treatment for composite rent. If the composite rent is separable, composite rent is separable means what, sir? You can divide the rent amount to house property ka value and other assets ka value, then it is treated as composite rent is separable. For example, I have given a house along with furniture. I am charging a rent of 25,000, 15,000 for house, 10,000 for furniture. So here it is separable. So if the composite rent is separable, rent of house property is taxable under income from house property. Rent of other assets will be taxable under income from house property or income from, rent of house property will be taxable under house property if it is separable. Rent of other assets will be taxable either under IFOS or under PGBP. If the composite rent is not separable, the total rent will be taxable under PGBP or IFOS. Now, if let out of a house property is not possible or not acceptable, if you cannot let out a property, or if you cannot let out a property without other assets, or the opposite party is not going to accept your house without other assets, then the entire rent will be taxable either under PGP or IFOS. The entire amount of rent will be taxable under PGP or IFOS. Now, what if house property is held as stock in trade? What if house property is held as stock in trade? When the house property is held as stock in trade, for example, I am a builder. For me, what will be a house? For me, house will be a stock in trade. So when the house property is held as stock in trade, is not sold during the previous year. See, basically my business is to sell them. See, please see. house property held as stock in trade. I am a builder. I have around 9 houses. One of the house I have not rented also. I have not sold also. Correct? I'm not renting also. I'm not selling this also. Then this house, what will be the treatment done? Normally my business is to construct, sell. Whatever income I get, that is taxable under business income. But if the property is rented by me, where will that income go, sir? That income will go under house property. House property held as stock in trade. I am a builder. Income from sale of house property will be taxable under PGBP. Income from renting of a house property will be taxable under income from house property. Why? Common sense, no? See, if I sell, because it is my business income, taxable under business. If I don't sell, if I rent it, if I don't sell, and if I rent it, lawmaker says, if you are not selling it and if you are renting the property, then that income will be taxable under income from house property. Why? Because your assessee should be owner of the property, and so two conditions. There should be house property, assessee should be owner of the house property. Both the conditions are satisfied. Therefore, the rental income will be taxable under house property. Now, sometimes what may happen is you may not rent the house property, as well as you may not sell them also. In such cases, lawmaker says, when house property is held as stock in trade, is not sold or let out during the previous year, then the net annual value of such house property shall be taken as nil for a period of 2 years. For a period of 2 years, the value of the house property, I will take it as nil. For a period of 2 years, from the end of the financial in which construction was completed, the value of the house property will be taken as nil, and thereafter it shall be deemed as let out property. Now, income from house property located outside India. If the house property is located outside India, if the house property is located in India, income from house property will always be taxable in India, whether assessee is resident or not. Correct? Because the house is located in India, the income is going to accrue or arise in India, therefore that income will be taxable in India. But if the house property is located outside India, then that means it is a foreign income. Whatever income I am going to get is a foreign income. If you are a resident and ordinary resident, you have to definitely pay tax in India for that income. But if you are a non-resident, or if you are a resident but not ordinary resident, for that property you will have to pay tax in India only if that rent is received by you in India. Other points, SOP exemption can be claimed only by individual or HF. Municipal taxes for the property paid outside India is also allowed as deduction. Building, if it has different flats, each flat will be taken as separate property. Refund of municipal taxes is taxed under IFRS. Owner includes legal owner, beneficial owner, and deemed owner. So that is all about this beautiful chapter called as income from house property. Then we have capital gain, but before that, where is this question paper? Yeah. Okay, after this question, we are going to, after this question, what will we do, sir? After this question, we are going to take a break. The lunch break will take, and then continue the other parts. Mr. Aradhya provided following information in respect of various house properties. House property 1, 2, and 3 used for self-occupied, situated at Delhi, Mumbai, Indore, GAV, then fair rent, then this standard rent, municipal taxes they have given, repairs you please ignore, interest on loan, and they have given loan is taken on which date. Oh, very nice. He does not opt for 115 BSE, meaning he is not opting for default tax regime. Prepare that statement determining the income from house property chargeable for the assessment. Now please see, he has 3 properties and all are self-occupied. Just now we saw this concept. That if you have self-occupied, if you have what, sir? If you have more than 2 self-occupied property, then you can claim exemption only for 2 properties, and balance will be treated as deemed to be let out. So how do I solve this? One of the easiest way of solving this is what, sir? First, compute the income from house property as if all are self-occupied. Then compute the income from house property as if they are all let out. Then find the answer under 3 different cases. Whichever case the answer is minimum, that case will be followed. So step number 1. Step number 1. Computation of income from house property if all are self-occupied. See, this is the fastest way to solve this. I'll write the places: Delhi, Indore and Mumbai. So when all are self-occupied, I can directly start with NAV, taking NAV as 0. Why, sir? If the property is a self-occupied property, you will not have any income from them. So NAV will be 0 less 24A ka standard deduction will not be there, less 24B ka interest on loan. So whatever interest on loan they have given, I'll take that interest on loan. See, whatever method I am doing here, that is one of the easiest and fastest method. So use the same method in examination. 70,000, 150 and 250. Income from house property will be negative 70,000 for house 1 if it is a self-occupied property. For house 2 it is 1,50,000, and house 3 maximum interest you can claim is how much, sir? 2 lakh rupees for self-occupied. Correct? No? So this is separately for each of the house. Step 2. Income from house property if they are particulars: Delhi, Indore, Mumbai. Municipal value, fair rent, whichever is higher, compare that whichever is higher with standard rent, take whichever is lower, that is my expected rent, compare that with actual rent, whichever is higher, gross annual value less municipal taxes will give me my net annual value less 24A standard deduction, 24B interest on loan. So municipal value is how much, sir? 2.5, 3.5, 7.5, 2,50,000, 3,50,000, 7,50,000. Fair rent is 2 lakh, 3 lakh, 7 lakhs. 2 lakh, 3 lakhs, 7 lakhs, whichever is higher is 2.5 lakhs, 3.5 lakhs, 7.5 lakhs. Compare that with standard rent 3, 6.5. 3, 6.5. So whichever is lower, 2 lakh, 50,000, 3 lakhs, 6.5 lakhs. Actual rent is not there. So gross annual value will be 2,50,000. 3 lakhs and 6 lakh, 50,000. Less municipal taxes 15%, 15%, 15%. 15% of what? Municipal value. So first case 2,50,000 into 15% is 37,500. 3 lakh into 15%. 45,000. 6,50,000 into 15%. 2,50,000 minus 37,500. Now standard deduction is 30% of this. Into 30%, 63,750 255 into 30%, 76,500 into 30%, 165,750. Interest on loan they have given 71.5 and 2.5. Here it is fully allowed. So my income from house property, if they are deemed as let out property, will be 78,750 minus 76,500 minus 1,50,000, 28,500, 5,52,500 minus 165,750 minus 2,50,000, 1,36,750. So we have got the answers. We should see which is the best option. Correct? No? For this, selecting the best option. Case 1, case 2 and case 3. House 1 mean Delhi, Indore, Mumbai. First case SOP, DLOP, SOP, DLOP, SOP, DLOP, SOP and SOP. So SOP 70,000, 1.5 and 2. I'll just write the figures. 70,000, 1,50,000, 2,50,000. No, not 2,50,000. 2 lakh rupees only I can take. 70,000. Are you understanding what I'm doing over here? If it is a self-occupied property, what is the income? We have computed already. I'm just putting those incomes in these figures. Now in case of DLOP, 78,500, 78,750, sorry, 28,500, and lastly 1,36,700. Now one important point you should note is the maximum interest for self-occupied property you can claim is how much? Only 2 lakh rupees. Here also 3,50,000 is the total interest, but maximum it is restricted to how much? 2 lakh rupees. So there was a note which I had written in the interest point. Maximum interest which you can claim deduction is how much, sir? 2 lakh rupees only for self-occupied property. Okay, so only self-occupied part only I have made this observation over here. So here also I'll take maximum interest as only 2 lakh rupees. So I will take the net income from house property. Net income from house property for house 1. $78,750 minus 2 lakh. 1,21,250 negativities. 2 lakh minus 28,500. 1,71,500 again negativities. 136,750 minus 63,250 again negativities. How come we are getting negative for all the 3 houses? Okay, anyways. So if you see which is the best option, second case is the best case because my negative is more in that case. My negative amount is more in that case. Now let me check the answer first. So in first case, house 1 and house 2 is self-occupied. House 1 and house 3 is self-occupied, and house 2 is let out, which is which case, sir? Case number 2. In that case, they are getting an income of 76,750. We got an income of 71,500. So this is okay. Net annual value 2 lakh. House 2. I'll just see the answers. See that you ignore how the way I am checking it, because I'll check it little fast, so you may get confused. So gross annual value will be 3 lakhs, 2 lakh 50,000. 3 lakh, 2 lakh 50,000 and 6 lakh 50,000 should be the answer for the last case. Yes. Municipal taxes, municipal value, net annual value 2 lakh 47,500, 2 lakh 12,500 and 5 lakh 37,500. Oh ho ho ho. I think here there is a mistake. 2 lakh 15,000 into 15%. 3 lakh 50,000 into 15%. Yes. This should come to 2 lakh 52,500. 7 lakh 50,000 into 15%. So on municipal value I should have taken, I have taken wrongly on wrong amount. Anyways, first one is 2 lakh 50,000 minus 37,500, which is correct. 3 lakhs minus 500. See this kind of mistakes. Municipal value, if it is given in percentage form and if they are not given anything, I should take it as a percentage of what, sir? Percentage of municipal value. Small point but big mistake in life. Minus 67,500. Now 30% also will change. 247,500 into 30%. 74,250. 161,250. This is correct. 247,500 minus 74,250 minus 1,50,000. 23,250. Okay, let me check the answers. This is correct. This and this is also correct. 78,500. Yeah. So our answers are right now. So you understood the mistake over here. Municipal taxes on municipal value. What did I do? I took municipal value, municipal taxes on NAV only. But is there? Urgency in life is problem. Of course, these amounts will also change now. Second case, it will come to 23,250. 2 lakhs minus 23,250. 76,750. House, if this is DLOP, 1,26,000. House 3, Mumbai house is DLOP is this much. So 2 lakhs minus 126,250 will give me negative 73,750. House 1 is. So here also I did a mistake while taking the figures. Ulta I took 121,250. Yeah, but still the answer will remain same. Case 2. See, please note case 2. Though your answer is right over here, your computation is wrong. Correct me. If your computation is wrong, it is as good as your answer is wrong. Now, anyways, let us see the first answer. The total comes to 76,750. Then This is option case number 3, 121 250, and 96 250 is for the first case. How 96 250? Negative 2 lakhs, maximum 2. Last case answer comes to the interest amount they have allowed only 30,000 rupees. House 1, house 2, 30,000. See, if the loan is before 1/4/1999, I should take interest of 30,000. Now that information they have not given. I mean, they have given the information. The loan date is not before 1/4/1999. So the interest amount which they have taken 30,000 is wrong. Okay, it is wrong. But still, our main answer remains the correct. So whatever interest they have taken in the calculation in your answer, that is wrong. Okay. No problem, mistakes can happen. What they would have done is they would have changed the years and taken future years. They would have taken some previous year question and changed the figures and copied that same answer over here. No problem. So what is the main answer? So final answer, option 1 is the best option. What is the best option? Basically, house 2 is DLOP, house 1 and house 3 is SOP. Same thing we have to write conclusion over here. House 1 and house 3 is SOP, house 2 is DLOP, wherein my income will be least. Okay, yeah, so this is all about your income from house property topic. Income from house property topic is this much. We'll do one thing, take a break, lunch break. We'll take a lunch break of around an hour, around 1 hour. So 2:15 we'll meet after lunch. Let me meet you after lunch break on 2:15. Welcome back, students. Welcome back. Online students, I hope I'm audible and also the screen is visible. Screen is visible. Yes, sir. Yeah. So let us continue. Next topic for our discussion is capital gains. Income from capital gain. Or shall we discuss, 1 second, income from business or profession? We'll discuss better. Very simple and easy chapter. Income from business or profession. Yes. So now you all know, you all would have done this. You all know and you all would have done this. Done what, sir? You all would have prepared something called as profit and loss accounts in your accounts, correct? In your 11th standard, 12th standard, if you have taken commerce, or in your degree, if you have taken commerce, you would have prepared something called as profit and loss account, correct? So now this profit and loss account, on the credit side you record income, on the debit side you record expenses, and the difference is taken as net profit or net loss, etc. Correct? Now same thing, whatever you have learned in your accounts, same thing you are supposed to do over here. Meaning your business income is nothing but your net profit or net loss of the company. But while preparing this profit and loss account, one thing you should keep in mind. What is your business income? It is nothing but your net profit or net loss. But while preparing this, you should keep one thing in your mind. What is that one thing which I should keep in mind, sir? You should take income as per business income chapter, which is this chapter, and you should take expenses as per this particular chapter. Meaning you are not supposed to take all the income which a person is earning. You are not supposed to take all the expenses which a person is having. You should take only those incomes which are related to your business, only those expenses related to your business, and which is allowed under PGP, and also it should be covered under PGP chapter. The difference between that will be your business income or business loss. Okay, as simple as that. One of the easiest chapter, business income, an important chapter as well. So what do you mean by business? Business definition says business includes trade, commerce and manufacture. Definition of business is what, sir? Business includes trade, commerce and manufacture. Business includes trade, commerce and manufacture. So business includes trade, commerce and manufacture. So trade means you are doing any trading activity, buying and selling of goods. Commerce means any commercial activities which is done by you. Commercial activities means what, sir? Commercial activities will include like helping someone do his business, transportation of goods or banking. Manufacture means you are making a product. Profession definition says profession includes vocation. Profession means what, sir? If anyone is doing something because of his qualification or degree, that means he is a professional. If anyone is doing something because of his skill and talent, that means it is vocation. Now methods of accounting. There are two methods of accounting. One is cash system of accounting and accrual system of accounting. Under income tax law, this method of accounting is required to be used for computing the income under PGBP or under IFOS. Now we have something called as income computation disclosure standards, which you will study in your final year. Section 28 is the charging section. Section 28 is the charging section of PGBP. This gives the list of income which are covered under PGBP. What does it say? Any profit or gain from any type of business or profession during the previous year. Charging section, section 28 says what's any profit or gain from business or profession during the previous year. Amount received by any person for termination of his office or business or for modification of terms of his contract. What is business income? Section 28 says any profit or gain from business or profession during the previous year. Whatever type of profit you are earning, whatever type of gain you are having from any type of business or profession you are doing, it does not matter what type of business or profession you are doing. Amount received by any person for termination of office or business for modification of terms of his contract. So I am doing a business and I am modifying the terms of the contract. Because of modifying the terms of contract or because I am terminating or closing my business, I am getting some money. That is also my business income. Amount received for not carrying on business or not sharing technical know. So I receive some money so that from some person telling that I am not supposed, let us say I have a sari business. Right next to me there is one more person who is starting a sari business. I give him around 10 lakh rupees to him and tell him that please don't start a sari business over here. So this is an amount given. That person has receiving some amount for not carrying on a business. For him that income will be a business income. Income from services rendered by a association to its members. So if there is any association, resident welfare association, it is giving services to its members for which they are charging something, that amount will be their business income. Interest, salary, bonus, remuneration, commission given by partnership firm to its partners. So if you are a partnership firm and if the partnership firm is giving salary, interest, bonus, remuneration or commission to its partners, then that income which the partnership firm is getting is called as business income. Some received under Cayman insurance policy, whatever money you are receiving under Cayman insurance policy. Fair market value of stock in trade on conversion of capital asset into stock in trade into capital asset. So if you are converting stock in trade into capital asset on the date of conversion, whatever is the market value of that stock in trade, that will be taken as your business income. Now normally business is your normal business, correct? But for the purpose of set off and carry forward chapter, your business is divided into two categories. Basically three categories. You will understand that in that chapter. One is your normal business. All types of business which you are doing falls under normal business. And one more type or category of business which you have is called as speculation business. Speculation business means what, sir? Speculation means buying and selling of shares without taking its actual delivery. Speculation means what, sir? Buying and selling of shares without taking its actual delivery. That is called as what, sir? Speculation. What is speculation? Buying and selling of shares without its actual delivery. Now section 29 is there, which says how to compute the business income. It says if you want to learn how to compute the business income, then you will have to learn about all the provisions which are there from section 30 to section 43D. So let us learn about all the provisions which are there from section 30 to section 43D. Section 30 says rent, rates and taxes, repairs and insurance of building. Rent, rates, taxes, repairs and insurance of building. So if you have a place from where you are doing business, this place can either be owned by you, or this place from where you are doing business can be taken by you on. So the place from where you are doing business, that place from where you are doing business, it can either be owned by you, or the place can be taken by you on rent. So the place from where you are doing business, it can either be owned by you, or that place can be taken by you on rent. If that place is owned by you, meaning let us say this is the place where I am doing my sari business, and this place is my own place, meaning it is owned by me, I am the owner of the place. Now if this place is a owned place, will I be paying rent to anyone? If this place is a owned place, will I be paying rent to anyone? No sir, you will not be paying rent to anyone, correct? No. So I cannot, while preparing my profit and loss account, can I take the rental expenditure as a deduction over here? No. Why? Because I am not going to pay rental rent to anyone. So if it is a owned place, and if the place where I am doing my business is an owned place, then in that cases I cannot claim the deduction of rent. But if I am paying any rates and taxes for that building, if I am incurring any insurance expenses for that building, that can be allowed as deduction while computing my business income. Now if I incur any expenditure for repairs, that repair expenditure I should see whether that repair is a type of, what type of repair it is, capital repair or revenue repair. If it is a revenue repair means something which you are incurring regularly, then it will be allowed as reduction while computing your business income. But if it is a capital expenditure or capital repair, you cannot claim the deduction of that expenditure straight away, but you should add that expenditure to your cost of the asset and claim depreciation on that particular expenditure. Now the place where you are doing your business, that place can be rented. If that place is a rented place, while preparing your profit and loss account, can you claim the deduction of rental expenses? Yes. Can you claim the deduction of rates and taxes paid by you? Yes. Can you claim the deduction of insurance paid by you? Yes. Can you claim the deduction of repairs? If it is revenue repairs, yes. Capital repairs, you cannot claim any deduction, but you please add it to your cost and claim depreciation. Sir, how will I add it to my cost when I am not the owner of that particular building? Lawmaker says, if you are doing business from a place which is not owned by you, and if you incur any capital expenditure for that particular business, then you can create an asset in your books of account called as deemed building and claim depreciation accordingly. Next, insurance and repairs on plant, machinery and furniture. Now in the business, the plant and machinery which we have, the furniture which we have, that also can be owned or it can be rented. If it is owned by me, insurance cost, repairs cost can be claimed as deduction. But if it is a capital repair, add it to the cost and claim depreciation. If it is a rented plant and machinery furniture, then also rent, whatever I am paying, that can be allowed as deduction. Insurance, which whatever I am incurring, can be allowed as deduction. Revenue repairs can be claimed as deduction. Capital repairs, add it to the cost and claim depreciation. Section 32 is the most important section in your business income chapter. What is section 32 talking about, sir? Section 32 talks about what, sir? Depreciation. Depreciation is allowed as deduction if two conditions are satisfied. What lawmakers are telling, you can claim deduction of depreciation if two conditions are satisfied. What are these two conditions? Assessee should be owner of such asset, and that asset should be used for business or profession. Assessee should be owner of that asset, and that asset which is there, it should be used for business or profession. Depreciation is allowed as deduction if two conditions are satisfied. Assessee should be owner of such asset, and such asset should be used for business or profession. Let us say there is a plant and machinery, it is owned by me, can I claim depreciation? It is rented by me, can I claim depreciation? No. If it is owned by me, can I claim depreciation? Yes. I have a laptop. This laptop I am using for my personal purpose. Can I claim depreciation? No. I am using it for business purpose. Can I claim depreciation? Yes. If I purchase any asset under hire purchase system, can I claim depreciation on that asset? Yes, I can claim depreciation from the date of possession only. If in case of lease transaction, lessor is the owner, lessee is the user. Who can claim depreciation, sir? Lessor can claim the depreciation. In case the asset has 2 or more owners, joint owners or co-owners, in such cases, depreciation can be claimed by each co-owner proportionately. Depreciation under income tax law is allowed. This is also very important. From which date will I get the depreciation, sir? Under income tax law, the depreciation will be allowed from the date when the asset is put to use and not from the date of purchase of the asset. Under income tax law, the depreciation will be given to you from the date when the asset is put to use and not from the date of purchase of that asset. Now, for the purpose of calculation of depreciation, the assets are divided into 3 categories. For the purpose of for the purpose of computation of depreciation, the assets are classified into 4 categories. One is your building, another one is your furniture, another one is your plant and machinery, another one is your intangible assets. Building, furniture, plant and machinery, and intangible assets. Intangible assets, all types of intangible assets except goodwill. On goodwill, you cannot claim any depreciation. Now, there are 2 methods of depreciation. How many methods of depreciation are there? 2 methods of depreciation. One is SLA method of depreciation and WDV method of depreciation. SLA method of depreciation follows a system called as individual asset system, and WDV method of depreciation follows a system called as block of asset system. Sir, what is this individual asset system? What is this block of asset system? Individual asset system is a system wherein you give depreciation to each and every asset separately, individually. Whereas block of asset system is a system wherein all the assets which has the same rate of depreciation and which falls under the same class. All the assets which are having the same rate of depreciation and all the assets which are falling under same class, they will be grouped as one asset and depreciation will be given to that particular asset. Who can follow this system? SLM can be followed only by power generation and distribution assessees. WDV method of depreciation should be followed by all the types of assessees. So what is block of asset system? You are grouping the asset into a block which are having same rate of depreciation and which are falling under same class. Rates of depreciation. So there are different rates of depreciation. Should I remember these rates? Yes. Now building, if it is a residential building, 5%, temporary structure 40%, other buildings 10%. Furniture including electrical fittings, 10%. Intangible assets except goodwill 25%. Plant and machinery, if it is a plant and machinery, see, building, normally remember the rate, building is 10%, furniture is also 10%, intangible assets it is 25%. For plant and machinery, the rate of depreciation will be motor vehicle. If it is a motor vehicle, 15%. And if that person is in the business of running the motor vehicle on hire, then 30%. For ship, vessel and boat, 20%. Aircraft, 40%. Pollution control equipment, also 40%. Computer, including computer peripheral, 40%. Windmills, 40%. Oil wells, 15%. Books, including annual publications, 40%, and all other type of plant and machinery, 15%. Note, very important. So if nothing is given, what should I do, sir? Call that asset as a plant and machinery and apply the rate of 15%. If an asset cannot be classified under any head, treat it as plant and machinery and apply the rate of 15%. Computation of depreciation. How do I compute the depreciation? Please note 5-6 items about which you should remember the rate of depreciation. One is building, 10%. Furniture including electrical fittings, 10%. Intangible assets, 25%. So this is simple, sir. Laptop, computer, 40%. Printer, etc. 40%. 15% for normal, all the types of plant and machinery. Now, how do I compute the depreciation? First, take the opening WDV of the asset. To that opening WDV, add assets which are acquired by you during the previous year, asset which is purchased by you during the previous year. So whatever assets are acquired by you during the previous year, take that. Take opening WDV. Add assets acquired by you during the previous year. Now, whatever assets are acquired by you during the previous year, that should be divided into three categories: asset acquired and put to use for 180 days or more, asset acquired and put to use for less than 180 days, and asset acquired but not at all put to use. So first take opening WDV, add assets purchased by you during the year. Whatever assets you are purchasing during the year, that will be divided into three categories: asset purchased and put to use for 180 days or more, asset purchased and put to use for less than 180 days, and asset not at all put to use. From that, subtract sale proceeds of assets sold during the previous year. Subtract what's a sale proceed. Sale proceed means whatever amount you are receiving by selling the asset during the year. That will give you WDV for depreciation. Meaning, on this amount we should give depreciation. How will I give depreciation? This amount which you have got, WDV for depreciation, that you should divide into three categories. Whatever amount you have got, WDV for depreciation, that should be divided into three categories. What are these three categories? It is asset which is not put to use, asset which is put to use for less than 180 days, asset which is put to use for 180 days or more. Asset which is not put to use for less than 180 days, put to use for 180 days or more. Now, out of this WDV, first give it to whom, sir? Whatever amount is there, no? Whatever amount is there, that first you apportion to those assets which are not at all put to use during the year. Sir, how will I get the value of that from this? See, whatever purchases you have made, you have bifurcated into three categories. Now, this WDV for depreciation, first give it to those assets which are not put to use at all. Then, after giving it to that, anything is left over, give it to asset which is used for less than 180 days. Now, the balance is that asset which is used for 180 days or more. So, WDV for depreciation divided into three categories: asset which is not put to use, asset which is put to use for less than 180 days, asset which is put to use for 180 days or more. Asset which is not put to use, on that don't give any depreciation. Asset which is put to use for less than 180 days, asset which is not put to use, no depreciation. Asset put to use for less than 180 days, only 50% depreciation should be provided. Asset which is put to use for 180 days or more, 100% depreciation. Okay, whatever is the rate of depreciation, 100% of that. 50% means what, sir? If the rate of depreciation is 40%, I will give only 20%. The rate is 15%, I will give only 7.5%. Okay. Now, important point to be noted over here is, if there is any asset which is purchased during the previous year and is put to use for less than 180 days in that same previous year, then 50% depreciation will be allowed for that same previous year. Meaning, if I purchase an asset in this year and use it for less than 180 days in this year, then only the concept of 50% depreciation will come. If I purchase in this year, use it in next year, whether I use it for more than 180 days or less than 180 days, it does not matter. I will give full 100% depreciation. Now, if you purchase an asset on 4th of October or any time after that, then you will give how much depreciation, sir? Only 50% depreciation. So if any asset is purchased on or after 4th of October, the rate of depreciation which you are supposed to give is only how much, sir? 50%. Whatever is the rate, 50% of that. Now you see over here, compute the depreciation of Priya Sarees using following information. Opening WDV is there, assets acquired and put to use 25, 12, 25, 15, 9, 25. So I have purchased, so 25, 12, 25 is less than 180 days, 15, 9, 25 is more than 180 days. Sale proceeds of assets sold during the previous year, 3 lakhs, and rate of depreciation is 15%. So what will I do? First take opening WDV, asset purchased and put to use for 180 days or more, asset purchased and put to use for less than 180 days. not put to use, not there. So 15 lakhs less sale proceeds. So I get 12 lakh rupees. Now this 12 lakh rupees which is there, that I'll give it to first to whom, sir? That asset which is not put to use. Here it is 0. Then I'll give it to asset which is put to use for less than 180 days. How much is that asset which is put to use for less than 180 days? 4 lakhs. Balance is what, sir? Asset put to use for 180 days or more. Asset which is put to use for 180 days or more. So on 4 lakhs, I'll give only 15% into 50%. On 8 lakhs, the balance assets which is there, I'll give 100% depreciation. Then section 32 subsection 1 clause 2a, additional depreciation. Section 32 subsection 1 clause 2a talks about what, sir? Additional depreciation. Sir, what is additional depreciation? It is an extra depreciation given to you over and above the normal depreciation. What is additional? Additional, name only says I am additional depreciation. It is an extra depreciation given to you over and above your normal depreciation. Extra depreciation given to you, what, sir? Over and above your normal depreciation. That is called as your additional depreciation. Now additional depreciation is allowed to whom, sir? It is allowed to those people who are in the business of generation of power, distribution of power and transmission of power. Hello, sir, can I get a mic, sir? Yeah, please. Power generation, power distribution and power transmission. And if you are in manufacturing business, so either you should be in power business or you should be in manufacturing business to get additional depreciation. How much additional depreciation will I get? You will get an additional depreciation equal to 20%, meaning whatever is the rate of depreciation, whatever is the type of asset, also it does not matter. If you are eligible for additional depreciation, how much is the additional depreciation which you are going to get? You will get an additional depreciation of how much, sir? You will get an additional depreciation of 20% flat, irrespective of type of asset. Additional depreciation will be available only if the assessee has opted for WDV method of depreciation. One more condition is what, sir? If you want additional depreciation, you should have opted for what method of depreciation? WDV method of depreciation. And additional depreciation is available only if the plant and machinery, only for plant and machinery. Additional depreciation is available only for plant and machinery, meaning you will not get any additional depreciation for building, furniture and intangible assets. Now, additional depreciation. Hello, sir. How are you? Yeah. Mic also. Additional depreciation is not available in following cases. When is it not available? If you are having an asset which is a second hand or used plant and machinery. See, normally additional depreciation will be given only for plant and machinery. If it is an used plant and machinery or second hand plant and machinery, then no additional depreciation. If it is a vessel, vehicle, aircraft, no additional depreciation. If it is a plant and machinery which is used in residential accommodation, then also no additional depreciation. If it is a plant and machinery which is used in office premises, then also no additional depreciation. If it is a plant and machinery on which 100% deduction is already claimed under any other provisions of PGBP, so no additional depreciation will be given in which cases, sir? Check. No problem. Sufficient. Hello. Additional depreciation. We are discussing about what, sir? Additional depreciation. Additional depreciation is allowed only for plant and machinery. Additional depreciation is allowed for only for plant and machinery. Additional depreciation will not be allowed in following cases. When, sir? When it is an used or second-hand plant and machinery. In case of vessel, vehicle, aircraft. In case of plant and machinery which is in residential accommodation. In case of plant and machinery which is there in office premises. or in case of plant and machinery for which you have already claimed 100% deduction anywhere else. Now please see. If you are a person who is opting for default tax regime, you cannot claim any additional depreciation. Additional depreciation is allowed in the previous year in which plant and machinery is put to use. Further, if the plant and machinery is put to use for less than 180 days then in the previous year, then only 50% additional depreciation will be allowed for that year, and the balance 50% will be allowed in next year. Okay, what is this point telling? Additional depreciation will be allowed only for plant and machinery, and it will be allowed in the year when the plant and machinery is purchased. Every year I will not give additional depreciation for the same asset. Meaning, if this asset is purchased in this year, for this year I will give additional depreciation. Next year I will give only normal depreciation. Additional depreciation will not be available. So it will. So basically, what does that mean, sir? This means additional depreciation is allowed for a plant and machinery only in the year when they are put to use. Only in the year when they are put to use. Now, if it is put to use for less than 180 days, what will I do? If any plant and machinery is put to use for less than 180 days, then only 50% additional depreciation will be allowed, and the balance 50% will be allowed in the next year. So, for example, let us say Priya Saris, a manufacturer, has purchased a plant and machinery on 15th of August 24 for 5 lakh rupees. 24 or 25 will be 25. Compute the depreciation for the previous year 25-26. Plant and machinery put to use for 15/8/25, and what will be the answer if the plant and machinery is put to use on 20th October 25? Calculation of depreciation for the previous year 25-26. Particulars, case 1. Normal depreciation will be same, 5 lakhs into 15% into 100%. Additional depreciation will be 5 lakhs into 20% into 100%. So yeah, if it is put to use on 20th of October, that means less than 1 days. So I'll add 50% instead of 100%, meaning 50% of that will be given. Now, capital gain in case of depreciable assets. Very simple. Normally, they will not test on all these points in examination. Capital gain on capital gain on depreciable assets, etc. They will not test. Anyways, when will I get a capital gain or capital loss? See, you can provide depreciation only if you have WDV as well as asset. Only if you have a positive WDV as well as an asset, then only depreciation can be provided. If you don't have WDV or if you don't have an asset. So repeat, sir. If you don't have a WDV or if you don't have an asset, you cannot provide any depreciation. See, depreciation will be allowed only when you have a WDV as well as you have an asset. If you don't have both of them, you cannot give depreciation. Now, please see this carefully. See, in first case, I sold all the assets, so I have 0 assets. Okay, I'll just tell like that only, because explaining this will, if I just explain, you may not understand. Very simple. I should have both asset as well as WDV. See, I should have asset as well as WDV to give depreciation. If I don't have asset, and if I don't have WDV, no depreciation will be given. Who will come in life? Capital gain or capital loss will come. If I don't have asset, but if I have WDV, then also capital gain or capital loss will come. If I don't have WDV but I have asset, then also capital gain or capital loss will come. Meaning, both WDV as well as asset should be there to give depreciation. If any one also is not there, depreciation will not be given. Either capital gain or capital loss will come into existence. Next, under straight line method of depreciation, which follows a system called as individual asset system. What is individual asset system? Depreciation is given individually, separately to each and every asset. Let us say I purchased a plant and machinery for 100 lakhs, purchased on 15th of August 23. Depreciation rate is 10%, and this asset was sold by me on 31st of December 25. Cost of, so this was sold in this year 25-26. So what is the WDV of this asset for this year? 100 lakhs it was purchased. It was used for 2 years, 23-24 and 24-25. So 2 years ka depreciation if I give, I'll get a WDV of
80 lakh rupees. I'll get a WDV of how much, sir? 80 lakh rupees. Case number 1, I sold this asset for 72 lakhs. I sold this asset for how much? 72 lakhs. So sale price is 72 lakhs, WDV is 80 lakhs. So difference is 8 lakhs. So please note, I sold at a price less than its WDV. WDV was 80 lakhs, I sold for 72 lakhs. I sold at a price less than its WDV. That means I sold at a loss. Now the difference between sale price and WDV will be taken as what, sir? Terminal depreciation. The difference between sale price and WDV will be treated as terminal depreciation. It will be treated as what, sir? Terminal depreciation. Terminal depreciation is allowed as business expenditure. It is allowed as reduction in the previous year when the asset is sold. Case 2, I sold the asset for 90 lakh rupees. Sale price is 90 lakhs. WDV is 80 lakhs. Difference is 10 lakhs. Sale price 90 lakhs. WDV is 80 lakhs. 10 lakhs is my positive figure, meaning I sold the asset at a price more than its WDV. Correct? No. So there is a gain which I got. This gain will be deemed as business income. If I sell an asset for which I am giving depreciation under SLM method, if I sell that asset at a price more than its WDV, then the difference between the sale price and WDV will be taken as balancing charge. It will be balancing charge, nothing but business income. This balancing charge is nothing but it is a business income. Sale price is 1,12,000. If the sale price is 1,12,000, that means sale price is 1,12,000. Sale price is 112 lakhs. Cost is 80 lakhs. Now, can I say the sale price is more than its actual cost? Actual cost was 100 lakh rupees. WDV is 80 lakh rupees. Now the asset is sold at a price more than its actual cost. Now the difference between sale price and the actual cost will be taken as your capital gain, and the difference between actual cost and WDV will be taken as balancing charge. Balancing charge is nothing but deemed as business income. Section 32 subsection 2, unabsorbed depreciation. Unabsorbed depreciation means what, sir? See what happens. Profit and loss account, we have income, expenses and profit. Correct? Difference is profit or difference is loss. So if my income is more than expenses, that means it is profit. If expenses are more than income, that means it is a loss. Meaning, let us say my income is 10 lakhs, expenses is 8 lakh. That means my income is able to absorb the expenses. Therefore, the difference is a positive figure, which is a profit. My expense 14 lakhs, income is 10 lakh. That means my income is not able to take care of expenses completely. The difference is treated as business loss. My income is 10 lakhs, expense is 8 lakhs and depreciation is 4 lakhs. My income is able to take care of the expenditure, but it is not able to take care of the depreciation completely. So there is a loss of 2 lakh rupees. This loss is called as unabsorbed depreciation. This loss is called as what, sir? Unabsorbed depreciation. Depreciation in case where the asset is partly used for business purpose and partly used for personal purpose. Depreciation when the asset is partly used for business purpose and partly used for personal purpose. So if there is any asset which you are using for business as well as personal purpose, lawmaker says I will give depreciation to you proportionately only for business purpose. Okay, proportionately it will be given only for business purpose. By the way, unabsorbed depreciation provision, though we did not study only. We understood the meaning of unabsorbed depreciation. Now this unabsorbed depreciation, when will I get, sir? If the current year business income is not able to fully adjust or absorb the current year depreciation, then that unadjusted depreciation is called as unabsorbed depreciation. What will happen to this unabsorbed depreciation? Now this unabsorbed depreciation can be carried forwarded for indefinite period and can be set off or adjusted against the income in future years except income from salary. You can adjust this unabsorbed depreciation in future years against any type of income except the income under the head salary. Actual cost of an asset. This is a very lame point. I mean, normally they'll not test you. Actual cost means what, sir? What is the cost of the asset? This will normally be tested in accounts and all, but it will not be tested in tax, but still it is there. Actual cost is nothing but your purchase price. Add all the expenses incurred by you till the asset is put to use. It can be installation charges, transportation charges, packing charges, trial run charges, any taxes which is paid by you on the asset for which you are not claimed input tax, interest on loan till the asset was put to use, Separate government grants or subsidies which you have received, sale proceeds of trial run expenses, etc. That will give you the actual cost. Now, this expenditure, if you are incurring more than 10,000 rupees in a single day, and if you are giving it to a single person by any mode other than account paid check, account paid demand draft, or other electronic clearing system, then that expenditure should not be considered. So, more than 10,000 rupees you should pay through these three modes. Only any other mode will not be taken into consideration. Now, if any stock in trade is converted into business in asset, then the market value as on the date of conversion will be taken as actual cost of that asset. If any asset is acquired by you by way of gift, someone gifted an asset to you, then whenever he purchased, less depreciation for that asset as if it was used for business purpose by that fellow. Difference of that will be taken as actual cost. Meaning, if you receive any asset by way of gift, will, inheritance, etc., then whatever was the actual cost of this asset to the previous owner, less depreciation as if that asset was used by the previous owner for his business purpose till the date he gifted to you, or you received it, should be subtracted. The difference will be taken as actual cost for you for your business purpose. Now, if you purchase any asset at a higher price so that you can claim depreciation at a higher rate, lawmaker says, I will not accept the rate which is purchased by you. The rate will be determined by the assessing officer. Now, if you sell an asset and repurchase the same asset at a higher price, then the actual cost will be WDV at the time of sale or repurchase price, whichever is less. Now, if you sell any asset to someone and if you purchase an asset from someone who is already claiming a depreciation on an asset, and you give that asset back to the same person on lease, for you the actual cost will be the purchase price of that asset or WDV of that asset in the books of that seller before sale. Now, if any building is purchased by you, if any building is not purchased, if any building which is used by you for your personal purpose, now if it is put to use for business purpose, okay, if there is any building which is used for personal purpose, now if it is put to use for business purpose, the actual cost of that building will be cost of that building less notional depreciation as if that building was used for business purpose. Next, we have scientific research, section 35. Section 35 talks about what's scientific research. Scientific research means any activity for extension of knowledge in the fields of natural or applied science, including agricultural, animal husbandry, or fisheries. Now, scientific research. See, some businesses are there wherein for those businesses they'll have to keep on doing research for those businesses. So, in such cases, how do I do the computation? Scientific research. Now, scientific research can be of two types. Either it can be in-house scientific research, or it can be a case of donation to a research organization. In-house scientific research means what, sir? If I am doing research for my own business, then it is in-house scientific research. Donation to research association or organization means what, sir? You are a person, you are an association, you are an organization who is doing research. I am giving money to you. That falls under donation. In-house scientific research. In-house scientific research means assessee is doing research for his own business. Assessee is doing research for his own business. Now, I have to see when is the expenditure incurred by me. Is the expenditure incurred after commencement of business, or is the expenditure incurred before commencement of business? Meaning, for that research purpose I am incurring the expenditure. No. When is that expenditure incurred? Is it incurred after the business has been commenced, or is it incurred before the business has been commenced? For example, I am a person who is manufacturing lace. Okay, I am manufacturing some mixtures, chips, etc. Now, I have to make the first product. I'll have to do some research. Correct? No. So, before starting to sell the first product, I'll have to do some research to make that product. So now, to make that product, I am incurring expenditure. So that expenditure is what's before commencement of business. Now I'm already selling a product. Now I'm adding new flavors of lace. If I incur any expenditure for making new flavors, then that expenditure is incurred by me after commencement of business. Now, in-house scientific research, expenditure is incurred after commencement of business, meaning whatever expenses are incurred by you is after the business has been started. Now, if it is whether it is a capital expenditure or revenue expenditure, it does not matter because the business is already started. Any expenditure incurred by you, whether it is a capital expenditure or a revenue expenditure, does not matter. Capital expenditure or revenue expenditure does not matter. 100% of that expenditure will be allowed as deduction, except on land. Except the value of land, all the types of expenditure will be allowed as deduction 100%. Expenditure incurred before commencement of business. If it is a capital expenditure, 100% deduction is allowed except on land. If it is a revenue expenditure, for material and salary excluding perquisites, 100% deduction is allowed. For any other type of revenue expenditure, no deduction will be allowed. Now, A. Expenditure incurred after commencement of business, whether revenue expenditure or capital expenditure, 100% deduction will be allowed except on land. Expenditure incurred before commencement of business, you can go back maximum how many years before? 3 years before commencement of business. In that, if it is a capital expenditure, allowed as deduction except on land. If it is a revenue expenditure, for material and salary, deduction will be allowed excluding perquisites, and for any other type of revenue expenditure, no deduction will be allowed. Note, where any deduction under section 35 is allowed to any asset, depreciation under section 32 will not be allowed for that asset. So if you have already claimed a deduction for an asset under section 20, if you have already claimed deduction under section if you have already claimed deduction for any asset under section 35, you cannot claim depreciation for that asset. Why? You have claimed 100% deduction. Meaning, if you purchased it for 10 lakhs, you claim deduction of 10 lakhs. Now, what is the cost of that asset? 0. Correct? No. So, no additional depreciation will be allowed. Sorry, no depreciation will be allowed additionally. So, if, sir, you said except on land, I will get the deduction. Correct? No. So, what if I am purchasing a building along with land? Then for building, deduction will be allowed, land deduction not be allowed. How will I come to know the value of building? Divide the value of building and land based on the market value of land and building. Unabsorbed capital expenditure can be carried forward to unlimited years and set off in future years, just like unabsorbed depreciation. So unabsorbed capital expenditure means if your business income is not able to fully take care of the capital expenditure incurred for the scientific research, then that capital expenditure will be called as unabsorbed capital expenditure, that is treated on par with unabsorbed depreciation. Sale of an asset on which deduction under section 35 is claimed. So if you have an asset for which you have claimed deduction under section 35, okay, if you have an asset for which you have claimed deduction under section 35, then if you sell those assets, then whatever income you receive will be deemed as business income. Now, how much will be business income? Whatever deduction is given to you or sale price of that asset, whichever is less. Where the sale price is more than the cost, business income will be cost or deduction. Capital gain will be sale price minus cost. Donation to research organization or research association or researchers. You are giving donation to those people who are doing research. Donation to approved research association, approved institution, approved college or university. Now please note, I am giving money, I am donating money to them. If donation is given to approved research association, approved institution, college or university, for why am I giving the donation to? For scientific research, social research, statistical research, 100% deduction will be allowed. If donation is given to approved research association, institution, college or university for scientific, social and statistical research, 100% deduction will be allowed. Donation is given to approved Indian company which is engaged in research and development business. Approved Indian company which is engaged in research and development work. For scientific research, if it is given for what purpose, sir? For scientific research, then also 100% deduction will be allowed. Donation is given to National Laboratory, IIT, University for approved scientific research. 100% deduction is allowed. Please note, in first two cases, the person to whom you are paying the money is approved. In last case, the work which is done by them is approved. Okay. Now, donation for scientific research under section 35 will not be allowed as reduction if the assessee is opting for default tax regime under section 115 BAC. Sir, I donate the money to someone and after donating the money, if the approval is withdrawn, will I still get that deduction? Yes. Section 35 AD. Section 35 AD gives list of some specified businesses. Like Section 35 AD talks about specified business like setting up and operating cold chain facility for specified products, beekeeping, production of honey and bee wax, setting up and operating warehouse facility for storage of sugar, laying and operating cross-country natural gas or crude oil or petroleum pipeline network for distribution, including storage facility being integral part of such network, building and operating two-star and above hotel of 2-star and above category anywhere in India, or you are developing building housing project under a notified scheme of affordable housing framed by central government, or you are developing building a housing project under notified scheme for slum redevelopment or rehabilitation framed by the central government or state government. Production of fertilizer in India, developing and maintaining and operating new infrastructure facility anywhere in India, building and operating hospital anywhere in India with at least 100 beds, setting up and operating warehouse facility for storing agricultural produce, setting up and operating semiconductor wafer fabrication manufacturing unit if such unit is notified by board in accordance with the prescribed guidelines, setting up and operating an inland container depot or a container freight station or an approved which is approved under customs law, laying and operating slurry pipeline facility for transportation of iron ore. So there are total list of 14 businesses. Okay, if you're able to remember these 14 businesses, good. But in examination, they are going to give you that it is a 35 AD business, or they will use the word specified business. Okay, so section 35 AD talks about 14 businesses. If any person starts these 14 businesses, and for starting these 14 businesses, if he is incurring any capital expenditure, or for running these 14 businesses, if he is incurring any capital expenditure, that will be allowed as reduction under section 35 AD. See, normally for a capital expenditure, what do I get? Normally for a capital expenditure, I get depreciation. But section 35 AD says if you incur capital expenditure for these particular businesses, then instead of giving you what? Instead of giving you the depreciation, I will directly give you deduction. Okay, so to whom is this section applicable? This section says I am applicable to all types of assessees if they are engaged in specified business and if they are incurring any capital expenditure except on land, goodwill and financial instruments. They can claim deduction, 100% deduction for that capital expenditure. Now, section 35 AD says that yes, you can claim 100% deduction, etc. But what is important about this section is, if you want to follow this section, you follow, or else please ignore. Meaning, section 35 AD is an optional section. The assessee may or may not opt to follow this section. Then, the business covered over here is new business. Such business should not be set up by splitting up or reconstruction of existing business. It should be completely new business. New plant and machinery should be there. The plant and machinery used in this business should be a new plant and machinery, except 20% of the total plant and machinery can be second-hand plant and machinery. And imported second-hand plant and machinery will also be treated as new plant and machinery for this particular section. Now, out of all this, this is something which is important. How much deduction will I get under section 35 AD? How much deduction will I get, sir? 100% deduction is allowed under this section for capital expenditure. How much deduction will I get? 100% deduction I'll get for the capital expenditure incurred by me. Now, this capital expenditure can be incurred either after commencement of business, or the capital expenditure can be incurred by me before commencement of business. If the capital expenditure is incurred by me after commencement of business, it will be allowed as reduction in the year when such expenditure is incurred. If the capital expenditure is incurred by me before commencement of business, then deduction will be allowed in the year when the business is commenced if such expenditure is capitalized in my books of account. So if it is incurred before commencement of business, allowed as deduction in the year when business is commenced, provided you capitalize the same in the books of accounts. If it is after commencement of business, allowed in the year when the business is when the expenditure is incurred. No double deduction. If you have already claimed deduction for an expenditure under this section, you cannot claim deduction for the same expenditure anywhere else. No depreciation. If you are claiming a deduction under section 35 AD for any asset, then you cannot claim depreciation on that particular asset. Now the asset for which you have claimed deduction under section 35 AD, that asset has a lock-in period of 8 years. It cannot be sold or transferred within the lock-in period of 8 years. If you sell it or transfer it to anyone within the lock-in period of 8 years, then whatever deduction given to you, there will be some business income. What is that business income? We'll see. Consequences of sale or transfer within 8 years. If the asset is demolished, destroyed, discarded, transferred within 8 years, then amount received will be deemed as your business income. If the asset is given by you to someone else, someone else means you have specified business as well as non-specified business. If you are giving this asset to your own non-specified business, then the amount of deduction which you got earlier minus the depreciation, as if this asset was used for normal business, will be deemed as business income for you. Meaning, if you would have not used this asset for specified business, you would have got depreciation, no? So subtract that depreciation amount. And for the other business which is taking this asset from you, whatever is the actual cost of this asset less depreciation as if it was used for normal business purpose by that old fellow, the difference amount will be actual cost in your books of accounts. And if the asset is transferred by you to your own unit, different unit, after 8 years, then the cost of acquisition of this asset will be taken as nil. Then one more important point in this chapter is set off and carry forward of losses. Loss of specified business can be set off only against profit of specified business. See, loss of specified business can be set off only against profit of specified business. Loss which is not set off in the current year can be carried forwarded and set off in the future years for indefinite period. Please note, set off and losses. Loss of a specified business. So if you have a specified business and if that specified business has a loss, that specified business ka loss can be set off only against specified business ka profit. Sir, what if I am not able to set off the full loss? If you are not able to set off the full loss, no problem. The unadjusted loss can be carried forward to future years for indefinite period and adjusted in the future years. Now, what is important point over here? Specified business ka loss can be set off only with specified business ka profit. However, non-specified business ka loss can be set off with any business ka income or profit. Other points are simple points, not relevant points. Section 35D. Preliminary expenditure. Preliminary expenditure means what? That expenditure which is incurred by you before commencement of business. Lawmaker says preliminary expenditure, section 35, section 35D, preliminary expenditure. This section is applicable to a resident assessee only, meaning you can either be an Indian company or you can be any other type of resident assessee like individual HUF, OPBI, etc. What is preliminary expenses? Expenses incurred before commencement of business or expenses incurred after commencement of business for setting up a new unit or for extension of existing undertaking. Now, deduction is allowed in 5 equal installment from the year in which business is commenced. Amount of deduction allowed is, if you are an Indian company, actual expenses or 5% of capital employed, 5% of cost project, whichever is higher, compare that with actual expenses, take whichever is less. For other resident assessee, actual expenses or 5% of cost of project, whichever is less. Capital employed means how much money you have put in the business, which is nothing but share capital except reserves and surplus, debentures and long-term borrowings. Cost of project is the amount invested in fixed assets of that particular business as on the last day of the previous year. Preliminary expenses are listed below. What is preliminary expenses, sir? expenses incurred by you for preparation of feasibility study report, preparation of MOA, AOA, legal expenditures, engineering expenditures, market survey reports, and expenses for public issue of shares and debentures. Section 35DDA, expenses incurred by you for in relation to voluntary retirement scheme. This expenditure is allowed as reduction for all types of assessees. Expenditure should be incurred in connection with VRS voluntary retirement scheme. Expenditure is allowed a reduction in 5 equal installment from the year when the amount is paid. Now section 36, beautiful section 36(1) gives the list of expenditure which is allowed as deduction specifically. Now from this explanation we'll take one by one. Beautiful section, this is section 36. What are those expenses which are always allowed as deduction when computing business income? Insurance premium paid by you on stocks and stores. So when you are doing business, whatever type of business you're doing, say for example, if I'm a sari dealer, for me, saris will be stock in trade. If you are a Tata Motors, for you, cars will be stock in trades, nuts, bolts will be stores for you, etc. Now, if you are taking insurance for all these things, then deduction will be allowed to you. Okay, so insurance for stock and stores. Similarly, employee insurance if you are taking. So for employee, there are two types of insurance. I can either take life insurance or I can take health insurance. Life insurance is never allowed as reduction. Life insurance is never allowed as reduction. Under income tax law, it is never allowed. Health insurance, if you are taking for employees, or if you are taking Mediclaim insurance for employees, then it will be allowed as deduction, provided that the premium of that insurance should be paid by you by any mode other than cash. Bonus or commission paid to employees is allowed as deduction subject to section 43B, meaning whatever bonus or commission you are paying to employees, it will be allowed as deduction subject to 43B. Subject to 43B means what, sir? So there is a section called as section 43B. Section 43B is a section which will give you the list of all those expenditure which will be allowed as reduction only if those expenditure are paid within the due date of filing income tax return. Meaning 43B is a section which will give you list of different expenses. These expenditure will be allowed as deduction while computing your business income if these expenditure are paid off within the due date of filing income tax return. 43B gives the list of expenditure which is allowed a deduction, which is only if they are paid within the due date of filing income tax return. So if there is any income which is earned by you in the previous year, on that income, see normally what is the rule telling? You earn the income in the previous year, on that income you have to pay the taxes in assessment year. How do you pay the taxes? By filing income tax return. Now the due date of filing income tax return, normally it is 31st of July. In audit cases it is 31st of October. Now bonus and commission will be allowed as deduction only if you pay within this date. Just because you have written bonus in your books of accounts, will it be allowed as deduction? No. You should actually pay it. Okay, you should actually pay it within these dates. Sir, what if they are paid after the due date of filing income tax return? If this bonus or commission is paid after the due date of filing income tax return, or if expenses given in 43B is paid after the due date of filing income tax return, they will be allowed as deduction in that year in which they are actually paid. Now, for example, in my books of accounts based on accrual system of accounting, I have recorded bonus or commission 10 lakh rupees. Bonus or commission, how much I have recorded? 10 lakh rupees. Now, this 10 lakh rupees is paid as follows. So 5 lakhs is by 31st of March, 31st of June 2 lakhs, another 2 lakhs, 31st of July another 1 lakhs. So if my due date is 31st of July, I will get the deduction only of these things. Anything paid after this will not be allowed as deduction. But if my due date is 31st of October, anything paid till this date will be allowed as deduction, last one will not be allowed as deduction. Interest on loan. Interest on loan. Now the loan, see, when you are doing a business, for your business purpose, you can take a loan from any person. Whatever loan you are taking, on that loan, interest which you are paying will be allowed as deduction. Loan can be taken from bank or it can be taken from any other person. If the loan is taken from bank, it will be allowed as deduction subject to condition of section 43B. What is 43B telling? Provided that the interest on that loan should be paid within the due date of filing income tax return. If you take loan from any other person means other than bank, then that interest will always be allowed as deduction whether actually you are paying that interest or not. Now please, if you are liable to pay any interest, and that interest which is payable by you if you are converting into a new loan. So whatever interest is payable by me, if that interest amount, if I am converting into a new loan, any interest payable on a loan is converted into a fresh loan, is not treated as repayment of that interest. The deduction will be allowed as and when you pay the installment of that particular new loan. Discount on zero coupon bonds. Discount on zero coupon bonds means what, sir? See, we have zero coupon bonds. What are zero coupon bonds? Zero coupon bonds are those bonds which are issued at a discount and redeemed at par. Meaning, if there is a bond whose value is 1 lakh, when I issue that bond to you, I will give you at 80,000 rupees, and when I redeem it on a future date from you, I will give you 1 lakh rupees. So there is a discount of 20,000 over here. This discount on zero coupon bonds is amortized over the useful life of asset. So face value of bond is 10 lakhs, issue price is 8 lakh rupees, life is 5 years. The issue, and it was issued on 1st of April 2025. How much discount is allowed at deduction for the year 25-26? So what is the total discount? 2 lakhs divided by 5, 40,000 per annum will be allowed as reduction. Further, if the bond is issued in the middle of the month and if the month has more than 15 days in it, then it will be taken as that particular month. If the number of days in the month is less than 15 days, that month will be ignored. Employer's contribution to employee ka welfare fund. Whose contribution? Employer's contribution to employee ka welfare fund. So the fund can be approved fund or recognized fund, or the fund can be unapproved or unrecognized fund. If it is an approved fund or a recognized fund, deduction will be allowed subject to 43B. If the fund is an unapproved fund or unrecognized fund, deduction will be never allowed. See, if it is an approved or recognized fund, deduction will be allowed subject to 43B. If it is an unapproved fund or unrecognized fund, deduction will never be allowed. Who is contributing money? I, as an employer, is contributing money to the fund for your welfare. Fund is approved or recognized, deduction is allowed subject to 43B. Subject to 43B means what, sir? Provided I pay off those money within the due date of filing income tax return. If the fund is not approved or if the fund is not recognized, then deduction will never be allowed. 80CCD pension fund. Amount contributed by employer, 14% of salary. Salary means what's a basic pay plus DA in terms. So if the employer is contributing to 80CCD ka pension fund for the welfare of employee, I am contributing for your welfare, I can claim the deduction of that. How much can I claim? Amount contributed by me or 14% of salary, whichever is less. Salary is basic plus DA in terms. Employee ka contribution to recognized or approved fund. Now please see, my contribution we just now discussed, employer's contribution. Now employee ka contribution is also allowed as deduction to me. See, what happens is, let us say I have created a fund, recognized provident fund. I will contribute money in this fund. For my contribution, I can claim the deduction provided I pay it within 139(1) ka due date. Now you also contribute the money in this fund. But the problem is you cannot directly contribute the money. What will you do? You will give the money to me and I will contribute that money on your behalf. Now because you are giving the money to me, that will be treated as my salary. Okay, because employee has given that money to the employer, first not salary, sorry, that will be treated as my business income. Now I will get the deduction of that only if I pay within the due date of that act. Which act? PF Act, ESIC Act, etc. So employee ka contribution to recognized provident fund or approved funds, etc., recognized or approved funds, first it will be treated as income for the employer. For the employer, it will first be treated as income, and then deduction will be allowed only if it is paid within the due date of that respective act. Which act, sir? That respective act means what, sir? That respective act means the due date of if you are putting the money in, if you are putting the money in PF, the due date of PF Act. If you are putting the money in ESIC, the due date of ESIC Act, etc. Within the due date of that respective act. Now, let me talk about the summary over here. Contribution to any approved or recognized fund. Employer ka contribution. My contribution. Allowed as deduction if the contribution is made within 139(1) ka due date. If it is paid after 139(1) ka due date, it will be allowed in next year, meaning the year in which I am making the payment. Employee ka contribution, your contribution for employer, for me, it will be first treated as income. Then I will get deduction if it is paid within the due date of that respective act. If it is paid after the due date, then it will never be allowed as deduction. For employees, ignore it for salary calculation, then he can claim deduction under section 80C. Bad debts. See, in accounts we have provision for debts, bad debts and bad debts, correct? No. Under income tax law, we do not have the concept of provision at all. Any type of provision is not allowed under income tax law. Any type of provision, not only bad debts, I'm telling, any type of provision is never allowed at deduction under business income computation. So provision for bad debts is not allowed as deduction. Okay, but if it is an actual bad debts, then it will be allowed. If it is related to your business, then allowed as deduction, condition that it should be treated as income first and it should be written off in your books of accounts. If it is not an actual bad debts, if it is related to the loan given by you to someone, say my business is selling sari, okay, but I have given money to someone and he has not paid the money to me, so that is loan related bad debts. I have sold sari to someone, he has not given the money to me, that is business related bad debts. So if bad debts are related to my business, allowed as deduction, two condition, it should be treated as income and debt should be written off in the books of accounts. If the bad debts are related to loan given by the assessee to someone, it is not allowed as deduction unless my business is only giving loan. Now please note, recovery of bad debts will be taxable. Recovery of bad debts, if there is any recovery of bad debts happening, so first if I have given, if I have sold the goods and if you have not paid me some money, that will be taken as bad debts and that bad debts will be allowed as deduction. Now if the bad debts are recovered after a few years, then it will be deemed as business income under section 41(4). Section 37 is the next section which talks about general deduction. If there is any expenditure which you are incurring wholly and exclusively for your business purpose, and if it is not a capital expenditure, if it is not a personal expenditure, if it is not an expenditure covered anywhere else, and if it is not an offense prohibited by the law, then that expenditure can be allowed as deduction under section 37. Meaning if there is any expenditure not covered anywhere else, that expenditure will come over here. General deduction. This section allows for deduction of all other business expenses. However, business losses are not covered over here. Condition to claim deduction under section 37. That expenditure should not be covered under section 30 to 36. That expenses should be wholly and exclusively for your business purpose. Expenses should not be of personal nature. Expenses should not be of capital nature. That expenses should not be an offense prohibited by law. This condition should be satisfied. Expenses should not be covered under section 30 to 36. Expenses should be wholly and exclusively for your business purpose. Expenses should not be of personal nature, not of capital nature, and it should not be an offense prohibited by law. Now, if it is a penalty which you are paying to someone, if the penalty is for the breach of law, not allowed as deduction. If the penalty is for breach of contract, then deduction, it will be allowed as deduction. Penalty for breach of law, not allowed as deduction. Penalty for breach of contract will be allowed as deduction. Salary to employees. If you are paying salary to employees, allowed as deduction. Salary to partners, allowed. To working partners, sleeping partners, salary is not allowed as business expenses. Directors, you are paying, allowed as deduction. Leave salary also is allowed as deduction. Insurance, if you are taking on life insurance of any person, not allowed as deduction. Health insurance of employees allowed. Key man insurance policies allowed. Stock or asset insurance if you are taking, then also it is allowed as deduction. Advertisement expenses, normally it will be allowed. However, advertisement in the newspaper or a pamphlet or a brochure owned by political party is not allowed as deduction. CSR, corporate social responsibility, is not allowed as deduction. So whatever CSR spend you are doing. Taxes under direct tax, any type of expenses incurred by you under income tax law will not be allowed as deduction, whether you are paying tax, surcharge, cess, interest, penalty, anything under income tax law is not allowed as deduction. The business income is nothing but your profit before tax. Under income tax law, if you are paying any expenses with respect to indirect taxes, that is allowed. So if you are paying GST, if you are paying custom duty, if you are paying interest under GST law, that will be allowed subject to 43B. However, penalty will not be allowed as deduction. All other expenses like telephone, internet, printing, stationery, audit fee, etc., they all will be allowed as deduction. Section 43B. What is section 43B? Section 43B means what, sir? Section 43B, expenses allowed as deduction on payment basis. So there are some expenses. There are some expenses which will be allowed as deduction only if those expenses are actually paid off. Only if what, sir? Only if those expenses are actually paid off. Section 43B, expenses allowed as deduction on payment basis. Below expenses are allowed as deduction only if they are actually paid within the due date of filing income tax return under section 139(1). So there are some expenditure which will be allowed as deduction only if those expenditure are actually paid off. Only if those expenditure are actually paid off within 139(1) ka due date. Which are those expenses? Flood bonus. Flood bonus means what, sir? F for contribution to fund. Employer contribution to any approved or recognized provident fund, superannuation fund, gratuity fund, or any other welfare fund of employees. L for leave, salary, or any sum paid for earned leave. I for interest on loan taken from scheduled bank, NBFC, state industrial investment corporation, state financial corporation, public financial institution. R for any sum payable to Indian Railway for use of railway asset. T for any taxes, duties, cess, or fees payable under any law for the time in force. B for bonus or commission payable to employees. All this expenditure will be allowed as deduction only if it is actually paid within the due date of filing income tax return. Note: if above payment are made after due date of filing income tax return under section 139(1), then such expenditure will be allowed as deduction in the year in which payment has been made. Note: if any interest payable is converted into new loan, this is already covered. Now under MSME law, what does it say, sir? If you don't make the payment to a micro or small enterprises. Now what is a micro enterprises, small enterprises? Micro enterprises ka definition is changed. Micro enterprises means those enterprises who, wherein the money invested by you is less than 2.5 crores and the turnover is less than 10 crores. Small enterprises means those enterprises where the money invested by you is less than 25 crores or the turnover is less than 100 crores. Now, if you may see normally as per section 15 of MSME law, it says that you should make the payment to this micro and small enterprises within a number of days agreed between you both, which should not be more than 45 days. If you don't have any agreement, then you should make the payment to them within 15 days. If you don't follow this, then that expenditure will not be allowed as deduction unless until you pay that expenditure. Section 40, expenses which are specifically disallowed. So there are some expenses which will not be allowed at all, provided you satisfy this condition. Section 40A1 talks about what's interest, technical fee, royalty which is payable by you outside India or to a non-resident or a foreign company in India, where TDS is not deducted by you, or after deduction of TDS, if you have not paid it to the government within 139(1) ka due date, 100% of that expenditure will be disallowed. Interest, technical fees or royalty payable by you outside India or to a non-resident or a foreign company in India, where TDS is not deducted by you in the previous year, or after deducting the TDS in the previous year, it is not paid by you within 139(1) ka due date, 100% of that expenditure is disallowed. Section 40A1A, this is to non-resident or paying outside India. What if I pay to a resident in India? If there is any money, so here interest, technical fee, royalty, but for resident any money, any sum payable to a resident in India without deducting TDS in the previous year, or after deducting TDS but not remitting it to the government within 139 ka due date, then 30% of that expenditure will be disallowed. Basically, both are same. One is 100% if you are making payment outside India to a non-resident. If it is to a resident, then 30% of that expenditure will be disallowed. Now, this amount, whatever disallowed amount is there, that will be allowed subsequently when the TDS is deducted in the next year, or if it is deducted in the current year and paid in the next year, in the year of payment, it will be allowed as deduction. And further, it will be allowed if the recipient has filed his return and considered the above amount and paid the taxes on same, it will be allowed in the previous year in which the return has been filed. Section 40A3, income tax including surcharge and cess will be allowed as deduction. 40A, 2A, wealth tax will, not allowed as deduction. I'm talking about allowed as deduction. Section 40A2, income tax including surcharges and cess not allowed as deduction. Wealth tax not allowed as deduction. 40A3, if you are paying salary to outside India, if you are paying what, sir? Salary to outside India, or if you are paying what, sir? If you are paying salary to outside India, if you are paying salary outside India or to a non-resident in India where TDS is not deducted by you, or after deducting TDS it is not paid to the government within 139 ka due date, 100% of that amount will be disallowed. Section 40A 4, contribution made by you to Provident Fund or any other welfare fund where TDS arrangement has not been made. If you have not made any TDS arrangement, then that expenditure will not be allowed as deduction. If any tax on non-monetary perquisite which is required to be paid by employee, if it is paid by you as an employer, then that also will not be allowed as deduction. Section 40A2, unreasonable payment made to related person. If there is any excess amount or unreasonable amount paid by you to a related person, then that excess or unreasonable amount will be disallowed. And any payment made in excess of 10,000 rupees to a single person in a single day by any mode other than cash will be disallowed fully. 40A2, unreasonable or excessive payment made to a relative or related person. Where any unreasonable or excessive payment has been made to a relative for an expenditure, then such excess amount shall be disallowed. Now, who is a related person for me? For me, related person is, so for individual, it is spouse, father, mother, brother, sister, lenient ancestor, lenient descendant. For HUF, members of HUF and their relative. For firm, partners of the firm and their relative. For company, directors and their relative. For holding company, it is a subsidiary company. Any person having substantial interest in the concern, that is meaning if any person has 20% or more, profit sharing ratio or voting rights. 40A3 is what? Payment more than 10,000 rupees in cash. Payment made in excess of 10,000 rupees for a single expenditure to a single person in a single day by any mode other than account pay check, account pay demand draft or any other electronic clearing system, then such expenditure will be disallowed fully. So if you pay by cash, bearer check, cross check, all these are not allowed. This limit will be 35,000 in case you are making the payment to a transporter. 40A7, provision for gratuity is not allowed as deduction. 40A9, contribution to any unrecognized or unapproved welfare funds for employee is not allowed as deduction. 40B, taxation of firm. Remuneration and interest to partners of a partnership firm. Any remuneration means salary, bonus, commission or any other sum, or any interest. Interest is interest on loan or interest on capital, which is paid by you to by partnership firm to partners, whether it is allowed as deduction or not. Who will tell? 40B. Remuneration and interest is allowed as deduction only if it is authorized by partnership deed. So remuneration and interest you can claim as deduction if it is authorized by partnership deed, if partnership deed is allowing it. Remuneration and interest will be allowed prospectively and not retrospectively. So if you don't have a partnership deed, or if the partnership deed does not mention about remuneration, interest cannot be given. If you make any amendment in partnership deed and say that I will get remuneration from any previous period or past period, lawmaker says it will not be allowed. It will be allowed prospectively and not retrospectively. Remuneration and interest. Remuneration will be allowed only to working partners, whereas interest will be allowed to both working and sleeping partners. Sir, how much interest will be allowed as reduction? Maximum interest which will be allowed as reduction under section 40B will be 12% per annum to each partners. Interest as per deed is nil. How much can I give? Nothing. Interest as per deed is 15%. I can give only 12%. If it is as 12%, I can give 12%, 8%, 8%. Remuneration allowed as per section 50B. Remuneration under section 40B. This is important. Remuneration amount. That remuneration amounts which you can give depends on book profit of the firm. If the book profit is up to 6 lakh rupees, up to book 6 lakhs of your book profit, whatever your book profit is there, 90% of that or 3 lakh rupees, whichever is higher, is the remuneration which can be given by you. 90% of book profit or 3 lakh rupees, whichever is higher. Not 6 lakh, 3 lakh rupees. Up to 6 lakhs, it is 90% or 3 lakhs, whichever is higher. For remaining book profit, balance book profit into 60%. A and B combined together is the total remuneration which can be paid by you. Now please note, even if the company is making a loss, you can give a remuneration up to 3 lakh rupees because 90% of book profit or 3 lakhs, whichever is higher. Now what is the book profit? Book profit is nothing but your business income before remuneration. What is book profit? It's a business income before remuneration. So first find the net profit of the company before remuneration and interest. Before remuneration and interest, find the net profit. Then allow the remuneration as per 40B, which is, allow the interest as per 40B, which is 12%. That leftover part is your book profit. Now, what happens to the income of a partnership firm? What happens to the income of a partnership firm? Income of a partnership firm and partners. See, whatever firm earns on that income, firm has to pay a tax at 30%. Correct? Taxability of income earned by partners from the firm. Now, remuneration and interest. So the firm can earn what's the remuneration and interest, and the firm can see, firm earns money, whatever profit is earned by a firm, 30% flat is the interest rate. Now partners are earning money from the firm. What can partners earn from the firm? It can earn remuneration and interest, and it can also get share of profit. Whatever share of profit a firm is getting, whatever share of profit a partner is getting from the partnership firm, that is exempt in the hands of partners. Why? Because on that profit the firm has already paid tax at 30%. So when the profit is distributed to the partners don't have to pay any taxes. Now the remuneration and interest which the partners are getting from partnership firm, that remuneration and interest, if it is within 40B ka limit, it will be allowed as deduction to the firm, and it will be taxable in the hands of partners as business income. If the remuneration and interest is more than the 40B limit, the remuneration and interest within the limit of 40B will be allowed for the firm, and it will be taxable in the hands of partners. Remuneration and interest in excess of 40B limit, it will be disallowed for the firm, and it will not be taxable in the hands of partners. Because the firm is not paying the tax on the, so firm is already including it. It is disallowed to the firm. That means firm is paying the tax on that. For partners, it is disallowed. Deemed business income already covered. Section 41 talks about deemed business income. What are deemed as business income? See, we have covered this balancing charge, sale of scientific research asset, and recovery of bad debts. Apart from that, what is deemed business income, sir? Remission or cessation of trading liability. So if you have any business liability, and if that is seized, cancelled, you don't have to pay that anymore. That is your business income. Brought forward loss from defunct business. So if there is any business which is closed by you, now if the loss of that business is recovered, meaning that business is closed by you, were making losses, and you close that business, if there is any recovery of that money, that will be deemed as your business income. Solving PGBP question has two methods. One is direct method, indirect method. Direct method, what will you do, sir? Take only income of business or profession, subtract expenses related to business or profession, that is your business income. Indirect method, they'll give you profit and loss account, okay, or they will give you list of all the different types of income expenditure, and they'll meaning everything will be included in one sheet only, correct? So you take the net profit which they have given, from that subtract whatever is not related to business, add whatever is related to business, or add and subtract whatever is related to business, add and subtract whatever is not related to business. Meaning, take the net profit which is given in the question. From that, subtract all the income taxable under other heads. Add expenses related to income taxable under other heads. Add the expenses which is debited to profit and loss account but which is not allowed. Subtract the expenses which is allowed but not debited. Add any business income which is not credited to the profit and loss account, that will give your business income. Yeah, I think we are almost on the verge of completing this. We have presumptive taxation. Income under presumptive scheme. Income under what scheme, sir? Income under presumptive scheme. Section 44AD is for business. 44ADA is for specified profession, and 44AE is for goods carriage businessmen. Presumptive taxation we are discussing. 44AD, presumptive taxation means what, sir? We are going to presume or assume that this is your business income. Section 44AD, business or non-specified profession. Now, Section 44AD says I am applicable to a resident individual, HUF and a firm. Section 44AD says I am applicable to a resident individual, resident HUF and resident firm excluding LLP if they are doing any types of doing any type of business, or if they are not doing any specified profession, except commission business, agency business, and 44AD as well as 44AE business. And if the total turnover is up to 2 crore rupees, and if the total turnover is up to 2 crore rupees, so in that cases 2 arrow marks, your business income will be turnover into 8% and or your business income will be turnover into 6%. Okay, normally I will take 8% of your turnover as your business income. I'll take 6% of your turnover as your business income if whatever sales you have made, whatever turnover you have made, or whatever sales you have made, if you have received the money of that sales by account paid check, account paid demand draft, or any other electronic clearing system within the due date specified in the section 139(1). Within this due date, if you have received the money through these modes, then it will be taken as 6% of turnover, or else we'll take 8% of turnover. Now, 44ADA, presumptive scheme for specified business. See, normally the limit is how much, sir, over here? 2 crore rupees, but this limit will be 3 crore rupees if the cash payments and cash receipts of your business are less than 5% of the total receipts and total payments of your business. Section 44ADA, presumptive scheme for specified professional. Specified professional means I left come. I left come means what, sir? Accountant, architect, interior designer, legal professional, IT professional, film artist, technical professional, company secretary, medical profession, and engineers. Accountant means chartered accountant as well as cost accountant. Now 44ADA is applicable if you are a resident individual as well as a resident firm who are specified professionals and whose gross receipt is up to 50 lakh rupees. Your business income will be 50% of your gross receipts. Okay, for them 50% of gross receipts. Now this 50 lakh rupees will be 75 lakh rupees if their cash receipts and cash payment is less than 5% of total receipts and total payments. Now, if you are following this presumptive scheme, you will not get any deduction under section 30 to 37, and 40B ka benefit also will not be given to a firm. Higher income, if you want to disclose more than 8%, 6% or 50%, you can always disclose. If you want to disclose income lower than the limit specified over here, then you will have to maintain books of accounts, and you will have to get those books of accounts audited by a chartered accountant or a cost accountant. Sorry, not cost accountant, only chartered accountant, sorry. Deductions under chapter 6A is allowed from this 44AD and 44ADA income. Brought forward losses can be subtracted against this income. Okay. Next, this is the most important thing. This is something which they test normal in the examination. Presumptive scheme for goods carriage business or for transporters. Presumptive scheme for goods carriage business or for a transporter. This is applicable to all types of assessees. If you are in the business of plying, hiring, leasing, renting of goods carriage, and if you have up to 10 goods carriage at any time during the previous year. Now, this is applicable to all types of associates if you are in the business of playing, hiring, leasing, renting of goods carriage, and if you have up to 10 goods carriage at any time during the previous year. And if you have heavy goods vehicle, that goods carriage will be divided into two categories: heavy goods vehicle and other vehicles. If you have heavy goods vehicle, then what is heavy goods vehicle? Those vehicles whose gross vehicle weight is more than 12 tons or 12,000 kgs. Then you take the value of that vehicle to be equal to 1000 rupees per ton per vehicle for a month or part thereof. For other vehicles, you take 7,500 per vehicle per month or part thereof. Now the month shall be considered from the date of purchase of the vehicle and not from the date of put to use of that vehicle. Last part of this chapter is your maintenance of books of account. Will not ask all those points. So if you are a specified professional, who is a specified professional? Specified professional means I lift come. You should maintain your books of accounts if your gross receipts in preceding 3 previous year, in all the 3 preceding previous year, if your gross receipts are more than 1,50,000 rupees, or if you are a new entity and your expected gross receipts in the current year is more than 1,50,000 rupees. For specified profession, if your gross receipts is not more than 1.5 lakhs in all the 3 years, or your new entity and your current year gross receipts is not more than 1.5 lakhs, you have to maintain such books of accounts which will help the income tax officer to compute your business income. If it is more than this limit, you maintain cash book, journal book, ledger book, carbon copy of bills more than 25 rupees, original copy of bills more than 50 rupees, and medical professionals should also maintain daily case register. And if you are a person who is not carrying any specified profession, or if you are doing any type of business, then if your profit is more than 1.2 lakhs or turnover is more than 10 lakhs in any of the 3 preceding previous year, or if you are an individual or HUF and if your profit is more than 2.5 lakhs or turnover is more than 25 lakhs, then you should maintain books of account which will help the income tax officer to compute your business. Sir, what if my profit is not exceeding 1.2 lakhs or turnover is not exceeding 10 lakhs, or if I am an individual HUF and my profit is not exceeding 2.5 lakhs or not exceeding 25 lakhs, should I maintain books of accounts? Answer is no. Now, you should get your books of accounts audited if your turnover is more than 1 crore. Now, the limit will be 10 crores if the total cash receipts and cash payment is less than 5% of total receipts and total payment. If you are a professional having a gross receipts more than 50 lakhs, then also you should maintain your books of accounts, and this limit will be 75 lakhs if the total cash receipts and cash payment is less than 5% of total receipts and total payments. And if you are a presumptive person, if you want to declare income lower than the limit specified over there, then also you should get your books of accounts audited. If you don't get books of accounts audited, penalty is 0.5% of turnover or 1.5 lakhs, whichever is less. Okay. So that is all about this chapter. We'll see the question which they have given over here. Okay. Mr. Ratan, a resident individual aged 40 years, is engaged in the business of hiring, playing of goods vehicle. He gives the following details of his vehicle fleet. Opening stock of vehicle as on 1/4/25, meaning these vehicles are there from the beginning of the year. Vehicle number 1, 2, 3, 4. Gross vehicle weight is 8,500, 13,000, 15,000 and 10,000. So these two vehicles are heavy goods vehicle. These vehicles are, one of the vehicle is sold in the first month itself. So for 1 month I will compute the income for this. He bought following vehicles during the year. Both the vehicles are less than, a normal goods vehicle, not heavy goods vehicle. And the date of purchase they have given, date of put to use they have given, date of purchase they have given. During the financial year, he received 45 lakhs from hiring and playing these businesses. Since he did not maintain proper books of accounts, so he wants to opt for presumptive scheme under 44A. Analyze the situation and calculate Mr. Ratan's income chargeable to tax under PGBP for the assessment year. Discuss the relevant provision. So they're asking you to find the income for him. Nice, very nice, no problem. Very simple question, very easy question. So totally how many vehicles he has? 1, 2, 3, 4, 5, 6. Very simple. So vehicle number 1, 2, 3, 4, 5 and 6. Vehicle type, whether it is heavy goods vehicle or other vehicle. So vehicle type, first I'll write how much is the gross vehicle weight. 8,500, 13,000, 15,000, 10,000, 7,500 and 8,500. Date of purchase, I'll write month in use. Month in use means how many months I have used this asset. Use means use will be calculated from the date of purchase itself. So these first two vehicles will be used for full 12 months because they are opening vehicles. Correct? No. These were there at the beginning, therefore it will be used for 12 months. This vehicle will be used for 1 month only because it was sold on 24th. So first 1 month only will be taken for this. Next vehicle is also for 12 months. New vehicles, this is 11 months, this is 10 months. 1st May, 1st June. 1st May, 11 months, 1st June, 10 months. Okay, months I have written, number of months. Now how much is the value? Type of vehicle. See, that vehicle whose heavy goods vehicle is a vehicle whose weight is more than 1,200 kgs. So for this I will take 1,000 rupees per ton per vehicle. For other vehicles which is less than 12,000 kgs, I will take 7,500 per ton per vehicle. So for this I will take 7,500, not per ton, 7,500 per vehicle for 12 months. This will be 1,000 into 13,000 is nothing but 13 tons into 12 months. 1,000 into 15 tons into 1 month. 10,000 kgs is nothing but 7,500 into 12 months. 7,500 into 11 months. 7,500 into 11 months. So you just have to first identify whether it is normal vehicle or heavy goods vehicle. That identification will help you. For normal vehicle it is 7,500 per vehicle. Correct? For heavy goods vehicle it is 1,000 rupees per ton. 1,000 into 13 into 12. $90,000, 1,56,000, 15,000, 90,000, 82,500, 75,000, 5,08,000, 500 rupees is the answer. For this answer you will get 7 marks. $5,08,500. Very simple, very easy. So first they have written the provision. What is the provision they are writing, sir? Presumptive basis, section 44A. When is it applicable? if you are a person who is involved in the business of flying, hiring, leasing, renting of goods carriage, and if you don't have more than 10 vehicles at any time during the previous year. Section applicable is 44A. Okay, now what I'll do is I'll conclude my today's class over here only. I was supposed to take till 8, I believe, but I'll conclude till here only because voice is not supporting me, and we'll take, instead of 2 days, we'll complete in 3 days. Okay, so we'll continue our discussion on other topics in our next class. So we have in this means what, sir? In direct taxes, which chapter is pending? In direct taxes, the pending chapter is your so basic concepts are the heads of income from capital gain. All these chapters are pending, which will hardly take around 3 or 4 hours. Okay, 3 or 4 hours I'll complete this. Capital gain and other sources is major topic. All other topics are just 15-20 minutes each chapter. Max to max 3 hours is what I'm going to take. Max to max. Okay, so we'll complete this and then we'll start the discussion with indirect taxes. So let me meet you tomorrow, same time. Till then, tada, bye bye, take care, enjoy.
Hello friends, welcome back. Very good morning to you all. So let us continue our discussion. So in our previous class, we discussed till profits and gains from business and profession. Let us continue the next topic which we have. The next topic which is there is called as income from capital gain. Okay, so income from capital gain, income from capital gain, income from capital gain. Yeah. Now, what is this topic talking all about? Very important topic, simple topic. 7 marks, 1 question can be asked, will be asked from this topic. So, income from capital gain. So, what is this chapter saying, sir? If you have a capital asset and if you transfer that capital asset, if you have a capital asset, if you transfer that capital asset, upon transferring that capital asset, if you get any gain, that gain will be called as capital gain, and that capital gain will be taxable under the head income from capital gain. Whatever gain you get, that gain will be taxable under which head, sir? Under the head income from capital gain. Now, section 45 subsection 1 is the charging section. Section 45 subsection 1 is the charging section. What is section 45 1 telling? Any profit or gain arising from transfer of a capital asset shall be taxable under the head income from capital gain in the year in which transfer took place. If you get any type of profit or gain, how are you getting this profit or gain? If you get any type of profit or gain, how are you getting this profit or gain? By transferring a capital asset. Now the gain will be taxable under the head income from capital gain. Now in which year will it be taxable, sir? In the year when transfer has taken place. Sir, what do you mean by transfer? See, 2 things are important. One, transfer. Another thing is capital asset. Sir, what do you mean by transfer? Transfer means what, sir? Definition of transfer says transfer includes, meaning whatever you generally understand by the word transfer is a transfer. Whatever you generally understand by the word transfer is already a transfer. But apart from that, transfer shall include sale of a capital asset, exchange of a capital asset. You actually physically sell it for a money. Exchange means you are giving it to someone in exchange of something else. Relinquishment or extinguishment of capital asset. Relinquishment means what, sir? You are surrendering or giving away something. Or extinguishment means what, sir? Destruction or destroy of capital asset. Conversion of capital asset into stock in trade. Compulsory acquisition of capital asset. Allowing possession of immovable property as per Transfer of Property Act. Transfer of share in cooperative society and redemption of zero coupon bonds. These are the different forms of transfer. These are the different forms of what, sir? These are the different forms of transfer. Then, what do you mean by capital asset? Capital asset means property of any kind. Capital asset means what, sir? Property of any kind held by. Please note, you don't have to by heart this definition. They'll not ask all this definition in examination, but you should be knowing what it is. Correct? No? Because only when you know what is a capital asset, the transfer of that capital asset will give you capital gain. Section 2 clause 14 talks about capital asset. What does it say, sir? It says capital asset means property of any kind held by the assessee, whether connected to business or not. So any type of property which is held by you, whether it is related to your business, connected to business or not connected to your business, it does not matter, is called as a capital asset, but it shall not include stock in trade.
Now they say the property of any kind held by the SSC, whether connected to the business or not. When they say the property of any kind held by the SSC, that means they are talking about all the things which you have. But they are specifically telling that stock in trade will not be treated as capital asset. Because if you sell a stock in trade, the income which you are going to get from sale of stock in trade will be taxable under the head business or profession. Gold monetization bonds and gold certificates which are issued by Government of India. Then movable personal effects, all those things which are movable and which you are using for your personal purpose, they are also not a capital asset except DJ Paso BV. Movable personal effects except what, sir? DJ Paso BV. See, normally whatever is movable, for example, mobile phone is movable personal effects. My car is a movable personal effects. My iPad is a movable personal effect. My t-shirt is a movable personal effects. Correct? All these are not treated as capital asset. Movable personal effects are not treated as capital asset except DJ Paso BV. Now, DJ Paso BV, though it is movable, it will be treated as capital asset. What is DJ Paso BV, sir? D for drawings, J for jewelry, P for paintings, A for archaeological collections, S for sculptures, S for shares and securities, O for other work of art, bullion and virtual digital asset. These things will be treated as capital asset. These things will be treated as capital asset, though they are movable. Okay, and rural agricultural land is also not a capital asset. Please note. Agricultural land in urban area will be treated as capital asset, but if it is in rural area, then it is not a capital asset. What is rural area? All the areas other than urban area. Yeah, sir, but what is rural area? An area where the population is less than 10,000. Then any securities held by foreign institutional investor will be treated as capital asset. Investment fund specified under section 115 UB, that also will be treated as capital asset. And ULIP, which is not exempt under section 1010D, also will be treated as capital asset. Now there are two types of capital asset. One is called as long-term capital asset, another is called as short-term capital asset. If you transfer a long-term capital asset, you will get a gain called as long-term capital gain. If you transfer a short-term capital asset, you will get a gain called as short-term capital gain. Now, how do I determine whether the capital gain which I have is a long-term capital gain or a short-term capital gain? To check whether the capital gain which you got is a long-term capital gain or a short-term capital gain, you should see something called as period of holding. How long is that asset held by you? So if the period of holding, what is period of holding? That period of holding is the period from the date of purchase of the asset till the date of transfer of the asset. If the period of holding is long, what is that long period? More than 1 year or 2 years, then it is long-term capital asset. And if the period of holding is less than 1 year or 2 years, it is a short-term capital asset. Now the period of holding for different capital asset, meaning there are some assets, if you hold this asset for more than 1 year, that is more than 12 months, then it will be treated as long-term. If you hold some assets for more than 2 years, it will be treated as long term. Okay, so what are those assets which has a period of holding of 1 year? What are those assets which has a period of holding of 2 years? Period of holding for capital asset. So 12 months period of holding is applicable for any securities other than units which are listed in recognized stock exchange of India. So whatever shares you see, securities you see which are listed in recognized stock exchange of India, for them the period of holding which you are supposed to see is 1 year. Meaning if you transfer those assets, then the capital gain will be applicable. The long-term capital gain will come if you sell after 1 year. Short-term capital gain will come if you sell within 1 year. Units of equity-oriented mutual funds, units of unit trust of India, and zero coupon bonds. So these are the different things for which period of holding is 1 year or 12 months. Anything apart from this, four things: listed securities, unit of equity oriented mutual fund, units of unit trust of India or business trust of India, and zero coupon bonds, anything other than this, any other type of capital asset you see, for that the period of holding is 2 years or 24 months, like jewelry, unlisted shares, immobile property, house, etc. Now, how do I compute the capital gain? Computation of capital gain is one of the easiest. Now, it does not matter whether the capital gain is a long-term capital gain or a short-term capital gain. The asset which is transferred by you is a long-term capital asset or a short-term capital asset. The gain amount will remain same. The gain amount will remain same. First, the gain amount in the sense the calculation part I am telling, not the actual gain amount. The computation mechanism will remain same. First, you should take full value of consideration. Full value of consideration is nothing but the value at which the asset is sold by you. From that, you subtract expenses incidental to transfer. Take full value of consideration, subtract expenses incidental to transfer. That will give you your net sale consideration. From this net sale consideration, you subtract the cost of acquisition, you subtract the cost of improvement, you will get your gross capital gain. First take full value of consideration, subtract
expenses incidental to transfer, take net sale consideration. You will get net sale consideration, sorry. From that, subtract cost of acquisition, cost of improvement, you will get your gross capital gain. From that, you subtract exemption, you will get your taxable capital gain. You will get what, sir? Taxable capital gain. Correct? So it is same for both short term and long term. Now, for long term capital asset, if the long term capital asset is transferred before 23rd of July 2024, if the long term capital asset is transferred before 23rd July 2024, then instead of subtracting the cost of acquisition and cost of improvement, you should subtract index cost of acquisition and index cost of improvement. Sir, 1 second. I'm getting confused over here. What is the confusion? See, normally to calculate the cap gain, take full value of consideration less expenses incidental to transfer, subtract cost of acquisition, cost of improvement. That will give you capital gain. Correct? That is normally what is required to be done. But if there is any long-term capital asset, and if that long-term capital asset is transferred before 23rd of July 2024, if there is any long-term capital asset and if that long-term capital asset is transferred before 23rd of July 2024, then a transfer means what, sir? If it is sold before which date? 23rd July 2024. In such cases, while calculating the cost of acquisition, you should take index cost of acquisition, and while calculating cost of improvement, you should take index cost of improvement. Meaning, the capital gain should be computed by taking the indexed values of acquisition and improvement. Okay, and there is one more case when you are request to use this indexation benefit that we will see later. How will I find that, sir? First, same full value of consideration less expenses, you will get your net sale consideration. From that, subtract your index cost of acquisition, subtract your index cost of improvement. That will give you your gross capital gain. Subtract your exemption, you will get your taxable capital gain. Now, in two scenarios, you are supposed to do along capital gain computation along with indexation. One is when transfer is before 23rd July. Second case, if you are an individual or an HUF, and if you are transferring an immobile property. If you are an individual and an HUF, and if you are transferring an immobile property, and if the question is asking you to finding the tax amount, not the gain amount, but the tax amount. See, if the transfer is before 23rd July, always with indexation. But if the transfer is after 23rd July, then you will have to do with indexation if they are asking you to only to find the tax amount. Okay, if they are asking only the gain amount, ignore indexation. If they are asking you to find the tax amount, then with indexation as well as without indexation, we will see the tax later. How do I find that index cost of acquisition, sir? What do you mean by index cost of acquisition? See, basically index cost of acquisition or index cost of improvement means you are giving the benefit of inflation to the expenses incurred by you. See, when I purchase, whatever I was able to purchase, let us say, the 2 idlis were costing 5 rupees or 10 rupees around 20 years ago. The same 2 idlis will not cost 10 rupees today. The same 2 idlis will cost around 30 rupees today or 40 rupees today in some places or 50 rupees some places. Correct now? Why is that, sir? Because of inflation. So just like that, they are telling when you take the actual cost only, then you are not giving the benefit of inflation. Therefore, you please take the index cost of acquisition. So index cost of acquisition is your cost of acquisition multiplied by index for the year of transfer divided by index for the year of acquisition. Similarly, index cost. So what is this index for the year of acquisition? Index for year of transfer, sir. Take your cost of acquisition multiplied by the inflation rate, cost of inflation index, as in the year whatever is there for the year of transfer, divided by cost of inflation index for the year of acquisition. Index cost of improvement. For taking index cost of improvement, you take the cost of improvement, multiply the cost of improvement with index for the year of transfer, divide that with index for the year of improvement, multiply it with index for the year of transfer, divided with index for the year of improvement. Note, if a capital asset is acquired before now please note, this indexation benefit is available from the year 2001 to, meaning the index values are there, no cost of inflation index values, they are available from the year 2001 to. Therefore 2001 to is the base year, and for the base year the index value is 100.
Okay, so for the previous year 2001 to the index value is what's 100, that is the base year, meaning from that year they are going to compare what is the inflated price. And for the previous year 25-26, which is your examination ka year, the index value is 376, meaning what, sir? If you had 100 rupees in the year 2001 to, that 100 rupees would have become 376 rupees in the year 25-26. If a capital asset is acquired before 1st of April 2001, if a capital asset is acquired, purchased before 1st of April 2001, then the cost of acquisition shall be actual cost of acquisition or the fair market value as on 1/4/2001, whichever is higher. Now, because index value is not available before 1/4/2001, because index values are not available before 1/4/2001, so if any asset was acquired before 1/4/2001, for that the cost of acquisition will be actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. If any improvement has been done by you before 1/4/2001, that improvement should be ignored, because when you are taking the market value, that market value will be along with improvement ka price only. Now, tax rates for capital gain. Capital gain can be of two types: long-term capital gain and short-term capital gain. Now, if it is a short-term capital gain, then it can be either taxable under 111 or it can be taxable under 111A. If it is a short-term capital gain and if it is taxable under 111, then it will be taxable at what rates are? Slab rates. If it is a short-term capital gain and if it is taxable under 111A, then it will be taxable at what rates are? 20%. Short-term capital gain 111, 111A, 111 slab rates, 111A taxed at 20%. Sir, what is covered under 111A? Yesterday we discussed. In the first chapter we have discussed only 3 assets are covered under 111A and 112A, which is nothing but listed equity shares, equity-oriented mutual fund, and units of business trust of India. Long-term capital gain can be taxable either under 112A or under 112. If it is taxable under 112A, then the tax rate will be 12.5% for gain in excess of 1,25,000. If it is taxable under 112A, 12.5% is the rate of tax for the gain in excess of 1,25,000. And long-term capital gain under section 112, check the asset is an immovable property or any other type of capital asset. Sir, it is not an immovable property, sir. If it is not an immovable property, it can be any other type of capital asset like shares, jewelry, debentures, etc. If it is any other type of capital asset, tax rate will be 12.5%. No, sir, it is an immovable property, sir. If it is an immovable property, check whether the transfer is made by individual or HUF or the transfer is made by any other person. If the transfer is made by any person other than individual HUF, then the tax rate will be 12.5%. But if an immovable property is the capital asset, and if that immovable property has been transferred by an individual and HUF, tax rate will be 20% with indexation, 12.5% without indexation. Okay, now simple. See, long-term capital gain taxable at 112A taxable at 12.5% for gain in excess of 1,25,000. 112, it is taxable at 12.5%. But if the asset is immovable property and if it is transferred by individual or HUF, then the tax rate will be 20% with indexation, 12.5% without indexation, whichever is lower, whichever is less. Now see, so when the question is compute the capital gain and the tax liability, then you are required to do with and without indexation. So normally our answer will remain this much only. Okay, meaning take your full value of consideration, subtract expenses, net sale consideration. I'll read the question and we'll maybe consider this question. Mr. Champak purchases a house property for 3 lakh rupees on 26th of May 1989. The following expenses are incurred by him for making additions or alteration for the house property. Cost of construction in the year 92-93, cost of construction of second floor 2003-04, reconstruction of property 2009-10. Fair market value of the property as on 1/4/2001 is 9,50,000 and the house property was sold by Mr. Champak on December 10, 2025 for 85 lakhs and he incurred an expenses of 60,000. Now see, how will I compute? I'll take full value of consideration 85 lakhs, expenses less expenses incidental to transfer 60,000. Net sale consideration is 84 lakh 40,000 rupees.
Now from that I'll subtract cost of acquisition. How much is my cost of acquisition, sir? My cost of acquisition will be the actual cost of 3 lakhs or the fair market value as on 1/4/2001, whichever is higher. How much is higher? 9,50,000. So my cost of acquisition is 9,50,000. Now improvement done before 1/4/2001 should be ignored. So I'm ignoring this improvement. Then 3-4 improvement I will take, and 2009-10 improvement also I'll take. So 5,30,000 and 2,90,000 rupees. That will give me my long-term capital gain of 66,70,000 rupees. Now they have also asked, so this is my main capital gain answer. If the question was talking only about capital gain, this is my answer. I close over there. But because they have also asked to find the tax liability, now what will I have to do? On this amount, this is capital gain without indexation. I have not taken index value. So on this amount, the tax rate will be 12.5%. 12.5% without indexation. So 66,70,000 into 12.5% is 8,33,750 rupees. Capital gain with indexation, that is, this is required to be done only for computing tax amount. So I'll take full value of consideration will remain same, cost, the expenses also will remain same, and net sale consideration will remain same. Now the cost of acquisition, now instead of taking the actual cost, I mean whatever the cost is coming as, I will take indexed cost, meaning I'll multiply it with the inflation, cost of inflation index. So 9,50,000 is my cost of acquisition multiplied by 376 divided by 100. Cost of improvement is nothing. Cost of improvement of second floor, 5,30,000 into 376 divided by 109. 2,90,000 into 376 divided by 148. So that will give me my capital gain amount with indexation. So to this, I'll apply the rate of 20%. I'll compare both the amounts, take whichever is less, that is my tax liability. See, normally what happens, capital gain is taxable in the year when transfer took place. So whenever transfer is happening in that year, only capital gain will be taxable. So this is what happens normally. Capital gain will be taxable in which year? Capital gain will be taxable in that year in which transfer took place. But however, there are some exceptions. What do you mean by exceptions? See, normally I have to pay capital gain tax when actually the transfer of the capital asset is happening. But there are some exceptions for this. 3 major important exceptions are this. Okay, first 2 exceptions are most important. Conversion of capital asset into stock in trade. Conversion of what's a capital asset into stock in trade. Let us say I have a 100-acre land which I purchased in the year 2001-2 for 10 lakh rupees. I have an 100-acre land which I purchased in the year 2001-2 for 10 lakh rupees. Now I converted this land into my stock in trade, meaning I started real estate business, and therefore I converted this into my stock in trade. Now on the date of conversion, the value of this property was 40 lakh rupees. Have I sold it? No. Have I sold it? No. But we studied somewhere that conversion of a capital asset into stock in trade is also treated as transfer. Even if you convert a capital asset into stock in trade, that will be treated as transfer. Now transfer is happening in the year 17-18. Now I sold this stock in trade. See, there is a capital asset. I converted this into stock in trade. Now, in the year of conversion, did I actually receive any money? See, we know that if I convert any capital asset into stock in trade, it is treated as transfer. But did I receive any money? Do I have any amount with me to pay the taxes? No. So lawmaker says normally you have to pay capital gain tax in the year of transfer, but in this case, no, you should not pay in the year of transfer. Yes, I understand the transfer took place in the year when you converted, but capital gain will be taxable in the year when the stock in trade is sold. So in the year when you are selling the stock in trade, you have to pay the tax on this particular transaction. How much tax I have to pay? In the year of sale of stock in trade, 2 possibilities are there. So 2 incomes will be there. One is capital gain income and business income. Now what is sold by me for 90 lakh rupees is not my capital asset, it is my stock in trade. Correct? So for computing stock in trade, I will take sale price as 90 lakhs. But for computing capital gain, what will be my sale price, sir? What will be my full value of consideration? Lawmaker says the full value of consideration shall be fair market value of capital asset on the date of conversion. On the date of conversion, when is the conversion happening, sir? The conversion happened in the year 17-18. So in that date, what was the fair market value? 70 lakh rupees. So I will take this amount. Fair market value as on the date of conversion, which is 40 lakh rupees, not 70 lakhs, 40 lakh rupees. 40 lakh rupees less expenses incidental to transfer. You will get net sale consideration. Subtract
index cost of acquisition. Why, sir, index cost of acquisition? See, transfer took place in the year 1718. Correct? No. A transfer of this capital asset, conversion took place in the year 1718, and conversion of capital asset into stock in trade is treated as transfer. So, because transfer took place in 1718, which is before 23rd of July 2024, I will take indexed cost of acquisition. I'll get my capital gain. How much is my business income? Sale price of stock in trade less expenses less cost of acquisition of stock in trade. That will give me my business income. Therefore, in the year when the stock in trade is sold, you have two types of income. Now, so the provisions are written over here. Now the question comes is, sir, what if the stock is sold in installment? Sir, it may not be possible that entire 100 acres are sold. I converted 100 acres, I understand. But entire 100 acres may not be sold by me at once. So what if the stock in trade is sold in installment? Lawmaker says if the stock in trade is sold in installment, then capital gain amount will not change. Capital gain amount will not change. Correct? See, here also we got 12,80,000 as capital gain. Capital gain amount will not change. The capital gain amount will remain same. But the capital gain amount will be taxable in installment. Now, the capital gain amount is 12,80,000, but in the current year, how much was sold, sir? Only 70 acres was sold, or 70% was sold. Therefore, in the current year, 25-26, you should pay tax only on 8,96,000 rupees. And business income, of course, you should take proportionately only for 70 acres. So, sale price is for 75 lakhs. Cost of stock in trade is 40 lakhs into 70%. Next is compulsory acquisition of a stock in trade. What do you mean by compulsory acquisition of stock in trade? Many times it may happen that government has plans for construction of highway projects or roads or metro rail projects, etc. And your land is coming in between. Now, because your land is coming in between, what government may do is they may acquire your land. Now, what happens is the acquisition may happen in the year one, and they may make the payment to you after 3 years, 4 years, 5 years. In this case, transfer will take place in the year when compulsory acquisition is happening. But capital gain you will have to pay in the year when you receive the compensation. See, government is going to acquire your land today, but the compensation may be paid after 5 years. Now, because the acquisition happened in this year, today, it is treated as transfer. Correct? Because why, sir? Government acquired your property, and transfer definition says compulsory acquisition of a capital asset under any law is also treated as transfer. But because you did not receive any money, you don't have any money, you don't have to pay capital gain tax. Capital gain tax is required to be paid by you when you receive the compensation. Now, this compensation also can be of two types: initial compensation and additional compensation. Initial compensation is the compensation which they agreed to pay you. Additional compensation is the extra money which you are asking them. Sometimes what may happen, they may pay you less. So you may put a court case, they may pay you extra money. So when you receive that extra money will be taxable in the year when you receive that extra money. So let me read the provision for you. See, compulsory acquisition of a capital asset is regarded as transfer. And transfer takes place in the year when capital asset is compulsorily acquired. However, capital gain tax is payable in the year in which compensation is received. See, compulsory acquisition of capital asset is regarded as transfer. Transfer will take place in which year? Transfer will take place in the year when compulsory acquisition took place. However, capital gain will be taxable in the year when compensation is received. When you receive the money in that year, you will have to pay the taxes. Now, computation of capital gain. Capital gain can be of two types. Capital gain can be for initial compensation and for additional compensation. For initial compensation, first take the full value of consideration less expenses incidental to transfer, that will give you net sale consideration. Subtract cost of acquisition, cost of improvement, and subtract index cost of acquisition, index cost of improvement, depending upon the type of asset, you will get your capital gain. It can be long term or short term. Now, if you receive additional compensation, if you receive extra money, from that extra money, you can subtract only one thing, which is legal expenses. You have already subtracted cost of acquisition, cost of improvement. Therefore, when you receive extra money, you see what is the extra money received by you. What is the additional compensation received? less only legal expenses to receive this, that will be taxable as capital gain. Now, what may happen is the money which they agree to pay you, they may not pay you at once. They may pay you in installment. So, in such cases, when should I pay the taxes? They say, if the compensation is received in installment, which compensation? If the initial compensation is received in installment, then total capital gain amount will be taxable in the year when the first installment is received. If your initial compensation is received in installment, the entire amount of capital gain will be taxable when you receive the first installment. But if your additional compensation, which extra money which they agreed to pay you, if additional compensation is received in installment, then the capital gain will be taxable as and when the compensation is received. Then it will be taxable as and when the compensation is received. Now, if any interest is received for delay in payment of initial or additional compensation, then such interest will be taxable in the year of receipt. However, it will be taxable under the head income from other sources. So now, because government is making a delay in paying this money to you, so the government may also pay you interest. If you receive any such interest, that interest will be taxable when, sir? That interest will be taxable under income from other sources. And taxable interest will be how much, sir? Amount received into 50%. Now, sometimes the owner may die before receiving the compensation. In that case, what will happen? The person who is receiving the compensation, in his hand, it will be taxable. Sir, direct taxes is not yet complete. I thought today live is indirect. Direct taxes, 2 hours part is there. We'll complete that and do indirect taxes. Okay. Then we have section 45(1)(a), which is insurance claim for damage and destruction of capital asset. So if you have a capital asset which is damaged and destroyed because of 4 reasons. So if there is a damage and destruction of capital asset, see, damage and destruction of a capital asset is regarded as transfer. If such damage and destruction is happening because of natural calamities, enemy attack, riots, or fire explosion. So if you have any capital asset which is damaged or destroyed, because of natural calamities, any enemy attack, riots and fire explosion, and if insurance claim is received for such damage and destruction, then it will be taxable as capital gain. A damage and destruction should be because of 4 reasons: natural calamities, enemy attack, riots and fire explosion. And because of this damage and destruction, you should be receiving something called as insurance claim. Now, the transfer will take place in the year in which damage and destruction has happened. In the year in which damage and destruction has happened, that year transfer will take place. However, capital gain will be taxable in the year when you receive the compensation. So, in the year when compensation is received, the capital gain amount will be taxable. In the year when you receive the compensation, in that year, capital gain amount will be taxable. How much will be taxable, sir? The full value of consideration will be the insurance claim received by you, which will have money plus fair market value of other assets received, less expenses. You'll get net sale consideration, less cost of acquisition, cost of improvement, or index cost of acquisition, index cost of improvement. That will give you capital gain.
Section 50C, Section 50C is the concept of stamp duty value. Section 50C is what, sir? Concept of stamp duty value. Section 50C is applicable only for immobile property. Section 50C talks about the concept of stamp duty value. It is applicable only for immobile property. See, normally, what is my full value of consideration? Normally, my full value of consideration is the price at which the capital asset is sold by me. Normally, what is my full value of consideration? It is the price at which the capital asset is sold by me. However, as per section 50C, what is 50C telling? If the stamp duty value of a capital asset or immobile property, if the stamp duty value is more than 110% of sale price, see, normally what will be taken as full value of consideration? Whatever price you have sold it for. However, if the stamp duty value is more than 110% of sale price, then the stamp duty value shall be taken as full value of consideration. Okay, so meaning what, sir? Let us say you sold any asset for 20 lakh rupees. Stamp duty value is 21 lakh rupees. Now, is stamp duty value more than 110% of sale price? Answer is no. So what will be taken as full value of consideration? Your actual sale price. Now, sale, you sold an asset for 20 lakhs. However, the stamp duty value is 23 lakhs. Now, can I say the stamp duty value is more than 110% of sale price? Therefore, full value of consideration is what, sir? Stamp duty value. So, if the stamp duty value is more than 110% of sale price, then full value of consideration will be your stamp duty value. Now, sometimes what may happen is the stamp duty value may be unreasonably high, which is not acceptable, and I would have sold the asset genuinely for a lesser price. In such cases, what will happen? Further, if the assessee is not satisfied with the stamp duty value, then if I am not happy with the stamp duty value, then I can make a request to the assessing officer, and assessing officer will transfer my case to the valuation officer. Now, the valuation officer's value is more than stamp duty value, then stamp duty value will be taken as full value of consideration, because valuation officer is telling more value. If the valuation officer value is less than stamp duty value, I will take valuation officer ka value because I will be happy. If valuation officer ka value is less than sale price or equal to sale price, you take the sale price as your full value of consideration. Now the question is, the stamp duty value as on the date of agreement should be taken or the date of transfer should be taken? Should I take the stamp duty value as on the date when I sold the asset or when I agreed to sell the asset to you? Lawmaker says, see, normally capital gain is taxable in the year of transfer, correct? No. So when transfer should take place to tax a capital gain, therefore stamp duty value as on the date of transfer should be taken. However, say normally the stamp duty value as on the date of transfer should be taken. However, if any amount is paid on the date of agreement through account pay check, account pay demand draft, or any other electronic clearing system, but electronic clearing system will include UPI, net banking, debit card, credit card, NEFT, RTGS, etc., then the stamp duty value as on the date of agreement shall be taken. Cash, bearer check, cross check, they are all not allowed. So if you are paying through these modes, then I will not consider that. Now, one very important point is, for immovable property alone, see, if the immovable property is acquired before 1/4/2001, see, normally what happens if any capital asset is acquired before 1/4/2001, the cost of acquisition is actual cost or fair market value, whichever is higher, correct? No. Now, for immovable property acquired before 1/4/2001, first you compare the fair market value with stamp duty value and take whichever is less. That whichever is less should be compared with your actual cost and take whichever is higher. First, compare your fair market value and stamp duty value and take whichever is less. That whichever is less you compare with your actual cost and take whichever is higher. That will be your cost. That will be taken as your cost of acquisition. Section 51 talks about advance money forfeited. Section 51 talks about what, sir? Advance money forfeited. Now, advance money forfeited. Advance money forfeited means what, sir? Let us say I have received advance from you for purchase of the property. Now, you did not satisfy all the conditions, therefore, or you did not pay the balance amount, therefore I kept that advance money with myself. That is called as advance money forfeited. If the advance money is forfeited before 1st of April 2014, before 1st of April 2014, then reduce that from the cost of acquisition before indexation. If it is forfeited on or after 1/4/2014, then it will be taxable under income from other sources under section 56(2)(9) in the year when it is forfeited. Sir, if someone stole jewelry, insurance claim is approved, is it taxable? Now, damage and destruction, it is not covered over here. Okay, it is not covered over here. The damage and destruction is not regarded as transfer. Theft is not regarded as transfer. Yes, not regarded as transfer. Section 47. Section 47. Transactions which are not regarded as transfer. Okay, what are the situations when I will not call a particular transaction as transfer at all? Where the capital asset became the property of an assessee on distribution of a capital asset on total or partial partition of HUF. So if I am getting any capital asset because there is an HUF which got partitioned, if I get a capital asset under a gift or a will from any individual or HUF, if I get a capital asset by way of succession, inheritance or devolution, or any distribution of an asset on liquidation of a company, if I get a capital asset because of revocable or irrevocable trust, if I get a capital asset under any transfer of a capital asset by holding company to its subsidiary company. If I get a capital asset from amalgamating company, amalgamating company is giving it to subsidiary company, or demerger is happening, demerged company is giving it to resulting company, or conversion of individual own property to his HUF. Now in all these cases, let us say Simbu purchased a property for 10 lakh rupees in the year 2001-2. He gifted the property to Nayantara in the year 1718. Now we all know gift is not treated as transfer. Now if Simbu has gifted the asset to house to Nayantara, it is not treated as transfer. So if it is not treated as transfer, that means there is no capital gain which is going to be applicable in the hands of Simbu. In the hands of Simbu, capital gain will not be applicable. Why? Because it is not a transfer. So if it is not a transfer for Simbu, there is no capital gain. Now tomorrow when Nayantara sells this property, for her, when she sells the property, of course there is a transfer and therefore capital gain should come. When we compute the capital gain for her, what should I take the cost of acquisition? Because she got it for free. What should I take the period of holding? Should I take it from the date when she became the owner, or should I take it from the date when Simbu held the asset, etc.? So this is the major question which we have, for which section 49 subsection 1 says, in the above cases, in all of the above cases, okay, whatever we are seeing is applicable for all these cases. In all of the above cases, the cost of acquisition should be taken as cost to previous owner. The period of holding of previous as well as present owners should be taken. Meaning, for Nayantara, the cost of acquisition will be the cost of acquisition which was there for Simbu. Period of holding should be taken from present as well as previous owner. Cost of improvement should be taken from present as well as previous owner. Meaning, whatever improvement done by Simbu as well as Nayantara, both will be taken. To check whether it is long term or short term, take the period of holding from Simbu. Then indexation benefit will be given from the date when the asset was first held by assessee. Who is the assessee? Which is Nayantara. However, we are supposed to, in our examination, we are supposed to follow Manjula Jesha case. Now, Manjula Jesha case says indexation benefit will be applicable from the date when capital asset was held by previous owner. Meaning, to compute the capital gain for Nayantara, cost of Simbu will be taken, improvement from Simbu will be taken, then period of holding also from Simbu will be taken, as well as indexation from Simbu will be taken. Okay, to find the index value, take the indexation also from asset when take this indexation also from the date when the asset was held by Simbu. Now, benefit of fair market value as on 1/4/2001 also will be applicable if the asset was purchased before 1/4/2001. Next, we have a small concept called as concept of slum sale. Slum sale means what, sir? Slum sale is a mechanism of transferring an undertaking without assigning values to individual assets and liabilities. If you are transferring an undertaking without assigning values to individual assets and liability, then that transfer is called as what, sir? Slum sale. Slum sale means transfer of an undertaking without assigning values to individual assets and liabilities. Particulars rupees. First, I'll take full. So, see, slum sale means you have different businesses. Like I have Priya Industries, Priya Sarees, Priya Electronics, Priya Chudidar, Priya Airlines, Priya Sweets, etc. Now, this Priya Sweets is transferred by me, sold by me for 100 crores without checking what is the total value of assets I have, what is the total value of liabilities I have. So, I will take full value of consideration. From that full value of consideration, I am going to subtract expenses incidental to transfer. I will get my net sale consideration. From that subtract cost of acquisition, I will get my capital gain. Now, what is my full value of consideration? Full value of consideration is nothing but fair market value as per Rule 111 UAE. From that subtract expenses incidental to transfer. That will give me my net sale consideration. From that subtract my cost of acquisition. Now, full value of consideration is what, sir? They'll give you market value. They'll give you two market value, two fair market value. One is fair market value of unit transferred, fair market value of consideration received, whichever is higher. You should take that. Then cost of acquisition is net worth of the company. Net worth is nothing but assets minus liabilities. Assets are depreciable assets as well as other assets. Liabilities means all types of liabilities. Depreciable assets, if you are taking, then you should take the WDV of that asset as per income tax law. WDV means what, sir? After giving depreciation, what is the value of that asset? And for all other assets, if it is not a depreciable assets, then take the book value of that asset. Liabilities, all the liabilities should be taken at their book value, excluding shareholders fund. That will give you your net worth. Now, stock in trade transferred in slump sale. If you transfer what's a stock in trade under slump sale, then it will be taxable under capital gain. Revaluation of asset should be ignored. Section 35 AD asset, if you are transferring under slump sale, then the cost of acquisition of that asset should be taken as nil or zero. If you are transferring any intangible asset, the cost of acquisition of that asset, if it is purchased, then purchase price. If it is self-generated, then the cost of acquisition should be taken as nil or zero. Then capital gain in case of shares and debentures. In case of shares and debentures, also capital gain will remain same. Only thing is shares can be unlisted or listed. If it is unlisted shares, it is taxable under 111 or 112. If it is a listed shares, taxable under 111A, 112A. And the security transaction tax paid by you on these shares cannot be subtracted as an expenses incidental to transfer. The capital gain computation will remain same. What is important in shares and debentures is with respect to bonus shares. Bonus shares means what, sir? I am getting some shares, extra shares. Bonus means what? I am getting some extra shares. Now these bonus shares are something which normally you get for free. Correct? No. Normally you get bonus shares for what, sir? Normally you get bonus shares for free. Therefore, if you have any bonus, if you got any bonus shares, check when is the bonus share given to you. If the bonus share was issued, if the bonus was issued before 1/4/2001, then that bonus share ka cost will be taken as actual cost of those shares or fair market value as on 1/4/2001, whichever is higher. If the bonus is issued before 1/4/2001, if the bonus is issued before 1/4/2001, actual cost will be cost of acquisition will be actual cost or fair market value as on 1/4/2001, whichever is higher. But if the bonus is issued on or after 1/4/2001, cost of acquisition will be taken as nil. Then you have what, sir? Right shares. What are right shares, sir? Right shares is the company is giving you a right. The company is giving you a right. The company is giving you a right to purchase the shares of the company at a discounted price. Okay, this right will be given to existing shareholders. Now the existing shareholders can either exercise the right or he may transfer his right to someone else. If he exercises the right, then the cost of acquisition of these shares will be right issue price. If he renounces or transfers his right to someone else, then relinquishment, it will be called as relinquishment of capital asset, and therefore it will be treated as transferred. Whatever amount you get, that entire amount will be taken as short-term capital gain. For purchaser of the right, cost of acquisition, the person who is purchasing the right from you, for him the cost of acquisition will be right issue price plus renouncement price. Right issue price which he is paying to the company and renouncement price which is paying to the right holder. So whoever purchases the right from you. Now the last part which is there is what, sir? Exemptions under capital gain. Section 54 talks about exemptions from capital gain. Exemptions from capital gain means what, sir? Whatever capital gain amount you got, from that you can subtract this. The balance amount is the capital gain on which you have to pay the taxes. Section 54, exemption for residential house property. Section 54 talks about what? Exemption for residential house property. Section 54 exemption is applicable or available if you are an this is important. Important exemptions are 54, 54 EC and 54 F. This is something which you should be knowing. Okay, section 54 is an exemption for residential house property. This is applicable if you are an individual or an HUF. So this exemption you will get if you are an individual or an HUF, and if you have a residential house property, and if you transfer that residential house property, upon transfer of that residential house property you get a gain. What type of gain? Long-term capital gain. That long-term capital gain will be exempt if you acquire another residential house property in India. See, this exemption, section 54 exemption is applicable to you if you are a resident, if you have a residential house property. If you have what, sir? A residential house property. And who are you? If you are an individual or HUF and having a residential house property, if you transfer that residential house property, upon transfer of that residential house property, if you get a gain. What type of gain, sir? If you get a gain, what type of gain, sir? Long-term capital gain. That long-term capital gain will be exempt if you acquire another one residential house property in India. If you acquire another one residential house property in India. Now the date of acquiring this another one residential house property in India should be within 2 years from the date of transfer. You should purchase it, or you can purchase it 1 year before the date of transfer. Now if you want to construct this new property, then the construction can be done within 3 years from the date of transfer. Okay. Now this new property which is purchased by you has a lock-in period. It has a lock-in period, meaning you should not transfer this new property within a lock-in period of 3 years. The new residential house property which is if the new residential house property is transferred within the lock-in period of 3 years, then the capital gain exempted earlier should be reduced from the cost of acquisition of the new property while computing the capital gain of that new residential house property. Okay. Now this new property will have a lock-in period of how many years, sir? 3 years. Now exemption is how much, sir? Exemption under section 54 is how much, sir? The exempt amount will be your capital gain amount, how much ever capital gain you got, or the amount invested by you, or the limit of 10 crore rupees, whichever is less. Capital gain amount, amount invested, or 10 crores, whichever is less. Now the amount can be invested either in the new property or you can deposit the money in capital gain account scheme. See, sometimes what happens, you have a time limit of 2 years from the date of transfer and 3 years from the date of transfer to purchase or construct the new property. Now, but you have to file your income tax return by 31st of July. Now, if you are not able to purchase the property or construct the property by 31st of July, put the capital gain amount in an account called as capital gain account scheme account. If you put the money in this account, then also it is going to be assumed that you are going to use it for purchase or construction, and therefore exemption will be given to you. Now, normally what is the you are required to purchase only one residential house property, but however, if your gain amount is up to 2 crore rupees, if the capital gain amount is how much, up to 2 crore rupees, then the assessee can purchase how many properties, sir? 2 residential house properties instead of 1. Section 54B, exemption for urban agricultural land. Exemption for what, sir? Urban agricultural land. Sir, what do you mean by exemption for urban agricultural land? This section 54B says, I am applicable if you are an individual or an HF. If you have an urban agricultural land, if you transfer that urban agricultural land, upon transfer of that urban agricultural land, any type of capital gain which you get, whether it is long-term capital gain or short-term capital gain, that will be exempt if you acquire another agricultural land in India. Section 54B talks about what's an exemption for urban agricultural land. This exemption is available to whom, sir? Individual or an HF. If you have an urban agricultural land, if you transfer that urban agricultural land, upon transfer, whatever gain you get, whether it is a long-term capital gain or a short-term capital gain, that capital gain will be exempt if you acquire another agricultural land in India. If you acquire another agricultural land in India. Now this urban agricultural land which is there, no, that urban agricultural land, how will I know whether the land in urban area, which is a city area, is an agricultural land or not? They say that I will call a land in an urban area as an agricultural land if that land is used for agricultural purpose by individual or his parents or members of HUF for a period of 2 years before the date of transfer. Now this new land which you have purchased, no, that should not be transferred within the locking period of 3 years. If you transfer, then whatever gain was given to you earlier, whatever gain was exempted earlier will be subtracted from the cost of acquisition. Exemption is capital gain amount or amount invested, whichever is less. Section 54D, exemption for industrial land or building or both. So this exemption is applicable to all types of assessee if you have any industrial land or building or both, which is compulsory acquired. Whatever gain you get, whether it is long term or short term, that will be exempt. If you acquire within 3 years from the date of receipt of compensation, if you acquire another industrial land or building or both. So you are transferring, if your industrial land and building is getting compulsory acquired, and whatever money you get from that money, if you purchase another industrial land or building, then that capital gain amount will be exempt. Section 54EC, important section. Section 54EC talks about exemption for transfer of immobile property. This says if you have any type of immobile property, this is for exemption for transfer of immobile property. So what does it say? If you have any type of immobile property and you are any type of assessee, if you are any type of assessee, so this exemption says I am applicable to all types of assessee, whether you are an this exemption says I am applicable to all types of assessee if you have an immobile property. If you have what, sir? Immobile property, and if you transfer that immobile property. Now upon transfer of that immobile property, if you get any gain, what type of gain? Long-term capital gain, then that long-term capital gain will be exempt if you invest the money in government bonds. that long-term capital gain amount will be exempt if you invest your money where, sir? If you invest your money in government bonds. Which government bonds? There are 6 bonds. NHEI, National Highway Authority of India bonds, RECL, Rural Electrification Corporation Limited, PFCL, Public Finance Corporation Limited, IRFCL, Indian Rail Finance Corporation Limited, HUDCO, Housing and Urban Development Corporation Limited, and IRADA, which is Indian Renewable Energy Development Agency. So if you invest money in these bonds, then whatever capital gain you got, that entire capital gain amount will be exempt. If you invest money in which bonds, sir? These different bonds. So this section says, very important section. It is applicable for all types of assessee if they are having immovable property, and if they transfer that immovable property, upon transfer, if they get any long-term capital gain, that long-term capital gain will be exempt if they invest the money in government bonds. The investment should be made within 6 months from the date of transfer. When should I invest the money, sir? The deposit should be made within 6 months from the date of transfer. Within 6 months from the date of transfer, the deposit should be made. And the government bonds in which you have invested the money will have a lock-in period of 5 years. So exemption under section 54 EC will be capital gain amount or amount invested or limit of 50 lakh rupees, whichever is less. Now, this lock-in period of 5 years is an important lock-in period. What do they say? That these bonds which you are purchasing or in which you are investing the money, they should not be sold by you, or they should not be converted into money within the lock-in period of 5 years. What will happen if you sell them or convert them into money within the lock-in period of 5 years? Then on the date of sale of bonds or conversion, whatever amount you have got, that entire amount will be taxable as capital gain. What type of capital gains are same? Long-term capital gain. Section 54F, another important section, section 54F. Exemption for transfer of any type of long-term capital asset. Exemption for what? Transfer of any type of long-term capital asset. This exemption says I am applicable to individual or HUF if you have any type of long-term capital asset except a residential house property. So you can have any type of asset like shares, jewelry, land, building, etc. This exemption says I am applicable to an individual or HUF if you have any type of long-term capital asset except residential house property, and if you transfer that long-term capital asset, upon transfer of that long-term capital asset, if you get a gain, what type of gain? Long-term capital gain, that will be exempt if you acquire one residential house property in India. Now this residential house property should be acquired within 2 years from the date of transfer. You should purchase it, or you can purchase it within 1 year before the date of transfer. Or if you want to construct it, then you can construct it within 3 years from the date of transfer. Now the new property will have a lock-in period of 3 years. It should not be sold. It should not be transferred within the lock-in period of 3 years. If you transfer it, then whatever gain was exempted earlier, that will be reduced from the cost of acquisition of this house which you are transferring. Now, important in this is the capital gain calculation. Exemption calculation, sorry. Exemption under 54F. They say if the money invested by you is more than or equal to net sale consideration. Please note, full value of consideration, from that you subtract expenses incidental to transfer, you will get your net sale consideration. From that you subtract cost of acquisition, you will get your capital gain. Correct? No. Now this amount of gain which is there, see, full value of consideration less expenses will give you net sale consideration. From that subtract cost of acquisition, you will get your capital gain. Now all the cases which we studied previously, you should invest this much money. How much money, sir? Amount of capital gain or more than capital gain, you will get exemption for capital gain. But here you are not supposed to invest capital gain amount. You are supposed to invest how much, sir? Net sale consideration ka amount or more than net sale consideration ka amount to claim full exemption for capital gain. If you invest less than 90 lakh rupees, then you will this entire 40 lakhs will not be exempt. It will be exempt proportionately. Okay. So exemption is based on, exemption under section 54F is based on what, sir? Amount invested by you. If the amount invested by you is more than or equal to net sale consideration, then the entire capital gain will be exempt. If the amount invested by you is less than net sale consideration, then the capital gain will be exempt proportionately. So how, sir, proportionately? For example, let us say capital gain is 40 lakhs. The amount invested by me is 90 lakhs. So can I say I have invested equal to net sale consideration? So entire capital gain is exempt. If I invested more than net sale consideration, 150 lakhs, entire capital gain is exempt. Let us say I have invested only 50 lakh rupees. If I have invested only 50 lakh rupees, that means I have invested less than net sale consideration. Now 40 lakhs is the gain into 50 divided by 90, proportionately 22 lakhs 22,000 will be exempt. Now, maximum amount of exemption which you can claim under this section is 10 crores only, and the assessee should not have more than one residential house property on the date of transfer to claim the exemption. Section 1037, exemption for compulsory acquisition of urban agricultural land. So if you have urban agricultural land in urban area, and if that urban agricultural land is compulsory acquired, then whatever gain you get, that gain is fully exempt, irrespective of whether you invest that money or not. Okay, so apart from that, some other important points are what, sir? Yeah, for intangible asset, if it is purchased, the cost of acquisition is purchase price. If it is self-generated, the cost of acquisition is nil. Intangible assets will include goodwill, trademark, patent, brand name, right to carry on business, route permit, LUMARs, tenancy rights, etc. Okay, for debentures, listed equity shares, virtual digital assets, global deposit receipts, non-resident where shares and purchased in foreign currency, and for slum sale there is no indexation available. Anyways, now the indexation is not available for anyone. Now for market linked debentures, the capital gain which you get will always be a short-term capital gain. Now, if any listed share is acquired by you, if any listed share is purchased by you before 1/2/2018, 1st of February 2018, then the cost of acquisition of those shares will be actual cost compared with fair market value or stamp duty value, whichever is higher. Compare that with actual cost, whichever is, first compare fair market value and stamp duty value, fair market value and sale price of that asset. Fair market value as on 31st of January 2018, compare that with sale price of that asset. Take whichever is less. That whichever is less you compare with the actual cost of that asset. Take whichever is higher. Whatever is higher over here will be taken as cost of acquisition of those shares which were listed and purchased by you before 1/2/2018. Other two sections are time passed. So section 50C, full value of consideration in case of unquoted shares. In case of unlisted shares, the full value of consideration will be taken as sale price. If the fair market value of these shares is more than 110% of sale price, then the fair market value will be taken as full value of consideration. 50D, full value of consideration if consideration is not determinable. If the consideration is not determinable, then the fair market value of the capital asset transferred by you will be taken as full value of consideration. Yes, that is all about your capital gain chapter. Other sources. Before other sources, let us see what is the question given. Yeah, we had discussed this in our previous class. Okay. Raj Limited as an industrial undertaking operating in urban area. During the year 25-26, it sold its two machineries for 2 lakhs and 3,80,000 in the course of shifting its industrial undertaking. So they are talking about machinery, that means depreciable asset. Shifting their industrial undertaking from urban to rural area. The written down value of that block consisting of 4 machinery as on 1/4/2025 is 3,50,000 rupees. Okay. It sold it for 2 lakhs and 3,80,000. The company incurred 20,000 expenses on expenses other purpose as specified in the scheme framed by the central government for the purpose of this section. Calculate the taxable capital gain. Calculate the taxable capital gain if the company acquired new machinery for 50,000 as on these two different dates. Okay. So if this is acquired within the same year, this is acquired in next year. Anyways, so here this question is about, here only I do it right normally. This question is about depreciable assets. So two different dates they have given. Particulars, case A, case B. Now this topic we have covered under business income chapter, but however in your institute material, of course, they have covered this because it is a capital gain related topic. In your institute material, they have covered this concept where, sir, they have covered this concept in capital gain chapter 25-26. Why am I doing like this? Yeah. First, I will take opening WDV of the asset. So case 1, case 2, opening WDV. What is the opening return on value? 3,50,000 rupees. First, I'll take opening WDV. Then calculate the capital gain. If a new machinery was acquired for industrial purpose of 50,000. So if it is purchased in the current year, it will be taken in the current year itself. If it is purchased in the next year, we should just ignore for the current year. So we are finding it for previous year 25-26. Add purchase in previous year 25-26, 50,000, case 1. In second case, it will not be considered because the purchase was made in next year. We are finding the gain for current year. And the sale was made for these two amounts. So I'll get some amount which is 4 lakh, 3,50,000 less what, sir? Sale proceeds of assets sold, 5,80,000. This 5,80,000 will remain same in both the cases. Now the difference is a negative amount. So that is my short term capital gain, 1,80,000 and two lakh 30,000. Now this is the capital gain. Now whatever amount I have invested in new plant and machinery, that can be claimed as exemption. Why can I claim exemption? Because see, these two machineries were sold during the year and a new machinery was purchased on these two different dates, which is by end of the year, which is eventually after the sale. So less section 54G gives the exemption for this purchase of new plant and machinery. While shifting, if you are purchasing a new plant and machinery, if you get any gain on sale, that will be exempt. So taxable short term capital gain will be 1,30,000. Expenditure we have not subtracted. Expenses of transfer, which is 20,000. So taxable 1,10,000 and what, sir? $1,60,000. 1,10,000 and 1,60,000 rupees. So this is the answer for this question. Return on value, add assets purchased during the year, whichever is purchased in the current year, that only will I'll take, less sale value, that will give me capital gain. Now because capital gain has come, subtract expenditure before this only, before claiming the exemption. You can subtract expenses and then subtract exemption for purchase of new plant and machinery. You will get the answer. Next is what, sir? IFOS, very simple and easy chapter. Income from other sources. 7 marks question will come. Now, what is this chapter telling? If you are a person who is having any income, and if that income is not covered under salary, if that income is not covered under house property, if that income is not covered under business or profession, and if that income is not covered under capital gain, then that income will be taxable under IFOS. So if any income is not covered under any of the above heads, that income will be covered over here and it will be taxable over here. Okay. If any income is there which is not covered anywhere else, it will be covered here. Now the major part of this chapter is taxation of gift. If you are receiving any gift because of your employment, it is taxed under salary. If it is received because of business profession, taxed under PGBP. If it is received because of any other reason, then it is taxable under IFOS. So we will start with our gift taxation, section 56 to 10. Section what, sir? 56 to 10, taxation of gift. Gift is taxable in the hands of recipient. In whose hands it is taxable, sir? Gift is taxable in the hands of recipient. Section 56 to 10, gift received by any person or asset is acquired for an inadequate consideration. Either you receive gift from someone, gift received means what, sir? You are receiving something from someone for free, or even if you purchase something for a lesser price, inadequate consideration, that is also covered under 56 to 10. Okay. Anyways, let us see. If you are receiving any gift at the time of your marriage, if you are receiving any gift from your relative in contemplation of debt by way of inheritance or will, by local authority, by way of trust, university, hospital, or COVID cases, then it will be exempt. So if you are getting married at the time of your marriage, if you are receiving any gift, exempt. If you are receiving any gift from your relative, who is a relative? For me, for Dilip, relative is my father, mother, brother, sister, spouse, and my children's. Correct? For me, my father, mother, my brother, sister, my spouse, and my children's. My father, mother ka brother, sister, my spouse ka father, mother, spouse ka brother, sister, they are all my relative. Now, what is important over here? Spouse of all these above people are also my relative. Spouse of all the above people are also my relative. Apart from that, lenient antecedent and lenient decedent are also my relative. Lenient antecedent and lenient decedent means what are my parents, their parents, their parents, my children, their children, their children's. Now for HUF, the members of HUF are treated as relative. So if you receive gift from your relative, it is exempt. If you receive gift at the time of your marriage, if you receive the gift at the time of your marriage, then also you can claim the exemption. Now, in gift, what are you receiving? In gift, if you are receiving money, okay, apart from these cases, normal cases, what will happen to your gift? Taxability of the gift in normal cases. Now, if you are receiving money, and if the total or the aggregate money received by you in a year is more than 50,000 rupees per annum. If you receive money and the total money received by you in a year is how much, sir? If the total money received by you in a year is more than 50,000 rupees per annum, then it will be fully taxable. So in a year, from a single person, in a year totally, so someone is giving me 100 rupees, someone is giving me 10,000 rupees, someone is giving me 20,000 rupees. So in a year total, the aggregate money received by me, if it is more than 50,000 rupees per annum, then it will be fully taxable. Next, if you are receiving movable property means what, sir? If you are receiving DJ Paso BV, if you are receiving movable property means drawings, jewelry, paintings, archaeological collections, sculpture, shares and security, other work of art, bullion and virtual digital asset. If you are receiving these things, check whether you have received it without consideration or you have received it for inadequate consideration. If you are receiving movable property without consideration, aggregate fair market value is more than 50,000 rupees per annum, it is fully taxable. If you are receiving what, sir? Jewelry from someone free without consideration means for free you are receiving jewelry. If you are receiving it for free without any consideration, then the total market value, if the market value of that is more than 50,000, it will be taxable. Please note, let us say someone gave me a bracelet, someone gave me a chain. Bracelet market value is 30,000, chain market value is 40,000. Individually the market value is less than 50,000. Is it taxable? Yes. Why? Because collectively the market value is what, sir? 30 plus 40 is 70,000. So I should take aggregate fair market value is more than 50,000, then that amount will be fully taxable. Now if I receive movable property DJ Paso BV for inadequate consideration,
If I receive this for inadequate consideration, then what will happen? Inadequate consideration means what, sir? I am receiving it for a price. I am buying it actually, but a lesser price I am paying than what is the actual price. Let us say a jewelry of 10 lakh rupees I am purchasing for 8 lakh rupees. 2 lakh rupees less I have paid. No? That means 2 lakh rupees is the benefit which I am getting. It is taxable over here. Inadequate consideration, if the aggregate difference between fair market value and consideration is more than 50,000. If the total difference between the market value and the consideration is more than 50,000, then such difference will be taxable. Then what will be taxable? Only the difference amount will be taxable. If I am receiving immobile property, then what will happen, sir? How are you receiving the immobile property? If the immobile property is received without consideration, for mobile property I will see stamp duty value. For immobile property I will see, mobile property I will see fair market value. For immobile property I will see stamp duty value. Now if the immobile property is received by me, if the immobile property is received by me for free without any consideration, and if the stamp duty value of that immobile property is more than 50,000, then it will be fully taxable. If the immobile property is received for inadequate consideration, if the immobile property is received for what, sir? Inadequate consideration. Inadequate consideration means money is paid, but the money paid is very less. If the immobile property is received for inadequate consideration, then check the difference between stamp duty value and consideration. Difference between stamp duty value and consideration is more than 50,000, and the stamp duty value is more than 110% of consideration. Difference should be more than 50,000. Difference between what? Stamp duty value and consideration should be more than 50,000, and the stamp duty value should be more than 110% of consideration. In such cases, the difference amount will be fully taxable. Now, please see. Money, total money more than 50,000, fully taxable. Movable property without consideration, total value is more than 50,000, taxable. For inadequate consideration, difference between fair market value and consideration is more than 50,000, taxable. Immovable property, free. So for immovable property, if you see, you should they are not using the word aggregate. Here they would have all used the word aggregate. That means if you are receiving from more than one person, you combine all those things and take the total value. But here for immovable property, they have taken stamp duty value only. That means each and every immovable property should be separately considered. Okay, now immovable property, if you receive it for free without consideration, the stamp duty value is more than 50,000, it is taxable. If you receive it for inadequate consideration, then two conditions. See the difference between stamp duty value and consideration, it should be more than 50,000, and stamp duty value should be more than 110% of consideration, then such difference will be fully taxable. Now the provision of 56 to 10 is applicable for a capital asset and not for a stock in trade. So whoever is receiving the gift, for him that item should be a capital asset. Now we have studied somewhere gifting of a capital asset is not a transfer. Now if it is not a transfer, that means there is no capital in the hands of the person who is gifting it. Now the person who is receiving it, for him we should take cost of previous owner. Just now we studied under capital gain chapter. Correct? No, we should for a person who is receiving the gift, we should take the cost of question as cost of previous owner. Nayantara Simbu example we saw. Now, if let us say Bhim gifted a capital asset to Tuntun auntie, now Tuntun auntie got it for free. She got a house. This house she got it for free. The stamp duty value of this house is 50 lakh rupees. Now, because she got the house for free and they both are not related person, and the stamp duty value of the house property is more than 50 lakh rupees, can I say Tuntun auntie will have to pay tax under 56 to 10? Under income from other sources, because she received an immobile property for free? Yes sir, definitely she has to pay the taxes. Now if Tuntun auntie has paid the taxes on this 50 lakh rupees, then in such cases for Tuntun auntie tomorrow when she sells this asset to someone, the cost of acquisition will not be taken as cost of previous owner. The cost of acquisition will be taken as what, sir? The stamp duty value on which she has paid the taxes. So that is what is given in section 49.4. Section 49.4 says, if any capital asset is received as gift, that is without consideration or for inadequate consideration. If any capital asset is received for without consideration or for inadequate consideration, and if the recipient assessee has paid the taxes under 56 to 10, then the stamp duty value of such capital asset will be taken as the cost of acquisition of that capital asset to the recipient. So if I have paid the taxes under 56 to 10, then for me the cost of acquisition will be stamp duty value or fair market value. Now we have a concept of section 50C. Section 50C talks about what? If the immovable property is held as capital asset and if the stamp duty value is more than 110% of sale price, then the stamp duty value will be taken as sale price. So similarly, we have one more provision called as section 43CA. We have one more provision called as what's our section 43CA, which is applicable when the immovable property is held as stock in trade. If the immovable property is held as stock in trade, in such case also if the stamp duty value is more than 110% of sale price, then the stamp duty value will be taken as sale price. Now taxation of dividend, very simple. See, dividend is taxable in the hands of recipient. Taxation of dividend. So dividend, whether it is given by domestic company or it is given by foreign company, it does not matter. Whether the dividend is given by domestic company or it is given by foreign company does not matter. The dividend will be taxable in the hands of shareholder and it will be taxable under IFOS. Now, we also have a concept called as deemed dividend. Okay. Now, deemed dividend, they will not test you at this level, but yeah, we still have this concept. They may test 224C because there is a specific question under capital gain chapter with respect to that. Yeah, dividend received by any type of shareholder, whether dividend received from any type of company, whether domestic company or foreign company, does not matter. It is taxable in the hands of shareholder. Now we have a concept of deemed dividend. Deemed dividend means what, sir? Whatever we are going to see now, it is actually not a dividend, but we are going to assume that it is a dividend. Distribution of any asset by the company to its shareholder. So where the domestic company distributes any asset to its shareholder, it will be deemed as dividend. If a domestic company is distributing asset to whom? Its shareholder, it will be deemed as dividend to the extent of accumulated profit, whether capitalized or not. So if you are a domestic company and if the domestic company is distributing asset to whom? Its shareholder. If a domestic company is distributing the asset to whom, sir? Its shareholder. If domestic company distributes the asset to its shareholders, I am going to call it as dividend. Please note, instead of giving money to the shareholders, what am I doing? I am giving asset to the shareholders. Lawmaker says if you do that, if I give money to the shareholders, that means it is a dividend. Now, instead of giving the money, what am I doing? I am giving asset to the shareholders. Lawmaker says if you are a domestic company and if you are doing such kind of activity, if you are domestic company and if you are doing such kind of activity, what kind of activity? Instead of giving money, you are giving any asset to your shareholders, then I am going to call that asset as dividend. I am going to deem that asset as dividend to the extent of accumulated profit, whether capitalized or not. Section 222B, distribution of debenture or debenture stock to shareholders. So if any domestic company is distributing debenture or debenture stocks or deposit certificate to its equity shareholders or any bonus shares to its preference shareholders, then it will be deemed as dividend to the extent of accumulated profit, whether capitalized or not. Section 222C, distribution of asset by company upon its liquidation. So this says what, sir? Company is getting liquidated, that means company is getting closed. If the company is getting closed and when the company is getting liquidated or when the company is getting closed, when the company is getting liquidated or when the company is getting closed, at the time of closure of the company, if the company is distributing dividend to its shareholders, what will happen? Where any domestic company distributes any asset to its shareholder on its liquidation, then it shall be deemed as dividend to the extent of accumulated profit, whether capitalized or not. To the extent of accumulated profit, whether capitalized or not. So if there is any domestic company which distributes assets to its shareholders, when is it distributing? On its liquidation, then I am going to call it as what, sir? Dividend. How much am I going to deem it as dividend? To the extent of accumulated profit, whether capitalized or not. Now, what is the tax treatment? So let us say there is a company and the balance sheet of the company is given as on liquidation. So first, what will company do? Pay all its liability and whatever is left over, it will distribute to its shareholders. Correct. Now, in the hands of company, what is the tax treatment? Whatever assets are sold by the company in the market, if the sale price is more than its book value, then it will get any capital gain. Whatever assets are distributed by the company to its shareholders are not treated as transfer as per section 47, and therefore no capital gain will come in the hands of
company whenever it distributes any asset to its shareholders. But in the hands of shareholders, what is the tax treatment? Shareholder will have two types of income. One is capital gain income, one is your other sources income. So income from other sources will be how much? Deemed dividend. How much will be deemed dividend? I should see what is the total accumulated profit of the company and what is the share of that particular shareholder whose computation you are doing. So share in accumulated profit. For example, we are talking about this company is having 5 shareholders. Each of them have invested 1 lakh rupees. So each of them has 1/5 share in the company. Now each shareholder got 7 lakh rupees from the company. Now this 7 lakh rupees will be divided into deemed dividend and capital gain. Now what is the reserves accumulated profit of the company? 15 lakhs divided by 5. Each shareholder has a share of how much, sir? Each shareholder has a share of how much? 15 divided by 5, 3 lakh rupees. So now deemed dividend will be total accumulated profit divided by A's share in accumulated profit. Deemed dividend will be 3 lakh rupees. Taxation in the hands of shareholders. Take full value of consideration less expenses, you will get net sale consideration less cost of acquisition, you will get your capital gain. Meaning 7 lakh I received, full value of consideration I will take only 3 lakhs because on only 4 lakh I will take as full value of consideration because on 3 lakh rupees I will also already paid the taxes under other sources. Now taxation in case of buyback. See, buyback of shares is done by the company. Company is buying back the shares which is given by company to the shareholders. They are buying it back. Now whenever buyback is happening, in the hands of company there is no tax treatment. Meaning company does not have to do anything. No tax is recorded paid by the company. It will be taxable in the hands of shareholders. Whatever money the shareholders receives, the total buyback price which the shareholder is receiving. What is the total buyback price? Number of shares bought back by the company into the buyback price per share. That is the total money which is received by the company. What is the total money received by the company? Number of shares bought back by the company into buyback price per share is the total buyback price. That entire amount will be treated as deemed dividend and it will be taxable in the hands of shareholders under section 222F. And what is taxable under capital gain? Full value of consideration less expenses. Meaning full value of consideration should be taken as 0. Why, sir? Because the total money received by you is already taxed as deemed dividend under section 222F. So for capital gain computation, your cost will be 0. Subtract your expenses and for capital gain computation, your full value of consideration will be 0. Subtract your expenses and cost of acquisition, you will get your capital loss. It can be long term or short term capital loss. Note, full value of consideration will always be taken as nil in case of buyback of shares. So you'll always get a capital loss. Now reduction of share capital. So what some companies do is where any domestic company is reducing its share capital, and how is it reducing? By distributing asset to its shareholders, then it will be deemed as dividend to the extent of accumulated profit whether capitalized or not. Similarly, where any private company, that is where any closely held company is distributing any loan or giving any loan or advance to its shareholder. If a closely held company, basically a private company, is giving loans or advances to its shareholder. Which shareholder? That shareholder who is having 10% or more equity shareholding. I am going to call it as what, sir? I am going to call it as deemed dividend. If a closely held company is giving loans or advances to any person, the closely held company is giving loans or advances to any person, then also I will call it any person for the benefit of the shareholder who is having more than 10% equity shareholding, then also I am going to call it as deemed dividend. If the closely held company is giving loans or advances to any concern, any company, firm, AOPB, etc., wherein the shareholder is having substantial interest, meaning 20% or more equity shareholding, profit sharing ratio or voting rights, then also I am going to call it as deemed dividend. Okay, so now the loans and advances in all the above cases will be deemed as dividend to the extent of accumulated profit which the company has. Now, this provision will not be applicable in two cases. If the company's main business is only giving loan, or if the loan given by the company is a business loan. Section 222E shall apply even if loan is squared off or repaid during the same year. Even if you repay during the same year, this provision is applicable. Section 222E shall apply even if the interest is charged at market rate for the loan. If the company is charging interest for the loan given by the company, still this section will be applicable. Okay, that is all about this chapter. Now, all the incomes covered over here, we'll just discuss that. Following incomes are taxable under IFOS. What are the different incomes which are taxable under IFOS? Dividend income, casual income. Casual income means income from winnings from lottery, crossword puzzles, race horses, then card games, gambling, any other types of games, etc. Undisclosed income, black money. Interest received on delay in payment of compensation or enhanced compensation for compulsory acquisition of capital asset. Advance money forfeited on transfer of a capital asset on or after 1/4/2014. Gift received or asset which is purchased by the company for an inadequate consideration. Compensation received due to termination. So gift received or asset which is acquired by you for inadequate consideration. Compensation received due to termination of employment or modification of terms of employment. So if you are leaving the job and the company is giving some money to you, if it is not taxed under salary, it will come over here. Some received under life insurance policy, which is not exempt under section 1010D. So if you receive money from life insurance corporation and if that money is not exempt under 1010D. Income from owning and maintaining race horses, if you are in the business of owning and maintaining race horses, or any other income which is not covered anywhere else. Following income will be taxable under IFOS if they are not taxed under PGP. These incomes will be covered under IFOS if it is not covered under PGP. Which incomes are? Interest on securities. Normally it will go under PGP if your business is to invest in securities and earn interest from that. If it is not covered under PGP, then it will be covered over here. Then what, sir? Income from letting out on hire machinery, plant and furniture, composite rent of house property, any sum received by employer from his employee as a contribution to PF, superannuation, any other welfare fund of employees, or any sum received under Keyman insurance policy which was not taxed under salary. Now, following incomes are covered under other sources, but they are exempt, meaning you should show this income under other sources and then exempt it. Agricultural income from land in India, interest income credited to an individual from his non-resident external account, compensation received due to disaster, educational scholarships, awards given by government. Now, what is the tax rates under IFOS? If it is a casual income, flat 30%, undisclosed income 60% plus 25% surcharge plus 4% health and education, cess effectively 78%. Online money games 30% flat, and all other types of incomes are taxed at slab rates. Examples of other incomes covered under IFOS: income from subletting a house property, renting of a vacant land, insurance commission which is there, remuneration for paper checking, interest on income tax refund, stipend, family pension given by you, royalty income, sitting fees of a director, interest income, income of MLA, MP, etc., except daily allowance and constituency allowances. Now, interest income which are covered under other sources, what happens to different types of interest income covered over here? If you receive an interest because of delay in payment of compensation for compulsory acquisition of capital asset, then that interest income will be taxable under other sources, and taxable amount will be 50%. If you receive interest income from post office saving bank account, then 3,500 rupees will be exempt from that amount which you receive. If it is a joint account, then 7,000 rupees will be exempt. Interest from PPF, Sukanya Samriddhi, gold bonds, deposit certificates under gold monetization scheme, all these interests are exempt. Any other type of interest like FD interest, saving account interest, loan, recurring fund interest, they are fully taxable. Now, can I subtract expenditure from the income which I am earning under other sources? Yes. If the income is taxable, any expenditure incurred to earn such income also will be exempt. If the income is taxable, any expenditure incurred to earn such income will be allowed as reduction. If the income is exempt, the expenditure incurred to earn such income cannot be subtracted. Casual income expenses cannot be subtracted. Interest for delay in payment 50% can be subtracted. Family pension under optional regime you can subtract 1/3 of family pension or 15,000 rupees as expenses, and on default regime 1/3 of family pension or 25,000. And dividend income or income from UTI, only interest expenses is allowed as deduction to the extent of 20% of income earned. Section 58, deduction. What is not allowed as deduction? Any personal expenses of an assessee, interest paid outside India without TDS, salary paid outside India without TDS, excessive or unreasonable payment made to related person, any payment in excess of rupees 10,000 for a single expenditure to a single person in a single day by any mode other than account pay check, account pay demand draft, other electronic clearing system, and 30% of expenses to a resident without TDS. Last point under section 59 says, if there is any expenditure allowed for any previous year and that expenditure is not paid by you in the current year, it is seized, then that expenditure will be treated as income. Yeah, concept of grossing up. Sometimes what may happen is the question may give you the income net of TDS. If they give you the income, let us say Dilip won a lottery of 10 lakh rupees, but what will government do? They'll deduct the TDS and pay me only 7 lakh rupees. Now I would have received only 7 lakh rupees. I won a lottery of 10 lakhs, but I have received only 7 lakhs. So how much is my income? 7 lakhs or 10 lakhs? Lawmaker says 7 lakh rupees is your income. You have received net of TDS. You should gross it up. You should gross it up and take the gross amount. Net lottery income will be 7 lakh. Gross lottery income will be 10 lakh. While computing the income, we need to take the gross amount. Okay. Let us say I received 21 lakh net of TDS. TDS rates may not be given in some cases. Okay. If the amount taxable amount will be 21,000 divided by 70%, because 30% they have not paid, 70% only they have paid, so total income will be 30 lakh rupees. Yeah, before going to the next chapter, let us see the question which we have over here. I'll just do the answer over here only, right side. Mr. Ajit, a resident Indian aged 55 years, a cost and management accountant, shares the following information about his income during the previous year. About his income during the previous year, what sir? 25-26. Amount received for evaluation of answer book of professional examination 70,000. Expenses incurred for earning this is 1,200. Can I subtract this expenditure? Yes. 70,000 minus this thing is 68,800. Income tax refund. Income tax refund is not an income. The interest on income tax refund is an income, 7,000 rupees. Cash gift received from his friend on his marriage anniversary. Marriage anniversary is not marriage, therefore that is also taxable. Gift received from his son. Son, ignore because relative. Amount received from letting out residential house property, 50,000 per month. Amount received from letting out of a residential house property. So this is your income from house property. 50,000 into 12 months, which is 6 lakhs. 30% standard deduction if I give, 6 3s are 18. So taxable amount will be 4,20,000. Dividend received from listed companies 65,000. Interest expenses on loan taken to buy the shares for which dividend. Now for the loan which you take, 15,000 is the expenses, but the expenses cannot exceed 20% of the income received. Maximum expenses you can claim, this is important for dividend income, maximum expenses you can claim is 20% of the income received. Income received is 65,000 into 20%. 13,000 or 15,000, whichever is less. So income is 65, subtract 13,000 expenses for that income. So this is my total income. Under other sources, Calculate the income from other sources. 4,20,000 may not come under other sources. I'll ignore that for the time being. 65,000 minus 13,000. 2,03,800. If I add a house property income, 6,23,800. 2,03,800 rupees, meaning amount received from residential house property is covered under income from house property, correct? So this is the answer, 2,03,000. So total income including residential income will be 6,23,000. Now the major chapters are over. Major chapters, by major chapters, what do you mean, sir? By major chapters, I mean what? See, basic concept, residential status, agriculture income not forming part of total income is done. Heads of income is done. Now you have this part, okay? From this 14 marks question will come. Okay, module 3, how many marks question will come, sir? 14 marks question will come. Wherein set off and carry forward one question will come, and taxation of individual one question will come. Apart from that, advanced tax, CDS, TCS, filing of return, PAN, self-assessment, normally they will not ask a question on these topics. So one day before examination, if you feel that I have less time, then you can ignore these topics because small topics it is. Yeah, let us see clubbing, then set off, carry forward, deductions, etc. Shall we start the discussion? Yes, sir. Clubbing of income, very simple and easy chapter it is. Smallest topic. Normally they will not ask a question, separate question on this. If they ask any question, it will be merged with which chapter, sir? It will be merged with your IFOs. Section 60, transfer of income without transfer of asset. Transfer of income without transfer of asset. If an individual transfers the right to receive income without transferring the ownership of the asset, then such income shall be clubbed in the hands of transferor. Meaning what, sir? Let us say there is an asset. See, I have an FD of 10 lakh rupees. Now this FD is giving me an interest of 60,000. Now without transferring the FD, only the income I am transferring it to someone. Now the income is received by someone else, but the asset is owned by me only. Though the income is received by someone else, it will be clubbed in my hands. Transfer of income without transfer of asset. Then revocable transfers. Revocable transfer. If an assessee transfers an asset with the power to revoke, that is cancel the transfer, income from such asset will be taxable in the hands of transferor. So if I transfer the asset to someone else with the condition that I will take back the asset from you on a future date if I want to, that type of transfer is called as revocable transfer. Now though the owner of the asset is you, because I have the power to take back the asset from you, whatever income is earned by you on this asset will be clubbed in my hands. However, there are two exceptions. Irrevocable transfer. If I transfer the asset to you with a condition that I will never take back this asset from you, that is irrevocable transfer. Or if the transfer becomes revocable upon death of the transferee. Or if I say that I'll transfer the asset to you, but if you die, I'll take it back. Then also it will be taxable in your hands only till you are alive. Section 64(1)(4) and section 64(1)(6). Section 64(1)(4) talks about transfer of an asset to your spouse. 64(1)(6) talks about transfer of asset to your daughter-in-law, son's wife. If an individual transfers any asset to his or her spouse without consideration or for inadequate consideration, if as an individual Dilip transfers any asset to his or her spouse without any consideration or for inadequate consideration, then the income from such asset shall be clubbed in the hands of transferor. Whatever income is received from that asset will be clubbed in my hands. For example, I am transferring an asset to my wife without consideration or for an inadequate consideration. Whatever income wife is receiving on that asset will be clubbed in my hands. Now, if the asset is converted into any other form by my spouse, then also it will be clubbed in my hands. Let us say I have given 10 lakh, I have given an FD of 10 lakh rupees. Now she converted that FD into jewelry. Whatever income is received from jewelry, that will also be clubbed. Note, marriage should exist at the time of transfer of asset as well as at the time of receipt of income. Then, this above provision is not applicable in case of divorce and in case of agreement to live apart. And if any amount has been given to the spouse and if the same is invested by the recipient spouse in his or her business, clubbing provisions will apply only if such amount is included in the capital of the business as on 1st April of previous year. Meaning what, sir? If any amount has been given to the spouse, please see, above provision is applicable if I give some money to the spouse, if I give some money to my spouse and my spouse invests that money in the business. Now from that business any profit is earned by my spouse, that also will be clubbed in the hands proportionately to the extent of money given by me if that money is there in the opening capital of that particular business. No clubbing provision. See, when I say clubbing of income, that means loss also will be clubbed. Let me talk about this spouse ka thing because there are some examples which you should take care of. Let us say I have transferred a car to my wife. My wife gave the car on rent to someone and earned 1 lakh rupees. This rental income will be clubbed in my hands. I gave shares of lens industry to my wife. My wife earned dividend. It will be clubbed in my hands. She sold the shares, earned capital gain. That capital gain also will be clubbed in my hands. I gave an FD of 1 crore rupees. She closed the from this FD. She is earning an FD interest that will be clubbed in my hands. She closed the FD, and after closing the FD, from the money that 1 crore rupees, she purchased a house from which she earned a rental income of 5 lakh rupees. That 5 lakh rupees also will be clubbed. Now I gave an FD. She closed the FD and got 1 crore rupees, and she invested another 50 lakh rupees of her own. And she purchased a new house of, she purchased an asset worth rupees 1.5 crores. Now here, only to the extent of 1 crore clubbing will apply. Income from a concern where assessee has substantial interest. Let us say I have a substantial interest. Substantial interest means 20% or more profit sharing ratio, voting rights and equity shareholding. If I have substantial interest, let us say I have substantial interest in a company and that company is paying money to my wife and she does not have any professional or technical qualification to receive that money. Whatever money she is receiving will be clubbed in my hands. Now let us say I as well as my spouse both, so substantial interest should be seen of assessee as well as his relative, meaning I have 10%, my spouse has 12%, so combined together we have more than 20%. So it will be said that Dilip has substantial interest as well as spouse also has substantial interest. So relative over here is self, brother, sister, lenient descendant. Let us say there is a concern in which I have substantial interest as well as my spouse has substantial interest. Now the concern is paying money to both of us and we both don't have professional technical qualification. In such cases, clubbing will happen in the hands of that person who has a higher income before clubbing this income. What if both do not have any other income? Then clubbing shall not apply. What if one has substantial interest, another does not has? Whoever has, what is one have qualification, the another does not has? Whoever has professional technical qualification in his hands, the clubbing will be done. Clubbing of minor child ka income. Any income which is earned by a minor child, that minor child ka income will be clubbed in the hands of parent. Which parent? Father or mother? Any parent who has a higher income before clubbing that minor child ka income. Now, if the income is clubbed in the hands of any parent in 1 year, for all the future years also the income will be clubbed in the hands of same parent. Once the income is clubbed in the hands of a parent in the current year, then in all the subsequent year also it will be clubbed in the hands of same parent. Exception: the income earned by way of skill and talent, the manual work, ATU, disability, minor child. In these cases, clubbing will not apply. If the minor child is earning the income by way of his own skill and talent, if he is a minor child who is earning the income by way of his own manual work, or if you are an ATU disabled minor child. Now, in whosever parent's hand the minor child ka income is clubbed, that parent will get a exemption of 1,500 rupees per annum per child, irrespective of number of children he has. Now, minor child will include minor married son and minor married daughter. Minor child will include own child, stepchild, and legally adopted child. And in case of divorce, clubbing will happen in the hands of that parent who is maintaining the child. Yeah, that is all about this chapter, which is clubbing of income. Simple topic. Of course, you will not have any question because questions will be asked from set off and carry forward. If you see over here, set off and carry forward ka question is there, which is our next topic. Very simple and easy topic again. Set off and carry forward of losses. Set off means adjustment. Adjustment means what, sir? Loss is adjusted with profit. Carry forward in set off means current year, if the loss is not getting adjusted, you take it to future years and adjust in future years. Set off means adjustment of loss against income. Intra-head set off or inter-source. Intra-head set off means loss of one head with profit of another, loss of one head with profit of same head. Inter-head means loss of one head with profit of another head. Intra-head set off. Loss of a particular head is adjusted or set off with income of same head. Let us say house property, I have house property 1, house property 2. House property 1 has an income, house property 2 has, house property 1 has loss, house property 2 has an income. I am adjusting this and taking net income as 2 lakh rupees. This is setting off the income and losses of the same head. Intra-head set off. Inter means salary is setting off house property ka loss. So loss under one head is being adjusted with income of another head. We have one more thing called as carry forward and set off. What is carry forward and set off? Carry forward and set off means if the current year losses cannot be fully adjusted, if the current year losses cannot be fully adjusted with the current year income completely, then such unadjusted losses will be carried forwarded and adjusted in subsequent years. Section 70, intra-head set off or inter-head adjustment. Income from salary. So first we are talking about intra-head, solving your own house problem. Now salary will not have a loss, so solving loss under this head is not possible, so therefore no intra-head set off concept is there for salary. Income from house property. Can a house property have a loss? One house property having loss, another house property having income. Can I set off this? Yes. Intra-head set off of loss of one house property with income of another house property can be done. Business losses. If it is a normal business loss, it can be set off with normal business loss can be set off with any type of business income. Any type of business income. If it is a speculation business loss, it can be set off only with speculation business income. Speculation means buying and selling shares on securities without taking actual delivery. If it is specified business loss, specified means 35 AD business loss. The 35 AD or specified business loss can be set off only with the specified business income. Specified business loss can be set off only with whom, sir? Specified business income. Okay. Normal business loss with any business income, speculation business loss with speculation business income, specified business loss only with specified business income. Capital gain. If it is a long-term capital gain, that long-term capital gain ka loss can be set off only with long-term capital gain. Short-term capital loss can be set off with long-term capital gain as well as short-term capital gain. IFOS, normally loss will not be there under IFOS, but if it is loss of any exempt income or loss of any casual income, those losses cannot be set off at all. Owing and maintaining racehorse ka loss can be set off with another owing and maintaining racehorse ka income, and any other type of loss under other sources can be set off with other taxable income under other sources. Interhead, now solving other people's problem. Now what we saw was solving our own house problem. Now we are going to see solving other people's problem. Now salary cannot have a loss, therefore salary's loss others you are adjusting with other people, not possible. But can salary set off other people's losses? Yes. Loss under any head can be adjusted with income from salary except the losses of business or profession. So salary can adjust or set off any type of losses except the losses of set off and except the losses of business or profession. Once again. Now income from house property. Can house property ka loss be adjusted with other heads? Yes. Can other losses be adjusted with the house property? Yes. But if others are setting off house property loss, maximum 2 lakh rupees can be adjusted. See, loss of any head can be adjusted or set off with income of house property. Any head ka loss can be adjusted with house property ka income. However, loss of house property can be adjusted or set off with other incomes, maximum to the extent of 2 lakh rupees. Income from business or profession. Loss of any head can be set off or adjusted with income of business or profession. Similarly, business loss can be adjusted or set off against income under any head except salary. See, can other losses be adjusted against business income? Yes. Business loss, can it be adjusted with other incomes? Yes, except salary. However, speculation business loss and specified business loss can be adjusted only with speculation business income and specified business income. Income from capital gain. Loss of any head can be adjusted or set off with income from capital gain. Loss of any head can be set off with income of capital gain. However, loss under capital gain cannot be set off with income under other heads. See, loss of any head can be set off with capital gain. So any person's problem capital gain can solve, but capital gain ka problem can others solve? No. Income from other sources. Loss of any head can be adjusted or set off with income from other sources. However, so any person's problem other sources can solve. Loss under other sources can be adjusted with income of any head. However, exempt loss, casual loss cannot be adjusted with anyone. Unadjusted losses of other sources cannot be carry forwarded. See, normally unadjusted losses will be carry forwarded to future years for adjustment purpose. However, other sources ka loss cannot be carry forwarded. Now, carry forward and set off. Carry forward and set off means what, sir? If there is any loss in the current year which you are not able to adjust, then you can take that loss to the subsequent year and adjust in subsequent year. Unadjusted loss are carry forwarded to future years for adjustments against the income of those years. Loss under any head of current year can be adjusted with income of any other head of the current year. However, once any loss has been carry forwarded, then that loss, carry forwarded loss can be adjusted only with the income of same head in subsequent years. Meaning what, sir? If you carry forward any loss in future years, you can adjust that loss only with the same head of income. House property loss, can I carry forward? Yes. How many years can I carry forward? 8 years. In future, against whom can I adjust it, sir? House property income. Normal business loss, can it be carried forward? Yes. How many years can I carry forward, sir? 8 years. And it can be adjusted with which income, sir? Any type of business income. And for carry forwarding this loss, you should file a loss return. See, I file income tax return. Just like that, I also have to file something called as loss return. Speculation loss can be carried forward for 4 years, and it can be adjusted only with speculation income. Specified business loss can be carry forward for unlimited years and can be adjusted only with specified business income. Long-term capital loss can be carry forward for 8 years and adjusted only with long-term capital gain income. Short-term capital loss can be carried forward at 8 years and be adjusted only with short-term or long-term capital gain. Owning and maintaining racehorse can be carried forward for 4 years and be adjusted only with owning and maintaining racehorse income. Unabsorbed depreciation can be carried forward for indefinite period and be adjusted with any income except salary. Now, to carry forward these losses, you should definitely file a return of loss, except house property loss and unabsorbed depreciation. Meaning, if you want to carry forward unabsorbed depreciation and house property loss, you need not file any loss return. Order of set off. See, first you should solve your own house problem, then you should solve other people's problem. Meaning, first you do intra-head set off, then you do inter-head set off. Order of set off of business loss. If you have business loss, first solve current year ka loss set off with current year business income, current year depreciation with current year business income, brought forward business loss with current year business income, brought forward unabsorbed depreciation with current year business income, etc. Now, if you have any brought forward loss and if you have any losses in the current year, first do the adjustment of current year losses, then you do the adjustment of brought forward losses. Meaning, current year losses should first be adjusted with current year income, and then the brought forward losses should be adjusted with current year ka income. Brought forward business loss can be set off even if the business is discontinued. No loss can be set off against undisclosed income. And if you are a person who's opting for default tax regime, you cannot set off current year ka house property loss against any other income. That is all about set off and carry forward. We'll do the question which is there. Next is deductions. Okay. Anupreet provides you the following information of income and losses for the previous year 25-26. Salary income is 5 lakh, loss under house property, profit from speculation business, loss of non-speculation business, loss of other sources, okay, loss from long-term capital gain, profit of short-term capital gain, carry forward loss of speculation, unabsorbed depreciation of shut down business, okay. We are required to compute the total income. Okay, anyways, very simple. See, again, from salary income is how much, sir? 5 lakh rupees. From salary, first I will subtract other sources ka loss. Why, sir? Because other sources ka loss cannot be carry forward. So I have subtracted 3 lakh rupees. Then I will subtract house property ka loss 2,20,000. Maximum I can subtract is how much? 2 lakh. So 2 lakh rupees. So this is done. This is done. So in this 20,000 will be carry forward. So I am writing over here carry forward loss is 20,000 of house property. So my salary income becomes 0. Speculation business ka what is this? Speculation business ka income is 6 lakhs. Brought forward speculation business ka loss is 3,50,000. Current year business ka loss is there, non-speculation business ka loss 3 lakh rupees. Now what will I do? Brought forward, see, actually first I should adjust the current year loss. If I adjust it fully, then this I will not be able to adjust fully, and speculation business loss can be adjusted only with speculation business income. This loss is with respect to 21, 22. So 22, 23, 23, 24, 24, 25, 25, 26. This is the last year to set off this. So I'll adjust that 3.5 lakhs first. After adjusting 3.5 lakhs, how much is left over? 2.5 lakhs. I'll adjust the 2.5 lakhs. So this is brought forward loss. This is current year business loss. So this amount. Okay. So now this income is also 0. But here 50,000 is left over. That will adjust with someone else. We'll see if someone else is there. Non-speculation business loss 2.5 lakhs I have adjusted. 50,000 is left over. Loss of long-term capital gain, you cannot do anything. You have to carry forward 1.5 lakhs. And from current year ka capital gain, short-term capital gain, 40,000 is the income. So this 50,000 which is there, no, adjust 40,000 over here. So we'll have to carry forward how much, sir? 10,000 rupees. So taxable will be 0. This is done. This is also done. This will be carry forward as it is. So what is my income, sir? Net income will be, of course, income will be 0. Loss to be carried forward will be there of 20,000, 10,000, 1.5 lakhs and this unabsorbed depreciation. So what is the answer? See, first salary income I have subtracted other sources ka loss, and then I have subtracted house property ka loss. Net income from salary is 0. Speculation business, first carry forward losses, then current year ka losses, net income is 0. Profit from short term cap gain, against that I subtract business income, or net income is 0. So total taxable income is 0. What is the loss which I am going to carry forward? The brought forward unabsorbed depreciation, yes. Non speculation ka 10,000 ka loss which was pending. Capital gain ka loss long term, house property loss 20,000. So this is required to be carry forwarded by me. Deductions. Once we complete this chapter, what you are supposed to study for examination will be over. Okay, once we complete this chapter, what you are required to be complete, what you are required to complete for your examination will be over. Deductions. Now please see. See the format for computation of total income. What is the format for computing total income of a person? First, you should take income under all the heads. First, income from salary, then income from house property, income from business or profession, income from capital gain, income from other sources. So after computing the income under all the different heads, whatever you get, against that adjust your clubbing. You should do clubbing of income if there is any income which is required to be clubbed by you. After doing the clubbing provision, what you should do, sir? After doing the clubbing provision, do the set off and carry forward. Set off and carry forward the losses. So after doing the adjustment of set off and carry forward, what is left over with you now is called as gross total income. From this gross total income, you subtract deductions, you will get your total income. Now this total income is required to be, on this total income you are required to pay the taxes. How will you pay the taxes? First compute the tax at special rates, then compute the tax at slab rates. So after computing this tax, subtract your rebate under section 87A if the total income is up to 5 lakh rupees or 12 lakh rupees, as the case may be, whichever method you are following. Apply surcharge if the total income is more than 50 lakhs. Add health and education cess. Then margin relief also you can do adjustment if it is available. So that will give you a total tax liability. From that, subtract TDS and TCS credit. You will get an amount. From that, you subtract your advance tax paid by you. Now what you get is called as what, sir? Your net tax liability. Now please see deductions. Why is this chapter important? Because you have to pay tax on total income, and total income is the income after the deductions. So gross total income, from that you subtract deductions, you will get total income. Now deductions is not available against special incomes. So deductions under chapter 6 is not available against long-term capital gain 112, long-term capital gain 112A, short-term capital gain 111A, and casual incomes. You cannot subtract deductions from this, meaning from your gross total income which you get, first subtract these special incomes, then whatever is left over from, against that only you subtract deductions. Deductions under chapter 6A is available only if the assessee claims such deduction. Only if you are claiming the deduction will be given to you. Deduction under chapter 6A is not available if an assessee has claimed benefit or deduction under any other provisions of income tax law. So if you have already claimed a benefit under any other provisions of income tax law, you cannot claim the deduction. Now you have different types of deduction. Most important deduction for your examination, and 90% of the time they'll ask that only, which is 80C, 80D, 80E, 80G, TTA, 80U. Okay, so these things, so definitely you should remember. Other things, whether you remember or not, that is not that important. This points 80C, D, E, G, TTA and U, compulsory you should be knowing. One by one we'll see. 80C talks about life insurance premium, tuition fees, provident fund, principal repayment of housing loan, etc. So if you are an individual or an HUF, it does not matter whether you are a resident or not, you can claim deduction. How much deduction can you claim, sir? 1,50,000 rupees per annum deduction can be claimed by you. You can claim a deduction of how much, sir? 1,50,000 rupees. You can claim a deduction of 1,50,000 under 80C. So for LIC premium, if I take a life insurance policy for myself, or if I take a life insurance policy for my spouse or my children, I can claim the deduction under 80C. And if you are an HUF, you are taking a policy for, if you are an HUF and if you are taking a policy for members of HUF, you can claim a deduction. How much deduction can I claim? Whatever premium you are paying or whatever limit is given in the law over here. What is the limit, sir? The limit is based on when the policy is taken by you. If the policy is taken before 1/4/2012, 20% of sum assured. If the policy is taken on or after 1/4/2012, it is 10% of sum assured. If you are a person with disability, if the policy is taken before 1/4/2012, 20% of sum assured. Sir, what is sum assured? See what happens. When you take a policy, there will be an amount which they will guarantee that in case of death, I will pay so much to the nominee, or if you survive, then I will pay you so much minimum amount. Correct? No, that is called as sum assured. This is the assurance which the company is giving, the insurance company is giving, that this much to definitely will pay. So, whatever premium you are paying will be compared with the 20% of sum assured and take whichever is less will be taken. Now, this is the deduction which I am going to give you for life insurance policy under 80C. Of course, this total amount should not be more than 1,50,000 rupees. %20% of sum assured if the policy is taken before 1/4/2012, and 10% of sum assured if the policy is taken on or after 1/4/2012. If you are a person with disability, check when is the policy issued. Policy is issued before 1/4/2012, 20% of sum assured. Policy is issued during the year 2012-13, 10% of sum assured. On or after 1/4/2013, 15% of sum assured. Let us say I have taken 3 policies for myself, my spouse and my children's. For myself in the year 2008, for my spouse in the year 2014, and my children's in the year 2019. How much, sir? 3 lakhs, 5 lakhs and 10 lakhs is the policy value. Premium is 50,000, 75,000 and 80,000. Limit is how much? 60,000, 50,000 and 1 lakh. How, sir, you got this limit? Limit, because the policy is issued before 2012, 20% of 3 lakhs. This will be 10% of 5 lakhs, which is 50,000, and this will be 10% of 10 lakhs, which is 1 lakh. So compare the premium with premium or limit, whichever is less, 50,000, premium or limit, whichever is less, 50,000, whichever is less, 80,000. So this is the total amount eligible, but I can take maximum how much, sir? 1,50,000. Now, if you are taking policy, if any policy is issued on or after 1/4/2024, then the total premium in a year should not be more than 50,000. If you have taken an insurance policy and the premium amount paid by you is more than the limit given, if premium amount is more than the limit given, that is, if it is more than 10%, 15% or 5 lakh rupees, then amount received on maturity by the policy holder will be fully taxable. Exemption under section 1010D. See what happens normally, whatever amount you receive on the maturity will be exempt under section 1010D. Normally, amount received on maturity of life insurance policy is exempt under section 1010D in the hands of policy holder. Now, please see, at the time, who is receiving the money, that is important. If the money is received by nominee upon death of the policy holder has died and nominee is receiving the money, whatever amount is received, that entire amount will be exempt. Fully exempt, always exempt under section 1010D. If the amount is received on maturity of the policy by policy holder, now see how much is the premium paid. Premium paid during the term of policy is more than the limit specified, then it will be fully taxable. Meaning, during the term of policy, if you have paid a premium more than that 20% or 10% of sum assured, then the amount received will be fully taxable. Of course, whatever amount you have received, you can subtract from that. You can subtract what, sir? You can subtract whatever policy the premium was paid during the tenure. And if the premium paid by you during the term of the policy is less than the limit specified, then whatever amount you receive is exempt under at the time of maturity will be exempt under 1010D. Further, other items covered under ATC is investment made in public provident fund. You make for yourself, spouse or children and members of HUF. Employee ka contribution to recognized provident fund, superannuation fund and statutory provident fund. Principal repayment of housing loan, including the stamp duty and registration charges, provided the loan, the house should be residential house property, loan should be taken from bank or financial institution, and loan should be taken for construction of house property. Now, if you make the contribution to unrecognized provident fund, or if you make the contribution to unapproved fund, then it will not be allowed as deduction. Amount contributed or invested in National Savings Certificate, NABARD bonds, National Senior Citizen Savings Scheme, Equity Linked Savings Scheme, Unit Linked Insurance or Pension Scheme of Mutual Fund, Notified Units of Mutual Fund or Sukanya Samriddhi account or fixed deposits for 5 years or more, then also it is covered under ATC. Now, if you are paying tuition fees or school fees, tuition fees means school or college fees, tuition fees for maximum 2 children, you can claim an exemption if the education is happening in India and it should be a full-time education. ATCC. If you are investing in pension scheme of any insurance company or any life insurance corporation, if it is done by individual, contribution should be made in pension scheme of life insurance corporation or any other insurance company. Maximum deduction which will be given to you is 1,50,000 rupees per annum. ATCCD, contribution to pension scheme. Which pension scheme, sir? National pension scheme, central government pension scheme, or Atal Pension Yojana, if you are making contribution to this. Now, who can make the contribution? Either a salaried employee can make the contribution or others can make the contribution. If a salaried employee is making the contribution in the national pension scheme, whatever contribution is made by him, you ignore for salary calculation and give deduction to him under ATCCD1. How much deduction will the employee get for his employee contribution? Whatever contribution he has made, or 10% of salary, whichever is less. Now, this will be taken as 14% of salary for a government employee. Then, if employer is making the contribution to this fund, first add the employer's contribution to the salary. Then, deduction will be allowed under section ATCCD 2. How much deduction will be allowed, sir? Employer contribution or 14% of salary. Other than salaried individual, if you are not a salaried individual, then the amount contributed is 20% of the if you are not a salaried employee, then you will get a deduction in the section ATCCD 1, which is amount contributed by you or 20% of gross total income, whichever is less. Now, the total deduction which you will get for ATC, CCC and ATCCD1 combined together is not more than 1,50,000 rupees. Then ATD, medical insurance if you are taking. So, medical insurance if you are taking or health insurance you are taking, for which the premium is paid by you by any mode other than cash. Compulsory the premium should be paid by any mode other than cash, or you are contributing the money to central government health scheme, or you are contributing the money for preventive health checkup or medical treatment. Then it is covered over here. Medical treatment of whom, sir? Any senior citizen who is not having an insurance policy, then it is covered over here. Now, who is covered under this particular case, sir? If you are an individual and if you are taking a policy for yourself, your spouse, your dependent children, or your parents, and for HUF, members of HUF. Now, please see how much is the deduction allowed under ATD. Important. This is important. If you are contributing the money, if you are taking a health insurance, if you are taking what, sir? If you are taking a health insurance for yourself, your spouse, or your dependent children, you can claim a deduction of 25,000. If you are taking a policy for yourself, spouse, and dependent children, you can claim a deduction of 25,000. Now, any one of you or all of you are senior citizen, extra 25,000 will be given. So, normally the limit is 25,000. Additional 25,000 will be given if anyone among you is senior citizen or all of you are senior citizen. Then, point number 2. If you invest, if you take life insurance, health insurance policy for your parents also, you will get a deduction of 25,000. And if your parents, one or both of them are senior citizen, then extra 25,000. So normally what is the deduction, sir? If policy is taken by me for myself, my spouse, my children, 25,000. And if I take policy for parents also, 25,000. If anyone among us is senior citizen, extra 25,000. If parents, anyone is senior citizen, extra 25,000. So minimum I'll get 25,000 for myself and my parents separately. Maximum I'll get 50,000 for myself and my maximum I'll get 50,000 separately for parents also. Say for example, I have taken policy for myself, my spouse, dependent daughter 1, dependent daughter 2 and non-dependent son. Whoever is not dependent, remove. Whoever is dependent and my spouse, total premium paid is 30,000, maximum I will get is 25,000. I am 32 years, I have, my spouse is 62 years. So combined together, how much insurance premium I am paying for myself and my spouse. And I have a daughter, both the daughters are dependent on me, and combined together I am paying a premium of 58,000. I can claim reduction of 50,000. Why, sir? Because my spouse is more than 60 years. I can take separate benefit for her. Now I am taking a policy for myself and my spouse, my parents. For myself and my spouse separately I will calculate, and for my parents separately I will calculate. My parents I am paying 60,000, I will get maximum 50,000. For myself and my spouse I am paying 40,000, I will claim full. I will claim full 40,000. 80DD. If you are maintaining or incurring any expenditure for medical treatment of a person who is dependent on you and who is disabled, then you can claim a deduction over here. This is a flat deduction which will always be given. So if you are a resident individual whose dependent relative is a disabled person, dependent relative is spouse or children's father, mother, brother or sister. And if you are in HUF, members of HUF. Normal disability 75,000 is the deduction given to you, and in case of severe disability you will get a deduction of 1,25,000, and this is a flat deduction. Severe disability means the disability should be 80% or more. Note, deduction is available only if such disabled person has not claimed any deduction under section 80U for himself. I will get a deduction. When, sir, I will get a deduction? If I have not claimed a if the person for whom I am claiming deduction has not claimed a deduction for himself under section 80U. Section 80U, deduction for disabled assessee. Deduction for whom, sir? Disabled assessee. If I myself, I am a disabled person, what will happen? So if you are a resident individual who is a disabled person, then you will get a deduction. In case of normal disability, you will get a deduction of 75,000. In case of severe disability, you will get a deduction of 1,25,000. 80DDB. 80DDB, deduction for medical treatment of specified disease. So if you are a resident individual, if you take a if you are incurring expenditure for medical treatment of yourself or your dependent, not relevant at all for exam point of view. If you are a resident individual, if you are taking if you are incurring expenditure for medical treatment of yourself or your dependent relatives such as spouse, children, father, mother, brother, sister, or if you are an HUF incurring an expenditure for members, will get a deduction of 40,000 or 1 lakh rupees depending upon whether it is normal case or you are incurring the expenditure for senior citizen. So how much is the deduction which I am going to get, sir? Actual expenses or limit, whichever is less, subtract insurance claim received. 80E, interest on higher education loan. So if you are an individual who is taking educational loan for higher education of yourself, spouse or children's, whatever interest is paid by you is allowed as deduction for 8 consecutive years from the year in which you start paying interest. Higher education means education after 12th standard. 80G, this is deduction for donation which you are making. So if you are an assessee who is giving any type of donation, then you will get a deduction. Now the deduction, how much deduction will you get, sir? There is no limit or there is limit based. No limit meaning any amount you contribute, 50% of that will be given if you contribute the money in PM drought fund. If you contribute the money to any central government fund, any state government fund, any prime minister fund, chief minister fund, any fund of national interest, etc., or Swachh Bharat Clean Ganga Army fund or Zilla Parishad fund, etc., then you will get 100% deduction. Any amount can be donated without any limit. Then we have limit based. Limit based means what, sir? How much amount you are contributing, there is no how much deduction you are going to get, that will be restricted to some amount. See here, no limit means what? Amount contributed into 50%. So if you contribute the money to PM drought fund, I have contributed 1 lakh rupees, 50,000 deduction will be given. If you have contributed money to any central government fund, any CM fund, any PM fund, I have contributed 1 lakh rupees, full 1 lakh rupees will be given as deduction. But this limit based is what, sir? What they'll do, whatever amount you have donated, that will be compared with the limit, which is equal to 10% of adjusted total income, whichever is less will be taken. So, for example, minority, if you are contributing to any minority or any trust, ATG registered trust, temple, mosque, church, or housing accommodation, then whatever amount is contributed will be compared with 10% of adjusted total, and I'll take whichever is less, into 50% will be allowed as deduction. But if you contribute money for family planning, or any Indian company is giving the money for Olympics, then 100% deduction will be given. 100% of what? Whatever amount you are getting over here. Adjusted total income is gross total income minus all the deduction except ATG ka deduction. Donation given in kind is not covered. Donation more than 2,000 rupees should be by account paid check, account paid demand draft, or any other electronic clearing system. 80 GG, rent paid for house property. Okay, so this is just like your HRA, but if you are not receiving HRA, if you are an individual who is not getting HRA and who is not having a house at the place of his employment and who is not claimed any SOP benefit, then you will get a deduction of 5,000 rupees or 25% of adjusted gross total income, or rent paid minus 10% of adjusted gross total income, whichever is less. Adjusted gross total income is your gross total income less all the special incomes, of course, because you cannot claim any deduction, and subtract all the deductions except 80 GG ka deduction. Of this, 10%, 25% should be taken. 80 GGA, donation for scientific research or rural development. So if you are an assessee who is not having any business income, and if you are contributing money for scientific research under section 35, or rural development or poverty eradication, whatever deduction you have, whatever donation, you will get a deduction equal to 100% of donation made by you. Donation to political party or electoral trust, 80 GGB. If you are an Indian company, you will get 100% deduction. 80 GGC, all the assessee will get 100% deduction. Donation should be by any mode other than cash, even 1 rupee. If you are making to political party, expenses incurred for donation to political party is not allowed as business expenses. 80 JJAA, if you are giving employment opportunity to new workmen, new employees, then you will get a deduction under section 80 GG, 80 JJAA. So you are any type of assessee who is engaged in business, whose books of accounts are audited under section 44 AB, you will get an additional deduction equal to 30% of additional employee cost incurred by you, and this will be allowed for 3 assessment years continuously. Additional employee cost means emoluments paid to additional employees. For existing business, it is the increase in the total number of employees compared to the increase in employees employed as on last day of the previous year. So what was the number of employees as on last day of previous year? Compare that with what is the number of employees as on today. And for new businesses, all the employees employed during the current year. Additional employee shall not include employees whose salary is more than 25,000, who is working for less than 240 days, and if you are not participating in rent provident fund, recognized provident fund. 80 TTA, very important. If you are an individual, except senior citizen, and if you have any interest income from saving account, you will get a deduction equal to, basically, if you have a saving account, that saving account can be in a bank or a post office or a cooperative society. If you get any interest income from that saving account, then you will get a deduction of interest income earned by you, or the limit of 10,000, whichever is less. 80 TTB, interest on deposit. If you are a senior citizen earning any type of interest from any type of deposit, if you are a senior citizen having any type of interest income, it can be fixed deposit, bank deposit, post office deposit, any type of deposit, whatever interest is earned by you, or 50,000, whichever is less, will be allowed as deduction. 80 TTB is applicable only if you are a resident. 80 TTA is applicable for both resident and non-resident. Saving account only is covered over here. Here, any type of deposit is covered. Royalty income. 80 QQB is for royalty for book. 80 RRB is royalty for patent. Maximum deduction will be given to you is 3 lakh rupees. Now, one quick recap. So, if a person is opting for default tax regime, so basically comparative analysis of default tax regime and optional tax regime, we already know the tax rates, etc. I will not waste time repeating this. Now, apart from that, income, what are the benefits you are going to lose if you opt for default tax regime under section 115 BSC? Under salary, you will not get leave travel concession, you will not get HRA exemption, you will not get any allowances under section 1014. Except transport allowance, traveling allowance, daily allowance and conveyance allowance. No deduction will be given to you under section 16. Income from house property. For self-occupied property, you will not get interest deduction. For let out or deemed to be let out property, there is no change. Income from business or profession. No depreciation or no additional depreciation will be given to you. No deduction for donation made under section 35 and no deduction for 35 AD specified businesses. Income from capital gain, there is no change at all. Income from other sources. 1032 ka exemption will not be given when you are clubbing the minor child's income, and MLA MP ka constituency allowances, daily allowance will be taxable, and if you are a person receiving family pension, then 1/3 of family pension or 25,000, whichever is less is the limit, meaning higher limit is there. Set off and carry forward. House property loss cannot be set off with any other head in the current year, and any brought forward losses because of above reasons cannot be set off. Deductions under Chapter 6A, you cannot claim any type of deduction under Chapter 6A except 80 JJAA and 80 CCD 2. Special incomes will be taxable at special rates only, and AMT is not applicable for 115 BSC assessee. What is AMT, sir? Alternate minimum tax, section 115 JC, alternate minimum tax. So alternatively, this is the minimum amount of tax which is required to be paid by a person. So you are any type of assessee, whether except company. All section 115 JC is applicable to all types of assessee except company. If you are so normally they'll not test you at intermediate level for this thing. If you are any type of assessee except company, if you are an individual HUF, AOP, BOI, firm, LLP, AJP, the tax to be paid by an assessee will be the tax calculated as per normal provision or of the alternate minimum tax as per 115 JC, whichever is higher. Alternate minimum tax is how much, sir? Your adjusted total income into 18.5%. To this, you should add surcharge and cess if your adjusted total income is more than 50 lakh rupees, etc. What is adjusted total income? Take your total income. Now, while computing total income, if you have given these deductions, add it back. From your total income, add 3580 deduction if you have taken, add 10AA deduction if you have taken, add 80 JJAA, QQB, RRB if you have taken. Then subtract depreciation for 3580 ka asset. Now you will get your adjusted total income. This provision shall not apply to an individual HUF, AOP, BOI, firm, AJP if their adjusted total income does not exceed 20 lakhs. An assessee who pays tax under section 115 BSC. Yeah, that is all about this beautiful concept called as. Yeah, so now please note the tax which you have to pay is alternate minimum tax or normal tax, whichever is higher. Now because you are paying whichever is higher, if AMT is higher, you have to pay AMT. That means what, sir? Normally you are required to pay 10 rupees, but you are paying 15 rupees because 15 rupees is more. Now, therefore, 5 rupees extra which you have paid will be given to you as AMT credit. This will be available for the next 15 years and you can use it when your normal tax is more than alternate minimum tax. Okay, so this is all about this chapter and this is all about direct taxes also. We will see the question which is there, last question, and we will conclude our direct taxes. Mrs. Kajal, a resident individual aged 45 years, an employee of private company, furnishes the following particulars for her income for the previous year 25-26. Income from business, income from salary before standard deduction 9,20,000. Interest from government securities 5,000 rupees. Okay. She made the following payment, deposited 2 lakh rupees in public provident fund. I'll get only 1,50,000 benefit. Medical insurance premium for own health 20,000, spouse health 10,000. So 30,000 they have paid, but I'll get only 25,000. Donation to PM drought fund 10,000. I'll get only 50% of this, which is 5,000. You are required to calculate total taxable income and tax liability of Mrs. Kajal for the assessment year 26-27 under default tax regime and under optional tax regime. Compare and discuss whether Kajal should opt for default tax regime or very simple, very easy. So very simple question. So computation of total income of Mrs. Kajal. Particulars. Optional regime. Default regime. First is salary received 9 lakh less standard deduction under section 16(1)(a). 9,20,000 is correct. For optional regime it is 50,000. Default regime it is 75,000. That will give me my income from salary. $8,70,000. $8,45,000. So this is first income from salary. Second income is income from other sources, interest on government securities. ₹5,000 and 5,000 rupees. Now, any other type of income is there? No. So my gross total income. My gross total income is how much, sir? 8,75,000. 8,50,000 rupees is my gross total income. Less deductions under chapter 6A. ATC PPF 2 lakh rupees, but maximum allowed is only 1,50,000. Under default regime, you will not get. ATD Mediclaim 30,000, but maximum allowed is only 25,000. PM drought fund 80G. If you remember the section numbers, it will be very advantageous. PM drought fund 10,000 rupees, but I'll get only 50% of this, which is 5,000. So my total income will be how much, sir? $6,95,000 and 8,50,000. Now the tax on total income. Under optional tax regime, up to 2.5 lakhs, no tax. 2.5 lakhs to 5 lakhs, 12,500, 5 lakhs to 6 lakhs, 95,000. Into how much, sir? 20%. Health and education says 4%. And for this, no tax, I'll not write directly. Default tax regime. Up to 4 lakhs 0, 4 lakhs to 8 lakhs 20,000, 8 lakhs to 8.5 lakhs on 50,000, it is 10%, 5,000, which is 25,000, less rebate under section 87A. Why, sir? Because income is less than 12 lakhs, so net tax liability is 0. This is the answer. Avada. Very simple, very easy, one of the easiest question. So your income is correct. Total income is also correct. 8,50,000 is one side, 6,95,000. Okay. So this 53,560 is correct. And this they have taken 36,400. The tax liability under default regime useless people. So they have given wrong answer. They have taken a wrong answer over here. So they have taken as per the old provision. Just copy paste your institute. Yeah. So you can ignore this. Okay. So with this, we conclude our direct taxes. Now I'll take a break for around 15-20 minutes and we'll continue discussion on indirect taxes. So break will be there till 11:10 and we'll start the discussion on indirect taxes.
Welcome back, students. Welcome back. Let us continue our discussion.
Let us start with indirect taxes. Introduction to GST. Beautiful. Indirect taxes is very easy, very simple. Indirect taxes. Indirect taxes. Now, indirect taxes, you see. Okay. Introduction. If you see from your institute material, internet, I'll have to change once again. Indirect tax is one of the easiest and very easy to score. One of the easiest, very fast to complete also. Unlike your direct taxes, which is little lengthy, indirect taxes is not that lengthy. So we have 5%, 35% and 10%. Meaning what, sir? Your basic concepts which are there, concept of indirect taxes, will have one question. Definitely one question will come for 7 marks. From just 12 pages you have to study and 7 marks will get. Just 12 pages. Then from this module number 5, which is there, which is 5.1 to 5.8, will come for 35 marks and customs law will come for another 10 marks. Wherein normally one question will be from MCQ or 2 questions from MCQ and then one 7 marks question, valuation question will be there. So very easy and simple concepts they are. Important chapters are, as I told you, first chapter, one theory question for sure will come from there. Here also introduction, one theory question they may ask. Then time of supply, value of supply, place of supply, input tax rate, computation of GST. This will contain the maximum marks will come from this only. Maximum in the sense almost out of 35, around 20 to 25 marks will come from there. Customs law valuation is one important topic. So we'll try to cover everything today and complete our discussion. Okay. Introduction to GST. Introduction. Now, as we all know, we have already studied about tax. What is tax? Tax is pecuniary. Tax is one of the important source of revenue to the government. Two types of taxes are there. Now, the difference between direct taxes and indirect taxes is important question. One theory question you can expect from this. So, I will tell you from the first topic which is there. No, I'll cover the first chapter, which is module number 4 from your institute material also, and I'll tell you which are the questions which you should emphasize on. Those questions, if you study, 7 to 14 marks will definitely get from there. So types of taxes: direct taxes, incident impact is on same person; indirect taxes, incident impact is on two different person. Direct taxes are progressive in nature; indirect taxes are regressive in nature. Direct taxes burden cannot be shifted; indirect taxes burden can be shifted. Direct taxes on income; indirect taxes on goods and services. Now, features of indirect taxes, important question, expected. I mean, you can expect this question. So first important question is types, difference between direct taxes, indirect taxes. Second important question is features of indirect taxes. What are the features of indirect taxes? RCB will win, sir. Who is going to win the IPL this year? RCB will win, sir. Who is going to win the IPL this year? RCB will win, sir. R for important source of revenue to the government. C for taxes on commodities and services. B for shifting of burden. W for wider tax base. I for inflation in nature. No, N for no perception of direct pinch. S for promote social welfare, and R for it is regressive in nature. Features of indirect taxes are RCB will win, sir. R for important source of revenue to the government. C for taxes on commodities and services. B for shifting of burden. W for wider tax base. I for inflation in nature. N for no perception of direct pinch. Promote social welfare, and it is regressive in nature. Now, constitutional provisions with respect to taxation, something which we studied under direct taxes, same thing is there. Article 265 says no tax can be levied or collected unless there is an authority of law. Article 245 says the central government has the power to make law for whole or any part of India, and the state government has the power to make law for whole or any part of that particular state. Article 246 has a schedule called as Schedule number 7, which has 3 lists: union list, state list, and concurrent list. Now, whatever matters or activities are contained in union list, with respect to that only the central government can make the law. Whatever is there in state list, with respect to that only state government can make the law. Whatever is there in concurrent list, with respect to that both the central government and state government can jointly make the law. Okay. So now union list talks about income tax, excise duty, service tax, custom duty. State list talks about VAT, tax on alcoholic liquor for human consumption, lottery, betting, gambling, sales tax, etc. Concurrent list, it does not talk about any tax law. It talks only about general laws, correct? So we have union list which talks about what are the taxes which can be collected only by union, which is central government. We have state list which talks about what are the different types of taxes which can be collected by state government. But we did not have even one article or one provision in the entire constitution which gave the power to both central government and state government to jointly collect, to jointly come together and make it tax law. Okay, so in our entire constitution there was not even a single point which gave the power to both central government and state government to jointly come together and make a law with respect to taxes. Therefore, amendment was made in the constitution. See, central government had power to collect taxes on some specific items, and on those items only central government can collect taxes. Similarly, state government had the power to collect taxes on some specific items on which only state government had the power to collect taxes. But there was not even one point which gave the power to both central government and state government to jointly come together and make a tax law. Therefore, an amendment was made in the constitution. There was no article in the entire constitution which gave the power to both central government and state government to jointly collect a tax. Therefore, constitution was amended and Constitution's 101st Amendment Act 2016 was passed, wherein they introduced various different articles. Some of the important article is Article 246A, 269A and 279A. Now, it was Article 246A. Please note, how did these articles come into existence? MCQ important point. By Constitution's 101st Amendment Act. It was Article 246A which gave the power to both the central government and state government to jointly come together and make a law with respect to goods and service tax. And it is Article 246A which also said that central government will have the exclusive power to make law with respect to interstate supply. Now, concept of GST. What is GST basically? Concept of GST. What is GST basically? GST is a tax on value addition. So if there is any value addition, then only GST will be applicable. In GST, you have continuous tax credit available at each and every stage of supply chain. GST eliminates the cascading effect. GST burden is on final consumer. India follows dual GST model, and India follows a principle called as destination based principle. Okay, GST basically is a tax on value addition. So if there is any value addition, GST is applicable. If no value addition, no GST is applicable. Under GST, you have continuous tax credit available at each and every stage of supply chain. And GST eliminates the cascading effect. Under GST, there is no tax on tax because of GST. And under GST, the burden is on final consumer. The tax is required to be paid by final consumer. India follows a system called as dual GST model, wherein both central government and state government jointly levies taxes on a single supply. And India follows destination based principle under GST law, or GST is a consumption based tax. Now, nature of supply. Supply has two nature. Either it can be intrastate supply and interstate supply. Intrastate supply means if you are supplying goods or services in the same state or same union territory. Interstate supply means supply of goods or services in two different states, two different union territory, one state and one union territory. If it is an intrastate supply, the tax which you have to pay is CGST, SGST. Interstate supply tax which you have to pay is IGST. If you make a supply within the same union territory, CGST and UTGST. Now, the actual definition of intrastate supply and interstate supply we'll discuss in a chapter called as place of supply. Now, union territory which is there. Now, union territory. In India, we have totally 8 union territories, but there are 3 union territories which are regarded as state for the purpose of GST law. Which are these 3 union territories? Puducherry, Delhi and Jammu and Kashmir. For the purpose of GST law, this Puducherry, Delhi and Jammu and Kashmir will be called as state. And you are going to levy CGST and SGST. Andaman, Nicobar, Lakshadweep, Ladakh, Diu Daman, Dadar Nagar Haveli and Chandigarh, you will levy something called as CGST and UTGST. Now, what are the deficiencies in existing indirect tax laws? Another important question. What was the need for GST to come into existence? What are the deficiencies or limitations or disadvantages of pre-GST taxes or existing? Existing means what, sir? Pre-GST taxes, the taxes which were there before GST law. Now, what were the deficiencies, sir? There were certain transactions which were taxed as both goods and services. There were multiple taxes collected by the same state government. Tax on services was not integrated with tax on goods. CST, that is Central Sales Tax, was not VATable. Then another important question, what are the different types of taxes which got subsumed or merged with GST? The central taxes which got merged with GST are Central Excise Duty, Central Sales Tax, Service Tax, CVD and Special CVD, Excise Duty on medical and toilet preparation, and any other surcharge and cess related to goods and services collected by central government. The state taxes which got merged with GST are VAT or sales tax, entertainment tax except collected by local authority, tax on lottery betting and gambling, purchase tax or entry tax, or any other surcharge and cess collected by whom, sir? Collected by state government on goods and services. Now, are there any taxes which did not get merged with GST? Yes, there are some taxes which did not get merged with GST. Excise duty on alcoholic liquor for human consumption, basic custom duty, property tax or stamp duty, electricity duty, and entertainment taxes which was collected by local authority. Now on tobacco and tobacco products, GST as well as pre-GST taxes will be collected. On opium, Indian hype, narcotic drugs, GST as well as pre-GST taxes will be collected. Alcoholic liquor for human consumption, GST can never be collected. And on HP man, presently GST is not collected, but GST will be collected on a future date as may be notified by the government.
Now, another important question is, what are the advantages of GST? Advantages: it mitigates ill effects of cascading. There is a certainty in tax administration. It is beneficial to small traders and beneficial entrepreneurs. Reduces compliance cost. It enhances, increases investments and employment. There is a certainty. It helps in creation of unified national market. Because of GST, there is ease of doing business. It boosts Make in India initiative, and there is automated procedure with greater use of IT. GST Common Portal. It is a website which is designed, developed and managed by a company called as GSTN, Goods and, this is also important question, Goods and Service Tax Network. GSTN is a Section 8 company. It is a not-for-profit organization. Website is gst.gov.in. Taxpayer can access it through internet, and tax officials can access it through intranet. What are the functions which can be performed by GST Common Portal? What are the things which you can do on the Common Portal? Question which they ask in examination. GST Common Portal helps in filing of returns, filing of registration application, generation of payment challan. It acts as clearing house for settlement of IGST, and it generates business intelligence. Then Article 269A, which talks about levy and collection of GST on interstate supply. Central government has the power to levy. Taxes or levy and collect the taxes on interstate supply. On interstate supply, they are going to collect a tax called as IGST, and IGST will be collected by central government. It will be apportioned between central government and the consumer state. Article 279A. Article 279A talks about GST Council. Constitution's 101st Amendment Act 2016. Constitution 101st Amendment Act 2016 has an article called as Article 2, introduced an article called as Article 279A, which said within 1 month of this article, you should form a council called as GST Council, who should form, sir? President of India should form. The provision of GST Council came into existence on 12th of September 2016, and the GST Council was formed on 15th of September 2016. Now, the GST Council consists of a chairperson who is the Finance Minister of India, that is the Union Finance Minister, and it will also contain members who will be Union Ministers in charge of Revenue and Finance, and Minister of Finance or Taxation, or any other person nominated by state government. These members shall elect one among themselves to be the vice chairperson. Now, the question which they are going to ask is about this: what are the recommendations which GST Council can do? It can recommend with respect to taxes, duties, surcharges and cess which are required to be subsumed or not required to be subsumed with GST. GST rates on goods and services, goods or services which are exempted, principles for determining the nature of supply. How do I classify different goods and services? The threshold limit for taking registration under GST, persons who are exempted from taking registration under GST, and persons, special provisions which are required to be made applicable for 11 special category states. So we have total 11 special category states, which is S. Nagaland, ma'am, through Michael Jackson, which is Sikkim, Nagaland, Manipur, Assam, Arunachal Pradesh, Meghalaya, Tripura, Himachal Pradesh, Uttarakhand, Mizoram and Jammu and Kashmir. For this, we have different provisions which we'll see later in the coming chapters. GST will be applicable. They also are going to give recommendation from the date when GST will apply for HPMAN. Now, how is decision made in GST Council? By meeting. Meeting will have minimum number of members, which is quorum of the meeting is half of total number of members. How is decision taken, sir? Decision is taken by majority of not less than 3/4 of weighted votes of members who are present and voting. So I'll take majority. Majority is how much, sir? Not less than, meaning at least 3/4 of weighted votes of members who are present in the meeting and voting. Weights assigned to central government is 1/3. Weight assigned to state government is 2/3. Now, before we go to the main discussion, let us see the first topic. As I told you, first two topics actually I'll cover concepts, module number 4, as well as 5.1 introduction to GST. I'll tell you what are the important questions. Please make sure that you should definitely know them. Now, what is the concept of features of GST? So this is concept of features of GST. What is features of GST or indirect taxes? RCB will win, sir. So this is one question which they'll ask. What is the difference between direct and indirect taxes? Important question. This also they can ask. Then background of GST, all the stories. This is entry number 82, list 1, list 2, list 3. All these are important from MCQ point of view. All the stories are not relevant. You can ignore all of them.
So I hope you understood two questions. One is features, one is difference. Constitution's 101st Amendment Act, in that nothing is important. Now here under GST, what is important, sir? Levy and collection of GST introduction. Now GST Council, what recommendation can it give? They have given it over here. Recommendations which can be given by them. Just remember 5-6 recommendations. What is GSTN and what are the functions of GSTN or GST Common Portal? Need for GST in India is nothing but what are the disadvantages of earlier pre-GST taxes. What are the taxes which got subsumed with GST? This is also an important question. What are the benefit of GST? This is also an important question. Yeah, silent features of GST, all these stories are not relevant for you. What is GST compensation says? Now, because of introduction of GST, before GST, the tax revenue was going to that state from where the goods were originating, from where the goods were coming. It was origin based tax, and GST is a consumption based tax. The tax revenue will go to that state where the goods are going or consumed. So therefore, many people objected introduction of GST. Now to compensate the loss of revenue, why they objected, sir? Because if GST introduced, the revenue will go to that state from to whom I am supplying, correct? So many people objected, the supplier state objected, telling I don't want GST. So to compensate the loss of revenue, they started collecting something called as GST compensation cess. That is what this GST compensation cess talks about. So these are levied on high value products or demerit products like pan masala, tobacco products, cigarette, motor cars, aerated waters, coal, etc. Okay, that is all about this chapter. Whatever questions I have told you, 2 questions will come. 7 marks is the weightage of that question in examination. So 7 to 14 marks, whatever questions I have told, no, only those questions will come, nothing else will come. Okay. Now let us come back to the main discussion. Levy and collection supply topic is the first topic which you are going to start our discussion with. Supply under GST. Supply under GST. Now, see, we have a concept called as taxable event. What do you mean by taxable event? Taxable event means the reason because of which you are paying the taxes. What is taxable event, sir? Taxable event is the reason because of which you are paying the taxes. And the reason because of which you are paying the taxes is supply of goods or services. Section 7 of CGST Act gives the meaning of that supply. So taxable event is what, sir? Taxable event. Supply under GST, section 7 of CGST Act talks about supply. Taxable event is the reason because of which you are paying the taxes, and under GST law, the taxable event under GST law is supply of goods or services or both. What is the taxable event under GST law, sir? Supply of goods or services or both. And the meaning of the supply is given in section 7 of CGST Act. Now please note, we have different acts: CGST Act, SGST Act, UTGST Act, IGST Act, GST compensation cess. Should I study all these acts? No. Majorly, what is the act which you are supposed to study? CGST Act. Whatever sections you are going to learn in this entire chapter, all those sections come from one single act, which is CGST Act. Only one chapter, which is place of supply, is a chapter which you are going to study from IGST Act. Section 7 of CGST Act 2017. Section, see, sir, section 7 only directly you will start? Yes. What about 1, 2, 3, 4, 5, 6? Section 1 talks about title, extent and commencement. The title of this act is Central Goods and Services Tax Act 2017. It extends to whole of India and it shall commence from 1st of July 2017. Section 2 talks about definitions, which we will study as and when required. Section 3 to section 6 talks about different officers under GST law, their hierarchy, their powers, roles, responsibilities, which is not applicable to us, not there in our syllabus. Therefore, the first section which we have to study is supply. Most important section. Why, sir? Because only when there is a supply you have to pay GST. When there is no supply, no GST is applicable. Section 7, supply. So what are the different provisions you are going to see here? 7.1a, 7.1b, 7.1c, 7.1aa. 7.1c you will study with schedule number 1. 7.1 capital A, schedule 2, 7.2 schedule 3 and 7.3. Now, whenever there is a supply, please note, under income tax law, the questions are majorly practical questions. Under GST law, questions are theory, questions are practical, questions are case study. I have told you what is the weightage. Sometimes 30% will be practical, 40% will be practical, 30% will be theory, blank theory. Okay, so those types of questions will be there. So whatever provisions we are studying, you look into those provisions carefully, and I will give examples with each provision. You please look into the examples carefully, because that example is nothing but a question asked in the examination. Yeah, before we start this discussion, let us see the question from this topic. Now see, discuss the difficulties or limitations of pre-GST regime in the context of indirect taxes which were removed with introduction of GST. So what were the deficiencies of pre-GST taxes? So they have given these deficiencies. Compulsory, good question, important question. List 5 central and state taxes which got subsumed with GST. Again, I told you these two questions are important. I have told you, some questions which are important. Only those questions they will ask, okay? After that, they are starting with the other concepts, okay? Supply includes. Now, supply, see, under this chapter, this topic which we are going to see now, supply topic, theory question may come, or there are points, okay? I will tell you. Those are the points with respect to which they can ask a theory question, or they may give a example. They'll give a question and tell whether it is a supply or not a supply, etc., whether it is covered under this section, that section, etc. Something like this they'll ask. Now, supply means what, sir? Supply is the reason because of which you are paying GST. It is the taxable event under GST law. Supply includes all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, lease, license, rental, disposal, made or agreed to be made by a person for a consideration in the course or furtherance of business. Supply includes all the different forms of supply of goods or services or both. So whatever different forms of supply of goods or services or both, you can assume they are all included in supply. Example, sale, transfer, barter, exchange, lease, license, rental, disposal. These are the different forms of supply which is made by you or agreed to be made by you. So that supply can be made, or you can agree to make the supply on a future date by a person. That supply should be by a person for a consideration in the course or furtherance of business. So for example, if you come to Priya Sarees and purchase a sari, and if you pay some money for that sari, that transaction is treated as supply and you will have to pay GST on that transaction. Why, sir? Because the supply, 5 elements should be seen. You come to Priya Sarees, purchase the sari by paying 10,000 rupees to me. Now, if 5 elements are there in this transaction, I will call it as a supply. If it is a supply, GST is applicable. First, that supply should be of goods or services. Can I say sari is goods? That supply should be made or agreed to be made. Can I say I have made the supply to you? That supply should be by a person. Can I say I am a person? That supply should be for a consideration. Can I say you have paid some consideration to me? And that supply should be in the course or furtherance of business. Can I say there is this supply I am making in the course or furtherance of my business? Now, because all the 5 conditions are satisfied, this transaction is a supply, therefore GST will be applicable. Let us say, I have old newspapers, I sold these old newspapers, okay, for which I am getting 1,000 rupees. Now, my business is not to sell old newspaper, though there is a consideration, though there is goods, though the supply has been made by me, this transaction is not a supply because it is not in the course of furtherance of my business. Are you understanding? So as per 7.1a, if I want to call something as a supply, 5 things should be there. What are these 5 things? That supply should be of goods or services. That supply should be made or agreed to be made. That supply should be by a person for a consideration in the course or furtherance of business. Now, sir, what do you mean by goods? What do you mean by services? Definition per se, they will not ask a direct definition of this, what is the meaning of goods and services, but you should be knowing what is goods and services. Goods means every kind of movable property. So whatever is movable, that is goods. For example, my mobile phone, is it movable, sir? Yes, it is goods. This mic, is it movable, sir? Yes, it is goods. So goods means every kind of movable property other than money and securities. Now money and securities, though they are movable, they will not be regarded as goods. But goods will include actionable claims, growing crops, things attached to or forming part of land which can be further supplied. Goods will include what, sir? Actionable claims, growing crops, things attached to or forming part of land. Actionable claims means your lottery, betting activity, online money games you are paying, they are all actionable claims. Growing crops means all wheat, paddy, etc. Things attached to or forming part of land. This mangoes, mango leaf, the tree as a whole, they are all treated as goods. And whatever is forming part of land, whatever is there under the earth, crude oil is there, coal is there, etc. They are all falling under the definition of goods. What is not goods? Money and securities are not goods. What do you mean by services? Services means anything other than goods, money and securities. Whatever is not goods, money and security, that is services. And services will include activity in relation to use of money or its conversion for which a separate consideration is charged. Services will include what, sir? See, services means anything which is not goods. For example, whatever I am doing right now, this is services. I take a class house on rent, that is services. Services also shall not include money and securities, but services shall include activity in relation to use of money or its conversion for which a separate consideration is charged. Services shall include activity in relation to use of money or its conversion for which a separate consideration is charged. Activity in relation to use of money or its conversion for which a separate consideration is charged. Activity in relation to use of money or its conversion for which a separate consideration is charged. See, I give you money, you give me money, not a supply. I give you money and I charge some interest for that. I give you money for your use, I charge some interest, that interest component, now this transaction will be treated as service. Activity in relation to use of money for which separate consideration is charged. Or you give me dollars, I'll give you rupees, conversion of money for which a separate consideration is charged is service. Now what is a consideration, sir? Consideration definition. Consideration includes payment in money or otherwise by the recipient or any other person, but consideration shall not include subsidy given by central government or state government. So whatever payment you are making, either in money or otherwise, either in money means what, sir? Cash, UPI, net banking, etc. Or otherwise means what, sir? You give me wheat, I'll give you rice. Payment in money or otherwise by the recipient or any other person. Now this consideration can be by recipient or it can be by any other person, but the consideration shall not include the subsidy which is given by central government or the subsidy given by state government. Okay. Consideration also, definition also says, consideration includes monetary value of any act or forbearance by the recipient or any other person. So if any person is doing any act, take the monetary value of that particular act, that also will be considered as consideration. But it shall not include subsidy given by central government and state government. So any subsidy given by central government and state government will not form part of your consideration. Now, refundable deposits, they will also not form part of your consideration unless they are adjusted as consideration. What is the recipient, sir? Who is the recipient? Recipient, to remarks, for a particular transaction of supply of goods or services or both, who is the recipient of those goods or services? If you want to know, check for two things. Check whether the consideration is there for that particular transaction or consideration is not there. For example, I am giving this phone to you. Am I charging some money from you? Am I collecting some money from you? Am I taking any consideration from you? Or I am giving the phone to you without collecting anything? So if the consideration is there for both supply of goods and services, the person who is paying such consideration will be taken as recipient. If consideration is not there for supply of goods or services, then consideration if there is no consideration for supply of goods or services, then the person to whom the goods are delivered will be taken as a recipient in case of goods, and for services the person to whom the services are rendered will be taken as recipient. 7.1b talks about supply, which says supply includes. 7.1b also is an important section. Section 7 subsection 1 clause b says supply will include importation of services for a consideration whether in the course of business or not. Section 7b says what, sir? If you are importing any services for a consideration, whether the services are imported by you for your business purpose or not for your business purpose, it is treated as supply. Importation of services for a consideration, whether in the course of business or not. Now, what is importation of services? Importation of services is a transaction wherein the supplier, the person who is supplying the service, is located outside India, the recipient is located in India, and the place of supply is in India. So if you satisfy these three things, supplier is outside India, recipient is in India, and place of supply is in India, then the transaction will be treated as importation of services. Now, if you import any services for a consideration, whether that services are imported for business purpose or not, they will be treated as supply. 7.1c, activities specified in Schedule 1 will be treated as supply even if there is no consideration involved. So we are going to see few activities now. All those activities will be treated as supply, even if these activities are not for a consideration. See, 7.1a and 7.1b told if you want to call something as a supply, consideration should be there. But this point which you are going to see now, it says these things which you are going to learn, they will be treated as supply even if there are no consideration, also called as Schedule 1 activities. Okay, there are totally 4 activities. In these 4 cases, even if consideration is not there, they will be treated as supply. Point number 1. Permanent transfer or disposal of business asset, provided that input tax credit has been availed on such business asset. So if you have a business asset on which you have taken input tax credit, if you have a business asset on which input tax credit has been taken by you, if you are permanently transferring them, or permanently disposing them of, then it will be treated as supply, even though you are not receiving any money for transfer of that particular asset. Let us say I had a laptop which I am giving to a government school for free. I am not going to receive any consideration for this, but I had taken input tax credit on those computers and laptops. Lawmaker says it is a supply. Supply of goods or services or both between related person or between deemed distinct person as per section 25.4 and 25.5 if it is made in the course or furtherance of business. Meaning, if I supply any goods or services to my own related person, or if I supply any goods or services to a distinct person referred to in section 25.4 or 25.5, if it is made in the course or furtherance of business, then that particular transaction will be treated as supply. Now, if I give any goods or services for free to my related person or to my own branch office located, as per section 25.4 or 25.5, even if it is without consideration, it is a supply. Now, here what is important to be noted over here is employer and employee are related person, and for me, my family will be related. Who is a family? Spouse and children's. Father, mother, brother, sisters will be my related person if they are dependent on me. Now, since employer and employee are related person, any gift given by employer to the employee, if the value of the gift is not more than 50,000, it is not a supply. Now, 50,000 rupees is per employee per financial year. So, if any gift is given by employer to the employee and if the value of the gift is not more than 50,000 rupees in a year per employee, then it will not be treated as supply. Now, deemed distinct person, section 25.4 or 25.5, where a person has obtained more than one registration, whether in a state or in union territory or more than one state or more than one union territory, he shall in respect of each of those registrations shall be deemed as distinct person. So, if a person has obtained more than one registration, then each of those registrations will be deemed as distinct person. Section 25.5 says, where a person has an establishment registered in a state or a union territory and he also has another establishment in another state and another union territory, then this establishment will be treated as deemed distinct person. So if you have separate registration, you are a different person. If you have one establishment registered in a state and you have also have another branch in another state, whether that another branch is registered or not, you both are different person. So any branch transfer made will be taxable if those two branches are separately registered or those branches are in a separate state where one is registered. Then supply of goods by principal to his agent or vice versa. So if principal is supplying anything to his agent for free or vice versa, agent is supplying anything to the principal for free, where the agent is undertaking to further supply those goods on behalf of principal in his own name, where I supply something to my agent for free and agent is supplying those things to his customers for free, then this transaction will be treated as, agent is supplying this goods to customer, then whatever is supplied by me for free to the agent will be treated as supply if the agent, when he sells it to his customer, gives the invoice in my name. Then para 4, importation of services. If services are imported by a person from his related person located outside India or from his another establishment located outside India, if it is made in the course of furtherance of business. So importation of services by a person. If I am importing services from where, my related person located outside India or my another branch office located outside India, though I am importing it for free, I will call it as a supply if it is imported by me in the course of furtherance of my business. Now 7.1AA, time pass, not relevant. So activities or transactions by a person other than individual to its own members for a consideration will be treated as supply. Next, 7.2 talks about negative list of supply or no supply, again important. See, 7.1C read with schedule number 1. What are the questions which they can ask about this in examination? List down the activities which will be treated as supply even if there is no consideration, or what is deemed supply, or what are schedule 1 activities. 4 items you have to write. Next is supply without consideration or negative list of supply. A negative list of supply or no supply, or schedule 3 activities, transactions which are neither treated as supply of goods nor treated as supply of services. Section 7.2, government has notified 2 things which will not be treated as supply at all. What are these 2 things? Activities performed by panchayat or municipality as per article 243G or 243W, grant of liquor license by state government. State government is giving liquor license to you. Schedule 3 activities are important. So they have schedule number 3 has given list of some activities which will not be treated as supply at all. Which are those activities, sir? Services given by employee to the employer in the course of employment, services given by court or tribunal, services given by MLA, MP, President, Prime Minister, meaning member of Legislative Assembly, member of Parliament, President of India, Chairperson of GST Council. All those people, whatever services are given by them is not a supply. Then sale of land, and sale of building subject to para 5B of schedule 2. Sale of land is not a supply at all. Sale of building also is not a supply subject to para 5B of schedule 2, meaning para 5B of schedule 2 says check when is the consideration for the sale of building received. If the consideration for the sale of building is received before issuance of completion certificate or before first occupancy, that transaction is supply. If it is after completion certificate, after first occupancy, that transaction is not a supply. Then services by way of funeral, burial, cremation, mortuary, including transportation of deceased, not a supply. Actionable claim, sale of land, sale of building is done. Actionable claims except specified actionable claims. So if you are doing any transaction actionable claims, it is not a supply, no GST is applicable, except specified actionable claims like lottery betting, gambling, horse racing, casino and online money games. Now, 2 new additions are there in this. Apart from that, you have high C sales, warehouse sales. High C sales means what, sir? You are selling, if you are purchasing a product from outside India and selling the product to outside India without those product coming to India. Warehouse sales means you are purchasing a product from outside India. They have a high C sales means what, sir? You have imported some product and they are in high C. High C means under customs law, you will learn this. High sea means after 200 nautical miles, whatever area is there, no, that is called as high sea. Now, if you have imported some product and they are still in high sea, they have not come to India. At that time only, if you sell anyone, if you sell this product to anyone in India, then that is called as high sea sales. Or warehouse sales. You have imported some product, it has reached India, but you have kept them in customs warehouse. Now, keeping them in customs warehouse only, you sold that product to someone. That is called as warehouse sales. Next, we have out and out sales, which I told you. If you purchase a product from non-taxable territory and sell it to another non-taxable territory without the product coming to India, that means it is a warehouse sales. Sorry, out and out sales. All these transactions are not supply. Now, two new additions is activity of apportionment of co-insurance premium by lead insurer to the co-insurer for insurance services jointly supplied by them to the insured is not a supply subject to a condition that lead insurer has paid GST on the entire insurance premium. Activity of apportionment of co-insurance premium by lead insurer to co-insurer for insurance services jointly supplied by them to the insured is not a supply subject to condition that the lead insurer has paid GST on the entire insurance premium. Let us say, for example, there is a factory worth 100 crores. I have taken insurance from a general insurance company. Now, general insurance company has given this insurance services to me along with HDFC insurance. So my lead insurer, I have went to general insurance company, he is the lead insurer, and HDFC, because the general insurance company went to HDFC for giving these services to me jointly. So HDFC will be called as co-insurer. Now I will pay the premium to general insurance company. General insurance company will pay part of the premium to HDFC. Now whatever premium is apportioned by general insurance company to HDFC, on that GST is not applicable if the lead insurer has paid the GST on full 10 lakh rupees. Then services given by insurer to the reinsurer for which ceding commission or reinsurance commission is deducted from the reinsurance premium paid by the insurer to the reinsurer is not a supply subject to a condition that GST is paid by reinsurer on the gross reinsurance premium payable by insurer to the reinsurer. Let us say there is Air India flight. They have taken insurance for this flight. Insurance is taken from Tata Group. Tata AAG is the insurance company. Now what this Tata Group has done, they have reinsured this with HDFC. So now what happens, because Tata Group is giving HDFC has got services of giving HDFC is giving insurance services to Air India, and this services is something which they got through this Tata Group. This HDFC will give insurance commission to Tata Group, okay, because they may act they're acting as an agent. So whatever insurance commission is given by them, on that GST is not applicable if the HDFC is paying GST on the full reinsurance premium. On the full insurance amount, if the HDFC is paying the premium, whatever commission they have charged, given to Tata Group, on that GST will not apply. Section 7(1) capital A, activities or transaction to be treated as supply of goods or supply of services. Section 7(1) capital A of CGST Act classifies certain activities or transaction consisting of supply of a supply as per 7(1), either supply of goods or supply of services. Now what is this point telling, sir? What is this point telling? This point says what, sir? there are some activities given in schedule number 2. They are all supply as per 7.1, but they are just giving the classification whether it is supply of goods or supply of services. Okay, so just to make sure that you don't get confused. So if you transfer title in goods, that transaction is supply of goods. If you transfer title in the goods, means if you are transferring ownership of any goods, it is supply of goods. If you are transferring title in goods under an agreement which stipulates that the property in the goods shall pass on a future date upon payment of full consideration, that is also supply of goods. That is hire purchase system, that is also supply of goods. If you transfer right in goods, it is supply of services. If you transfer right in or share in undivided goods, that is also supply of services. Lease, tenancy, easement and license to occupy a land is supply of services. Lease or letting out of any building, including for commercial or business purpose, is also supply of services. Any treatment or process which is applied on goods belonging to another person, supply of services. Goods forming part of business is transferred or disposed of under direction of a person carrying on the business. Now you are disposing of goods under the direction of the owner of the business, supply of goods. Goods which is used for business purpose is put to use for personal purpose. You are just changing the use, therefore supply of services. Goods forming part of business carried on by a person who ceases to be a taxable person shall deem to be supplied by him immediately before he ceases to be the taxable person. This transaction supply of goods. Basically what is this point telling is, so if you are a person who is doing a business and if you close your business, at the time of closure of your business, whatever goods is there with you, that will be deemed to be supplied by you. Now this last point will not be applicable in two cases. If you are closing the business, if you are transferring the business to someone else as a going concern, or if the business is carried on by personal representative who is deemed to be taxable person. Renting of immobile property is supply of services. If you are involved in construction of building, civil structure, complex, etc., that is also supply of services. Except where the entire consideration has been received after issuance of completion certificate or after first occupancy, whichever is earlier. Temporary transferring or permitting to use or enjoyment of intellectual property right, supply of services. Development, design, programming, customization of information technology software, supply of services. Agreeing to an obligation to refrain from an act, to tolerate an act or a situation, or to do an act is supply of services. Then section 8 talks about taxability of composite and mixed supply. Now what is composite supply? Composite supply means supply of two or more taxable goods or services or both, which are naturally bundled in ordinary course of business, which are supplied in conjunction with another, and one among them is principal supply. That will be treated as composite supply. So if you are supplying two or more goods which are naturally bundled in ordinary course of business and they are supplied in conjunction with another, and one among them is principal supply, that is called as that particular transaction is called as composite supply. Now composite supply are taxed at the rate of principal supply. Next we have mixed supply. Mixed supply means supply of two or more individual goods or services or both. If you have two or more individual goods or services which are not naturally bundled in ordinary course of business and they are supplied in conjunction with another for a single price, then it is called as composite supply. And if it is and which is not a composite supply, then it is called as mixed supply. If it is a mixed supply is taxed at highest rate. See, naturally bundled means normally they are supplied together. For example, AC and AC remote supplied together, TV with TV remote, specs with box, they are all naturally bundled. Correct? No. If it is naturally bundled, it is a composite supply, and if it is a composite supply, apply the rate of principal supply. Now, mixed supply means what, sir? I am purchasing a toothpaste. I am getting brush free, mixed supply. I am purchasing wine bottle, I am getting glasses free, mixed supply. I am purchasing laptop, I am getting headphone free, mixed supply. So in case of mixed supply, apply the highest rate in that mixture. Next, charge under GST. Very simple basic concept. The specific section 9 talks about charge under GST. Here you just have to know 9.5. One section which you have to know is 9.5. The second thing which you have to know is the items which are taxable under reverse charge. These two things, if you know, sufficient under section 9. Charge under GST. So this is the charging section. Section 9 of CGST Act is a charging section for CGST. Section 9 of CGST Act is a charging section for CGST. Section 9 of SGST Act is a charging section for SGST. Section 7 of UTGST Act is the charging section for UTGST, and Section 5
5 of IGST is the charging section of IGST. Okay, all the sections talks about the same thing. Only thing is CGST Act will talks about CGST, SGST Act will talks about SGST, UTGST with UTGST, IGST will talk about IGST. Now under GST law, sale is called as outward supply. The tax which you have to pay on your outward supply is output tax. Under GST law, purchases are called as inward supply, and the tax which you have to pay on your purchase is called as what, sir? Input tax. Now tax payment can be under two ways under GST law. One is called as forward charge mechanism, and another one is called as reverse charge mechanism. What is forward charge mechanism? Forward charge mechanism means the supplier of the goods or services is making the payment of taxes to the government. Whoever is supplying is making the payment of tax to the government. Reverse charge mechanism means the person who is receiving the goods and services is making the payment of tax to the government. Section 9 subsection 1. I mean, you don't have to study this specifically, meaning you don't have to by heart this. Section 9 subsection 1 says, subject to the provision of subsection 2, there shall be levied a tax called as central goods and services tax on all intrastate supply of goods or services or both. So what is this point telling? We are going to levy CGST on all intrastate supply of goods or services or both except on alcoholic liquor for human consumption, and newly added point is except on denatured alcoholic liquor, which is used for denatured spirit, which is used for making alcoholic liquor for human consumption, on a value determined under section 15. Now they are going to levy a tax called as CGST whenever you make intrastate supply. On what they will levy, sir? All goods and services on the value determined under section 15 at such rates as may be notified by the government. The rate should not be more than 20%. It shall be collected in such manner as may be prescribed and paid by taxable person. So taxable person means a person who is registered or who is liable for registration under section 22 or 24. 9.2 says CGST on intrastate supply of HP man. 9.2 says what, sir? CGST on intrastate supply of HP man, high speed diesel, petroleum crude, motor spirit, aviation turbine fuel and natural gas. On these 5 things, CGST is not levied as on today, but it may be levied on a future date as may be notified by the government on the recommendation of council. 9.3 CGST on intrastate supply of notified goods or services shall be paid by recipient of that goods and services under reverse charge. So if you are receiving some goods and services, and if those goods and services are notified, meaning 9.3 says I am going to give the list of some goods and services on which you as a recipient have to pay the taxes under reverse charge. 9.4 CGST on intrastate supply of notified goods or services received from an unregistered person by notified registered person shall be paid by notified registered person under reverse charge. 9.4 says I am going to give the list of some goods and services. If you if some notified registered person purchase these things from unregistered person, then the notified registered person have to pay tax under reverse charge. Okay, what is important is that items covered under 9.3 is important. Under entire section 9 series, 9.5 is the only section which is something which you should be learning or knowing. Other sections you don't have to, I mean, you can ignore. 9.5 supply through e-commerce operator, important section. You can expect a question from this section. Supply through e-commerce operator. What does this section say? If notified services are supplied through e-commerce operator, the tax on that supply is required to be paid by e-commerce operator. So there are some services which they have notified or they have listed. If these services are supplied through whom, sir? E-commerce operator. Who has to pay the taxes? The taxes is required to be paid on those supply. The taxes is required to be paid by the e-commerce operator. Okay, if some services which they have notified, if they are supplied through e-commerce operator, the tax on that supply shall be paid by e-commerce operator. Provided that if the e-commerce operator does not have physical presence in taxable territory, then any person representing such e-commerce operator in taxable territory shall pay the taxes. So if the e-commerce operator is not having any physical presence in India, then what will happen, sir? Then any person who is representing that e-commerce operator in India should pay the taxes. Any person who is representing such e-commerce operator in India should pay the taxes. Provided further that if the e-commerce operator does not have physical presence in taxable territory and there is no representative of such e-commerce operator in taxable territory, then he shall appoint a person in taxable territory to pay the taxes. He shall appoint someone in India to pay the taxes.
So very simple. There are list of some services. Which are those services? We'll see. If these services are supplied through e-commerce operator, through means what, sir? E-commerce operator is not supplying. Someone is supplying the services, but with the help of e-commerce operator. So you are supplying the services through e-commerce operator. So in these cases, what they are telling is, if you supply notified services through e-commerce operator, the tax is required to be paid by e-commerce operator. But if the e-commerce operator does not have any physical presence in India, his representative should pay. If he does not have a representative, he should appoint a person to pay the taxes. Now, who is an e-commerce operator? E-commerce operator means a person who is owning, operating, maintaining, managing electronic platform for electronic commerce. So if you are owning, operating, maintaining, managing electronic platform for electronic commerce, that means you are an e-commerce operator. Now, notified services under section 9 subsection 5. So what are the different services covered under 9.5? There is newly added services. Services of transportation of persons, passengers, like Ola services. Accommodation in hotel, in guest house services, OYO, Make My Trip. Housekeeping services, Urban Company. Then restaurant services like Zomato, etc. And services by way of local delivery. Services by way of what's a local delivery, like we have this porter, etc. Now, in case of accommodation in hotel, in guest house, housekeeping, restaurant, and the local delivery services, if the person who is supplying the services is a registered person under GST law, then the supplier should pay the taxes and not the e-commerce operator. Now, for transportation of passenger services, who should pay the taxes? E-commerce operator. However, if the service provider is, if the person who is providing the services is a body corporate and he is registered under GST law, then the body corporate should pay the taxes and not the e-commerce operator. Now, what are the different services covered under 9.3 which are taxable under reverse charge? Important. Not everything, but few things are important. Like first thing, GTA. If a goods transport agency is giving services to 7 notified persons, if the GTA is giving services to factory, society, cooperative society, registered person, body corporate, partnership firm, casual taxable person located in taxable territory, then these 7 people will have to pay the taxes and not the goods transport agency. Then services supplied by an individual. Services supplied by an individual advocate or a senior advocate or a partnership firm of advocate by way of legal services directly or indirectly. So if an advocate, whether individual advocate or a senior advocate or a partnership firm of advocate, is supplying services to himself, business entity, the business entity has to pay the taxes under reverse charge. If arbitral tribunal is giving services to a business entity, the business entity has to pay the taxes under reverse charge. If sponsorship services are given by any person other than a body corporate to a body corporate or a partnership firm, then the body corporate or a partnership firm should pay the taxes under reverse charge. Then if any services are given by central government, state government, union territory or local authority to a business entity, the business entity has to pay the taxes under reverse charge, except renting of immovable property services, except the services given by Department of Post or the services given by Indian Railway, except services in relation to aircraft and vessel inside or outside the presence of ports or airports, except transportation of goods and transportation of passenger services. Services supplied by central government, if services are supplied by central government, state government, union territory, local authority by way of renting of immovable property, if renting of immovable property services are given by government to a registered person, the registered person has to pay the taxes under reverse charge. Renting of residential dwelling, if renting of residential dwelling is done by any person other than, if renting of residential dwelling is done by any person to registered person, if any person is renting a residential dwelling to a registered person, the registered person has to pay the taxes under reverse charge. Then services by way of renting of immovable property other than residential dwelling. So if any person is renting immovable property other than residential dwelling, if any person is renting immovable property other than residential dwelling, then the person to whom he is renting, if he is a registered person, he will pay the taxes under reverse charge. Then services given by director of the company to the company should pay the taxes under reverse charge, except the services given by the director in his personal capacity. Insurance agent, recovery agent giving services to insurance company or banking company, financial institution, the insurance company, banking company has to pay the taxes and reverse charge. Music composer, photographer, artist or author is giving services to music company, producer, publisher, they should pay the taxes and reverse charge. Overseeing committee of RBI is giving services to RBI, RBI should pay taxes and reverse charge. Individual direct selling agent, business facilitator, agent of business facilitator is giving services to banking company, NBFC, they should pay the taxes and reverse charge. Security services, meaning supplying manpower. Security services are provided by any person to a registered person, then that registered person has to pay the taxes and reverse charge. Renting of immovable property, renting of motor vehicle services given by any person other than a body corporate to a body corporate should pay the taxes under reverse charge. Now anyways, in all these things, points which you saw, what are important points? One is GTA services is important. GTA giving services to 7 notified persons, 7 notified people should pay the taxes and reverse charge. Legal services given by advocate to a business entity has to pay the taxes and reverse charge. Important service, very important. Then arbiter, tribunal, normal, they will not test. Sometimes they may test this. Sponsorship services given by any person other than body corporate to a body corporate should pay the taxes and the reverse charge. Any services given by government to a business entity should pay the taxes and reverse charge except RIP gap, renting of immovable property, Department of Post, Indian Railway, services by aircraft and vessel, transportation of passenger, transportation of goods. Renting of immovable property given by government to a registered person except Indian Railway, that registered person has to pay the taxes under reverse charge. Renting of residential dwelling to a registered person. Now, if it is given to a registered person, always taxable under reverse charge. Renting of immovable property by any person, any unregistered person to a registered person except composition dealer, that registered person has to pay tax under reverse charge. Director of the company, if you are an employee director, whatever services are given by you is not a supply, therefore no GST. If you are not an employee director, your services is treated as supply and it is taxable under reverse charge. Next, section 10 talks about composition levy. Section 10 talks about what, sir? Composition levy. 1 second. I'll drink water and come. Okay, composition levy, section number 10. Composition levy means what, sir? Paying tax at a lesser rate. Instead of following all the provisions of GST law, just follow some provisions of GST law. Composition levy. So see, a person who is doing business, under GST law, you will have to take registration under GST if your turnover is more than 20 lakhs. If your turnover is more than 20 lakhs, aggregate turnover is more than 20 lakhs, you are liable for registration under GST law. Now, you have two options to take registration. You can either take registration as a composition dealer or regular dealer. See, normally a person who is doing business, if his turnover is not more than 20 lakhs, he is not a registered person. But if he wants to take registration, then he has two options. One is he can take registration as a composition dealer or he can take registration as a regular dealer. Now, if you take registration as a composition dealer, you will have to follow one section called as section number 10. You will have to file only one return in a year, which is, we will see what is the type of return, and you will have to pay taxes on quarterly basis once in 3 months. But if you are a regular dealer, you will have to file, follow all the sections except section number 10. You will have to file 2 returns every month. You will have to pay taxes on monthly basis, etc. Okay, these provisions are there. Section 10 talks about what's a composition scheme. Okay, now composition scheme basically is a benefit given to those people who are liable for registration whose turnover is more than 20 lakhs, but they want to follow lesser provisions of GST law. They cannot follow the complicated provisions of GST law. Section 10 subsection 1 talks about eligibility. Now, who is eligible to become a composition dealer? A registered person whose aggregate turnover in the preceding financial year did not exceed 1.5 crores may opt to pay tax at composite rates instead of paying the tax at regular rates. So, if you are a registered person whose aggregate turnover in the preceding financial year did not exceed 1.5 crores. So, if you are a person who is taking registration under GST law and your aggregate turnover did not exceed how much, sir? 1.5 crores, if your aggregate turnover did not exceed 1.5 crores in the preceding financial year, then you have an option to pay the tax at composite rates instead of paying the tax at regular rates. Now, what are these composite rates? For manufacturer, it is 0.5% of turnover in the state. For restaurant or outdoor catering, it is 2.5% of turnover in the state. And for all other dealers of goods, it is 0.5% of taxable turnover in the state or union territory. Manufacturer, 0.5% of turnover in the state. Restaurant or outdoor catering, 2.5% of turnover in the state or union territory. And for all other dealers of goods, 0.5% of taxable turnover in the state or union territory. Now, this limit of 1.5 crores will be 75 lakhs for 8 special category states. There are totally 11 special category states, but only for 8 special category states, the limit is 75 lakhs. Which are these 8 states? Nammast. Nammast means what, sir? For Nagaland, Uttarakhand, Manipur, Meghalaya, Mizoram, Arunachal Pradesh, Sikkim and Tripura, the limit will be 75 lakhs instead of 1.5 crores. Okay. Now, this limit of 1.5 crores, the government has the power to increase the limit up to 2 crores. And if you are a registered person who is otherwise eligible to pay tax under section 10(1), you can supply services up to 10% of the turnover in the state or 5 lakh rupees, whichever is higher. So, if your turnover is, see, please note, if you are a person who is eligible to pay tax under section 10(1), meaning if you can become composition dealer as per section 10 subsection 1, then you can supply services. How much services can I supply, sir? You can supply services equivalent to 10% of the turnover in the state or union territory or 5 lakh rupees, whichever is higher. Whichever is what, sir? Higher. 10% of turnover or 5 lakh rupees, whichever is higher. Now, please note, if the registered person has a place of business in special category states, then the limit of special category states will apply to entire India. So, if you are doing business in that Nagaland, Uttarakhand, Manipur, Meghalaya, etc., then for you, instead of 1.5 crores, the limit of 75 lakhs will be applicable for whole of India. Then, while calculating, interest income shall not be added while computing value of services as per second proviso. So, to find the value of services over here, do not include interest income. Value of aggregate turnover to check the eligibility of scheme. To check whether a person is eligible or not eligible, you will have to find the value of services. While computing that, also do not take into consideration interest income. Turnover in the state or union territory while calculating tax liability of composition dealer. To check whether a composition dealer, to check the tax liability of a composition dealer, we take turnover in the state or union territory. Do not consider the interest income in considering this also. So, while finding the aggregate turnover to check whether he is eligible or not, while finding the tax amount or while finding the value of services, do not consider what incomes are interest income. Section 2 subsection 6 or section 2 clause 6 talks about aggregate turnover. Very important definition. This is the definition which you should remember along with section number. Section 2 clause 6. Aggregate turnover means aggregate value. Aggregate means what's a total? Total turnover. Aggregate turnover means aggregate value of all taxable supplies, exempt supplies, export of goods or services, interstate supply to a person having same PAN. Aggregate turnover means what's a total turnover. Total aggregate means what's a total. Aggregate turnover means the aggregate value, the total value of all the types of taxable supplies which you are making, all the types of exempt supplies which you are making, all export of goods or services, all interstate supply to a person having same PAN. This aggregate turnover, when you are calculating, you should calculate it on all India basis, meaning in the entire India, irrespective of how many branches you have, irrespective of how many types of businesses you have, everything should be taken. If they are all under the same PAN, everything should be totaled while calculating aggregate turnover. While calculating aggregate turnover, please do not include the taxes under GST like CGST, SGST, IGST, and do not include the inward supply liable for reverse charge. Okay, don't include these two things. Now, taxable supplies means those supplies on which you have to pay taxes, which are taxable under GST law. Exempt supplies means supplies which are nil rated, which are wholly exempt, and it includes non-taxable supplies. Non-taxable supplies means what, sir? Alcoholic liquor for human consumption, HP man, high-speed diesel, petrol and crude motor spirit. Export of goods or services is also called as zero rated supply. Zero rated supply means supply export of goods or services or supply made to an SEZ unit or SEZ developer. Now please note, while calculating aggregate turnover, you should not include taxes under GST and inward supply liable for reverse charge. But if you have outward supply liable for reverse charge, yes, you should include that in calculating aggregate turnover. Section 10 subsection 2 talks about conditions. Condition means what, sir? If you become a composition dealer, what are the different conditions which are required to be followed by? A registered person who is eligible to opt for composition scheme under section 10 subsection. A registered person will be eligible to opt for composition scheme under section 10 subsection 1 if he is not engaged in supply of services except those mentioned in section 10.1. So, if you want to become a composition dealer, you should not supply services. You can supply services which are mentioned in 10.1. What is mentioned in 10.1? Outdoor catering. What is mentioned in 10.1? Up to the certain limit services you can supply. Then, a person who wants to become a composition dealer as per section 10.1, he should not be engaged in making non-taxable supplies. Please note, conditions will be applicable only if you opt for composition scheme. So, if you want to become a composition dealer, you cannot make non-taxable supplies. What is non-taxable supplies? HP man, alcoholic liquor for human consumption, etc. Then, if you want to become a composition dealer, you should not be engaged in making interstate outward supply. You should not be engaged in making what's the interstate outward supply. You should not make an supply to another state, interstate outward supply. However, you can make interstate inward supply. You can purchase from another states. If you want to become a composition dealer, he should not be engaged in supply through e-commerce operator who is required to collect taxes under section 52. Then, if you want to become a composition dealer, you cannot manufacture notified goods. Pan masala, aerated waters, tobacco products, ice cream, bricks, roofing tiles, etc. And if you want to become a composition dealer, you cannot be a casual taxable person or non-resident taxable person. Meaning, if you are a casual taxable person or non-resident taxable person, you cannot become a composition dealer. Further, if there are more than one registered person under the same PAN, if there is more than one registration, then everyone should become composition dealer or everyone should become regular dealer. One person becoming composition, one person becoming regular, not allowed. Section 10.2a, important section. Now, section 10.1 talks about composition scheme for supplier of goods and restaurant services or outdoor catering services. But if I am supplying only services, can I become a composition dealer under 10.1? No, condition said that. But there is a section for you called as section 10.2a, which talks about composition scheme for service provider. Section 10.2a, composition scheme for service provider. Eligibility. Who is eligible over here? A registered person who is not eligible to apply for composition scheme under section 10.1 and whose aggregate turnover in the preceding financial year did not exceed 50 lakh rupees and who is exclusively supplying services other than those mentioned in 10.1. Please. Section 10.2a is composition scheme for service provider. Who are those people covered over here? If you are a person who is not eligible to become a composition dealer as per 10.1, if your aggregate turnover is up to 50 lakh rupees and if you are exclusively supplying services other than those services mentioned under 10.1, then you are covered under 10.2a. What are the composite rates applicable to you? The composite rate applicable to you will be 3% of turnover in the state or union territory. 3% CGST, 3% SGST, effectively rate is 6%. So a service provider can become a composition dealer under 10.2a if his aggregate turnover is not more than 50 lakh rupees. Now, what are the conditions applicable to service provider over here? The conditions applicable to him will be same. Whatever conditions are applicable to a normal composition dealer, meaning he should not make interstate outward supply, he should not supply notified goods, he should not supply non-taxable goods, he should not make non-taxable supplies, etc. All those conditions are applicable except the condition of supply of services. 10.3, composition scheme will lapse. Meaning that in the current year, your composition scheme will lapse. When will your composition scheme lapse in the current year? Lapse means it will go away. Meaning you will no more be applicable, you will no more be a composition dealer. A composition scheme shall lapse in the current financial year if your aggregate turnover crosses the specified limit of 1.5 crores, 75 lakhs or 50 lakh rupees. So in the current year, if your turnover crosses 1.5 crores or 75 lakhs or 50 lakhs, then your composition scheme shall lapse. You will no more be a composition dealer. Meaning from that date onwards, you will be a regular dealer. And if you are a regular dealer, you will have to pay tax at normal rates. And the period before this, because you were a composition dealer, you will have to pay taxes at composite rates. Next, section 10.2a. A composition dealer, section 10.2a. A composition dealer cannot collect taxes on his supply. Meaning he cannot give a tax invoice. He cannot collect taxes from customers. And he cannot take input tax credit, and whatever tax he has to pay from his own pocket. He cannot take input tax credit ka benefit also. Section 10.5, time pass. See, a composition dealer cannot issue tax invoice. Therefore, what is the document which is going to issue, sir? The document which is going to issue is called as what, sir? He will issue a document called as bill of supply. 10.5, notice by proper officer. If the proper officer has a reason to believe that a taxable person has opted for composition scheme, even though he is not eligible, then the proper officer shall issue a notice to such person. And such person will have to respond to that notice. If the reply is satisfactory, very good. If reply is not satisfactory, then you will have to pay taxes at regular rates, and also penalty provisions under 73 and 74 may apply. Rules applicable for them. Rule number 3 and rule number 4. Rule number 3, opting for composition scheme. Rule number 4 talks about effective date of composition scheme. Intimation to opt for composition scheme. If you are a person who is applying for new registration, then at the time of making an application for registration, you will have to intimate that you want to become a composition dealer. So this registration application will have two parts, part A and part B. Part A of registration application will talk about part B of registration application. When you are filling, you should make an intimation that you want to opt for composition scheme. If you are already a registered person, then you can still opt for composition scheme, but this you will have to do before the beginning of the next financial year by making an application in form GST CMP 02 before the start of next financial year. And validity will be what, sir? If you are applying for a new registration, validity will be from the date of grant of registration. If you are a person who is already registered, then from first day of the next financial year. Rule 5, other conditions for a composition dealer. A composition dealer will have to mention the words composition taxable person on his name board, sign board. A composition dealer will have to write on his bill of supply that he is a composition taxable person not eligible to collect the taxes on his supply. Then he will have to pay taxes at normal rates for inward supply, liable for reverse charge. Then he has to file a return called as GSTR 4. The due date important from an MCQ point of view. Okay, this chapter they may test you on MCQ. Aggregate turnover is most important in this chapter. Then, and limits are there, 10 lakh. This 1.5 crore, 75 lakhs important. He has to file a return annually. The return which is recorded filed by him is called as GSTR 4. The due date of filing this return is 30th June of next financial year. He has to pay taxes on quarterly basis by using a form called as form GST CMP 08. On quarterly basis, he should pay the taxes. And due date of paying taxes is what, sir? 18th of next month following the quarter. Now, what is the so due date is 18th of next month following the quarter. What is a quarter? Quarter is a period of 3 months starting from 1st of January. So January, February, March, April, May, June, July, August, September, etc. This is the quarters. 18th of next month, you should pay the taxes. Now, before time of supply, let me check if there is any question with respect to these concepts. This is value of supply. Discuss the eligibility of composition levy. Bharat and Sons, a partnership firm based in Lucknow, Uttar Pradesh, is registered trader in electronic dealer. The aggregate turnover for the financial year 24-25 is 1.2 crores. and he has provided for the financial year 25-26, which is this year. They have provided the following details of their outward supply. Intrastate outward supply 80 lakhs, intrastate supply through e-commerce operator 15 lakhs, intrastate supply of exempted goods 5 lakhs, interest received on bank deposits should not be included in aggregate turnover, correct? Additionally, he made inward supply of 2 lakh rupees from unregistered person on which GST is payable under reverse charge. On this also will not be included in aggregate turnover. So what is the total aggregate turnover, sir? 80 plus 20 is 100 lakhs. This is aggregate turnover. Calculate the GST. Okay. If assuming they have opted for the scheme. So is he eligible for the scheme? Yes, he is eligible for the scheme. What is the GST which he has to pay, sir? Now, because he is a trader, registered trader, a trader has to pay tax on taxable supplies only. So he will pay tax on how much, sir? So yes, he is eligible because the turnover is 1 crore. Now he will pay tax on 80 lakhs plus 15 lakhs into what is the rate of tax which he has to pay? Trader has to pay at 0.5% of turnover in the state. So 0.5% CGST, 0.5% SGST. 95 lakhs into 0.5%. 47,500. 47,500 CGST and 47,500 SGST. Okay, so this is the tax which he has to pay, plus under RCM also he will have to pay tax on 2 lakh rupees into 18%, which is 36,000 rupees. So let us see whether our answer is right. Threshold limit, since Uttar Pradesh is not a special category state, the limit of 1.5 crores is applicable. Preceding financial year, the turnover was 1.2 crores, which is within the limit. E-commerce nuance, under notification 36/23, a composition dealer can now make intrastate supply through e-commerce operator. Yes, he can make supply through e-commerce operator, but within the states, of course. Exclusion, interest income shall, interest received on deposit shall be excluded from aggregate turnover. Status, eligible to offer composition scheme. So they have just given the summary. They have not calculated the aggregate turnover, etc. Okay. What is the tax he has to pay? 47,500. That is what we also got, 47,500. And tax payable and reverse charges 18,000, 18,000. 18% I wrote, so 9% CGST, 9% SGST, which is 18,000, 18,000. Okay. Time of supply, value of supply, place of supply. 3 topics, 1 question, 7 marks. If you are lucky, they can ask you 2 questions. So what are the topics, sir? Time of supply, place of supply, value of supply. 3 questions, 3 topics, 1 question will be asked. See, in between, under levy and collection, no, you also have a chapter called as exemption, meaning you also have a concept called as exemption under levy and collection. But what I have noticed is, under exemption topic, just read it as a newspaper. Just read it as a newspaper. You don't have to by-heart anything under exemption. Exemption is majorly asked in your final level. See, introduction is done. Levy and collection, we discuss section 7, 8, 9, 10. 11 is exemption. 11 is something which is there in your final level. They have just given the list of all the items which are exempt. So just read that list. Normally, just meaning you don't have to read it so that you can by heart or understand. Just read it as a newspaper. Exempt means what, sir? Whether that particular transaction is exempt or not. Understand one thing. If it is required for normal human being, if something is required for public interest, that item will be exempt. Like healthcare services, required for normal human beings. Correct? No. So healthcare services are exempt. Education, basic education, 10th standard, 11th standard, 12th standard, degree college, all those educations are required. So on that GST will not be collected. Exempt. Now we are seeing what's the basic concept of time of supply, value of supply, place of supply. We will see the basic concept of now we will see time of supply, then place of supply, then value of supply. Yeah, whatever topics are there. Yeah, we'll start. No problem. Okay. time of supply, place of supply, value of supply. All the three chapters are very simple. One question will be asked for 7 marks. See, from introduction 1 7 marks question came, Levian collection 1 7 marks question. Now time of supply, value of supply, place of supply. Normally they will test a question on value of supply, if not place of supply. Time of supply, because it is a very easy chapter. Input tax credit and computation combined together, one question will come. Then registration, tax invoice, debit note, credit note, etc. These are all small chapters. We'll cover this. We'll complete this today only. Another maybe 2.5 hours or 2 hours is required. Time of supply. Time of supply means what, sir? At what point of time did the supply take place? What is this chapter talking all about? At what point in time did the supply take place? What is the time of supply? Why is this chapter important, sir? Why is this chapter important? Why is time of supply chapter important? Because this is going to tell me when I am supposed to or when I am liable to pay the taxes to the government. So section 12 talks about time of supply of goods. Section 13 talks about time of supply of services. And we also have section 14 which talks about time of supply whenever there is a change in rate of tax. Now before understanding this chapter, what is important for us to understand is the due date of issuing invoice. Section 31, which we will see later, talks about when is the invoice required to be issued by a person. When are you supposed to issue the invoice? For goods, when should I issue the invoice? If the supply involves movement in goods, invoice is required to be issued on or before removal of such goods. If you are making a supply and if that supply involves movement in goods, let us say I supplied sarees from Bangalore to Chennai. Of course, goods will move from Bangalore to Chennai. So in such cases, invoice is required to be issued on or before removal of such goods. If supply does not involve movement in goods, invoice shall be issued on or before delivery of such goods. If no movement is there, let us say you came to Priya Sarees, purchased a saree, I give you the saree at that location only, from my side there is no movement happening. The invoice is required to be issued at the time when the goods are delivered to you. In case of continuous supply of goods, what's that? Continuous supply of goods means goods are supplied to you on continuous basis or on recurrent basis under a contract. In such cases, the due date of issuing invoice will be successive statement date or successive payment date, whichever is earlier. In case of sale on approval basis, invoice is required to be issued on or before approval or within 6 months from the date of removal, whichever is earlier. Services. In case of services, when should I issue the invoice, sir? In case of services, normally I should issue the invoice on or before completion or within 30 days from the date of completion. In case of services, I should issue the invoice on or before completion or within 30 days from the date of completion. Now this 30 days will be replaced by 45 days if I am a banking company, financial institution, NBFC or any other insurance company. And in case of continuous supply of services, the invoice is required to be issued based on 3 different scenarios. If the contract between the supply, if the continuous supply contract has given the due date of payment, if the due date of payment is ascertainable, then the invoice is required to be issued by you on or before the due date of payment. If the due date of payment is not ascertainable, invoice is required to be issued on or before receipt of payment. If the payment is linked to completion, the invoice is required to be issued on or before completion. Time of supply of goods. So first point, section 12 subsection 1, time of supply of goods. Section 12 subsection 1, the liability to pay tax in case of supply of goods shall be the time of supply as determined under section 12. So if you want to know when you are liable to pay taxes in case of supply of goods, then please go refer to the provisions of section 12. Section 12 subsection 2 talks about time of supply of goods in case of forward charge. Okay, forward charge means the supplier has to pay the taxes, correct? If I have supplied something to you, on that supply, as a supplier, I'll have to pay the taxes. If I have to pay the taxes, when should I pay the taxes? If you want to know that, you go to this provision. By the way, before I continue, see 88 questions on GST. There is a PDF, on the main channel, ArivuPro channel, I have uploaded a video. We have uploaded the video, I have recorded a video, and that video has been uploaded, wherein 88 questions on GST is solved. You can refer to those questions. Okay, all the questions, I mean, good questions are solved over there. Refer to those questions. You solve those questions. You will have fair idea about this beautiful concept called as GST. Okay, GST will be completely taken care of if you solve all those questions. Section 12 subsection 2, time of supply of goods in case of forward charge. Check whether the invoice has been issued within the due date under section 31 or invoice is not issued within the due date under section 31. If the invoice has been issued within the due date under section 31, time of supply will be date of invoice or date of payment, whichever is earlier. If invoice is not issued within the due date under section 31, time of supply will be the last day to issue invoice under section 31 or the date of payment, whichever is earlier. What is the last day to issue invoice? As per section 31, we just know so. Now, what is date of payment? Sir, date of payment is the date on which entry has been made in the books of accounts or the date on which the amount is getting credited to the bank account, whichever is earlier. Now, we have a notification called as notification number 66/2017, which says if you receive any money before making the supply, then the date of receipt of money will not be taken as time of supply. In simple words, for determining time of supply of goods, date of payment shall not be taken into consideration. Who says? Notification number 66/2017. So because of above notification, which is notification number 66/2017, for supply of goods, the time of supply will be date of invoice or last day to issue invoice as per section 31, whichever is earlier. Then section 12 subsection 3, time of supply in case of goods reverse charge. That in case of reverse charge of goods, time of supply will be date of receipt of goods, date of making the payment, or date following 30 days from the date of invoice or any other document issued, whichever is earlier. Vouchers concept has been removed. In residual cases, if you are a person who is liable to file return, all these are not that relevant. So in residual cases, if you are a person who is liable to file the return, the time of supply will be the due date of filing return. In all other cases, the time of supply will be date of making the payment of taxes. Section 12 subsection 6 talks about time of supply in case of interest, penalty, late fee for delay in payment of consideration. If there is any interest, penalty, late fee charged by you for delay in payment of consideration, for that interest, penalty, late fee, the time of supply will be date of receipt of such amount. Time of supply of services, section 13. Section 13 subsection 1 says, if you want to know when you are liable to pay taxes in case of supply of services, then you should go refer to the provisions of section 13. You should go and refer to what provisions, sir? You will have to go and refer to the provisions of section 13. If you want to know when you are liable to pay taxes in case of supply of services. Section 13 subsection 2, time of supply in case of forward charge. In case of forward charge, check whether the invoice has been issued within the due date under section 31 or invoice is not issued within the due date under section 31. If the invoice has been issued within the due date under section 31, then date of invoice or date of payment, whichever is earlier. Date of invoice means the date which is mentioned by you on the invoice. Date of payment is book entry date or bank credit date, whichever is earlier. If invoice is not issued within the due date under section 31, the time of supply will be date of completion or date of payment, whichever is earlier. Date of completion. Here, what will I take, sir? Here I will take a date of completion. Here I will take what, sir? Date of completion or date of payment, whichever is earlier. Date of completion or date of payment, whichever is earlier. Now it has a proviso also, proviso to section 13 subsection 2, which says, provided that if you receive any amount up to ₹1,000 in excess of invoice value, then the time of supply for such excess amount at the option of the supplier will be taken as the date of issue of invoice for such excess amount. Now this is important because there is a new addition to this point. Section 13 subsection 3. Please note, time of supply more important when compared to goods, it is services. Time of supply of services is something which they normally test in the examination. Time of supply of what, sir? Services. Time of supply of services under reverse charge. Date of making payment or date following 60 days from the date of invoice or any other document issued by supplier, or date of issue of invoice by recipient if recipient is required to issue the invoice, whichever is earlier. See, now what is happening over here is, before there were only these 2 points. For services liable for reverse charge, the time of supply is date of making the payment or 61 days from the date of invoice. Date following 60 days is nothing but 61st date from the date of invoice or any the document issued by supplier, whichever is earlier. Now the new addition is this point. If the supplier does not issue the invoice, what will you do, sir? If the supplier has not issued the invoice, then the recipient has to issue the invoice. So if date of issue of invoice by the recipient, if the recipient has issued the invoice. Now, if I am taking some services which are taxable under reverse charge, for those services I have to issue the invoice. When should I issue the invoice, sir? Lawmaker says, where the recipient is liable to issue the invoice for supply taxable under reverse charge under section 9.3 and 9.4, then such invoice shall be issued within 30 days from the date of supply of goods or services. Meaning, if I as a recipient is liable, if I am liable to issue the invoice for supply taxable under reverse charge under 9.3 or 9.4, then such invoice should be issued by me within 30 days from the date of supply of goods or services. So if supplier did not issue the invoice, I have to issue the invoice, and I should issue the invoice within 30 days from the date of receipt of those goods or services. Now in case of importation of services, recipient has to pay the taxes under reverse charge. So when should I pay the taxes? Same, this concept is applicable. Date of making the payment 61 days from the date of invoice, or date of issue of the invoice if the invoice is issued by recipient. Now if you are importing services from your own branch outside India, time of supply in such cases, time of supply in case of services received or imported from an associated enterprises, your own branch outside India, will be date of making the payment or date of entry in the books of accounts, whichever is earlier. Date of making the payment to them, or the date which the date on which you are making an entry in your books of account that I have received the payment, whichever is earlier, will be taken as time of supply. Here also this vouchers is removed. Then residual cases is same. If you are a person liable to file return, due date of filing return. If you are all other cases, date of making the payment. And section 13 subsection 6, time of supply in case of interest, penalty, late fee for delay in payment of consideration will be date of receipt of such amount. That is all about time of supply. Section 14 is there, talks about time of supply in case of change in rate of tax. In case of change in rate of tax, 2 possibilities are there. Supply can be made before change in rate of tax, or supply can be made after change in rate of tax. What you should remember is, date of supply can never become time of supply. So who will be time of supply? Either date of invoice will become time of supply, or date of payment will become time of supply. Now whoever is with supply, meaning if the invoice and supply is before change and payment is after change, then date of invoice will be taken as time of supply. Similarly, if supply and payment is before change, whereas invoice is after change, then the date of payment will become time of supply. Similarly, same is vice versa. If the payment is before change and supply and invoice is after change, date of invoice will be taken as time of supply. If invoice is before change and supply and payment is after change, date of payment will be taken as time of supply. So there, basically in simple words, in case of change in rate of tax, whoever is with supply, that person is becoming time of supply. Meaning either invoice or payment, any one among them only can become time of supply. Who will become either the invoice date or the payment date? Whoever is with supply, they will become time of supply. Now what if invoice and payment both are not with supply, or what if all the three are together? Then also invoice or payment, whichever is earlier, will become the time of supply in case of change in rate of tax. Next, value of supply. Value of supply means what, sir? Value of supply means value of supply. So what is the value? What is the value? One second. Section 15 talks about value of supply. Value of supply means what, sir? On what amount should I pay GST? Section 15 says 15 subsection 1, 15.2, 15.3, 15.4 and 15.5 are there. 15.1, 2, 3 are important from exam point of view. Okay, these are the three which is important from exam point of view. 15.4 and 5 talks about rules. That also we'll see. Section 15 subsection 1, value of supply, practical question. They'll ask you to compute the value. Section 15 subsection 1 says value of supply. What is value of supply, sir? Section 15 subsection 1 says value of supply is transaction value. What is value of supply, sir? Value of supply is transaction value. What do you mean by transaction value? Transaction value means the price which is actually paid or payable for supply of goods or services or both, where the supplier and the recipient are not related and the price which you are paying is the sole consideration. Section 15 subsection 1 talks about value of supply. What is value of supply? Value of supply is transaction value. What is transaction value? Transaction value means the price which you are actually paying or which is payable. The price which you are actually paying or which is payable for supply of goods or services or both, where the supplier and the recipient are not related and the price which you are paying is the sole consideration. Now, are there anything which is required to be included in value of supply? Yes. You can include these things in value of supply. 5 things are there. What can you include in value of supply? All taxes except the taxes under GST law if they are charged separately. What can be included, sir? All taxes except the taxes under GST law if they are charged separately. Any payment made by the recipient which the supplier had to incur. All taxes except the taxes under GST law. So when you are making the supply, if any tax is levied on that supply, like for example, custom duty is levied, property tax, pollution control tax, any type of taxes, municipal taxes are levied, they will all be added in value of supply except the taxes under GST law, except CGST, SGST, IGST, all those taxes will not be levied. Apart from that, any other type of taxes will be levied. Any payment made by the recipient which the supplier had to incur. If supplier had to incur some expenditure, but if that expenditure is incurred by recipient, that also will be added in value of supply. Any expenses incurred by recipient which the supplier had to incur. Incidental expenses for anything done to make the supply. So for making the supply, if I have incurred any incidental expenses like transportation, insurance charges, etc., that also will be added in value of supply. Interest, penalty, late fee for delay in payment of consideration. For making the supply, if I have incurred expenditure for by way of interest or penalty or late fees, etc., meaning I supplied the goods to you, I told you to make the payment within 30 days. If you make the payment within 30 days, okay. If you don't make the payment within 30 days, I will levy penalty of 10,000. I will levy what, sir? I will levy a penalty of 30,000. So now this 30,000, a penalty of 10,000 rupees. Now this 10,000 rupees ka penalty which is there, will I get this penalty, sir? Will I get this penalty? Sorry, this 10,000 rupees ka penalty which is there, I will get only if you pay after 30 days. So till that 30 days is completed, I don't know whether I am going to get this extra 10,000 or not. Now, if there is any interest, penalty, late fee for delay in payment of consideration, that will be added in value of supply. When will it be added in value of supply? If I received it, correct? Subsidy directly linked to the price, excluding the subsidy given by central government or state government. So if there is any subsidy, which is directly linked to the price, now it does not matter whether the subsidy is given by central government or state government, that subsidy will be added in value of supply. If there is any subsidy which is directly linked to the price. Directly linked to the price means because of this subsidy that the price is increasing or decreasing, that subsidy will be added in value of supply. Except the subsidy given by central government or state government. Meaning what, sir? If the subsidy is given by central government or state government, it will not be added in value of supply. I told Ulta. Then, so what should be included in value of supply? 5 things. All taxes except the taxes under GST law. Any payment made by the recipient which supplier has to incur. Incidental expenses for making the supply, interest, penalty, late fee for delay in payment of consideration, and subsidy directly linked to the price, excluding the subsidy given by central government or state government. Section 15 subsection 3, exclusion from value of supply. Now, what are the different things which can be excluded from value of supply, sir? Lawmaker says you can exclude only one thing from value of supply, which is discount. Only discount can be excluded from value of supply. Now, this discount can be of 2 arrow marks. Only discount can be excluded from value of supply, and this discount can be 2 arrow marks. Discount can be before or at the time of supply, or discount can be after supply. If the discount is before or at the time of supply, exclude it from value of supply if they are shown separately on the invoice. And if the discount is after supply, exclude it from value of supply if following 3 conditions are satisfied. What are the 3 conditions? See, if the discount is given before or at the time when the supply is made, exclude. If it is shown separately, discount amount is shown separately on the invoice, exclude. But if the discount is after supply, exclude it from value of supply if 3 conditions are satisfied. Condition number 1, it should be agreed between supplier and recipient. Condition number 2, it should be linked to specific invoice. Condition number 3, such discount should be, ITC on the discount should be reversed in the books of account by the recipient. ITC on the discount should be reversed by the recipient. Then there is a clarification telling TCS collected under income tax law shall not be included in computing the value of supply. Now we have rules for valuation. Rule number 27. So section 15.4 says if you are not able to determine the value of supply as per section 15.1, then determine as per rules. Rules is what is given in CGST rules. We will see that. In rules, what is important rules are section 20, rule number 27, 28, but most important is 32. Rule number 27, value of supply of goods or services where the consideration is not wholly in money. So where the consideration, section 20, rule number 27 talks about value of supply of goods or services where consideration is not wholly in money. So when the supply of goods or services or both is for a consideration which is not wholly in money, the value of supply shall be open market value. So for example, there is a mobile phone which I am which is worth rupees 25,000. I am purchasing this mobile phone. How am I purchasing this mobile phone? I am purchasing this mobile phone by giving 20,000 and my old phone. Now what is happening over here? There is a consideration involved, but consideration is not fully in money. Yes, there is a consideration in money, but there is something else also which I am giving. When the consideration is not wholly in money, value of supply will be the open market value of this product. What is open market value? 25,000, that will be value of supply. So what if open market value is not available? If the open market value is not available, then the value of supply will be money plus fair market value of other consideration. If money plus fair market value of other consideration is not available, then value of like, kind and quality. If value of like, kind and quality is also not applicable, then rule 30-31 in that order will be taken as value of supply. You take money plus apply rule number 30-31 in that order. Now, what if you are making a supply to your agent? If you are making a supply to your agent or your related person or distinct person referred to in 25.4 or 25.5, except through agent. If you are making supply to a related person or distinct person referred to in section 24.4 or 24.5, in such cases value of supply will be open market value. If open market value is not there, value of like, kind and quality. If value of like, kind and quality is also not there, then I will apply rule number 30 and 31 in that order to find the value of supply. There are 2 provisos provided that if the goods are intended for further supplied by the recipient as such, at the option of supplier, the value can be taken as 90% of the amount charged by the recipient from his customer. Meaning, if I supply anything to my branch and if my branch is supplying it to their customer, whatever they are charging from the customer, 90% of that can be taken by me as my value of supply if this customer and they both are not a related person. And of course, this is an option given to me. Provided further that if the recipient is eligible for full input tax credit, then the value declared on the invoice will only be taken as open market value. So if the person to whom I am making the supply, if he is eligible for full input tax credit, then whatever value I am charging him, whatever value is declared on the invoice, that only will be taken as open market value. Rule number 29 is applicable when you make a supply to your agent or when the supply is made by agent to you free of cost. The value of supply in such cases where the supply is between principal and agent shall be the open market value. or at the option of supplier 90% of the amount charged by the recipient from his customer who is not a related person. And if that is not available, then apply rule number 3031 in that order to find the value. Sir, you are telling apply rule number 3031 in that order to find the value. What is rule number 30 and rule number 31? Rule number 30 talks about cost based value. Cost based value means what, sir? Rule number 30 says value of supply will be 110% of cost. 110% of cost of production, cost of purchase, or cost of providing services. Whatever is the cost of production, cost of purchase, cost of providing services, add 10% to that, that will be value of supply. Meaning basically find your cost. If you cannot find your sale price, no problems, find your cost. Cost into cost plus 10% is the value of supply. Rule 31, residual method for determining the value of supply of goods or services or both. Where the value of supply of goods or services or both cannot be determined as per rule 27 to rule 30, then the same shall be determined by applying the provisions of section 15 consistently and reasonably. So if you cannot determine the value of supply as per rules, then please apply the provisions of section 15 to determine the value. Now rule number 31A is applicable for lottery betting gambling. So for that, for lottery, the value of supply will be whatever is the prize money or whatever is the face value of lottery ticket multiplied by 100 divided by 128. The tax rate 128 is now 118 because the tax rate has been reduced. Okay, for lottery ticket, the value will be what, sir? See, at whatever price they are selling the lottery ticket into 100 divided by 118 because 28% rate is no more there. And for betting and gambling, it is whatever amount you are paying as bet, that entire value will be taken as value of supply. Rule number 32 is important rule. Now rule number 32, which we are going to see now, it is completely optional rule. Meaning if a person wants to follow this rule, he can follow. If he does not want to follow this rule, he can completely ignore it. Rule number 32.1, notwithstanding to anything contained in the provisions of this chapter, the value in respect of specified supply specified below shall up the option of supplier be determined in the manner provided thereafter, hereinafter. So in case of you are a person who is involved in the business of foreign exchange conversion, or you are a forex dealer, the value of supply of services in relation to purchase and sale of foreign currency, including money changing, shall be determined by the supplier of services in the following manner. So if you are a forex dealer or a money changer, then you have two options, option 1 and option 2. What is option 1 telling? Now the currency which you are exchanging, if RBI ka rate is given, RBI gives rate for dollar, pounds, euros and yen. If RBI ka reference rate is given, then the value of supply will be whatever rate is charged by the forex dealer minus whatever RBI rate is there into number of units exchanged. Let us say forex dealer is charging rate for $1 he is charging 96 rupees, for RBI rate is 95 rupees. Into how many units you have exchanged? I have exchanged $1,000. So value of supply will be this minus this into $1,000. What if RBI reference rate is not available? If RBI rate is not available, then let us say $1. I am exchanging $1,000. In exchange of this, I got 95,000 rupees. So take rupee value into 1% will be taken as value of supply. If RBI reference rate is not available, then 1% of gross currency exchange in Indian rupees. Sir, what if the currency which I am exchanging does not involve Indian rupees? Meaning I am exchanging dollars for pounds or euros. In such cases, see what is the rupee value of dollars, what is the rupee value of pounds. Take whichever is less, multiplied by 1%. So 1% of lesser of two amounts receivable in two currency converted into Indian rupees. Now they have one more option. Who forex dealer has one more option to find the value. What is that second option which they have, sir? The second option which they have is based on slab. Depends on how much money you are exchanging. If you are exchanging Indian rupee, meaning Indian rupee should compulsorily be inward. So if you are exchanging amount up to 1 lakh, then value of supply will be 1% of the gross currency exchanged by you, or rupees 250, whichever is higher. If you exchange more than 1 lakh up to 10 lakhs, then take 1000 rupees. Plus, why 1000 rupees, sir? Because for 1 lakh, if you take 1%, it will come to 1000. So up to 1 lakh, it is 1000 plus. For the extra amount, let us say I am exchanging 5 lakh rupees. So divide this 5 lakh as 1 lakh. On that 1 lakh, 1000 rupees. And on balance 4 lakh rupees, apply 0.5% of gross currency exchange, which is 2000. Total comes to 3000. If you exchange 10 lakhs, then what will happen, sir? Same. On 1 lakh, it is 1000 rupees. On balance 9 lakh rupees, 9 lakhs into 0.5%, which is what, sir? 4500 rupees. So total is 5500 rupees. If you exchange more than 10 lakh rupees, more than 10 lakhs, if you exchange, then take 5500, that is fixed up to 10 lakhs. And for the extra amount, apply 0.1% of gross currency exchange above 10 lakhs. Compare this with 60,000, whichever is lower should be taken. Let us say I am exchanging 1 crore rupees. Divide between 10 lakhs. You take 5500 for 10 lakhs. Remaining 90 lakhs, apply 0.1%, which is 9000. Total is 14,500. Compare that with 60,000. Take whichever is less, which is 14,500. Then, if you are an air travel agent, and if you are if you are booking domestic, if you are making domestic booking, then whatever is the base fare of the air ticket into 5% is value of supply. If you are making international booking, then 10% of base fare will be taken as value of supply. Okay, 2000, 4000, 2000 into 5%. So there will be other charges, etc., taxes, etc. You should just take the base fare. Base fare into 5% for domestic booking, base fare into 10% for international booking. If you are in life insurance business, if you are in the life insurance business, meaning life insurance agent, etc., then for you, how will I determine value of supply? In case of life insurance business, if the amount allocated towards investment is intimated, see what happens is whenever you life insurance policy, if you take, then you have to pay something called as insurance premium. So whatever insurance premium you are paying, they will put some money in stock market and some money they will cover towards risk, correct? So if the amount allocated towards investment is intimated, then the value of supply will be gross premium charged by the company minus amount allocated towards investment. If it is a single premium policy, 10% of gross premium charge will be taken as value of supply. And in all other cases, for the first year, it will be 25% of gross premium charge, and for subsequent year, 12.5% of gross premium charged. And in case of risk policy, whatever premium you are paying, entire premium will be taken as value of supply. If you are buying and selling second-hand goods, then the value of supply will be sale price of second-hand goods minus purchase price of that second-hand goods. Okay. Condition is that you should not make any changes for those goods. You should sell them as it is, and no input tax credit should be taken by you. Where a taxable supply is provided by a person dealing in buying and selling of second-hand goods that is used as such or after some minor processing which do not change the nature of the goods, and where no input tax credit has been availed on the purchase of those goods, value of supply will be the difference between sale price and purchase price. If it is negative, then please ignore it. Now, normally, if you are a dealer, you can directly take sale price minus purchase price. But if you are a repossessor of second-hand goods, for example, if I am a bank, I have given loan on loan for that car, and you have not paid the loan, I will take that car from you. So I am a repossessor of second-hand goods. In case of repossessor of second-hand goods, the purchase price is required to be calculated. Purchase price will be the actual cost of that product minus 5% per month or part thereof. 5% per month or part thereof I should take. From the date of purchase till the date of repossession, you give depreciation of 5% per month, 5% per quarter or part thereof. Okay, 5% depreciation you should give per month or per month. 5% per quarter or part thereof you should give depreciation from the date of purchase till the date of repossession. Subtract that from actual cost. Whatever amount you receive, that is your purchase price. From sale price, subtract this purchase price, you will get your answer. Then in case of vouchers, value of supply will be the money value of the product which you can purchase. And if taxable supplies are giving between distinct percent, the value of supply can be taken as nil. Rule number 33 talks about pure agent. So if any expenditure is incurred by way of value of supply in case of pure agent. In case of pure agent, what are they telling? If you are acting as a pure agent of any person, if you are acting as what? Pure agent of any person, whatever services are given by you as a pure agent will not be included in value of supply. Condition is you should act as a pure agent when you are making the payment to third party, and the payment made as a pure agent should be indicated separately on the invoice, and supply procured by the pure agent from the third person as a pure agent should be in addition to the supplies made by you in your own account. Now, what is the exchange rate which I am going to take, sir? If you are supplying services, the exchange rate which you have to take should be generally accepted accounting principal rate, meaning whatever is agreed between supplier and recipient. If you are supplying goods, the exchange rate as may be notified by the board under section 14 of Customs Act should be taken into consideration. Value of supply. One question is there, I think. Value of supply, one of the easiest topic. Please watch that 88 questions on GST video so that questions will be practiced by you. So P Heavy Engineering supplied a machinery to A Limited on 10th of January 26. List price is 15 lakh rupees excluding the taxes and discounts. Municipal taxes levied on this machinery 25,000 will be added in value of supply. Packing charges 12,000 rupees will be added in value of supply. Design and engineering charges also will be added in value of supply. TCS collected under income tax law not added in value of supply. GST charge not added in value of supply. What is the total of this? 15 lakhs plus 25,000, 65, 75 plus 2,000, 77. 15 lakh 77,000 is the value of supply. As 10. Nothing else. As simple as that. As simple as that. So see how easy these questions are. All the questions which you have solved till now, none of the question was difficult. Next, they have given registration and custom duty, the question, and that is the last question. Okay. Now, but we have a lot of topics to discuss upon. We have just completed discussion on value of supply. The next topic which we have is place of supply, then input tax credit, then other topics which are there. That will cover after a short break. Let us take a break now. I'll meet you at what time, sir? I'll meet you at 2:10, 2:15. After 1 hour, I'll meet you. Okay, and we'll complete this discussion on GST today only. GST and customs will complete completely today only. Let me meet you after a short break.
Welcome back, students. Welcome back, online students. I hope I'm audible and also the screen is visible. Sir, one doubt I have. Your doubt is what, Sundari? I finished 7A on half side. Means can I write 7B from leaving 2 lines? Start with a fresh page, no? What Google question you are asking? Are you paying some extra money for additional sheet which the institute is going to give you? No, correct, no. When you are not paying any extra money for the additional sheet, why don't you start with a fresh page? Every answer you should start with a fresh page. That is the best thing. Some people say new paper, some people say you can write 2 answers on 1 sheet. I got this doubt when there is option like A, B, C because answer was short for that. Maja is there. I hope your doubt is answered, Sundari. Maja is there. Place of supply. The next topic for discussion is called as what, sir? Place of supply. Place of supply. Place of supply and place of supply. Now this is the only chapter in your inter syllabus which you are going to learn from IGST Act. All other provisions which you are going to see, that is from CGST Act, but this is the only topic which you are going to learn from which act, sir? IGST Act. Now what is this place of supply topic talking about? So which are the different sections you are going to see? 7, 8, 9, 10, 11 and 12. 10 and 12 are most important sections. Section 7 of IGST Act talks about interstate supply. Now what is an interstate supply? I will call a particular transaction as an, I will call a particular supply as an interstate supply if the location of the supplier and the place of supply is two different states, two different union territory, one state and one union territory, or it is a case of import of goods or services, or it is a case of export of goods or services, or it is a case of supply made to an SEZ developer or SEZ unit, or all other types of supplies which is not an intrastate supply is an interstate supply. Okay, so if you are making a supply where the location of the supplier and the place of supply, where what?
The location of supplier and the place of supply is in two different states, two different union territory, one state and one union territory, then it is called as interstate supply. If you are importing any goods or services, exporting any goods or services, then also it is interstate supply. Or if it is a supply made to an SEZ unit or SEZ developer, or it is a case of supply made to an SEZ unit, SEZ, or it is a case where it is not an intrastate supply, that will be interstate supply. Section 8 talks about, Section 8 of IGST Act talks about intrastate supply. What is an intrastate supply? Intrastate supply is a type of supply wherein the location of the supplier and place of supply is in same state or same union territory. Section 9 of IGST Act talks about what if the supply is made in territorial waters. Where the location of supplier is in territorial waters, or where the place of supply is in territorial waters, then the location of supplier and the place of supply shall be the nearest coastal area. So if the location of the supplier is in territorial waters, or if the place of supply is in territorial waters, then the location of the supplier and the place of supply shall be the nearest coastal area. Okay. Location of supplier, if the supplier is a registered person, then wherever he has taken registration. If he is not a registered person, but if he has a fixed establishment, location of his fixed establishment. If he has more than one fixed establishment, then that fixed establishment where the supply is more directly concerned to, if nothing is available, usual place of residence. Section 10 is applicable to determine the place of supply where the supplier as well as the recipient both are located in India. Section 10 subsection 1 clause A says if the supply which you are making, if it involves movement in goods, if the supply which you are making, if it involves movement in goods, the place of supply will be location where the movement is ending, terminating. For example, Priya Saris Bangalore supplying goods to Karina Saris Mumbai. The goods will go from Bangalore to Mumbai. Location, the place where the movement is terminating is Mumbai. Section 10(1)(b). Movement is caused by third person. If the movement which you are making, if that movement is caused by third person, place of supply will be principal place of business of that third person. Meaning, if someone is asking you to supply the goods to someone else, now because on the direction of some person you are acting, the place of supply will not be the location of delivery of the goods, but the location of the person who has asked you to supply the goods to the person. So, if the movement is caused by some third person, principal place of business of that third person. Karina is telling Priya to supply goods to Nayantara. Now, because Karina is telling Priya, the place of supply will be location of Karina, not the place where the goods are terminating. 10(1)(c). If the supply which you are making, if it does not involve movement in goods, the place of supply will be location of goods at the time of delivery. If whatever supply you are making, if it does not involve movement in goods, for example, I am supplying sari to you when you came to Priya Saris. So from Priya Saris point of view, can I say there is no supply, there is no movement involved? So because there is no movement involved, the place of supply will be, where is the goods located at the time of delivery? It is located at Priya Saris only. So place of supply will be location of supplier. Now when the supply is made to an unregistered person, section 10(1)(c)(a), when the supply is made to an unregistered person, check whether that unregistered person ka address is recorded on the invoice or his address is not recorded on the invoice. Meaning, have you written the address of that unregistered person? You are giving invoice to unregistered person, and the invoice which is given by you to unregistered person, in that invoice have you recorded the address of that unregistered person? If that unregistered person ka address is recorded on the invoice, then the place of supply will be the address as per the invoice. If that unregistered person ka address is not recorded on the invoice, location of supply will be taken as place of supply. Now clarification is given with respect to e-commerce transaction. If the supply is made through e-commerce operator, to an unregistered recipient, and if the billing address and delivery address is two different location, then the place of supply will be delivery address. Meaning what, sir? See, if the supply is made online through e-commerce operator, I am asking the e-commerce operator to, I am at one place, and that meaning the person who is ordering it is at place A, and the person to whom the goods are delivered is at place B. In such cases, the place of supply will be location of delivery. Section 10(1)(d) talks about place of supply of goods in case of installation and assembly. In case of installation and assembly, the place of supply will be location where installation or assembly is happening. 10(1)(e) supply on board a conveyance. In case of supply on board a conveyance, the place of supply will be location where the goods are taken on board. The location where the goods are taken on board. Section 11 talks about place of supply of goods where either supplier or the recipient, any one of them, is outside India. So if section 11 talks about place of supply of goods where either the supplier or the recipient, any one among them, is outside India. So here only two possibilities are there. Either it can be import of goods or it can be export of goods. If it is a case of importation of goods, location of importer is the place of supply. If it is a case of export of goods, the place outside India is the place of supply. Section 12 talks about place of supply of services. Section 12, when will I apply provisions of section 12? If you want to determine the place of supply for services. Section 12 subsection 1. The provisions of section 12 shall apply to determine the place of supply of services where the supplier and the recipient both are in India. Meaning section 12 will be applicable where both supplier and recipient are in India. Section 12(2) is the main rule, which is the general rule. General rule means what, sir? Normally for services, what is the place of supply? See, general rule will be applicable if all the other rules which are there are not applicable. All the other rules we are going to see section 12 to section 12(3) to 12(14). If those rules are not applicable, then only general rule will be applicable. General rule says check to whom the supply has been made. If the supply has been made to a registered person, place of supply will be the principal place of business of that registered person. Meaning, if you are making the supply to a registered person, place of supply will be the location where he is registered. If the supply has been made to an unregistered person, the place of supply will be check whether the address of that unregistered person is available or address of that unregistered person is not available. If address is available, place of supply will be address as available, or else the place of supply will be location of supplier. If you don't have his address, then supplier's location will be taken as place of supply. For example, I am filing income tax return of Infosys. Infosys is a registered person and registered in Bangalore. Place of supply is Bangalore. I am filing income tax return of Mr. Sanjay, who is not a registered person, but I know he's from Andhra Pradesh. Place of supply is Andhra Pradesh. I am filing income tax return of Vanilla, whose address is not available at all with me. The place of supply will be location of supplier. Section 12 subsection 3. Section 12 subsection 3. Services directly related to an immobile property. Services directly related to an immobile property means what's a renting, leasing, construction, interior decorator, architect, hotel rooms, renting of hotel rooms, boat house, etc. So any services directly related to an immobile property. So in such cases, the place of supply will be the place where immobile property is located or intended to be located. Now, if the immobile property is, if supplier and recipient both are in taxable territory, that is India, and if the immobile property is located outside India, the place of supply will be location of recipient. Further, one more proviso is there, which says if the immobile property is located in more than one state, then place of supply shall be taken proportionately. Now, for example, if I give a house on rent to someone, the place of supply will be the location where the house is there. If someone is giving construction services to me, the place of supply will be location where the construction is happening. where the immobile property is located or intended to be located. Now, if the immobile property is located outside India, the place of supply will be location of recipient. Now, if the immobile property is located in more than one state, then it will be taken proportionately. Section 12 subsection 4 talks about performance based services. Performance based services means what's up? There are some services which are required to be performed, like restaurant food is required to be prepaid, personal grooming, beauty treatment, healthcare services, fitness services, and outdoor catering services. For all these cases, the place of supply will be location where the services are actually performed. Section 12 subsection 5, training and performance appraisal services. Training and performance appraisal services means what, sir? Training and performance appraisal services means like teaching services, evaluating performance of a person, etc. If these services are given to a registered person, the place of supply will be the principal place of business of registered person, location where he is registered. If these services are given to an unregistered person, the place of supply will be location where the services are actually performed. Section 12 subsection 6, admission to an event or amusement park. So admission means entry fees. So in relation to admission to an event or amusement park, the place of supply will be location where the event is held or location where the park is situated. For example, if there is an IPL match happening between RCB and CSK, now let us say the match was decided to happen on Bangalore, but just 2 days before the match, they told that due to heavy rain, the match will be held at Mumbai. Now the place of supply will be Mumbai. Why, sir? Because location where the event is actually held. Next, 12.7 talks about organization of an event. Organization of an event means that event management company ka services. Organization of an event. Organization of an event, if the services are check whether the services are given to a registered person or the services are given to an unregistered person. If the services are given to a registered person, place of supply will be principal place of business of such registered person, meaning location where you are registered. If the services are given to an unregistered person, the place of supply will be location where the event is held. Now proviso is there. If the supplier and recipient both are located in taxable territory, and if the place of supply is coming as outside India, the place of supply will be location of recipient. Provided further that if immobile property is located at more than one state or union territory, then the place of supply will be taken proportionately. Section 12 subsection 8, transportation of goods services. Goods transportation. If the services are given to a registered person, place of supply will be principal place of business of registered person, meaning location where he has taken registration. If the services are given to an unregistered person, place of supply will be location where the goods are handed over for transportation. Now, in this place of supply of event is very important. Let me take take this example. See, Priya Saris is a registered person. It is taking services from an event management company in Bangalore for a sari exhibition to be conducted in Delhi. Place of supply will be Bangalore because it is a registered person. What if Priya Saris is not a registered person? If Priya Saris is not a registered person, place of supply will be Delhi, location where the event is held. Now, Priya Saris is a registered person in Bangalore. It is taking services from an event management company to conduct an event in Singapore. What is the place of supply, sir? The place of supply will still be Bangalore because service is given to a registered person. What if Priya Saris is not a registered person? If Priya Saris is not a registered person, the place of supply will be location of recipient, which is equal to Bangalore, because it cannot be placed outside India. Now, if Priya Saris is taking services and the services are, if Priya Saris is a registered person and the services are provided in more than one state, still the place of supply will be Bangalore. But if it is not a registered person, then proportionately each of this state. Transportation of goods we saw. Transportation of passenger services. Now, transportation of goods also, if it is given to a registered person, location of registered person. If it is given to an unregistered person, then location where you are handing over the goods for transportation. 12.9, passenger transportation services. In case of passenger transportation services, check whether the services are provided to a registered person or to an unregistered person. If the services are given to a registered person, principal place of business of registered person. If the services are given to an unregistered person, the place of supply will be location where the passenger is embarking the conveyance for continuous journey. Now, this provision is not applicable in case of metro pass, bus pass. That is, this is not applicable in case of right to passage. In case of right to passage, this above provision will not be applicable. Okay, for example, ArivuPro is a registered person in Bangalore. It is taking services from SRS Travels for conducting a picnic to Goa. Now, because I am a registered person, place of supply will be location of registered person. Now, Jenny Leah is a person going from Bangalore to Chennai. She is an unregistered person. What is the place of supply, sir? Wherever she is embarking the conveyance. She is embarking the conveyance at Hosur. Though the bus is coming from Bangalore to Chennai, place of supply will be Hosur. Section 12, subsection 10. Services provided on board a conveyance. You are on board a conveyance. At that time when you are on board a conveyance, the services are provided to you. Place of supply will be the first scheduled point of departure of such conveyance, meaning the first place from where the conveyance started its journey. Now, three provisions I'll discuss at once. Let us say there is a flight starting its journey from Chennai. I am a person who boarded the flight at Bangalore. Then some goods were loaded in the flight at Hyderabad. And when the flight was somewhere between Mumbai and Delhi, I purchased some goods. And when the flight was somewhere between Kolkata and Jaipur, I took some services from the airline company. Now, in this case, what is the place of supply for passenger transportation? Location where the passenger is embarking the conveyance. What about the goods which are supplied in the flight to me? Location where the goods are taken on board. Where was the goods taken on board? Hyderabad. And in case of services, Chennai, which is first scheduled point of departure of that conveyance. Section 12, subsection 11, telecommunication services. In case it is fixed line, location where it is fixed. In case of postpaid, billing address. In case of prepaid, location where the vouchers are sold, and online, if you are doing any recharge, billing address will be taken as place of supply. Section 12, subsection 12, services given by banking company, NBFCs, stockbroker. For all this, if location of recipient is available, the bank will have your address, then place of supply is location of recipient. If the bank does not have your address, the place of supply is location of supplier. And in case of insurance company services, if it is given to a registered person, location of registered person. If it is given to an unregistered person, still the bank will have your address. Location, insurance company will have your address. So whatever address it has. 12.14 is place of supply to be determined as per rules, which is not applicable for your intermediate level. Section 13 talks about place of supply in case of either supplier or recipient are outside India. This is not applicable from exam point of view at this level, but still we will see because it is there in the material. Section 13, subsection 2. When is section 13 applicable? Either supplier or recipient, any one among them is outside India. Default rule. What is the default rule? Place of supply will be location of service recipient. If the location of service recipient is not available, then the location of service provider will be taken as place of supply. Where the services are with respect to goods which are required to be made physically available, the location where the services are actually performed. Where the services are provided through electronic means, meaning online form I am giving the services, place of supply will be place where the goods, place of supply shall be actual location of the goods. Where the services are supplied to an individual, not related to goods but to a person, then the location where the services are performed. Now, if the services are related to immobile property, location where the place where the immobile property is located or intended to be located will be taken as place of supply. If the services are with respect to admission to or organization of an event, place of supply will be wherever the event is held. If the services are related to point number 3, 4 and 5, meaning immobile property, event and this goods or performance based services, then if it is at more than one place including a place in taxable territory, place of supply will be location in taxable territory. Great, Pranav. Hi. Maja Panno, 85. where any services stated, okay, services performed as per, so if the services are provided at more than one state, then I will take the place of supply to be equal to proportionately in each of those state. Now specified services, section 13 subsection 8, section 13 subsection 8, services provided by banking company, financial institutions or NBFC, intermediary services, nothing but agency services, or services consisting of services relating to hiring any means of transportation except aircraft and vessel for a period up to 1 month. For all these services, the place of supply will always be taken as location of service provider, that is location of supplier. Passenger transportation services, the place of supply will be location where the passenger is embarking the conveyance for continuous journey. And where services are provided on board a conveyance, place of supply will be the first scheduled point of departure of that conveyance. Where online information and database access retrieval services are given, place of supply will be location of the service recipient, that is India. Next topic is very simple topic, input tax rate. Section 16 to section 21 is something which you have to study. What is input tax rate? Input tax rate means credit of input tax. Input tax rate means what, sir? It means the credit of input tax. If you are taking the credit of the taxes paid by you on your purchases, that means it is an input tax rate. Input tax means what, sir? Input tax means the tax which is paid by you on your inward supply or purchases, and it will include the taxes paid under reverse charge. It will include the taxes paid on import of goods under customs law, but it shall not include the taxes paid under section 10. But it shall not include what, sir? It shall not include the taxes paid under section 10. Now, so what is the sources of input tax? Sources of input tax is your purchases. Input tax can be input tax means what, sir? Input tax means the tax paid by you on your purchases. So purchases can either be of goods or services. So goods are further divided into two categories. One is called as capital goods, another one is called as inputs. Capital goods means any goods which are capitalized in the books of accounts. Inputs means any goods other than capital goods. And services which are purchased by you are called as input services. Section 16 talks about eligibility and condition. Who is eligible to take input tax rate and what are the conditions for taking input tax rate? Section 16 subsection 1 talks about eligibility and condition. Section 16 subsection 1 talks about eligibility. Who is eligible to take input tax rate? Every registered person is eligible to take input tax rate on goods or services or both which is used by him or intended to be used by him in the course or furtherance of business. So if you are a registered person, you can take input tax rate on what? On all those goods or services which are used by you or intended to be used by you in the course or furtherance of business. Now, are there any conditions for claiming input tax rate? Yes. What are those conditions? The registered person should have the invoice, should have the possession of the tax invoice, debit note or any other tax paying document. So the document based on which you are taking ITC, that document should be available with you. He should have actually received the goods or services or both. Meaning the person who is taking ITC should have actually received the goods or services or both. Then except in case of bill to ship to, meaning where on the direction of registered person, if the goods are supplied to any recipient, then it shall be deemed that the registered person has received the goods or services once it is received by the recipient. If the supplier has paid the taxes, and then condition number 3 is that supplier should have paid the taxes. Condition number 4, he should have filed the returns. He means the registered person himself, he should have filed the returns. And 2 additional conditions, which is important condition. A registered person can avail input tax rate if the details of supply made to him are furnished by his supplier in his GSTR1 and the same is communicated to the registered person in GSTR2B. Meaning if I want to take input tax rate, then the person who has sold the goods to me, he should have filed his GSTR1, and once he files his GSTR1, that information will come to me in my GSTR2B. Only when the information is coming in GSTR2B, I can take input tax rate. Details of input tax communicated to a registered person should not be restricted. It should not be blocked. It should not be restricted. Further, if the goods are purchased in lots or installment, ITC can be taken upon receipt of last lot or last installment. Provided further that if the recipient does not make the payment to the supplier within If the recipient does not make the payment to the supplier within 180 days from the date of invoice, if you don't make the payment within 180 days from the date of invoice, then what will happen, sir? Whatever ITC is claimed by you, that ITC should be reversed by you along with interest at 18% per annum, provided further that ITC can be availed once the payment is made by you. Now see, for example, I made a purchase on 1st of April. The input tax rate was availed by me by filing my GSTR 3B. On which date, sir? 15th of May, I availed the input tax credit. Now, I was supposed to make the payment within 180 days, which is 180 days from the date of invoice, which is 27th of September, but I actually made the payment on 20th of December. So, can I take input tax credit, sir? Now, because I have already taken input tax rate and I have not followed the law, not made the payment within 180 days, now whatever ITC I have claimed, I should reverse. Now on this the ITC should be reversed along with interest. The interest will be calculated from the date of taking the credit to the date of reversal of the credit. At 18% per annum, interest will be calculated. Now this condition of this 180 days condition is not applicable for supply attracting reverse charge, for deemed supply, meaning supply without consideration, and for those expenses which are incurred by the recipient which the supplier had to incur. 16.3 ITC on capital goods. Where a registered person has claimed depreciation on tax component of capital goods. Where a registered person has claimed depreciation on tax component of capital goods, then he will not be able to claim input tax rate on such capital goods. So if you have claimed depreciation on the tax amount also, that means you are already taking the benefit under income tax law. You cannot take ITC on that particular asset. Now, what is the last date for taking input tax rate? So, if you have missed to take input tax rate on any goods and services, then you have a time up to 30th November of next year. So, let us say 25-26 for the financial year 25-26, any invoice was there for which you have not taken ITC. No problem. This year ends on 31st of March 26. So, from that date, you have how many days time, sir? 30th November of the next financial year. Till 30th November of the next year, I can take the credit. Or date of filing annual return for 25-26, whichever is earlier. Within that time, I have the time limit to take the input tax rate for missed invoices. Now, the due date to file annual return is 31st of December of next financial year. Rule number 36 talks about what are the other tax-paying document based on which you can take ITC. The other tax-paying document based on which you can claim ITC is the tax invoice as per section 31, RCM invoice as per 31.3, bill of entry, debit note, and input service distributor invoice. And this tax-paying document should have some mandatory information like name of the supplier, name of the recipient, register number of the supplier and recipient, description of goods and services, details of taxes charged, place of supply details in case of interstate supply, total value of goods and services, and breakup of taxes. Rule number 37A says, see, if you have followed all the provisions, but if the supplier is not following the provision, then also you should reverse the input tax rate. Rule number 31A, from intermediate point of view, not that important. So, Karina made a supply to Priya. Okay. Karina filed GSTR 1, the information came in GSTR 2A, 2B. Based on this information, Priya took input tax rate. Priya Saris has taken input tax rate. Karina filed GSTR 1, but she did not file GSTR 3B. That means Karina has not paid the taxes to the government. Now, because Karina has not paid the taxes to the government, I should reverse the input tax rate within 30th September of next year. Section 17 talks about apportionment of input tax rate. What do you mean by apportionment? Distribution or division of input tax rate. Section 17, apportionment of input tax rate and block rate. Section 17(1) says, where any goods or services are partly used for business purpose and partly used for any purpose other than business, then ITC shall be restricted to so much of input tax as attributable to business purpose. So if you have any goods or services which is used by you for business as well as personal purpose, you take ITC only for proportionately only for business purpose. Let us say I have an iPad, to 80% of the time business purpose I am using, 20% I am using for personal purpose. Take ITC equal to 80%, meaning 18,000 into 80%, which is 14,400. 17.2, where any goods or services are partly used for making taxable supplies and partly used for making exempt supplies, ITC will be restricted to so much of input tax which is used for making taxable supplies, including zero rated supplies. Meaning, if you have any goods which are using for taxable supply as well as exempt supply, take ITC proportionately only for taxable supplies. Now, the exempt supply under 17.2 shall also include supply attracting reverse charge, sale of land, sale of building, and transaction in securities. All this will not be tested in examination. What is most important is section 17.5, most important section in your ITC chapter. Most important section, okay? Section 17.5 talks about block credit. Block credit means what? Those items on which input tax credit cannot be taken by you at all. It is blocked. You cannot take ITC on motor vehicle which is used for transportation of persons having seating capacity not more than 13. So if you have a motor vehicle which is used for transportation of person and which has a seating capacity not more than 13, including the driver's seats, you cannot take input tax rate. Now please see. Motor vehicle are divided into two categories. Motor vehicle can either be used for transportation of goods or the motor vehicle can be used for transportation of persons. If it is used for transportation of goods, you can always take input tax rate. If the motor vehicle is used for transportation of person, then see the seating capacity. If the seating capacity is less than 13 or equal to 13 including the driver seat, normally ITC will not be given. If the seating capacity is more than 13 including driver seat, ITC will be allowed. Now, if the seating capacity is less than 13, normally ITC will not be given on that motor vehicle. However, if that motor vehicle which has less than 13 seater capacity is used for further supply of motor vehicle, training in motor vehicle, transportation of persons, then you can still take ITC. Vessels and aircraft. Can I take input tax rate on vessels and aircraft? Lawmaker says yes. ITC, no. Lawmaker says you cannot take ITC on vessels and aircraft. ITC cannot be availed on vessels and aircraft, it is blocked. However, if the vessels and aircraft are used for further supply of vessels and aircraft, for training in vessels and aircraft, or you are a person involved in transportation of, if you are a person involved in transportation of person or transportation of goods, in these scenarios you can take input tax rate. Now, if you have a motor vehicle, vessel or aircraft, normally on this I cannot claim input tax rate, except those situations which we saw. But for this motor vehicle, vessels and aircraft, I may incur expenses for service cost, I may incur expenses for repairs cost and insurance cost. Can I take input tax rate on this? Lawmaker says no. Normally ITC is not allowed on service cost, repairs cost and insurance cost. However, ITC will be allowed if the ITC is allowed at the, on purchase of motor vehicle, vessels and aircraft, and if you are manufacturing motor vehicle, vessels, aircraft, or if you are a general insurance company. Then foods and beverages, outdoor catering, beauty treatment, health services, plastic surgery, cosmetic surgery, leasing, renting, hiring of motor vehicle, vessels and aircraft, and life insurance and health insurance. On these things also ITC cannot be claimed by you. However, on foods and beverages, outdoor catering, beauty treatment, plastic surgery, healthcare, life insurance services, etc., ITC can be claimed by you if you are using it for same line of business, meaning the outward supply and inward supply is same. ITC cannot be claimed by you for membership of a club, health center or fitness center if you are taking any membership. ITC cannot be taken by you on travel benefit which is extended by you to your employees. However, on all these things means foods, beverages, beauty treatment, membership of health club or travel benefit extended to employees, etc. On all these things combined, on all these things, ITC is allowed to you. When is the ITC allowed on all these things? ITC on all the above items will be allowed if it is a statutory obligation on the employer to provide the same to employee. If the law is mandating it, if the law is telling me to provide the same to my employees, then yes, ITC can be taken if it is a statutory obligation. ITC cannot be taken on works contract services or goods or services used for construction of immobile property other than plant and machinery. So if you are purchasing any goods or services like cement or construction services or works contract services for construction of immovable property, normally you cannot take input tax rate. However, if that immovable property is plant and machinery, then yes, you can claim input tax rate. Goods or services are both received by non-resident taxable person. On that also, ITC cannot be taken by you unless until or except the goods which are imported by you. Imported by that non-resident taxable person. Goods or services or both on which tax is paid under section 10. Composition dealer cannot take input tax rate. Similarly, a person is, if you are purchasing from composition dealer, then also ITC cannot be taken by you. Goods or services are both used for personal consumption, ITC cannot be taken. Goods stolen, lost, destroyed, written off, disposed of by way of gift or free samples, ITC cannot be taken. Goods or services where tax is paid under 74, 129, 130, that is fraud cases, ITC cannot be taken by you on those goods. ITC in special circumstances. There are some special circumstances. What will happen to your input tax rate in these special circumstances? Section 18(1)(a). If you are a person who is liable to file returns, if you are a person who is liable for registration and you apply for registration, so where a person is liable for registration and if he applies for registration within 30 days of becoming liable and that registration is granted to him, he can take ITC on inputs which is there with him 1 day prior to the date of liable for registration. 18 is something which will test you in your final level. Okay. Section 18(1)(b). Voluntary registration. If you are a person who has applied for registration on voluntary basis and if such registration has been granted to you, then he can avail input tax rate on inputs held in stock 1 day prior to the date of grant of registration. Section 18(1)(c). If you are a composition dealer and if you become a regular dealer, if a composition dealer is becoming regular dealer, then he can take input tax rate where a person registered under composition scheme converts himself into a regular scheme. So a composition dealer, if he is becoming a regular dealer, he shall be entitled to take input tax rate on inputs held in stock as well as on capital goods held 1 day prior to the change. So you can take ITC not only on inputs but as also on capital goods. But when you are taking input tax rate on capital goods, then how much is the ITC you can claim, sir? See what is the input tax on capital goods which you paid at the time of purchase. Subtract 5% from this per quarter or part thereof from the date of purchase till the date of change. So subtract 5% from that, from the date of purchase till the date of change. Whatever you get, that will be the total ITC which is allowed to you. Section 18(1)(d). Registered person's exempt supply is becoming a taxable supply. Registered person's exempt supply is becoming a taxable supply. Where a registered person's exempt supply becomes a taxable supply, he will be entitled to take input tax rate on inputs held in stock as well as on capital goods held 1 day prior to the change. On inputs, normally you can take ITC. On capital goods, reduce it by 5% per quarter or part thereof from the date of purchase till the date of change. Now section 18(2) says, now section 18(4) talks about reverse cases. If a composition dealer becomes regular dealer, you give credit. If exempt supply becomes taxable supply, you give credit. Similarly, if ulta is happening, ulta means what, sir? If a regular dealer is becoming a composition dealer, if taxable supply is becoming exempt supply, then do ulta of 18(1)(c) and 18(1)(d), meaning reverse the ITC. Now 18(2) says under 18(1), if any invoice is older than 1 year, you cannot take input tax rate on those invoices. 18(3) says whenever there is a change in constitution of business. What do you mean by change in constitution of business? Let us say amalgamation, merger, demerger, etc. is happening. Whenever there is a change in constitution of business by way of sale, merger, demerger, amalgamation, death of sole proprietor, etc., with a specific provision for transfer of liability. This amalgamation, merger, demerger or change in constitution is happening with a condition that even the liabilities will be transferred. In such cases, whatever unutilized input tax rate was available with the old company will be transferred to the new company. 18(6) talks about supply of capital goods or plant and machinery. Now normally my business is to supply sari. I have some computers in my business. If I sell those computers, then I will fall under this category. So in case of supply of capital goods or plant and machinery on which input tax credit was availed by me, it is not my business to sell capital goods. Okay, whatever is a capital goods for my business, I don't sell them. But if by chance I sell them, and if I have taken input tax credit on those assets, then this is what I should do. So in case of supply of capital goods or plant and machinery on which input tax rate has been availed, the tax to be paid or the ITC to be reversed shall be equal to the tax calculated on the transaction value as determined under section 15, or ITC on such capital goods shall be reduced by 5% per quarter or part thereof from the date of purchase of those assets till the date of sale, whichever is higher is the ITC which is required to be reversed by you. Section 19 talks about input tax credit in case of job work. Now job work means what, sir? If any process or treatment, if any process is carried on by a person on the goods belonging to another person, then it is said that job work is happening. The person who is doing that work is called as job worker, and on whose behalf that work is getting done, that person will be called as principal. Now section 19 subsection 1 says, the principal will be able to take input tax credit on inputs which are sent by him to the job worker for the purpose of job work. Now if the inputs are directly sent to the job worker by the supplier on the direction of principal, in that case also principal can take input tax credit. But whatever inputs are sent to the job worker, that should come back to the principal or sold from the job worker location within 1 year. If it is not done, then it will be deemed as supply. Similarly, the principal can take input tax credit on capital goods which is sent to the job worker. Now whatever capital goods are sent to the job worker, they should, okay, before that 9.5 says, the principal can take input tax credit on capital goods directly sent to the job worker by the supplier. Now whatever capital goods are sent to the job worker, they should come back to the principal within 3 years from the date of sending it of receipt by the job worker, or else it will be deemed as supply. This provision shall not be applicable to molds, dies, jigs, fixtures, etc. Now the inputs which are sold by the job worker on behalf of principal should be added to the aggregate turnover of the principal and not the job worker, because it is a sale of principal, meaning I gave some asset to you for job work, for painting purpose I gave some car to you. Now what is your job? Only to paint that car, correct? No. Now one of my customer purchased the car directly from your location. Is it a sale of car by you? No, it is a sale of car by me only. Section 20 and 21, input service distributor. Now input service distributor means what, sir? You are taking registration to your for your centralized office which does not make any sale but which has only inputs. You are taking registration for that unit as an input service distributor that will distribute whatever credit is available with them to your all the branches for which it is taking the services. Now the input service distributor can distribute the credit based on a document called as what, sir? Input service distributor invoice. So he will distribute the credit against a document called as input service distributor invoice. The credit distributed by him should not be more than the credit which is available with him. Now to how will he distribute? If the credit is attributable to one single recipient, distribute the credit only to that recipient. If the credit is attributable to more than one recipient, distribute to all those recipients. If the credit is attributable to all the recipient, distribute the credit to all the recipient on pro rata basis. How will I distribute, sir? On pro rata basis based on turnover in the state or union territory. Now section 21 says, if you distribute any extra input tax credit to your if the input service distributor distributes an extra input tax credit, that should be reversed along with interest at 18% per annum. Manner of utilization of input tax credit, section 49 subsection 5. Now what is the manner for taking, or what is the manner of utilization of input tax credit? How should I use or utilize this input tax credit? The manner of utilization of input tax credit is what, sir? The manner of utilization of input tax credit is, if you have IGST ka credit, first use it for paying IGST, then use it for paying CGST or SGST in any proportion. Once IGST credit is completely exhausted, then go to CGST. CGST credit will be used for paying CGST first and then used for paying IGST. CGST can never be used for paying SGST. Then SGST credit will be used for paying SGST first and then IGST. It will never be used for paying SGST. Now, IGST credit can be utilized for making the payment of CGST or SGST in any proportion. CGST and SGST credit will be utilized only if there is no IGST credit available. CGST credit can never be utilized for making the payment of SGST and vice versa. CGST credit will be utilized for paying IGST only if there is no credit available to pay IGST. SGST will be used for paying IGST only if there is no credit of CGST available to pay IGST. Now, payment of tax is a very simple topic. So there are three ledgers: electronic cash ledger, credit ledger, liability register or liability ledger. Cash ledger, whatever cash deposit you are making in your account will go and sit in your electronic cash ledger. It is maintained in a form called as Form GST PMT 05. And payment challan, how do I deposit the money, sir? By using a form called as Form GST PMT 06. MCQ. All these procedural aspects which are there, they are mostly applicable from MCQ point of view. Okay, meaning after registration chapter, whatever is there, after registration chapter, whatever is there, tax invoice, electronic way bill, returns, payment of taxes. Okay, these four topics basically, they are applicable from what point of view, sir? They are applicable from MCQ point of view, majorly MCQ point of view. Registration, sometimes they may ask you theory question also. So therefore registration sometimes, but normally MCQ. You can deposit using a challan called as Form GST PMT 09. Now, if you want to transfer the amount available in one credit ledger to another credit ledger, you can transfer it through a form called as Form GST PMT 09. Electronic one cash ledger to another cash ledger, not credit. Electronic credit ledger is maintained in a form called as Form GST PMT 02. What is the manner of utilization of input tax rate? We have already seen. Liability register. So you can have two types of liability either of tax dues or other dues. If you have liability of tax dues, then the tax amount can be paid either through credit or in cash. If you have liability of any other dues, then like interest, penalty, late fee, then that should be compulsorily paid in cash. Now there are some items which you should compulsorily pay in cash, which is other dues like interest, late fee, penalty, tax payable under section 10, TDS under 51, TCS under 52 and tax payable under reverse charge. They should be paid compulsorily in cash. There is an order for discharging the liability. First you should pay self-assessed tax and other dues of previous tax period. Then you should pay self-assessed tax and other dues of current tax period. Then you should pay all other types of dues which is there under GST law, including the penalty under 73 and 74. Now, interest for delay in payment of tax. If you don't file the return within the time limit, that means you have delayed in paying the tax also, you will have to pay interest at 18% per annum. Interest will be calculated from date after the due date till the date of actual payment of taxes, and interest will be paid on net GST payable in cash. Interest for undue or excess claim of ITC, interest is payable at 18%, and interest will be calculated from the date of taking that credit till the date of reversal. Registration under GST law. Section 22 to section 30 are the different sections covered over here. Section 22 talks about what, sir? Section 22 says, if you are a person who is liable for registration, section 22.1 is the only important section over here. Section 22.1 says, the supplier of goods or services or both shall obtain registration in the state or union territory from where the supplier of goods or services or both shall obtain registration in the state or union territory or both in the state or union territory from where they are making taxable supplies if their aggregate turnover exceeds 20 lakh rupees. This limit will be 10 lakhs if you are doing the business in 4 special category states, which is make my trip to Nagaland, Manipur, Mizoram, Tripura and Nagaland. Limit is 10 lakhs. All other states the limit is 20 lakhs. Now this limit will be 40 lakhs in some cases. Any person who is engaged exclusively in supply of goods and whose aggregate turnover does not exceed 40 lakh rupees, they have an option to take registration only if turnover is more than 40 lakhs. So in simple words, if a person is supplying only goods and if his aggregate turnover is up to 40 lakh rupees, he need not take any registration. However, there are some conditions applicable. This person is required to take compulsory registration under section 24. this provision which you see is not applicable for those people who are required to take compulsory registration, for those people who are supplying notified goods, for those people who are supplying in notified states, which is num must time pass, and those people who are opting, who have opted for voluntary registration. Then section 23 talks about person who are not liable for registration, person making only exempt supply, non-taxable supplies, agriculture is supplying whatever is cultivated out of, whatever is produced by him out of cultivation of land, or person making interstate outward supply up to of services up to 10 lakhs, 20 lakhs, person making supply taxable under reverse charge, and supply of services through e-commerce operator up to 10 lakh, 20 lakhs, person making interstate supply of handicrafted goods. They are not liable for registration. Theory question. One more theory question is, who are the persons who are required to take registration compulsorily? Compulsory registration is applicable to whom? Compulsory registration is applicable to a person who is making interstate taxable supply of goods or services. Not services, goods. If you are a person who is making interstate taxable supply of goods, if you are a casual taxable person, non-resident taxable person, who is liable to pay tax under reverse charge, e-commerce operator under 9(5), e-commerce operator under section 52, person making supply through e-commerce operator under 52, a person who is required to deduct the taxes under section 51, input service distributor, OIDAR service provider, every person who is supplying online money gaming services from place outside India, and any person making taxable supplies on behalf of another person. They are all required to take registration register law compulsorily. What is the procedure for taking registration? Very simple. If you are liable for registration, you should apply for registration within 30 days of becoming liable. But a casual taxable person and non-resident taxable person has to apply for registration 5 days prior to commencement of business. Normally, single registration will be given to you for the entire state, but if you have place of business at multiple location, you can take separate registration for those units. If you have a place of business in special category states, for that special category states ka unit, you should take separate registration. If a person can apply for registration on voluntary basis even if he is not liable for registration. 25(4) and 25(5) talks about deemed distinct person. Now, PAN is compulsory for taking registration. If you want to take registration as a TDS or TCS person, then PAN is required. For non-resident taxable person, other documents has been specified for taking registration, which you will see later. Now, officer will give you the registration if you are liable for registration but not applying for registration. And registration, once you are registered, you will get a something called as GSTN. The form which is used for registration is called as Form GST REG01, which has two parts, Part A and Part B. And once you are registered, you will get a registration certificate in Form GST REG06. This once you are registered, you will get a GST number, GSTIN, Goods and Service Tax Identification Number, which is of 15 digit. First digit is state code, then next 10 digit is PAN, then there will be one, and then a normal letter called as Z always, and checksum digit. So deemed registration 26 time pass. If you are registered under SGST or UTGST Act, it means that you are registered under CGST Act. This is important. Effective date of registration is important. If you have applied for registration because you are liable for registration or on voluntary basis. So you have applied for registration because you are liable for registration, and if you apply for registration within 30 days of becoming liable, then the effective date of registration shall be date of liable for registration. If you apply for registration after 30 days of becoming liable, then the effective date of registration will be the date of grant of registration. If you apply for registration on voluntary basis, the effective date of registration will be date of grant of registration. Section 27. Special provisions applicable to a casual taxable person or a non-resident taxable person. So if you are a casual taxable person or a non-resident taxable person, what are the special provisions applicable to you? If you are a casual taxable person or a non-resident taxable person, who is a casual taxable person? Casual taxable person means a person who is occasionally undertaking the transaction of supply of goods or services or both at a place which is not his usual place of business. So for example, normally I am doing business in the state of Karnataka. Now if I go to Chennai from Bangalore, if I am going to Chennai for 10 days for an exhibition and doing business over there, that means in Chennai I will be called as casual taxable person. Non-resident taxable person means a non-resident person who occasionally undertakes the transaction of supply of goods or services or both at a place which is not his usual place of business. Now, what are the special provisions applicable to a casual taxable person and non-resident taxable person? A casual taxable person and non-resident taxable person has to apply for registration at least 5 days prior to the commencement of business. Their registration will be valid for number of days they apply or 90 days, whichever is less. Extension of validity. Their validity can be extended, and it can be extended only once. They can extend it for number of days they want or 90 days, whichever is less or earlier. And a casual taxable person and non-resident taxable person has to pay the taxes in advance at the time of applying for registration on the basis of estimated turnover for the validity period. And if they are extending the registration for that extended period also, they should pay taxes in advance. Amendment in registration. Any change in registration, that change should be made within, if there is any change in the registration which you have already taken, that amendment should be made within 15 days of change. If amendment is in code field like trade name, principal, place of business, additional place of business, then it should be approved by proper officer and he will approve it within 15 days. If you are making an amendment in non-core fields, then that will always be approved. Cancellation of registration, section 29. Section 29 talks about what's a cancellation of registration. Section 29(1), registration can be cancelled by the officer, registered person himself, or legal heads of registered person if he has discontinued his business, or if there is a change in constitution of business, or that registered person is no more liable for registration. Registration in section 29(2) says registration scenarios where registration can be cancelled only by the officer if the registration has been obtained by fraud, if registered person has contravened the provisions of the law, if registered person has obtained registration on a voluntary basis and did not start a business within 6 months, or where the returns has been not filed by that registered person. Now, if your registration has been cancelled, then at the time of cancellation, if you have any goods or capital goods or inputs, on that capital goods or inputs, you should reverse the input tax rate. Revocation of cancellation. If officer is cancelling your registration, then you can apply for revocation within 90 days of cancellation. Now, this 90 days will be further extended to a period up to 180 days. Tax invoice, debit note, credit note. Now, tax invoice is a document which is required to be issued by you if you are making taxable supplies. For goods, issue three copies supplier, one for the supplier, one for the recipient, one for the transporter, and for services, issue 2 copies of tax invoice. And contents of tax invoice are name, address, GST number of the supplier, name, address, GST number of the recipient, document number, date of invoice, description, HSN, quantity, unique quantity code, value of supply, breakup of tax amount, total invoice value, signature of the person who is creating QR code, invoice details if it is applicable. Now, this contents you remember for one of the item, for one of the document, because for all other documents also content will remain more or less same. Now, invoice number, very important. Two things are important: invoice number and HSN code in an invoice. In the invoice number is important because invoice number should be unique for every financial year, and it should not be more than 16 characteristics. It cannot have any special characteristics except / and hash, or that is dash or hyphen. HSN code also should be given. HSN code is a system which is used for classification of goods or services. It is an 8-digit code which will help you to identify different goods and services. Now, in the invoice, you should mention the HSN code. How many digits I should mention, sir? In case of if your aggregate turnover is up to 5 crore rupees, meaning less than 5 crore rupees or equal to 5 crore rupees, mention 4-digit HSN code for B2B supply. For B2C supply also, you should mention 4-digit HSN code, but it is optional. But if your aggregate turnover is more than 5 crore rupees, mention 6-digit HSN code, whether it is a B2B supply or B2C supply. No tax invoice if supply is made to unregistered person and value is less than 200 and the unregistered person does not require invoice. Instead of issuing a separate tax invoice to the above registered person, a single consolidated tax invoice shall be issued for the supply made to you for all that unregistered person. E-invoicing, important provision. E-invoicing is not generating the invoice online. No. E-invoicing is a system wherein whatever B2B invoices are generated by you are authenticated electronically by the GSTN for further use of common portal. Under e-invoicing system, an identification number called as invoice reference number will be issued against every invoice which is generated by you on the invoice registration portal, which is managed by GSTN. E-invoice is required to be generated by those registered person whose aggregate turnover in any financial year starting with from financial year 17-18 exceeds 5 crore rupees. Now, e-invoicing is not applicable to government CPICs, government departments, local authorities, cinema halls, multiplexes, passenger transportation service provider, insurance company, banking company, GTA, goods transport agency, transporting goods by road, and SEZ units are not required to follow the provisions of e-invoice. Then we have something called as dynamic QR code. This is something which you are required to give for B2B invoices. All B2C, sorry, not B2B, B2C invoices issued by a registered person whose aggregate turnover is more than 500 crores should mention or give this dynamic QR code. The main purpose of dynamic QR code is to encourage digital payments for the buyer. So if you go to, let us say, Reliance, etc., Reliance Fresh, or you go to DMart, etc., the scanner which is there, the scanner which they show, that scanner, if you just scan, you will directly get the amount only. You don't have to enter the amount directly. That amount will be available. You just have to enter your PIN. Correct? No. So that is dynamic QR code. Now this is not applicable to same government CPICs. Dynamic QR code will capture information such as GST number of supplier, then UPI ID of the supplier, pays bank account details, invoice number, invoice date, and tax, total invoice value, and GST amount ka breakup. Revised tax invoice, this is required to be issued for supply made by you from the effective date of registration till the date of grant of registration. What, sir? Revised tax invoice. Revised tax invoice is issued for supply made from effective date of registration till the date of grant of registration. It is required to be issued within 1 month from the date of grant of registration. Bill of supply. Bill of supply is required to be issued by those people who are making supplies which are exempt, or you are a person who is a composition dealer. If you are making both taxable as well as exempt supply, issue an invoice called as a document called as invoice cum bill of supply. Receipt voucher. Receipt voucher, when you receive any advance, to acknowledge that you give a receipt voucher. At the time of receipt of advance, if you don't know the rate of GST, apply 18%. If you don't know the nature of supply, treat it as interstate supply. Refund voucher, if you have received advances and you have not supplied anything, and if you refund that money, you give something called as refund voucher. Payment voucher, if the registered person receives supply taxable under reverse charge under 9394, while making the payment to that supplier, you issue something called as payment voucher. Delivery challan. Delivery challan is if you are moving the goods or if you are giving the goods to someone, then you have to issue a document called as delivery challan, just to record the movement of goods. When is it required, sir? Supply of liquid gas where the quantity is not known, transportation of goods for job worker, transportation of goods for any reasons other than supply. Delivery challan. Number should delivery challan should it should be serially numbered and it should not have more than 16 characteristics. It should be issued the time of removal and it should be issued in triplicates. Now, if the goods are supplied in semi-knockdown and completely knockdown conditions, or in lots or installment, you should not that relevant from exam point of view for you guys. The supplier should issue a complete invoice before dispatch of first consignment, and supplier should issue the delivery challan as and when each and every consignment is going, and copies of corresponding delivery challan will be accompanying the original invoice, and original copy of invoice should go along with the last consignment. Now a GTA has to issue a document called as consignment note. What will this consignment note consist of? Consignment note will consist of gross weight of consignment, name of the consignor, name of the consignee, registration number of the goods carriage, details of goods transported, details of place of origin and place of destination of the goods, GST number of the person liable to pay the taxes, and other information as may be specified in rule number 4. Now, credit note and debit note, when should I issue? Important question. Majorly important is credit note. Credit note is required to be issued to reduce the value of invoice which is already issued by you. So for when will you reduce the value of invoice which is already issued by you? If the taxable value declared in the invoice is more than the actual value of goods and services, if the tax rate declared by you is more than the actual tax rates, if the quantity received is less than the actual quantity, if the quality of the goods or services are deficient, or if the goods or services are returned. Debit note is required to be issued to increase the value of invoice which is already issued by you. So if the taxable value declared in the invoice is less than actual value, tax rate declared in the invoice is less than the actual tax rate, if the quantity received is more than the actual quantity, declared on the invoice. Okay, what is e-way bill, sir? E-way bill is e-way bill is electronic way bill. It is a compliance mechanism wherein by way of digital interface, a person who is causing movement of goods uploads the relevant information prior to commencement of movement and generates e-way bill. The benefits of e-way bill is that physical interface will now pave a way with digital interface, and it will help in faster movement of goods. It will increase the turnaround time of trucks. When is e-way bill required to be generated? If the consignment value, whenever there is a movement of goods whose consignment value is more than 50,000, now that movement can be because in relation to supply for reasons other than supply or due to inward supply from unregistered person. E-way bill is required to be generated in a form called as Form GST EWB 01. Now, what do you mean by consignment value? Consignment value means the value of supply as per section 15, which is declared in the invoice bill of supply, and it includes the taxes. It includes CGST, SGST, IGST, UTGST, meaning value of supply plus taxes under GST less value of exempt supply will give you consignment value. Now, in case of bill to ship to concept, only one e-way bill is required to be generated. Now, what is the information which you have to give in e-way bills? E-way bill is generated in a form called as Form GST EWB 01. It has two parts, Part A and Part B. Part A will comprise of details of GST number of supplier, GST number of recipient, place of dispatch of goods, place of delivery of the goods, document ka number and document ka date, value of goods, HSN code and reasons of transportation. Part B will consist of transporter ka details like GRN, RRN, ABN, and to be furnished by the person who is transporting the goods. Okay. Now, e-way bill cannot be cancelled. E-way bill can only be cancelled within 24 hours. You cannot edit it. Now, e-way bill has a validity of 20 days. If it is over dimension cargo, for every 20 kilometer or part thereof, it is 1 day. If it is other than over dimension cargo, for every 200 kilometer or part thereof, it is 1 day. Now, e-way bill is not required to be generated in some cases when you are transporting LPG for home supplies, kerosene under PDS, postage bags, natural and cultured pearls, goldsmith jewelry, etc., used household products, etc. If the goods are getting transported in non-motorized vehicle, or if you are transporting HP man, alcoholic liquor for human consumption, petroleum crude, etc. If you are transporting those items which are not treated as supply as per schedule number 3, e-way bill is not required to be generated. Now, blocking the facility of e-way bill. The system will not allow you to generate e-way bill if you are a composition dealer has not paid the taxes for 2 consecutive quarters, a regular dealer has not filed return for 2 months or 2 quarters, or if you have suspended as per rule number 21A. Returns under GST. So, normal person has to file 2 types of return called as GSTR1 and GSTR3B. GSTR1 is your return for outward supply. GSTR3B is your summary return when you pay the taxes. GSTR1 is required to be filed by all the persons except non-resident taxable person, input service distributor, TDS, TCS person, OIDR, and composition dealer. Now, what is the due date of filing GSTR1, sir? If you are filing on monthly basis, the due date is 11th of next month. If you are filing on quarterly basis, then the due date is 13th of next month following the quarter. GSTR3B is a summary return wherein you give the details of outward supply and output tax, and you take the input tax. You also give the details of input tax as per GSTR 3B, and based on that you will pay your output tax liability and take input tax credit. Now, if you are filing on monthly basis, then GSTR 3B ka due date is 20th of next month. If you are filing on quarterly basis, then the due date is 22nd or 24th of next month. Other returns which we have is GSTR 4. Other returns which we have is GSTR 4, which composition dealer has to file. GSTR 5, which non-resident taxable person has to file by 20th of next month. GSTR 6, input service distributor has to file by 13th of next month. GSTR 7 is required to be filed by TDS person within 10th of next month. TCS person has to file GSTR 8 within 10th of next month. Annual return is required to be filed by you within 31st December of next financial year. And final return, if you close your business, you have to file a return called as final return within 3 months from the date of cancellation or cancellation order, whichever is later. First return is recorded filed by you for supply made from date of liable for registration till the date of grant of registration, which is recorded filed within 30 days from the date of registration. Yeah, that is all about what, sir? That is all about GST part. Now customs major important point, I'll tell you. What is that, sir? Major important point is valuation. Now remember one point over here. If you want to learn this entire thing in detail, meaning if you want to see DT along with questions, whatever we have done is, because of constraint of time, we have discussed the provisions, correct? It is just like on super fast revision which we have done. But if you want to understand every concept with an example for direct taxes, you see CA Inter Marathon. If you want to learn everything in detail for indirect taxes, including customs or especially for customs, if you don't know valuation chapter at all, then please go and watch CS Executive ka Marathon. Okay, because in this marathon customs law has been taken in detail, because those students had complete doubt in customs provision, so I have taken that marathon in detail, and there I had students. Here which I am doing, no, I don't have students in front of me, therefore it takes more energy for me to teach something. Anyways, customs law, valuation of customs, see, custom duty. Under valuation, 3 types of questions can be asked. Either they will ask you to find the assessable value, or they will ask you to find what is the total custom duty payable, or they will ask you to find assessable value and custom duty payable. Okay, so custom duty are levied on assessable value. So whatever assessable value is there, what is it? We will see that. On that I will levy custom duty. So first type of custom duty which I have is called as basic custom duty, which is assessable value into rate of basic custom duty. Then I should levy social welfare surcharge, which is, see, basic custom duty, assessable value is the main point. On that I will levy basic custom duty. Now once I get basic custom duty, 10% of this is always required to be levied as social welfare surcharge. And there are other types of custom duty like protective duty, safeguarding duty, additional duties. They may come, may not come. Normally it will not come. Normally it will not be available. Normally it will not be there. They are all levied on assessable value. So once you find assessable value, levy basic custom duty, social welfare surcharge. Now the amount which you get is called as landed value. On this landed value, on what amounts are? On this landed value, you will apply IGST rate and find IGST. On this landed value, you will apply GST compensation cess rate and find GST compensation cess. That the total of all this will give you total value of total value of imported goods. If the question asks you what is the total custom duty which you have to which you are liable to pay, total value of imported goods minus assessable value will give you the total custom duty, or add all these custom duties only. Now, sir, what is this assessable value? I understood that I should levy the taxes on assessable value, but what is assessable value? Assessable value or CIF value. CIF means cost, insurance, freight value. So, value of the goods, I should take the value of the goods at exporter ka factory price, meaning someone who is exporting me at his location in his country, what is the value of the goods. From there, he will send to his port and their loading will happen. Correct? No. For example, if I am importing goods from Africa, the goods are manufactured somewhere in Africa. So you take this value. This is called as value at X factory price. He will load in a truck. Then the truck will go to his port, and from there it will be loaded in the ship, and then the ship will come to India. So till this point, whatever expenses are there, you add that total is called as FOB value, free on board value. On this you will levy, add insurance and freight, that will give you cost, insurance and freight, CIF value. Now you got FOB value. On this FOB value you will do rule 10(1) additions. On this FOB value, what will you do, sir? Rule 10(1) additions. You will add commission. On this FOB value you will add commission, all types of commission except buying commission or purchase commission. You should not add buying commission or purchase commission. Add packing charges except durable and returnable packing charges. Add design and engineering charges if the design and engineering work has taken place outside India. Add royalties and license fee ka amount. Add free material supplied by the importer, add value of subsequent resale. Now, if you add these things, normally it will not be there. All the things will not be there. Commission and design engineering charges are normally available. If you add this, now what you get is called as FOB for customs. Now, whatever you get is called as what's a FOB for customs, meaning this is the FOB value for the customs department in India. Now, on this, to this you add actual cost of freight, you add actual cost of insurance. Okay, whatever insurance cost they have given, whatever freight charges they have given, add that. That will give you assessable value or cost, insurance, freight value. On this amount, you levy custom duty. Now, normally freight charges and insurance charges will be always given in the question. But if it is not given, then if cost of freight is not given, what is important for cost of price? Cost of freight for imported goods. If the goods are imported through sea route, then normally take freight charges as actual. Whatever freight charges is given in the question, take that only. And for if the goods are imported through air route, take actual charges or 20% of FOB value for customs, whichever is less. Okay, for if the goods are imported through air route, the freight charges cannot be more than 20%. Now, if the freight charges only they have not given in the question, if the freight charges is not ascertainable, then take it as 20% of FOB value for customs. Insurance cost, normally we need to take actual amount of insurance. But if actual amount of insurance is not given, take the insurance to be equal to 1.125% of FOB value for customs. These both amounts which we have just now discussed are important for your MCQ. Okay. Now, I understood, okay, how to find the assessable value, how to find the custom duty. Now, the amounts will be given in dollars. You have to convert them into rupees and then find the custom duty. So for conversion purpose, exchange rate you have to take. Exchange rate for conversion of foreign currency into Indian rupees. Exchange rate notified by CBIC should be taken. For imported goods, exchange rate as on the date of submission of bill of entry should be taken. For the imported goods, exchange rate as on the date of submission of bill of entry should be taken. And for exported goods, the exchange rate as on the date of shipping bill. Hey, please note, whenever you are importing something, you have to give a document to the custom officer, which is called as bill of entry. So on the date of submission of bill of entry, what is the exchange rate? That exchange rate should be taken. And for export, whenever you are exporting something, you have to give a document called as bill of export or shipping bill. That date, whatever exchange rate is there, that should be taken. Now, what is the custom duty rate which I should take, sir? The custom duty rate which you should take, if you are importing goods, for goods imported by you in India, the exchange duty rate, the custom duty rate which you are supposed to take is the bill of entry custom duty rate as on the date of bill of entry or as on the date of entry inwards, whichever is later. When you submit the bill of entry or when the entry inwards is granted by the officer to the ship, they'll tell the ship, please come inside. So either exchange rate as on the date of bill of entry or entry inwards, whichever is later. And for exported goods, exchange rate as on the date of let export order should be taken. And for export goods, normally they will not ask you to find for export goods. For export goods, you take the value of the goods at your factory. Let us say I'm exporting sari outside India. So what is the cost of manufacture of the sari at my factory? From there, I will send this to the port, Chennai port. So from my location to Chennai port, how much insurance and freight charges I have incurred and how much handling, loading, unloading charges is happening over in the port. That will give you FOB value. On that you should apply export duty ka rate. Yes, this is all about your indirect taxes ka marathon. Okay, this is all about your complete taxation ka marathon. I'll repeat once again, direct taxes, if you want detailed discussion or those who are writing in December and you feel that no, I want detailed discussion, watch CA Inter ka direct taxes. For indirect taxes, watch CS executive ka indirect taxes, because both of that I have taken separately in detail. Okay, anyways, I hope you enjoyed learning with me for last 10 to 12 hours. All the very best for your examination. Don't worry, examination will be very easy. You will definitely clear the examination with great marks. Hope to meet you soon in Vijayam or Jayam as soon as you qualify your examination. All the very best for your examination. Tata, bye bye, take care, enjoy.